Today coming in for the Indian markets, up almost 64 points as of now in a trade. So yes, we're going to be watching out for what is going to be happening in the Indian markets as well. Everyone's waiting out for those negotiations that could happen between the US and India as well. That will be key for our Indian markets. But as of now, Asian markets are buzzing because there are more trade deals that have taken place. Now, when you're looking at it in terms of the US market as well, it was the second day of record close that came in for S&P 500. But when you look at it, albeit marginally marking its 11th such close in 2025. Now, Dow Jones, meanwhile, that ended 0.4% higher. We're seeing that the Nasdaq witnessed cuts to close lower as all those tech stocks. That is something that weighed on the overall index. Now, this was the first negative day of a trade for Nasdaq in 7 sessions. So that is something that we'll be keeping an eye out on in terms of the US market. But how is all this going to be impacting our Indian markets? We have a team of research joining in with us to set us up for trade, important stocks to watch out for, as well as tell us what's going to be happening in the world of F&O. Gaurav as well as Sudarshan, good morning and thank you so much for joining in with us. But before I come to you all, I'm going to be setting you all up for trade, what we're watching out for. US markets, I clearly highlighted, how they've closed in trade. We do have some bit of a mixed opening that's coming in the closing that's coming in the US market. So Nasdaq weighed down by the tech stocks, but trade deals has kept the Asian markets on the positive front. Now, when you're looking at it in terms of the FII and DIIs, we're seeing that FII sold around 3,500 crores in yesterday's trading session, while DIIs were buyers of 5,240 crores in yesterday's day. Now, important to watch out for today, we have 2 block deals that's coming in the real estate space. Oberoi Realty and Macro Tech Developers or Loda Developers as we know it also. Keep an eye on that. 2 block deals expected here. One is Oberoi, another is Loda. The next one, keep an eye out on important earnings today. So we have Nifty earnings like Infosys, Dr. Reddy's, Tata Consumers that are reporting their numbers. And other than that, we have SRF, Coforge, Persistent, Syngene. All these will be reporting their numbers. So a lot of moves that we could be seeing coming in on these stocks on the back of the numbers. Important board meetings also. So these stocks could be in focus. IndusInd Bank, keep an eye out on that. Tilak Nagar Industries, that was buzzing in trade yesterday. We had a CNBC-TV18 exclusive that came in. Now, today they are meeting to consider a fundraising plan. Aditya Birla Real Estate, also a fundraising plan is over there, as well as Borosil Renewables. All these are what we are keeping an eye out on. Now, overall, when you're looking at it, Nifty yesterday had closed a bit flat. So we'll watch out for in terms of, whether this gain that we're seeing coming in for Nifty implied open, if that's going to be sustaining in the market. But that's how the setup is looking like as of now, implied open indicating a 69-point uptick. But Gaurav, which are the stocks that you are keeping an eye out on? A lot of earnings, a lot of news flow coming in as well.
Well, yes. Let me first highlight a few stocks which will be on our radar on the back of the earnings. So first, let's talk about Dixon Tech. Inline set of number. In fact, when we look at the net profit, that has increased almost by 68% on a year-on-year basis. Now it stands at around 225 crores. Other than that, JSW Infra also came up with good set of numbers. Profit increased almost by 31% on a year-on-year basis. And what remains a key thing is that the management said that they will be aiming to grow volumes by around 10% in FY26. Paytm actually came up with very good set of number. In fact, this was the first quarter when we saw operationally Paytm actually reporting profits. They reported profits of 122 crores versus the losses of 839 crores just a year ago in the same quarter. And EBITDA margin also, if you look at it, it is at around 3%. KEI Industries also came up with good set of numbers. In fact, profit was actually higher than what the street is expecting. It increased almost by 30% and now it stands at around 195 crores. United Breweries, on the other hand, actually reported profit which was a little lower than the street's expectation at around 184 crores, whereas the street was expecting number to remain at around 200 crores. Margins have also come down a little to around 10.8% on a sequential basis. Let's also not forget about Credit Access Grameen. Now, when we look at the numbers, they look down because the profit has gone down almost by 85%. It was in line with what the street is expecting, and what remains a key thing is that the credit cost has come down. So that is something which can push the stock today. Other than that, let's also watch out for Hyundai India because company has received GST demand worth 258 crores for non-payment of compensation cess. And there are 2 stocks which will be on our focus on the back of the sources. First is Oberoi Realty because block deal is likely to happen here where some investors may sell around 3% of the equity at a price of 1,753 rupees. And second is Loda Developers. This is also a candidate where block deal may happen. 1% of the equity is expected to change hand at around 1,384 rupees per share.
Okay, Gaurav, thank you so much for that. But finally, Sudarshan is here and waiting by to tell us what are we watching out for in the world of F&O. Good morning, Sudarshan. You know, yesterday was a muted day, but these trade deals coming in, are we expecting anything exciting in the world of F&O?
Good morning, Vinny. So we are back to a range-bound day of trade. Yesterday, we saw that Nifty manages to hold on to levels for 25,000, but after trading in a range that like from 24,900 to 25,100, finally it ended above 25,000. So now bad part is FIs continue to build positions on the short side. Now there is a positive part as well. If there are positive news related to earnings, if there is any, we might see a short covering and that will be very sharp. Now, GIFT Nifty for today is indicating a positive start, currently up around 60 points following the positive cues and all the trade deals that US President has announced. Now, talking about the flows, yesterday again we saw DIs buying and FIs selling. FIs have sold more than rupees 3,500 crore, DIs bought more than rupees 5,200 crore. But the interesting data is on the derivative side. Now, in the index futures, FIs have sold almost rupees 800 crore. They have reduced long positions of around 1,300 contracts, and also they have added short positions of almost 3,000 contracts. Now, FI long exposure has reduced to almost 14%. So it indicates you that if there is a positive news flow in the Indian market, there can be a short covering and it will be very sharp. Now coming to the option side, 25,200 call was the most active one, but again 25,400 call has also seen addition, and here the addition was almost of 26 lakh shares. On the put side, 25,050 put was active, and after that 24,800 put has been very active. That's the reason support remains around 24,880. That is the day before yesterday's low, and resistance remains around 25,300 or slightly above that. That is 20-day moving average. Now stocks in the focus, two stocks remain in the bank. Those are RBL Bank and Bandhan Bank. IEX has entered in the band yesterday, and also keep an eye on two stocks. Paytm. It has reported operationally positive. Its EBITDA has turned positive for the very first time. Stock has been at near to 52-week high, but it has seen a sharp recovery. It's up more than 100% from its recent low. And also another stock is M&M Finance. It has been trending lower in the last few sessions, but earnings are not that bad. So keep an eye on these two as well.
Okay, we'll keep an eye out on all the stocks and what are the levels to watch out for the Nifty as well. Thanks so much for that, Sudarshan. On that note, let's slip into a very short break, and after the break, we'll get you the updates from the White House in our special segment, Trump Watch. Stay tuned in for that. Welcome back. Thanks for staying tuned into Power Breakfast on CNBC TV18. Now getting you those latest updates, and especially those Trump-related updates and developments that we have overnight. Dia is joining in with us in a special segment, Trump Watch. Dia, over to you.
The United States has agreed to a trade deal with Japan, which would see a 15% US tariff on Japanese goods. The plan would result in Japan investing $550 billion into the US and paying a 50% reciprocal tariff. Listen in.
We just signed the largest trade deal in history, I think maybe the largest deal in history, with Japan. And that was done with Japan. They had their top people here, and we worked on it long and hard, and it's a great deal for everybody. I always say it has to be great for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that. But we're doing really well as a country. We're strong.
And Japan isn't the only country in focus. The White House also confirmed that Indonesia will ease export restrictions on critical minerals as part of a new trade deal with the US. Trump called it a huge win for American companies. Now, the deal also lowers a threatened US tariff on Indonesian products from 32% down to 19%. The U.S. has also reached a trade pact with the Philippines. President Donald Trump said Tuesday, adding that the deal will see the U.S. tariff on goods from the Southeast Asian country lowered to 19%. And in a sharp escalation, Donald Trump on Tuesday accused his predecessor, Barack Obama, of treason and called for his prosecution over a report alleging that officials in the Democrats' administration manipulated information on Russia's interference in the 2016 elections. Listen in.
If you look at those papers, they have them stone cold, and it was President Obama. It wasn't lots of people all over the place. It was them, too. But the leader of the gang was President Obama, Barack Hussein Obama. Have you heard of him? And except for the fact that he gets shielded by the press for his entire life, that's the one they... Look, he's guilty. It's not a question. You know, I like to say, let's give it time. It's there. He's guilty. This was treason. This was every word you can think of. They tried to steal the election. They tried to obfuscate the election. They did things that nobody's ever even imagined, even in other countries.
Moving on, the U.S. announced it will officially withdraw from UNESCO, the United Nations Cultural and Education Agency. Now, the move, according to officials, comes in protest of what Washington describes as an anti-Israel bias and the promotion of divisive causes. And lastly, a new investor filing from SpaceX reveals Elon Musk may re-enter politics. Now, the tender offer notes that Musk, who previously served as a senior advisor to Trump, could take on similar roles again. That's all for today. Now back to you.
Okay, Thea, thank you so much for that. Those are the important updates coming in there. But do not forget, President Trump has also plans to impose tariffs on imported medicines to push drug companies to cut down on the prices. He adds that the companies will face problems if they do not agree. Listen in.
We're going to get the drug prices down, not 30 or 40%, which would be great, not 50 or 60. No, we're going to get them down 1,000%. 600%, 500%, 1,500%, numbers that are not even thought to be achievable because I've used a certain talent that I have and convinced the drug companies that you have no choice. The drug companies were selling drugs, same company, in Europe and other places, based on what Europe told them to sell them at. And they said, let America pick up the difference, and I wouldn't let it happen.
And in the ongoing tussle between the White House and the Federal Reserve, Trump said that Jerome Powell will not be there much longer. Listen in.
I think he's done a bad job, but he's going to be out pretty soon anyway. In eight months, he'll be out. But I call him too late. He's too late all the time. He should have lowered interest rates many times. Europe lowered their rate 10 times. We lowered ours none. And it's causing a problem for people that want to buy a home. Look, our economy is so strong now, we're blowing through everything. We're setting records. You know that, you see that. And whether it's the Philippines or anyone else, we're setting records at levels that nobody's ever seen before. But you know what? People aren't able to buy a house because this guy is a numbskull. He keeps the rates too high.
While speaking to CNBC, the Federal Reserve's Vice Chair for Supervision, Michelle Bowman, spoke on the importance of maintaining independence with the monetary policy. Listen in to what she had to say.
It's very important, and I've said this a number of times in the past, that we maintain our independence with respect to monetary policy. I think that's very clear. But we also, as a part of that independence, have an obligation for transparency and accountability as well. But we also have an obligation, in my view, as we have throughout the time that I've been here on the board since 2018, to listen to a broad range of voices and to understand how others are viewing the economy and how that should influence our decisions in monetary policy making.
Meanwhile, the former Treasury Secretary and Fed Chair Janet Yellen talks about how market relies on the Federal Reserve's independence as well. Listen in.
Markets rely on the independence of the Fed and the Fed's commitment to achieving its congressionally mandated goals of price stability and maximum employment in assessing the soundness of the U.S. economy and their security in terms of returns they can expect investing in the United States. This is really disconcerting to markets, and what we've seen throughout history, both U.S. history and history around the world, is when that kind of pressure drives monetary policy in a country, high inflation is the inevitable consequence.
Okay, on that note, we're going to slip into a very short break, but don't go anywhere. After the break, we'll get to what is happening in the world of commodities. Stay tuned in. Welcome back to Power Breakfast on CNBC TV18. Now, the Indian cabinet has approved a free trade agreement with UK, and that is set for signing on 24th of July in London. Parikshit is joining in with us to give us the details on this front. Good morning, Parikshit. That much-awaited deal that has come in and now the final signing. So what are we watching out for here now?
Well, Prime Minister Modi is set to leave for the UK today. He's going to be there in London tonight and tomorrow. He will be holding bilateral and delegation level talks with UK Prime Minister Keir Starmer. He will be calling on King Charles III. The highlight of this visit would, of course, be the signing of the India-UK trade deal on the 24th of July. Now, this is a far-reaching agreement which will cover 99% of goods traded between both countries. UK's Scotch whisky, UK's cars would get easier access to the Indian market at a lower tariff regime, although there will be graded reduction in tariffs and there will be quotas over the years. Secondly, this is an FTA that will benefit India's labor-intensive sectors, especially textiles, gems, jewelry, engineering goods, chemicals, auto parts. They will benefit. Even services exports from India in the IT services, financial services, professional services, education, they are likely to benefit in a big way from the FTA. According to the Indian government, this FTA it has been designed in a way to benefit Indian farmers, fishermen, workers, MSMEs, startups, and innovators as well. We must highlight that agriculture and dairy have been kept out of this FTA, and this FTA will now, in a way, be a precedent, be a template for India in other negotiations with the EU and also with the United States.
Okay, Parikshit, thank you so much for that. Important updates coming in here. We'll keep an eye out on more over there as well. But let's go across to Manisha, who is here to tell us what are we watching out for in the world of commodities this morning. Good morning, Manisha.
Morning, Vinny, and thank you for that. Well, I absolutely want to start with silver because that really is the biggest headline right now in commodities. In the international markets, we are trading at a 14-year high. For the Indian markets, we are trading at an all-time highs above 1,15,000 rupees a kg. Well, with China Ministry pledging growth in auto, electric equipment has been supportive. We've also seen the gold prices gain quite strongly. And then you have the dollar index, which has seen a decline, including the U.S. Treasuries as well, which have continued to weaken. That has been supportive as well. Markets also looking at stronger industrial demand and then safe haven buying because you still have concerns on EU-U.S. trade deal. The U.S.-China meeting next week is something that the markets will keep in focus as well. But it's not just about silver. Almost everything in metals is trading on a higher note. We've seen 2 to 2.5% of gains in steel, in copper. The gold price is also gained up by a percentage point, and we are looking at multi-month highs continuing for many of the industrial commodities because of stronger Chinese data and China's pledge to support infrastructure projects. So metals clearly should be on your screens.
Okay, metals are something that we're watching out for. Metals not losing their sheen and silver continues to shine. Thank you so much for that, Manisha. But that's all the time we have on this edition of Our Breakfast on CNBC-TV18. Nifty implied open, indicating a positive start for the Indian market. Don't go anywhere. Your Bazaar Morning Call up next to take you through all those actions.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. But I think the Japanese are happy a lot today, this morning. But lots to talk about, as always. Single stocks more in focus than the broader market, I reckon. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi guys, good morning. This morning, reading all of those trade deal developments across Asia, I kept seeing, is there India somewhere? Is there India somewhere? But no, we're still waiting. But a lot of other Asian, countries maybe are slightly relieved, if nothing else. But at least there's some finality to it.
Well, that's right. And, from the music world, Ozzy Osbourne, rest in peace, dreamer. And, no chance to dream nowadays. But, legendary singer.
Absolutely. And,
many memories. Yeah.
Absolutely. We'll maybe remember him through the course of the day. But for now, let's just sort of take it from the top with regards to markets and how they are tracking. Well, in terms of price action, there is not much. If you just look at what the US market left us with. So quiet kind of day. NASDAQ was down about 0.3%. Nothing very much. The S&P was flattish. NASDAQ was down about 0.39, 0.4. The dollar index continues to weaken, right? So you basically have yesterday, in 2 days, the dollar is down about 1%. This is the broader dollar. And we're now at about 97.46. US-Japan trade deal was announced. And, Japanese goods will face a 15% import levy and see Japan invest about $550 billion in the US. So this is the basic broad deal which has been announced. It is unclear at this stage if Japanese auto and parts would receive a carve-out. Remember, the number which was doing the rounds for auto imports into the US was 25%. So, will Japanese auto exports into the US receive that carve-out? We don't know. By the way, on the Truth social media platform, President Trump said, well, US autos also will get a big footing in Japan. But the point is, the traffic with regards to autos is out, not in. Japanese autos sell hugely in the US, but, the US cars are not very popular in Japan. So, that's just something to note as an aside. By the way, Toyota stock has jumped about 10%, and other Japanese car makers are also higher on the back of expectation, and I think clarity, etc., will come that these are essentially being carved out from the 25% tariff because of the deal, the broader deal, which both countries have struck. On other tariff news, Philippines essentially got a 1 percentage point decrease in their tariff rate as opposed to what they got in the letter. So it was 20%, it's now gone to under 19%. Not very much, right? US-China talks, and this is the Treasury Secretary Scott Bessent who confirmed that the US-China talks will take place next week. July 28th and 29th is when the next set of talks will take place. He also, by the way, talked about Fed Chair Powell. He said, well, there's no reason for Fed Chair Powell to step down. His term ends in May. He can continue till then. If he wants to step down before that, it's his choice. He kind of left it out there, but basically saying that there is no reason for him to go. President Trump, by the way, continued, in a way, his criticism. He said, well, Powell, and I'm paraphrasing, is going to be out soon anyway. That is next year. And, of course, he'd like rates much lower going forward. The market, how's the market responding? You got a bit of excitement here in Japan and Japanese stocks, etc. But otherwise, it's been largely quiet. Yesterday, it was a bit of a drift down that we had across the board. Nifty, the Nifty Bank, the broader markets as well. So levels have not really changed very much, except, the intraday spike, especially in the Bank Nifty, did take out the earlier high. But beyond that, not very much. The Nifty first, support 24,882 does not change. And the resistance comes in same levels, 25,255, which is the recent high. And then the 61.8% retracement, which is 25,369. And for the Nifty Bank, the support does not change, 56,204. But yesterday's high, because we had a bit of the index did zoom up a little bit, 57,286 is that level. So that's the first kind of very near-term resistance which the Nifty Bank needs to get above. So still, I think we are in a bit of a confusing phase. Not very clear if we are in the early phase of a bit of a bounce. It did look like that yesterday morning, but didn't really follow through. We'll need to give it a day, 2 days more to get this sort of confusion cleared, hopefully. GIFT Nifty is indicating a 70-odd point higher start. And I think based on that, if you're able to build on and get above some of these levels that are put out, the resistance levels, very, very near term, I think you're going to start to bet on the fact that maybe the market goes up before it does anything else. Surabhi.
Absolutely. It's all about trade deals this morning. And actually, Asian markets are feeling pretty good. It's the Nikkei that's surging the most. That market's up over 2%. But even other regional markets, they've picked up. Look at the Hang Seng. It's about 0.5% higher. Look at the mainland Chinese market. The Shanghai Composite is also up 0.25%. Australia is higher. So all Asian markets are rising. Whether we will be in step with this feeling or not, we'll find out. It's all about, of course, those trade deals and tariffs. This deal finally getting done. Remember when the earlier announcements had come, those blanket tariffs, and Japan had been handed out 25%. So from that comparison, 15% is looking much, much better. And those stocks, by the way, I just checked Toyota, Nissan, Mazda, Honda. Those stocks are up anywhere between 7%. Some of them are up as much as 16%. So Japanese automakers are really surging. In the last 2 months, Japanese exports to US had come down significantly, more than a 20-25% sort of a decline. So the hope is some of that will start getting reversed as there's finality on this deal. Of course, Mr. Trump is also saying it's going to be a great deal when it comes to jobs. Actually, let's hear him out on this mega trade deal that has been signed with Japan, and then we'll talk about the others.
We just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. And that was done with Japan. They had their top people here, and we worked on it long and hard, and it's a great deal for everybody. I always say it has to be great for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that. But we're doing really well as a country. We're strong.
Okay, so agricultural products, American cars and trucks, that's what he's planning to push into Japan. We'll see where that goes. By the way, beyond Japan, we're talking about the Philippines deal as well, where the tariff level itself hasn't changed too much. It was 20% earlier, and now it's 19%. But Mr. Trump is talking about a bigger military engagement with Philippines as well as part of that deal. So that's gotten done. And the framework with Indonesia has also been declared with clarity. So 19% tariff on Indonesia as well. By the way, no incoming tariffs or no tariffs on US imports coming into either Japan or Philippines or Indonesia. So it's a one-way street. Tariffs only when goods are moving to the US. By the way, Mr. Besant has made it clear that the US could be rolling forward the deadline, that 90-day pause window with China. That window otherwise would expire around the 12th of August, but he's already given an indication that that could be extended as talks with China continue. And he himself is going to be meeting with his Chinese counterparts in Stockholm next week. So watch out for more headlines on the China-US trade deal as well. And with Europe, well, Mr. Trump has said a deal is coming tomorrow. So let's see. Lots of deal talk. India is nowhere in the picture. That's the short point. We continue to focus on our individual local news flow and earnings. Within that, the market has been extremely range-bound. The Nifty finally at least holding on to 25,000. That's been the good story. Let's talk about the flows. And there's a lot of FPI selling that we're consistently getting in India. It's been offset by, of course, a lot of domestic buying. But look at that. This data would also be skewed because of the large blocks that happened even yesterday in some of the stocks like 361 WAM. But for what it's worth, domestic buying of over 5,000 crores, FPI selling of over 3,500 crores. That's something to keep in mind. In terms of individual stock action today, like I said, more about news, earnings, just some names. Dixon, the market's been watching for those numbers, very steady, absolutely in line. KEI Industries, another strong performance from a wire and cables play, very similar to what we saw in some of the other names like Polycab as well. So it's looking good. Margins, you can quibble. Margins have come down a little bit, but that's KEI. Paytm has finally turned in positive on the EBITDA front and on the PAT front. So we'll get more details around this as we go on. And as always, as block deal action, I mean, we're learning from sources. Vivek has been picking this up, that there could be large blocks in a couple of real estate names like Oberoi and Macrotech today. So we'll watch for this. So Nigel, my guess is that while the world works around the trade deals, we'll still keep looking at individual stocks here.
Well, Trump kept talking about making America great again. Just looking at the Japanese market, it appears Japan as well is becoming great again because the kind of rally that we're seeing out there, stocks flying between 5 to 10%, and the index itself is up and about. Coming back to our markets, the data points that we got yesterday, there were mild shots that were added into the system. in both on the index futures as well as stock futures. Some of this will be an arbitrage, but there were some shorts that got into the system, which isn't such a bad thing. And post the short edition, the FI net short positions, well, last is at around 86%. It continues to hold, at around that 86%, and now the short positioning, net short positioning, has gone to around 1.5 lakh contracts. I think we play out the expiry and then we brace ourselves for a bit of a bounce. At around 1.5 lakh contracts, normally you should see a bit of a bounce. And the PCR as well has come down. It's holding at around 0.84 odd. At around 0.7 is where we see a bounce. The reason that we are seeing that the PCR has come down because, call writing has been very, very aggressive. From both the big participants, the clients as well as the FIs, the number of calls written are way more than the number of puts. So telling you that the call writers, they feel that higher levels are going to be protected. So what are the levels? Going by the action that we are seeing, at around the 22,200 call, where more than 50 lakh shares are getting added. The premium has come down to around 29 rupees or thereabouts. Aggressive writing being seen out there. While at that 25,050 put, there is mix of activity and there was only 12 lakh shares getting added out there. Going by the options data, since the 25,200 calls saw writing, the near-term resistance comes in at around 25,250. So that range of around 25,250 to around 25,325, which is a 20 DMA, that becomes a crucial resistance mark. On the downside, the recent low becomes your reference point. For the time being, it appears we're in this range of around 400 points. Given that today we'll have Infosys' numbers, I'm going to keep an eye out on some pre-positioning on the IT pack. Because remember, that index actually has been a rank underperformer. Infosys is one of the few large cap names that could deliver some kind of growth. And there is an expectation that they go ahead and they increase their guidance as well. That's what the street broadly estimates. But I'll watch out for some pre-positioning on this particular index, the IT index, whether or not we see a bit of a pop towards the end. Keep an eye on that. In terms of stocks that I'm looking at, well, you have Godfrey Phillips. That's going to be a stock that I'm looking at because you saw big delivery-based buying. The stock has crossed that 20 DMA and it's very close to its 52-week high as well. And yesterday there was a good amount of delivery-based buying. Philip Morris, in fact, they came out with their set of numbers and on the whole it looked disappointing. But the commentary on the India business actually was quite positive. So I'll keep an eye out on Godfrey Phillips for today's trading session. Let's see whether or not the street reads a little bit into that. And the other one that I'm looking at is purely sentimental in nature since the Japanese stocks are doing very, very well. Jacket India has not done much in the last few years or so, but it's got that Japanese parentage as well in there. So maybe some kind of positive sentiment rub-off. We'll keep an eye out on this name.
Nigel, thanks very much for that. So Japanese auto angs are doing well. Drew Pettit is Director, US Equity Strategy and ETF Analysis and Strategy Research at Citi. He's with us now on the program. Drew, good morning. Great to have you back on the show. Thank you very much for your time. Deals are coming, not just here with India. And I think we reported yesterday that a deal is unlikely before the 1st of August, and another US team perhaps comes here, post that deadline, and talks will continue. Drew, I mean, what's your sense? I reckon generally overall market assessment of where tariffs will finally settle are rising and have risen quite fast over the last few weeks now. They were consensus was, I think, around between 10 to 15%, closer to 15%. That number is now closer to 20%. Would you agree, Drew?
I would say it's shifting, but we're not all the way back to where the numbers were on Liberation Day. So I think the deal and the news we're seeing right now, Japan on Liberation Day was looking at about 24% tariffs, 15% is a win, in a sense. What has shifted? While we do think tariffs are probably drifting a touch higher versus our expectations, leading into all of this, we actually have some tailwinds now with the Trump administration signing the One Big Beautiful Bill law. So there are incentives for businesses that are investing in the United States. It'll show up as tax tailwinds that offset some of the tariff headwinds. Even if they come in worse than people have kind of modeled, if they're better than Liberation Day, you see that counteracting with the tax bill passage. It's mildly more positive than really how a lot of us were thinking, but let's call it 3 months ago.
Hi, Drew. Well, in the midst of all of this, the market's just surging along, right? And you can't blame it because earnings have been good so far. The big banks have been good. We'll see how the tech guys do now. But what's your sense? Further upsides for U.S. equities?
So it's funny, I have to answer this question in two parts, to be honest with you. Tactically, more short term, the market looks pretty fully valued. Sentiment's pretty stretched. Investors are paying a pretty high multiple for those earners, for those good earnings stories. So a little bit of tactical pullback here in the United States should be expected. Return were positive, so we really think you should be buying into that, especially for the growth names in the U.S. To put it really simply, we'd be buyers of U.S. growth on pullbacks throughout this earnings season.
Okay, so you'll be buyers on any pullback. Just on back to Japan, because now this seems to have settled and finally at least there's a rate and it's 15%. And maybe it's not as bad as what the other countries get. Do you expect this to lead to major flows out back into Japan? Remember, it was a couple of quarters ago. I mean, the money moving into Japan was a big trade. Do you see that coming back?
You've actually started to see it ahead of this. When I was looking at last month's ETF flows, maybe not Japan-specific ETFs, but you're finally seeing at least American investors buy non-US stocks. You know, going back a month, the flows into non-US listed ETFs, so thinking international equity from an American investor perspective, were about the fourth highest they've ever been on a monthly basis. We're seeing that at the same time we're finally seeing deceleration in US flows. So the flows were happening ahead of this. Could better than feared news continue that flow pattern? To be seen this month, but the tide was changing heading into this announcement.
Hi, Drew. Good morning. Good to see you, Ben. What about emerging markets? I believe China and Korea, they are your top bets out there. India is not making it. Cut to neutral.
Well,
Drew, bring us back to reality.
So we'll stick with China and South Korea to kind of kick this off. You're finally seeing good earnings growth revisions here. So that's been a real big driver to the house call around emerging market allocations. So South Korea, China upgraded. Again, both of those really do play to AI and kind of secular tech themes beyond just kind of the country-specific economic drivers. On India, downgraded to neutral. This is a really interesting story because you finally have some settling out of earnings downgrades. You have a good domestic economic story, but you're already paying a lot for that. So again, holding India exposure at neutral, not cutting it to underweight. It's just recognizing that it has been a good story and markets are pricing that in.
Got it. So more, and in terms of downsides at an index level, Drew, here in India, I mean, did you put something out as part of that call?
No, it's honestly maybe take some profits here, keep that allocation closer to more what a benchmark weight might be, and then buying, again, some of the secular growth stories that maybe markets have kind of forgotten about. Honestly, the trade really, if you're going to boil this down, whether it's EM or just international more broadly, is we can go get AI names in some of these regions at valuations that are much cheaper than what you see in the United States. So the AI trade is broadening, and big benefits of that are going to be in China, South Korea, and Taiwan, which Taiwan at its price is actually a neutral in our EM country weights.
By the way, tonight, Drew, is going to be a big day, right, for AI? I mean, isn't that President Trump going to talk about winning the AI race for America? I think the summit is called that, with David Sachs. I think that's happening later today in the US morning. So I don't know what will be announced, etc. But should be interesting to hear from him. Thank you very much for joining us, Drew. Great to speak with you. Thank you for your time as always. We'll take a quick commercial break here. We're going to come back with our top 10 list. But let me just quickly run you through what's coming up here over the next 2 hours or so. So lots of companies, right? 8:35, you'll hear from the management of IndiCube Spaces. Lots of co-working companies getting listed. So this is a 700 crore issue. 9 o'clock, you'll have Anurag Bhatnagar of the Leela Spaces Hotels and Resorts for their first quarter numbers. 9:20, Dheeraj Agarwal of Ambit will be with us. 9:30, we'll have the management of KEI Industries to talk us through their performance. Saurabh Gupta of Dixon joins us. We spoke with him recently, but this is on the back of the numbers. A little later at 9:50, Manoj Kumar Dubey of Indian Rail, IRFC, will be with us for their earnings. And towards the end of the program, Lata in conversation with Santanu Chakrabarti, BNP Paribas, on banking numbers.
Slip into that short break. A lot of stock-specific action to track for you in our top 10 segment. I give you a sneak peek into the list. Dixon, United Breweries, JSW Infra, Paytm, Dalmia Bharat. They'll all be reacting to positive news flow. But add to the list, KEI, Credit Access Grameen and IRFC. We have two large trades that we're looking forward to. The real estate companies, Oberoi and Lodha, will be in focus as well. Take that break, come back, get into further detail on all of them.
Welcome back. So we've been telling you that the picture across Asia is actually really good this morning. The Japanese market is leading from the front with a gain of well over 3% now. The others are not doing too bad. There's a fair amount of green. Taiwan, Hang Seng, mainland China, Australia, most markets in positive territory. Let's see what that means for us. The implied open is, coming up on the screen. So maybe we'll have a positive start. But how much can that pop be? Let's see. 70 points. That's what we have right now. Will help the Nifty get back above the 25,100 mark at least. A lot of individual stocks to track as well. Lots of news flow, earnings. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Let's kick it off. Upasana, with you then. Dixon, inline set of numbers?
Certainly, Surbi. Good morning. The company has reported in-line set of numbers. Company's revenue, PAT, EBITDA margin, all in line with our poll. Now, mobile segment continues to drive growth for the company, even in this quarter as well. Coming to the numbers first, revenue stood at 12,835 with an uptick of 95% on a YoY basis. EBITDA stood at 482 crore with an uptick of 94%, which transpired into a EBITDA margin of 3.8%, which was largely flat on a YoY basis, and PAT stood at 225 crore with an uptick of 68%. Coming to the gross margins, there is a downtick of nearly about 110 basis points here. This is mainly because of the change in the product mix of the company. Now, revenue surged nearly 95%. This is largely driven by the strong growth seen in the mobile segment as highlighted earlier. And there are few changes in the product mix of the company. Company's revenue contribution in mobile and EMS segment has increased significantly from 79% to 91% on a YoY basis, while the company's revenue contribution in other three segments, namely consumer electronics, home appliances and lighting, has decreased on a YoY basis. So all in all, looks like a good start of the year for Dixon Technologies.
All right, thanks for that, Upasana. In fact, we'll be joined by Saurav Gupta of Dixon Technologies. He'll be chatting with us at 9:40 a.m. to detail the past quarter's numbers. Little early in the morning, but time to get to United's breweries. Mangalam joins us to tell us about those numbers. Mangalam?
Good beers, Nigel. Premium beers doing
not
extremely
contributed,
well.
but they have done. The numbers look good.
I reckon you've contributed, and I'll tell you why as well. Premium beers doing very well. The overall volume growth has come in at around 11%, but it's led by premium volumes, which have actually rallied 46%. Most on the street were working with a number between 20, 25, some above 25, but 46 on a base of 47% volume growth definitely goes down well. What doesn't go down well is, despite this rise, there has been lower than expected rise in EBITDA and the net profit. So if you look at the revenues coming in at nearly 2,800 crores, much above street expectations of 2,750 crores, EBITDA at 310 crores, slightly lower than street expectations of 320 crores, and as a result of which the net profit too has fell shy of street expectations by about 15 crores odd. 11% total volume growth, so that's a positive because it's a double-digit volume growth for the first time in the last 5 quarters or so. And the street was working with a number of just 6 to 8%. Why is that? Because premium volumes, they grew by 46% versus expectations of 20 to 25% growth. The company said they saw continued traction for Kingfisher Ultra, Amstel Grand, as well as Heineken Silver. And volume growth has been driven mainly by Uttar Pradesh, Andhra and Assam. And the reason why I pointed at you, Nigel, because you traveled to Uttar Pradesh and I know that.
I was wondering, yeah, I heard the brands. I don't think Nigel's contributed there, but yeah, the UP angle is a solid one. I agree. Okay, all right, Mangalam. Thanks so much. But let's quickly go on to Vivek as well. He's watching out for earnings from JSW Infra. Vivek, good morning. How are they?
Good morning. A slightly soft start to FY26 as far as JSW Infra is concerned. But the good part is in the conference call yesterday, the management went ahead and retained that 10% volume guidance for the full year. Now, looking at the numbers themselves, the revenue is higher by 21.2%. The EBITDA was up 13%. Higher operating expenses up almost 36%. Dented the core EBITDA. EBITDA margins also on the back of that contracted on a year-on-year basis at 47.5%. Profitability, however, perked up almost 31% on a year-on-year basis. Now, the total cargo volumes that were handled were up 5%. And along with that, 2 confirmations from the management, in post the results. Number one was that the company has received the LOA for the redevelopment as well as mechanization of 2 container berths at Kolkata, and along with that has signed a binding MOU with Konkan Railway Corporation for the development of railway siding in Ratnagiri district. So overall, a good set of numbers coming in from JSW Infra. Soft start, but despite that, execution has been quite good, and guidance maintenance is something that the street will like.
All right, Vivek, thank you very much for that. Paytm is the next one. Numbers look good. Gaurav has got more. Gaurav, morning.
Well, yes, Paytm definitely looks good for the trade today, and the reason being that company has turned profitable for the first time if we exclude the exceptional items. Now, let's not forget, in Q2 FY25, actually company had reported profits, but that was because of the exceptional items. But in this quarter, they have reported profit, and this is on the operational basis, and this is specifically because of the reduction in cost. So first, let's understand the numbers. Revenue that has remained flat on a sequential basis, but direct expenses, now they have gone down almost by 9% on a sequential basis. As a result, when we look at the contribution profit and contribution margin, that has increased. Contribution profit has increased almost by 7.5%, and contribution margin has increased to around 60%, which is higher more than 400 basis points. Other than that, when we talk about indirect expenses, there also we saw a bit of a fall. 19% fall is what we saw in the indirect expense. As a result, we saw EBITDA was also up. Let's also not forget that in this quarter, ESOPs were low. They were only at around 30 crores versus what it was earlier. It was down almost by 82% on a sequential basis, and as a result, we saw EBITDA actually also turned positive even after ESOPs. Now the EBITDA margin stands at around 4%, and as a result, when we talk about profitability, that has also come up. Now company has reported profit of 123 crores. So definitely a positive number for Paytm in this quarter.
Okay, all right. Positive number coming out of there. These new age companies seem to be turning things around in this quarter. Thanks a lot for that, Gaurav. I'm looking at Dalmia Bharat. The stock is at a fresh 52-week high, and it's seen a big surge in the last few days. The numbers, they look good. So if you look at the revenue number, well, that's more or less in line. A little bit of a miss out there because the volume number is disappointing. It was expected to be soft, and it is a little bit softer than expected. However, the EBITDA number is a little bit better than expected, telling you that the realization factor out there has weighed in their favor. And take a look at the EBITDA per ton. Last couple of quarters, even if you look at it on a year-on-year or even on a sequential basis, it's sub that 1,000 rupee mark. Now it's clocked 1,260 rupees, telling you that the realization has improved. the focus on cost as well are playing out, and that's why you're seeing such a big surge in the EBITDA per ton. The volumes, they were a tad bit disappointing, though. They contracted by around 5%. Even X of the JPA volumes, because now it's not a part of the company, which was around 0.4 million tons. It's more or less flattish, which indicates they're not growing as much as what the industry is growing at. The blended realization, though, that was the positive, was up close to 9% on a sequential basis. And they've set out their path from around 50 million tons. They're going to be a 75 million ton plant. And to do this, they've laid out a capex, which has come at roughly around $65 on a per ton basis. It's going to be at Andhra Pradesh and Tamil Nadu, 6 million ton of cement and 3.5 million ton of clinker. Put everything together. Well, going with the green on this one, though you need to keep in mind the stock has already seen a big run in the last few days. Let's go to Upasana, though. She's here to tell us about KEI Industries. Upasana?
Well, it's a good quarter for cables and wire companies, and KEI Industries is no exception. Well, the company has reported a good set of numbers. Revenue and PAT is above pole, while EBITDA margin is largely in line. Now, when we look at the Q1 revenue growth, it stands around 26%, which is higher as compared to the company's full year guidance of 17 to 18% for FY26. So let's see what bodes for the company in terms of the full year basis. Now, coming to the numbers first, revenue stood at 2,590 with an uptick of 25%. EBITDA stood at 258 crores with an uptick of 18%. EBITDA margins were down nearly about 60 basis points at 105. At 10.5, beg your pardon. PAT stood at 195 crore with an uptick of 30%, and gross margins fell by 240 basis points on a one-year basis to 23.8%. This is likely due to lag in passing of the commodity prices. Now, when we look at the cable and wire revenue growth specifically, it stood at 32%, which is much higher as compared to Havells, which reported a growth of 27%, and Polycab, which reported 31% on a one-year basis. So KEI looks like ahead of its peers as of now.
All right, the management will be speaking with us at 9:30. So Mr. Anil Gupta, as always, after the numbers on the channel to talk about earnings. Well, let's go back to financials. Credit Access reported numbers, and IRFC as well. IRFC is another management you'll hear from in the next hour and a half. But Gaurav, numbers first.
Well, yes, Credit Access Grameen came up with the numbers. Now, when we look at the numbers on a standalone basis, they look a little weak because profit has declined almost by 85%. But let's not forget, this was actually expected from the company. What remains positive for this quarter is that net interest margins, now they have increased almost by 10 basis points because there is some benefit from cost of funds. And second is that the credit cost, now that has come down almost by 40 basis points. Now it stands at around 9.2% on an annualized basis. So that was something which is positive. Going ahead, management is also saying that credit cost guidance is given at around 5.5 to 6% for the year. They also believe that the PAR portfolio, which is the early delinquency portfolio from Karnataka, is likely to come down. So definitely positive commentary there. Second company, which is IRFC, there also we saw a good set of numbers. Profit increased almost by 10% on a year-on-year basis. Now, what remains a key thing here as well is that the net interest margins, now they have improved to around 1.53%. This is an improvement of around 11 basis points on a sequential basis. And let's not forget that the company has maintained its NPA profile at just 0%. Now, let's also not forget that this is a company where employee cost is just 0.1%. So definitely, very efficiently, company is actually turning profits. And as a result, this stock is also in our radar today.
Okay, all right, got it. Gaurav, thanks very much for that. And we will indeed be touching base with the IRFC management and get a sense of how the rest of the year could play out. Mr. Manoj Kumar Dubey will join in at 9:50 a.m. Okay, with that, let's move on. We've been telling you about the prospects of perhaps more large trades happening in today's market action. And Vivek has some exclusive inputs on this one. Vivek, so the real estate developers on your radar?
Right, last evening, two real estate companies, they've taken on Goldman Sachs as the broker to this particular deal. So an undisclosed institutional buyer, both in Oberoi Realty as well as Lodha Developers. Oberoi Realty expect a block deal of almost 230 million, translating close to 2,000 crore of equity. Floor price is at a 4% discount to yesterday's close, and total 3% equity is what is expected to change hands. Now, post this particular block deal, it's a clean out trade, so the seller will not have any stake left. Along with that, Lodha Developers, again, close to 1,420 crore, $165 million worth of shares expected to change hands. Floor price, again, is at a 4% discount to yesterday's close, close to 1% of total equity, and here too, it is a clean out trade as far as the undisclosed institutional seller is concerned.
Okay, all right. Thanks a lot for that, Viv. Here's a quick recap of all the top stocks that we're tracking. The ones with positive news flow: Dixon, United Breweries, JSW Infra, Paytm, Dalmia Bharat, KEI, Credit Access Grameen, and IRFC. The ones with negative news flow include Oberoi Realty and Lodha Developers. That's about all the equity market action. Manisha standing by to update us about what went on in the commodity space. Manisha, lot of those commodities higher this morning.
Oh, well, absolutely, Nigel. Especially the metal as a sector has continued to rise for a third straight day today on Wednesday. If you look at steel, we are up by 2.5%. Copper gained 2.5% as well to near all-time highs. Gold was up 1%. It's holding above $3,400 an ounce, not too far away from its all-time highs. And silver, with 0.5% of a gain, has hit a new 14-year highs in the international market. And the Indian markets overnight hit an all-time highs as well. So a lot of support coming in for this one. The markets are, of course, looking at the US-China meeting next week. And this week is going to be about the European Union and US trade deal. The weakness in US dollar treasuries has continued to support many of these commodities as well. And if you look at the crude oil prices, while we did see a decline of almost 2% yesterday, we've seen some gains come back into the markets yet again. That is because the economic data from China, from the European Union, has been on the positive side. So most of the commodities in Asia are trading in the positive right now.
All right. Manisha, thank you very much for that. So commodities there in focus. I think let's take a break here, right? We'll come back. And as promised, the IPO company, IndiCube Spaces, with their 700 crore IPO, we'll be speaking with Rishi Das on the other side. Stay tuned. We'll also have Deven Choksi join us after that with views on specific stocks, earnings, etc.
Welcome back. Well, let's focus on the primary markets now. IndiCube Spaces, their 700 crore rupee IPO opens for subscription. Through the IPO, the proceeds will be used to fund the capital expenditure of around 460 crores and also reduce debt by around 90 crores. To talk about its IPO offerings, we're joined by Rishi Das, the chairman, ED, and CEO at IndiCube. Hi, Rishi. Good morning and welcome to the stock markets. Your IPO opens. So let's get the basic detail out of the way first. You're going to be raising close to around the fresh issues around 650 crores. Break up the expenditure for us, and part of it is going to be used to repay debt. So post the repayment, what will the debt number look like, or will you be debt free?
Yeah. So we are raising, as you rightly said, a fresh issue of 650 crores, and only 50 crores is the offer for sale. And we have only one institutional investor as of now, Westbridge Capital. They are not doing any OFS. They have been invested with us since 2018. And out of this fresh proceeds, 460 crores will go toward capital expenditure and expansion over the next 2 to 3 years. And we are planned 93 crores of repayment of debt. And our debt currently is 332 crores. And it is from a large nationalized bank and a private bank. It's a low-cost debt. Even then, we are retiring a part of that debt. And we are CRISIL A+ rated. and the remaining 94 crores will be towards the general corporate purposes.
Okay, Mr. Das, I'm just taking a step back so that people have more clarity on your business model and the operating model itself. You currently have 115 centers. You have 6.3 million square feet of area under management. I'm guessing you don't own these spaces, right? I mean, just explain the model. And you're currently, the top line has been growing very, very well. We'll just put up the numbers. I mean, last 3 years, top line growth has really exploded from 500 crores, you're 1,000 crores plus. But the bottom line is still loss-making. Losses are reducing. So just explain the model, and by when can we expect profits at the net level?
So if you, as you rightly highlighted, that we have a total area of 8.4 million square feet under management, with we being having a leadership position in Bangalore, which is the largest managed office market in the whole of Asia Pacific and in general as well. And talking more specifically, as you rightly highlighted, the top line has grown in the last 3 years at a CAGR of about 35%. And we have a very, very healthy EBITDA margin. And one thing I would like to highlight that the accounting standard that we use currently is Ind AS accounting standard. And that accounting standard does not factor in the rental as an expense. That's the reason you see that the EBITDA margins are very, very high. Now, the obvious question is, if EBITDA margins are so high, then suddenly how you have a profit before tax loss? That is on account of the Ind AS accounting standard. For example, our total rental payout in FY25 was 502 crores, whereas as per the Ind AS accounting standard, we have factored a depreciation and interest of 690 crores. So there is a 188 crore worth of additional expense that is there. And the company in FY23, when our accounting standard was IGAP, we have reported a profit before tax of 20 crores. And in FY24 and 25 also, company has been paying income tax. So that is one thing which investors need to watch out for, that due to the accounting standard, they are getting a different perception.
No, fair enough, fair enough, sir. So get your point. The accounting is, making the bottom line a little lopsided, and we have to understand that. So let me look at the operating line itself. Your EBITDA is growing, but the margin keeps fluctuating. It was 40% in FY23. It fell to about 27, 28%. Last year, it rose to 58%. So at an operating margin level, what is a sustainable margin for your business?
So again, if you look at the EBITDA numbers that you are seeing, there is a fair amount of CCPS, which is the convertible preferential shares that have been issued, and there is again an accounting entry because of Ind AS standards. So that is, so if you look at the cash EBIT, for example, that is a better impression of the business. And that has been fairly steady above 10% all the 3 years, if you look at 23, 24, 25. And it has been, the overall numbers are growing on that account,
Rishi, hi, morning. What will margins be what are sustainable margins in this business? Surely they're not 58%, right?
Yes.
What are sustainable margins?
So if I were to give you the cash EBIT equivalent, the margins have ranged between, I will say, 10 to 12, 13%. And that is a past indicator. And we have been a prudent player. If you look at our occupancy has been consistently.
What is the sustainable top line growth that you see, Rishi?
So again, we can't comment on the future, but if you look at our area, today we have a total area, signed up area of AUM of 8.4 million square feet. We are paying rents today on 6.3 million square feet. So we have a pipeline of 2.1 million square feet, which will get added over the next 6 to 18 months. So that should basically all get occupied over a period of time. So we have a good headroom for growth. We have a lot of space that we have signed up as a pipeline.
Just like you gave that EBIT margin, cash EBIT margin number, if you can look at history and tell us what has growth been, and is that sustainable?
Yeah, so basically, that has been very healthy. As you can see, like we have been between 10 and like you see 13% year before, you will see 12% kind of a number. So it ranges. And why this is slightly having fluctuation is on account of properties that we keep adding, because this is at an overall level. So as you can imagine, if multiple centers suddenly get added, there is a bit of a blip. But again, a good indicator for us is occupancy. And if you look at our overall occupancy has been 82, 83, now currently it is 86%. So if we run our business at good occupancy, I think all these numbers will follow. That
All
has
right,
been the trend in the last 3 years.
Rishi, very quickly, 332 crores is your net debt. It comes down by around 93 crores. Is that correct?
Yes, yeah.
So you'll be left with around ballpark 240 crores in your books, which you're comfortable at, right?
Right.
God, that's out of the way. Value-added services, that's moved from sub 10%. It's moved to around 12.7% as of last fiscal year. Where is this number headed?
Sorry, we lost the voice.
VAS, value-added services. As a percentage of your mix, I think it was sub 10%. It's moved to around 12.7% odd. Where is it headed?
Sorry, the last word I am not able to hear. Sorry.
Where is it headed, sir? Where is it headed? Value-added services.
Yeah. So value-added services, if you notice, has shown a growing trend. And why it is? Because the customers that come to us, they are buying more and more from us. That is one aspect. For example, if you look at our, like when employees take office spaces, they also buy services like food, typically transport and other services also. So that is where you are seeing an increasing trend over there. And like typically 3 years back, this number was about 9% of our overall revenue. And today it is all 12-13%. So there is a very healthy uptake on that. And the same customers are buying in more. Another metric I will highlight is when customers come to us, they take space in one of the centers. And if they like us, they try and grow to other centers or they offer us more services. Today, if you look at 44% of our revenue is coming from clients who have taken more than one center from us. And this number was 20% 3 years back. So we are very fast, having a very, very high level of overlap in terms of spaces and services with the clients that we are serving.
Just a clarification, on the area which you're currently managing, I believe it's 6.3 million square feet, right? After utilizing the IPO proceeds, you are targeting to cross 8 million. Is that right?
Yeah, basically, if you see in our business, the capital expenditure has been about 1,500 rupees per square feet. So if we are raising 450 crores, that will suffice for 3.5 million. Plus, we have very good internal cash accruals. So that, and as of now, when I talk about 1st April 25, we have a inventory of 2.1 million square feet of space that we have signed up and yet to get operational.
So what is the total area you're currently managing?
Yeah, so 6.3 million is which is operational, where we are paying rents and collecting rent from our tenants and all of that is happening on that 6.3 million. Whereas the total signed up space is 8.4 million. So this gives you idea about the pipeline, that 2.1, almost 33% of the space that is operational today is available as a pipeline.
Right.
Over the
and
next
once you have this money, you will proceed with fit outs, etc. Right?
That's right. Yeah.
At that 1,500 rupees that you said per square feet.
Yeah.
We'll leave it there, but more numbers hopefully when we speak again during the listing. But good luck to you, and thanks for joining us. So lots of co-working sort of business models making it to the market. I think SmartWorks came to the market recently, and of course you have others which are already listed for a while, and I think there are a couple of more coming as well. We'll take a quick commercial break here. Devin Choksi on specific stocks on the other side. Stay tuned.
Welcome back. Well, let's focus on a couple of stocks and get some fundamental analysis going. Devin Choksi, Managing Director, DR Choksi FinServ, joins us on the show. Hi, Devin. Good morning. Good to see you in. You know, these new age companies, they have bounced back. They bounced back in style. Zomato, in fact, or Eternal, did very, very well in the last few trading sessions. Just imagine, around 45 days or so, we were talking about $1 billion of selling because of the rejig globally, FTSE as well as MSCI. That got gobbled up at 225 to 235, and boy oh boy, the stock is at 300 rupees. Now this morning we wake up to news coming from Paytm. Some part of the street was sniffing that maybe they break even, they turn into profit terrain, and that's happened. It's still half of what the IPO price was. Your view on the stock?
Yes, Nigel. Good morning. Well, I think it's happy to note that these companies have started reporting profit, particularly Paytm. For long, they have been promising and they have been passing through a lot of hurdles. I guess I think they have overcome that part of it. Not completely sure about the unit metrics of what exactly has resulted into the number of profit I think that they have created or they have produced in this particular quarter. But as we go through the details, I think we're more sure about it. More importantly, I guess I think even for Eternal, I believe that I think the higher amount of thrust is largely because of the Blinkit story, which is basically giving the larger thrust in this business. In my viewpoint, I think the market action or the price action in the market at current level is largely driven by the funds who are basically flush with inflows at this point of time. And as a result of which, I think allocation of money is happening into this space. So I believe that I think everything is in price today. I think they're expensively priced probably. Maybe I think the profit picture will have to be much larger and stronger going forward on a sustainable basis. That could possibly justify this price. But at this point of time, I believe that most of these companies are adequately priced or maybe fully priced at current levels.
Got it. Paytm, Devin, the numbers have come through, and I think the reaction, of course, will show through. But new age companies, etc., you're saying, well, maybe things are adequately priced in. What else out of the results stack that you saw, Devin? Anything which stands out to you in a big way? There is KEI Industries. We'll be speaking with the management a little later. Dixon has reported numbers. Anything stands out?
Yes, I think Dixon has promised, probably I think has generated and produced, I think, significantly large amount of profits on I think almost two times size the profit I think was they produced last year versus a one-time increase in the turnover. Not very surprising though, because I think each and every vertical in which they are operating, they have probably I think expanded the capacities. And that was promising to be generating better revenue and the profits for them. Again, I think the business looks absolutely convincing, no questions asked on it. Going forward, the visibility is also strong, but everything is in price. Unless I think you get meaningful price correction, I think you are not getting the advantage of buying such kind of stocks in the portfolio.
What about Dalmia Bharat, Devin? Actually, the numbers look good. The stock, though, has run up. And, you know, some of these stocks, earlier it was a bit of a surprise, you know, when you started getting those numbers that trickled in, Novoco came in. But from the highs, actually, that we saw in the result day, the stock actually has come off. Sagar Cement as well, good numbers that came off. Now, the street is bracing every time there's a South Indian company that's going to be coming out with a set of numbers that's going to be reasonably okay. Dalmia Bharat, Ramco Cement, in fact, that as well has done quite well. From the pack, what do you like?
Yeah, I think the cement as a whole, I think was anticipated to produce better performance, largely because of the higher increase in the prices, better capacity utilization, and at the same time, lower input cost, which is resulting into better amount of profitability, particularly on the fuel cost side. So that is resulting into better profitability. So cement was expected to do well, and as it happens, I think before the result, the market would get the understanding on this subject going in, as a result of which the price would already mature at that time. So maybe profit booking is not ruled out post announcement of result. But as I see it, I think two large companies, the Ultratech as well as the ACC Ambuja combined, which I believe I think are likely to be the bigger beneficiary of this particular move in the cement business, which is likely to be even stronger in the subsequent quarters of the current financial year. So larger the capacity, better the benefit, given the kind of scale on which they are operating. Some of the individual companies like Ramco and Dalmia Bharat, which you mentioned, both of them look promising at current levels. Maybe I think one can even add them into the portfolio as well.
Two more names, Devin, and these are kind of sort of follow-ups from yesterday. Tilaknagar Industries, we reported yesterday that they perhaps are, the front runners to buy Imperial Blue. Nigel put that story out. That is one. And then there is Max Financial. Again, a CNBC-TV18 exclusive. Axis Bank wants to buy another 10%. They own 19 point something. I mean, they have approval for 20%. They want to buy 10 more. So just these two names.
So unfortunately, I'm not covering these companies, Prashant, so won't be able to give more details about, I think, either of them.
I see. No problem. So those were stories that we sort of put out in trade yesterday, during market hours yesterday. What else is on the radar? 361, the block is done. On the wealth side, any thoughts here?
Looks, I think, convincing from a point of view of, I think, the kind of reach that they have created. Not too sure at this point of time, I think, what are the unfolding game plans are. But business conditions remain absolutely very conducive, and I think the growth is seen. We also like, I think, some of the housing finance businesses, because I think the way in which the real estate business is happening, housing finance companies are expected to do better. The bank-promoted housing finance companies are doing relatively slow, but I think the other NBFCs are doing probably better, in my viewpoint.
All right, Devin, we'll leave it there. Thank you very much for joining us. Short conversation, but punchy. We take a break. Technical trades on the other side. Welcome back. There's about 4 minutes to go for market pre-open. Sudarshan and Mitesh are with us with what they'd want you to do as far as trades are concerned. Gentlemen, good morning. Good to have both of you here. Once again, a bit of a thanda day yesterday. Mitesh, how are things looking?
Yeah. Good morning, Prashant. So I think, as I said, holding on to 24,900 gave us some confidence that we are not breaking down immediately, but there's no sign of a strong reversal on the upside. So my sense is that 24,900, 25,300 broadly would be the range, and the markets might just consolidate between these boundaries. A breakout on either side, will give us some kind of directional bias, and I would say that there is an equal chance of breaking on the downside as much as on the upside. So in that sense, we are for the time being neutral on the index, but trading with stock-specific biases.
Okay, an equal chance of the downside or the upside break. Got it. So in neutral territory. Morning, gentlemen. Sudarshan, let's get your thoughts in. Are you trading the index? Do you see anything here, Nifty or Bank Nifty?
Good morning. Well, the Bank Nifty is a buying opportunity on any dip, and I think that's the only index we should be trading in. The Nifty is in a very narrow range. Now, these narrow ranges can do anything. They can actually, the problem is if they break on the upside or the downside, a tradable opportunity will come. But the problem comes if they don't do that breakout at all. We have seen many, many instances in the past when the Nifty has drifted for weeks altogether, 3-4 weeks. This could be one of those cases. So the Nifty doesn't have any trading opportunity. Intraday, you can look for sharp dips for a quick trade. That is intraday traders only. For most positional traders, the Nifty is an avoid. The Bank Nifty remains a buy on dips.
Okay, got it. So avoid the Nifty. If at all you have to trade the index, stick to the Bank Nifty. Got that, gentlemen. So let's talk about stocks. Both of you are more convinced on individual stock trades. So Mitesh, what's on your list?
Morning, Suri. I have Tata Chemicals as a buy recommendation with a stop at 949, 948 for targets of 990. ICICI Bank, after that, getting into all-time highs, closed mildly weak, but it's still above those earlier closing pivots. So buy here with a stop below 1460 for a target of 1500. A sell on IRFC with a stop at 133 for targets of 122, and a buy on Hindalco with a stop at 680 for targets of 710.
Okay, all right. So Darshan, let's get your stock-specific trades as well.
Well, Indigo is a buy with a stop under 5830. Power Grid is another buying opportunity with a stop under 291. I have Nykaa. Now, Nykaa is a momentum stock. You don't actually want to buy and hold it for a very long period. But for the time being, there's an opportunity to buy with a stop under 215. I also have an intraday short. This is my only intraday short, Biocon, with a stop above 395. Remember, shorts are always intraday.
All right. Gentlemen, thank you very much, both of you, for joining us with specifics as far as trades are concerned. I think we're almost hitting the pre-open session. We're about 1 minute away. Leela, Hotel Leela Bangalore recently listed. Schloss Bangalore is the name of the company. For the first quarter, the company's seen a healthy revenue growth. EBITDA saw a strong 50% jump. They've repaid 2,300 crores from issue proceeds. To talk about how Q1 went and what's the outlook in this quarter, that is Q2, we have Anurag Bhatnagar, Chief Executive Officer of the company, now joining us. Anurag, good morning. Great to see you once again. And good to be talking now that you are, of course, in the listed arena. So we can talk specific numbers, Anurag. How was, if you can tell us, how was July gone? And at the margin, are things as strong as what we've seen over the last couple of quarters, or is there a bit of slowing?
Hi, Prashant. Great to be here. Thank you for having me. I think before I get to July, let me just give a brief color on the quarter that just went by, which typically is considered a bit of an affected quarter. There were some headwinds, there were some geopolitical tensions, as we all know. Despite all of that, we saw 25% growth in our revenue, a 63% growth in our EBITDA, and almost a 10% margin expansion on the EBITDA. Now, looking at July, our business that we recognize in the luxury segment is very resilient. And we have seen that looking at the macroeconomic indicators, the growing affluence, the consumption for luxury products and services and experiences, and the iconic nature of our hotels, we definitely are looking forward to a great July and as well as this Q2 as well.
So, hi, Mr. Bhatnagar. I'm just looking at some of the internals and they're looking really good. Your top line's 20% growth. Margins have improved to almost 37%. Your occupancy has also gone up. I think you're at about almost 64% now. How sustainable are some of these metrics? Let's start with the margin itself because it's looking very, very smart. Operating margin at almost 37%.
So a lot of investment has happened into our properties over the last 5 years. We have invested in CapEx. We invested in green energy. 51% of the total energy in our hotels comes from green energy sources. There is a lot of investment that has gone into asset management practices and revenue management. We have a new website, which is delivering almost 72% growth year on year in terms of both visits as well as in terms of optimization of the revenue. So we definitely believe with all the efforts that we have made and the value drivers that we are instigating in all our hotels, we definitely believe that these margins are very sustainable because we have gotten a robust cost discipline. We have also got synergies within the company and with our promoters to ensure that we get great procurement synergies.
No, so, but sir, the thing is that I think when we've spoken to you earlier, you've given a rough guidance of mid-teens EBITDA growth. But your EBITDA this quarter, first quarter itself, has jumped over 50%. And then, like I said, margins are almost 37%. So do you want to revisit that? Can you give us some sense of full year FY26 guidance for EBITDA growth, for margins, and maybe even revenue?
I think our margins, if you look historically, have been extremely high, as you have seen, close to 49, between 49 to 50%. And this is the margin that we are looking at for this quarter and towards the year end as well. And definitely sticking to a mid-teen kind of a EBITDA growth year on year.
50% margin. Okay, got that.
Close to
Taken note of
50%,
that.
I would say.
Close to 50% EBITDA margins.
Anurag, what will occupancies be? I think, will they be in this early 60s kind of range?
For the year end, look, this quarter obviously was impacted for a couple of weeks, I would say. But the Leela business is very resilient, as it is in most luxury products and experiences. So we didn't see much of a blip. But we definitely believe that H2 is typically 2x and far more stronger than the typical H1 in terms of financial year. Looking at the business that we have on books, the funnel that we are looking at, some major national level events which are happening in H2 of this year. And plus, I want to draw a perspective. Nearly 50% of Leela's business comes from international markets. And international business is still not caught up on pre-COVID levels. We are expecting going forward in H2, a lot of inbound business coming in based on the queries that we are receiving and the interest people are taking in India as a destination and Leela as a product.
International business, Anurag, is a percentage of mix. What was it earlier and what is it currently?
It's hovering between a 50% mix.
Okay, all right. And pre-COVID, you said?
Pre-COVID, it used to be nearly 65 to 70% of our mix. But we see this growing influence in India. Our products that we have created in our resorts in terms of family villas, kids play areas, reinvestments back into food and beverage and new venues and new spas. Our domestic consumption is growing. So now it's hovering around 50%. Plus, if in terms of international arrivals, if you have the statistics with you, they still haven't caught up with the pre-COVID levels. But for us, we are expecting based on the funnel and the expressions of interest in terms of international incentives, delegations and FITs, a strong rebound between October to February, March.
The big pull factor, the kids' play areas, I'll tell you what, I look out for them. All right. Your EBITDA target you have given of around 2,000 crores, right? By 2030. That's the aspiration. Can you hit 250 crores of PAT, say, in 27, 28? Would that be a possibility?
Hopefully, at an annualized run rate, we should be coming close to a 400 crore of PAT. But that being said, there are four major levers in which we are looking at, and I think we have already declared that yesterday in our earnings call. We see a lot of leg room and runway ahead in terms of same store growth because of the iconic nature of our hotels, which we own, as well as the markets that we operate in. There's a huge delta between demand and luxury supply. And secondly, based in terms of the business that we see coming into India and the growing affluent base to consume luxury.
Yeah. Now, we've asked you some, long-term questions. I must ask you a very near-term question as well. If you look at average room rates, they've been trending higher, right? I think you're closer to, FY25 overall, you were just above 16,000. How much higher do you see average room rates heading, especially as we get into the busy second half of the year?
So I definitely believe that the Indian, if I give you an industry perspective, we kind of call the room rates as higher in context to what we have been historically seeing. Now, Leela has been historically growing at a high double-digit ADR over the last 5 years at a CAGR. We definitely believe we are going to maintain that momentum for a couple of reasons. I spoke earlier where our hotels are located.
Right. Anurag, we're short on time. So 18,000 rupees or so was Q1, right? For the quarter, roughly the ARRs. Where do you think H2 you'll kind of sort of maintain this? This is the flow we should work with for the rest of the year?
We are definitely going to improve this significantly in H2. This was like the first quarter, as I mentioned earlier. H2 is much stronger and much more robust in terms of inbound.
So 20,000 plus?
For sure.
So F5 26 over 25 ARR would be up how much?
We will be looking at close to a double-digit growth in our ARR and maintain that. In the first quarter, we have grown 13% on ARR. We are likely to continue with the same trend for the full year as well.
You're adding 7 new hotels, 7 new properties, all managed?
No,
Anurag?
actually, 8 new hotels coming in our pipeline, out of which 6 are going to be owned and 2 are going to be managed. We have an active pipeline of 966 keys, and I would like to draw your attention that we are going to be coming back to Mumbai in a big way in our property in BKC. We got an iconic location in the G block in BKC, and we're going to come up with the Leela Palace, Mumbai. We already closed the transaction in this quarter, and we are getting into design development and the next steps.
Oh, wow.
Just to reconfirm that 400 crores of net profit by 2030 or 2028?
400 crores of EBITDA is an annualized run rate. 400 crores of PAT is an annualized run rate PAT that we are looking at starting from literally this quarter.
Of PAT, so there'll be 100 crores per quarter from which quarter?
Looking at starting from H2 onwards for the next 4 quarters, we're looking at 400 crores.
So FY26, 400 crores. I mean, basically, next 4 quarters, essentially, 400 crores.
Should be around 309 crores because you've done 9 crores of PAT in the first quarter, and you're saying that from here on you're going to do 100 crores of net profit.
So I tell you, the first quarter was impacted because the IPO came live on 2nd of June. So we serviced our debt and paid down our debt significantly. So first quarter is not a kind of a reflection on what the future quarters are going to be. But we definitely believe that us having paid down and having a very strong balance sheet, and our net debt to EBITDA is now 0.3x, which is significantly very low. So we definitely believe that having paid down our finance costs significantly, our next few quarters of PAT is going to be much higher.
100 crores.
Actually, Nigel, the numbers, I'm looking at, this is a JP Morgan report. Number, I think they'll be far higher then, right? I mean, rolling next 4 quarters, Anurag is telling us 400 crores in net profits.
Yeah.
So, that's a big bump. Anurag, thank you very much for joining us. Good speaking with you, and good luck as you sort of go into H2. Significantly better. Seasonally, it's much better for the hospitality industry as well. Let's just bring in Sudarshan and Mitesh back into the conversation. I think it's 9:10. Let's get their calls. Mitesh, what do you have?
I'll go with the buy on Tata Chemicals for targets of 990 plus.
Okay, and Sudarshan?
Well, I look to buy Indigo with a stop under 58.30.
Okay, all right. Indigo it is. By the way, thanks very much, gentlemen. By the way, the pre-open has settled, and we are set for what looks like an 80% pop at the start. Reliance is finally managing a bit of a recovery. Remember, first half of this week, Monday, Tuesday, Reliance has had a bit of a rough ride. Let's see. And some of the banks like ICICI Bank look like they'll march northwards as well. Paytm is on the radar. The company has turned in a profit at the net level as well. So, is the worst over or not? There's a great bull and bear argument on this, and Gaurav is bringing us that argument. Gaurav?
Well, yes, Paytm definitely reported good set of numbers, and now there are 2 sides to these numbers as per brokerages. First, let's talk about Jefferies. They have upgraded the stock to buy and also raised the target price to 1250. What they're saying is that the EBITDA was actually a beat in terms of the expectations. MTU, which is monthly transaction users, the number actually growth was at around 3%. It is encouraging. But from here on, what they are saying is that the contribution margin will stabilize as per them. What they are also highlighting is that when we look at the valuation now, it is at a discount to the company like PB Fintech, which is actually attractive as per them. And also they believe that this is going to be a compounding story. On the other hand, we also have Citi, who actually increased their target price to 1215 rupees. On the bear case, we have CLSA. Now, they have also highlighted a very interesting point here. They have actually downgraded the stock to underperform, although they have increased the target price to 920 rupees. What they're saying is that the company, again, there was a beat, definitely, if we compare it with the expectation. But the one key point that they have highlighted is that in the loan distribution business, Paytm has discontinued their default loss guaranteed program with one of their largest lender. Now, what it means is that the upfront cost in the results from the DLG was not there, but at the same time, deferred revenue that was booked in the last quarters was there in terms of revenue, and that is something that is hurting as per them. Lastly, what they are also saying is that there will be some quarter where we may see some kind of sluggishness in the revenues. Now, Macquarie also maintained its underperform rating and a target price of 760 rupees. So definitely 2 cases here for Paytm. We will definitely watch on how investors are going to treat Paytm today, but definitely from the brokerages, we are seeing 2 cases.
Okay. All right, well, for the time being, I think the bulls are having it because in the pre-open, Paytm is managing a 3% up move. Thanks for that, Gaurav. Let's quickly revisit Colgate as well. Colgate, of course, declared numbers yesterday during market hours. Stock was fairly tepid. What's the sense now, Mangalam? So management commentary, brokerage indications coming through. So put it all together for us.
It's fairly weak. Colgate weak side was expected. The stock has been an underperformer, down nearly 40% from its highs. And the management commentary isn't inspiring much confidence either. So you have the management saying that weak demand, high competitive intensity and a high base led to volume decline in this quarter. They do expect recovery in the second half of this year. That too will be gradual. Brokerages on the back of that. HSBC has a hold call, cut their target price to 2,600 rupees. They're saying that improvement is anticipated, but structural growth potential remains low. Nomura too has a reduced call. They have a target price at 2,350. They expect the volumes to have declined 3 to 4% this quarter as against street expectations of growth of 0 to 2%. Goldman Sachs as well has a sell call, target price at 2,300 rupees. They've paired their FY26 and FY27 estimates by 3 to 4%. Citi too, sell call. They've cut the target price from 2,300 to 2,175. They're saying challenges likely to persist in the second quarter as well. Nomura is the sole buyer here with a target price slightly upwards of 3,100 rupees. They are expecting recovery in the second half and they anticipate the volumes to have fallen just 2% as against, again, expectations of 0 to 2% growth.
Okay, all right. I think we're just hitting market open. Mangalam, thanks very much for that. So let's just do that. Let's look at market opening in terms of rates that come up, and then we will, look at individual stocks as well. So it's a good open, 80 points higher, back at basically where we were at highs day before yesterday. 25,140 or so is where we are at, and we'll see if these gains are sustained through the course of the day, early signs of recovery, but it's got to be backed up by price action, which so far we've not seen. Nifty Bank is up a little bit as well. Midcap index is up 0.18. Small cap index also coming up on your screen. But I think it'll be stocks once again this morning. Paytm and Credit Access and a few others which we've been highlighting. What do we have? First rates starting to come up shortly, and it should be higher. We'll look at the heat map and then quickly move on to individual names. What do we have? 67 points on the Nifty, 195 on the Sensex. So 25,120, 58,810. That's the Nifty and the Nifty Bank respectively. Small cap indexes, I think starting, that rate should move. It's on the small cap index. Mid cap index is absolutely flat. The small cap index is almost unchanged as well from yesterday's close. So it's large caps doing a little better, 0.25% each, but broader markets are finding their feet. Heat map should give you a sense of how Nifty stocks are opening up and down, and then we'll take it from there. It's bulk of it, starting higher. You've got about 5-6 names which are starting in the red at this point in time. Surabhi.
Actually, I started looking at the Eternal stock first. Let's pull up Eternal. It started lower because, after a 15% rally, some profit taking is expected. But the moment there was a little bit of a, couple of rupees of a down ticket got bought into, that's the sense for demand. And now the stock is flattened out. Anyway, let's talk about the winners on the Nifty this morning. Nestle India, 1% higher. Bharti Airtel, about 0.7% higher. Infosys is approaching numbers with, some sense of optimism, 0.5% up on Infi. HCL Tech is also managing a little bit of a gain for what it's worth right now. There is Tata Motors, which is up and about. Bharti Airtel. Bajaj Finance is managing a 0.5% up move. Shriram Finance, 0.5% up. L&T, 0.5%. So, all of these batsmen are chipping in with only a few runs here and there. No one's scoring the sixers and the boundaries. But little runs are coming in here and there, which is how the overall Nifty tally is about 70-odd points. Reliance has stopped dragging at least after 2 days. So that's big help. 0.5% up on that stock. TCS for what it's worth, 10 rupees adding up to the board. ITC. So likewise, it's a lot of stocks chipping in with little bit here and there. And no major declines on the Nifty, at least so far this morning, which is good news for the bulls. So like I said, Hero is down, but 0.25%. No Nifty stock is down more than 0.25%. It's a good-looking Nifty screen. And everyone's chipping in with a few runs on the board. So the overall tally is about 70 points now.
Well, that's right. The stocks are in focus. I think Lodha as well as Oberoi, those large trades, it appears, I think that should have probably gone out of the way because Lodha is down close to 5%. There's a big volume out there. So, that one has probably happened. get the chart up for you. Even Oberoi Realty, that one as well. So 4 and 5% because of those large trades on both those two names. Blue Jet, that was a stock that was down 10% yesterday. It's down another 5%. So post its numbers, remember, these are one of the stocks that in fact had a very, very big run. And now, in fact, it's coming for some serious profit taking. I'll tell you what, after yesterday's 10% cut, after today's 5% cut as well, still the stock is up 50% for the year. So it seems the street either miscalculated or it appears the stock has run way ahead of itself. So keep an eye out on that name as well. What else? JSW Infra, well, that's one of the notable winners in today's trading session. So that's doing fairly well from the broader markets itself. Godfrey Phillips, let's pull up that stock. You know, Philip Morris came out with its set of numbers overnight. The stock actually was lower. But, the commentary on the India business actually was a little bit encouraging. For the time being, the stock flattish. Volumes are a little bit higher than what we normally see. So keep an eye out on that.
SML is also, by the way. Remember, we were talking about
Yes,
the stock
10%.
yesterday as well. 5% up on SML again this morning.
I don't know if my screen, but Religare is up 10%. It's got a. I mean, I think we just put up Religare. If that is indeed the case, yesterday the Religare stock was up about
1%.
Okay,
Just refresh.
I don't know what my screen is showing. It's showing me 314. But
Credag,
that's why I
by
said
the way.
maybe we'll have to just give it 2 minutes more. Credag is, we should pull that up.
It's rising now. It's rising because I think some of those credit costs and asset quality issues, at least they've not been bad. In fact, they've done well this quarter, though at the profit level you can argue, but I think there's some buying on Credag from lower levels.
Absolutely. And this is the MFI space beaten down. When will turnaround happen? I mean, out of the lot, Credit Access has always been considered as the highest quality name, but it's also taken a bit of a battering over the last 2-3 quarters with a lot of problems starting to appear. We'll sort of address more names in just a bit. Dheeraj Agarwal is Managing Director at Ambit Investment Managers. He's with us for a quick chat. Dheeraj, good morning. Great to have you with us here. Thanks very much for your time. And just sort of kick us off with your assessment of earnings, especially from financials and outlook here. Which part of financials do you like? Because that is where you've got a, generally there is tailwind of, I don't know if it's helpful or not, but on the institutional side, people are bullish. I mean, people want to own financials, and everybody's got their own spots: gold finance, NBFCs, large private banks, small. So there's a fair bit here. On the other side, you also have the RBI, at least trying to prime growth here, kickstart lending in a big way. It's languishing at about 10% system wide, and they really want that to move higher. So let's just start with that space, Dheeraj.
So financials results in general are pretty decent, especially the large banks. And that space is interesting because there are no issues or negatives in that space at this point of time. So the NPL issues are very much under control. There is no credit crisis in the country. The only issue at this point of time in the financial services sector is that the loan growth, as you rightly said, or the credit growth is a little weak. It's come down to 9 or 10%. At this point of time, the market is expecting or hoping, depending upon which camp are you in, that the credit growth and the economic activity will pick up starting second quarter of this year, and more importantly, in second half of this year. Now, the great thing about a forward-looking positive expectation is that the current weakness, in some senses, does not matter, right? Because it's sort of priced in, it's expected. So the current results are pretty much in line with expectation from that point of view, that the credit growth numbers are tepid, but all other metrics are quite good. There are hopes and expectations of a credit growth and the economic activity pickup going into second quarter. That, to my mind, is the most crucial variable which will determine whether the rally continues or stalls. But it's, I think, a few months away for that judgment call.
Dheeraj, hi, morning. I'm just going back to a conversation we were having with Drew Pettit, who's the strategist for Citi. And as we all know, Citi has just downgraded India recently, right? Yeah. He made a very strong argument because on one side you have foreigners who are saying India is not expensive, earnings are all right, just about okay. You've got other markets like South Korea, China looking better. So they're allocating money there, they're selling here. And then you have, of course, the Indian market because of the domestic flows being strong, that SIP book being very strong. I mean, India, I don't know when India will ever be cheap, because there's so much of local money buying Indian stocks. Yeah. So then we're in a bit of a funk, aren't we? Because the FPIs are selling, domestics keep buying, and we remain in a range. I mean, how long do you think this will last?
Yeah, so the FPIs will come back in only when earnings growth accelerates. So, whichever way you actually cut it, the current expectation which the market has that from September quarter we will start seeing inflection point for earnings growth to start picking up, and second quarter will gather pace, are the most crucial variables which will determine whether the rally continues or not. So at this point of time, you're right. There's a tussle. If you look at the last 12-month performance, right? I mean, US S&P 500 is up, I think 13 or 14%. Nasdaq is up 13. India Nifty is up just 2% in US dollar terms in the last 12 months. Germany, Korea, Taiwan, even UK has done better than India. So what you're saying is absolutely correct. And for accelerated move in our market, we need FPIs too, in addition to the domestic money. And that, to my mind, will chase earnings. And for that, we might have to wait till September quarter.
You know, I was just thinking, folks, we haven't used the word melt up in such a long time, right? Prashant, when was the last time you used melt up to describe the Indian market? For old time's sake, at least it should come back, now. I mean, that phase or that sense of absolute golden euphoria. But I think we're still waiting for it now.
Well, that's right. Hi, Dheeraj. Good morning. I want to ask you about a stock. You want to guess which one?
Yeah, of course. It's done very well in the last 3 days.
Is it done and dusted, though?
No, I don't.
You think bulk of it is in the price? By the way, I mean, for those who are not...
Which stock are you talking about?
It's Zomato Eternal. We have been talking about it from 100, 120, 150, 200 rupiah, 300. So it's not just for the, for clients now. As a customer, you're not going to be only happy. Shareholders as well who got in, they'll be very happy. Tell us what's the outlook from here on?
So our team is still very confident on the stock, and it's one of the core holdings in one of our flagship portfolios in asset management. We still believe that the hyper growth journey for this company continues. The market leadership position continues. People keep on getting worried a little bit every time some new player or even an existing player launches the quick commerce business, saying competition is heating up in the space. But I think by now, leadership is very well established. So even if some competitor and some other players come in, it probably will compete versus each other and not really threaten the numero uno position for this company. So till such time the hypergrowth continues, and for that there is a long journey. I don't think there is one should be in any rush to change the view on this one.
Almost 3 lakh crores in market cap, Dheeraj.
Interesting, very interesting. It's larger than a number of very well-established old economy stocks now. But that's the way the world is moving. Look at all the mega caps in the US. I mean, they're all sort of new economy players.
Yeah, absolutely. And we'll see what this goes. But so, I mean, such divergent views on this one, right? But I think more and more people are sort of throwing in, saying, well, must have this one because it's done well. And gains get more gains in that sense. What about, Dheeraj, what else? I mean, Paytm, any thoughts?
I don't have a very clear view on this one, but just browsing through the results which came in last evening, it seems very encouraging. But I don't have any concrete view on this one.
Okay. So, Dheeraj, what else? I mean, we've discussed Zomato. Where else? This market is so hungry for growth ideas, right? Look what happened. Ixigo, the lead Travenues Tech, that stock Ixigo, they reported numbers and growth was good. That stock went up, 20% in a matter of 2 days after numbers. And that's the thing. There's such appetite, such hunger for growth stocks. Do you see anything else on the horizon? The wire and cable guys, for instance, they've done well this quarter. What else are you keeping on your radar?
So, the reason for that at a slightly higher level is something which I mentioned on the channel the last time I came here as well, that earnings are getting very, very polarized. This is a very different phenomena from, let's say, FY 22 to 24, where earnings was more widespread in the sense that a larger group of companies, a larger number of companies were able to deliver growth. And as the economy has slowed down a little bit, there's a risk that global economy will also slow down, looking at everything which is happening in the world right now, either on the trade front or geopolitics front going into next year. A very small bunch of companies will actually deliver growth. So this environment will end up becoming sort of similar to what we saw between 2015 to 20, where only a handful of companies were able to deliver strong earnings growth. And the entire whatever pool of money just kept on chasing the same stocks, and the valuations became astronomically high. So I see a repeat of that over the next 3 years. I think widespread earnings growth environment is over for the time being. And like the couple of names that we discussed right now, we will have to hunt for few individual names where earnings growth is actually fantastic and the quality of earnings is good. We have to beat the market.
But Dheeraj, that's precisely what I'm asking you. That's what I'm asking you. Give us some more names, some more clues at least, because it's not easy to make money in this market anymore. So help us out here.
Yeah, I mean, I generally prefer to avoid giving names, as you know, right? So
okay, clues at least, sectors, clues,
You know, in fact, sectors, you'll find winners in all the sectors. So like we started the discussion with financial services. So a few of the large private sector banks are clear winners out there. The quality of earnings is good, valuations are not that stretched. There is a fair bit of logic to say credit growth and economic activity will pick up in the second half of this year. So that's one very, very clear space. Very select consumer discretionary names, if demand does come back in the economy, buoyed both by interest rate cuts as well as the tax benefit which was given in the last budget, which will now trickle into the hands of the consumers starting this quarter. There'll be winners in that space. I mean, Eternal is one such example, which is benefiting both from a micro as well as a macro tailwind out there. So you could find winners in these spaces. Some financial services, specific consumer discretionary, autos, very, very worth watching very, very closely. Demand has been weak for a very long time. Let's see if the interest rate cuts spur a demand growth back into autos as well.
Okay, all right, Dheeraj, you're not letting out names, but one space that has been disappointing is old tech. The earlier darlings of the market. Now today, all eyes on Infosys, because from the large cap names that will at least grow, and in all probability we'll see a revision in their guidance. How are you placed out there? Because my director is going to pull up a chart. It's actually underperformed even the Nifty. Your take.
I'm still slightly cautious on this space. And again, when I say cautious, I'm saying broad brush cautious that there could be individual names which could shine in the space as well. The reason being, I think everything which is happening in the US, whether there's a deep slowdown or a shallow slowdown is the only debate in my mind, but there has to be some deceleration in the economic activity and growth in the US going forward. It's not possible that with so much of trade barriers, tariff controls, XYZ, and the other, growth can actually accelerate. So IT space being directly sensitive to what happens in the US and US economy could actually be in a slow growth zone for another year and a half. So I just continue to be cautious.
By the way, Nigel, Infosys will report, but so will Coforge.
That's a stunner.
That's the one to watch out for. Coforge stock should come up on your screen. Out of the pack, IT pack, I mean, just look at expectations.
Yeah.
This is the one which I think has got highest growth expectations. In the last few quarters, I mean, it has actually beaten what the street has said. So just keep an eye on this.
And just to close the loop on Eternal, in terms of market capitalization, 3 lakh crore and the 28th most valuable company on the BSE, the top 100 market capitalization companies. So what a journey out there.
I think Coforge, I would rank as probably all last 3-4 quarters, the strongest management commentary on the street. I think the only one that comes close today is the management of Schloss, Bangalore, Leela Hotels, sounding as confident about their business, 400 crores in profits this year. But anyway, these are the kind of stories that the market is really, really hungry for and willing to reward. Dheeraj, thanks very much for the conversation today. Great chatting with you as always. Wish you a good day and we look forward to connecting again soon. Okay, let's stay with the earnings. Markets holding up, actually. Markets been pretty okay so far, though the Midcap index is flashing some red, so watch for that. Nifty still holding on to a 50-point gain, but Midcaps are a little cautious. Now, we're staying with earnings and putting the spotlight on KEI Industries, and it's been a good quarter for KEI, especially their wires and cables business, because overall revenue is up in the 20s, but if you look at the wires and cables part of their business, then that has surged 32%. Margins are in line with street estimates, though, I mean, there's a little bit of a pressure that's coming over there. So let's discuss all of this and more with Mr. Gupta, who's with us now. Sir, great to have you back on. And another solid quarter. You know, we're just discussing this with our market guests that I think wires and cables at least is one segment where the market keeps getting growth. And you've done so well, right? You're best in class, 32% growth. Now, just tell us, what does this reflect? You know, how does this reflect on your full year projections? Because your first quarter has been so solid. Would you like to increase your full year guidance, overall revenue guidance, or maybe the wire and cables guidance?
Yeah, good morning. We will still be very cautious. I think we will continue with our guidance of 18 to 20%, although we will definitely try to aim better. The first quarter has been extremely good. We have grown our export of wires and cables by 122% compared to last year. It is the actual growth is 61%, but it is due to decline in the export of EPC project, which was there last year, but now it is not there. But the wire and cable growth is substantial.
On EPC, can you just tell us, I mean, that business has been weak. So the revenue is down 56%. EPC margins also under a bit of pressure. So what's happening there? Can you just specify and give us some numerical guidance as well on if it picks up in Q2, Q3?
No, the EPC business we are consciously bringing down. We are not taking new projects, and our aim is to limit it to maximum 3 to 4% of our total sales. So this has been a conscious decision 4 years taken back 4 years back, and we are consciously closing the contracts and bringing down the business as we are not taking new orders.
And by when will you get to that? I mean, this reorganization or this shift in focus, more on wire and cables. By when will you reduce EPC to 4%? So this whole exercise will be complete, just so that we know.
We have already reduced it to that level. So we want to keep it maximum within to 400 to 500 crore level a year.
Okay.
Mr. Gupta, you continue to beat what you say you will do. Good morning. 18 to 20% though revenue growth is maintained, but 25% growth this quarter. So, and you're saying you're confident of maintaining growth rates. The big, at a high level, the concern broadly for the sector is the simple question: have margins in the wire and cable segment peaked? Will there be pricing pressure because what new competition is doing in terms of setting up capacity over the next, I mean, it's already underway and will go on over the next 2 or 3 years. And that's a lot of new capacity, some 75 to 80,000 crores being put in. Will that, will that cap what margins you can make in wires and cables and have margins which are healthy? Have they peaked here?
Prashant, first of all, I think from where this figure of 75,000 crore capex comes, I don't know, because that much of capex has not been planned even in totality by all the companies. Secondly, the whatever capex will come, maybe 8 to 10,000 crore in next 2 3 years. Market is also growing, and I think there will be enough room. I think we will be seeing more growth in this business because government capex is growing, and I think private capex will also come up strongly. So there will be enough room for the growth for everyone. Our focus will remain on domestic market as well as export market. I continue to maintain my guidance that we want to take our export to 20% of our total sales within next 2 to 3 years as our new capacities comes on board, which is coming up by mid of this year and then by the next year.
So you say revenues will grow. There is absolutely no doubt. The market itself is growing. So it will get absorbed. All this will get absorbed. But even on margins, you're saying, I mean, there's no reason to imagine that there is a cap.
No, I don't think. And I think we have given a guidance of around 11% EBITDA margins. We'll definitely try to improve it by 0.5% to 1% as our economies of scale comes up, new capacities comes up. We are more established in Western markets. So we will definitely aim to grow the margins. But as of now, I will still maintain a EBITDA of 11%, for next 2 years.
All right. Hi, Mr. Gupta. Good morning. And the numbers look fairly okay. The wires and cables business, if I compare you with your peers, whether it's with Polycab or with Havells as well, in revenue terms, you have actually outgrown them. Margins are relatively lower. My question to you is, are you outpacing industry growth and have you gained market share in the wires and cables business?
I think you must have seen that our export of wire and cables has grown by 122%. It is more than doubled compared to last quarter. That is the reason that we have outgrown the industry peers in our revenue.
All right. So in the domestic market, actually, your market share will be more or less stagnant. Is that correct?
Yes.
All right. Do you have a number handy as per your calculations?
No, I don't have immediately handy numbers, please.
Okay. All right. Could you tell us, going ahead, what kind of a capex outlook are you looking to put out at current utilization levels? What is it? And give us a sense about how you plan on adding capacity.
This year, we expect to spend around 900 to 1,000 crore capex in our Sanand plant. And the next year, again, this capex can be 600 to 700 crore. Because we by the time we complete the project, we will be also doing another capex in the other lands which we have acquired. And it may be for the increase in the capacities of existing products or for some backward integration as well.
Mr. Gupta, I just want to come back to that margin point. And interesting to note that you're sticking to your guidance of touching the 11% EBITDA margin mark this year. And that'll be interesting because the last couple of years, the margin has been hovering between 10, 10.5. I think the last it was above 11% was around FY21. So just give us some more color. What is the kind of price hike that you will plan to take, if any? I think there was one taken towards the end of the previous quarter. Will there be need for more price hikes? And also, since you're going to grow your export business to 20%, how do the margins compare between the domestic business here and your exports?
In exports, the margins are slightly better. That is why I say that we will be able to improve our margins. Secondly, as we start our Sanand plant, we will have some improvement in the margins because of the logistic costs on imports and exports, and also on the incoming raw materials. Because many of the raw materials are procured from Gujarat, or many of the raw materials are coming through imports. So our inward freight cost and outward freight will be lesser, which will definitely improve some bit of our margins.
Okay. All right, Mr. Gupta, we'll leave it there. Thank you very much for joining us. Good speaking with you, sir. And appreciate your time here. Good luck. So, I mean, margins, keeping it at about 11% is the aim. But Mr. Gupta did say we'll aim to improve those EBITDA margins by between 0.5% to 1% or so. So interesting chat there. Nigel.
Just one more point I want to make. From the broader market, so the headline index is a little bit nervous, and the Midcap index has moved to the low point of the day. Bombay Dyeing was a stock that we had highlighted, a week or so, that we're seeing very, very large delivery-based buying out there. The volumes this morning are massive. It's I think more than 50 lakh shares out there, and the stock is flying away. We'll try to check out more, but we had highlighted that the stock was moving on very, very large volumes and very, very high delivery-based buying. For the time being, shooting up more than 8% as we speak. So just thought I'll highlight that one.
Absolutely. So just a few names, right? I mean, there are some reversals happening, as Nigel said. Market breadth is turned. About 1,450 stocks are lower and about 1,024 stocks are higher right now. Loda, of course, that block we highlighted. Paytm is down 2%. And there is Oberoi Realty down 3.5%. Tilaknagar, which went up like a rocket yesterday, is down about 4%. Blue Jet has been, again, I mean, yesterday was a sharp cut. Blue Jet is down another 3.5% right now. PNB Housing, Patanjali, M&M Finance, Iron Exchange is another, I mean, it's a water treatment company. It's down 9%. It's got decent sized volumes, by the way, about 491 on Iron Exchange. I mean, I hardly ever remember mentioning this name, but it's got volume. So just making a quick mention of it. Let's welcome in our next management. Dixon reported numbers yesterday. First quarter performance was in line with expectations. Revenues are up 95%, jump driven by the mobile segment. Now, the share of mobile as a percentage of the overall pie has increased quite a bit. Saurabh Gupta is Chief Financial Officer at Dixon, joining us now. Saurabh, good to have you with us here. Thank you very much for joining us. So, just the basics out of the way, based on what you've reported for the first quarter, right at the outset, what visibility do you have for the full year FY26, Saurabh, in terms of revenue growth?
So, Prashant, I was always expecting this question from you. Yeah, so my sense is, the quarter two looks, the order book for quarter two looks very healthy, and it's also the festive season, ahead of the festive season. We feel confident, Prashant, that at least a 45% kind of a growth is definitely doable. Yeah, there can be growth, can be marginally lower and higher than that, but broadly 40-45% is something that we are targeting for this financial year.
And margins, Saurabh?
Margins this year, Prashant, should be on a similar levels as last year. But we expect as and when our component foray, the components come into the system, then the margin expansion will start to happen. But this year, the margin should be almost similar to last year.
Okay. So same margins like last year and about 40-45% revenue growth for the full year.
That's right. That's right.
All right, got that. Within the revenue pie, Saurabh, hi, morning. Can you give us, by the end of this year, what will the breakup look like? Obviously, mobiles is a huge segment of it, especially this quarter, because you keep executing these large contracts. But then the laptop business is also coming along, the other, personal devices business. So by end of the current year, what will the revenue mix look like?
So still a large part of our contribution will come from mobiles this year. I think so. Laptop will start making meaningful contribution only next couple of years. This year it will be a smaller number for laptops as we are ramping up. We are expanding in a Chennai plant, and also our JV with Inventec will only come up by Q4 or Q1 of next financial year. My sense is those numbers. So large part of contribution will still be coming from mobiles. That's where we have the largest opportunity this year, and followed by telecom, I would say.
Okay, and what about segments like lighting, other appliances? I'm just trying to get a rough revenue pie mix, in a percentage sense. Should we assume that 90% will still be mobiles?
Almost 80% will be mobiles, 75 to 80%. The way we report is mobile and other EMS division, which also includes your IT hardware, also includes your telecom. So telecom vertical for us will be closer to 5,000 odd crores, which will be broadly 9 to 10% of our revenues. And but mobile will be the largest contributor. Lighting, our JV with Signify should be operational in the first week of August. So once the JV is operational, we expect to get more product categories from Signify for the Philips brand. Gradually and slowly, we'll keep getting some export opportunities there. So yes, the lighting revenue should see an uptake. Our refrigerator revenue should see a significant uptake this year because we are expanding our capacity in direct cool and also adding more product categories. So that will also start making meaningful contribution in the next couple of years. But mobile will be the largest piece for us this year.
So all this washing machines, telecom, lighting, IT hardware, all basically starts to show up in size FY27 beyond.
FY27 and beyond, right. Absolutely, Prashant.
On electronic components, we've spoken about this quite a bit and how that kind of helps you improve margins. Have you that subsidy scheme, what's the status?
Yes, so subsidy scheme, we expect to file our applications under the ECMS category. The deadline is July 31st. So we have already signed up the JVs on the display side, on the camera module side, on the mechanical side, on the precision component side. So we'll be filing our applications in the next 7-10 days before the deadline of 31st of July. And then, yes, the camera module, since it's an Indian acquisition, Indian company, which is already operating in India. So we plan to close the definitive agreements in the next couple of months and hopefully start consolidating by Q3. As far as the precision components, mechanicals and metal parts is concerned, it will require the Press Note 3 approval, which would take another 6-7 months. So hopefully the number should start reflecting by next financial year. And our display, the construction is underway right now. And the mass production should happen only by Q1 of next financial year. So next financial year, we're expecting at least a 120-130 bips margin expansion, net of the PLI impact that will go away. And by 27-28, there'll be further ramp up and stabilization of all these components. So I think so the margin expansion can be slightly better in FY 27-28.
Okay, Saurabh, we haven't, I mean, it's been a while. We haven't spoken about the semiconductor plans, I mean, and the facility that you were looking to set up in Noida under the semiconductor mission. Can you update us on what's happening there and, how much money you've committed as of now?
So, Surabhi, we are still awaiting for that ISM2 approval of the government, which, of course, has still not yet come in. So, we have already tied up with HKC for the display modules, and getting into a fab with them will be a natural extension for us. But we'll wait for the guidelines because since it's a large capex, we would need that support from the government, both from the central government and the state government. So if 70-75% of the capex as part of the policy guideline is committed by the government, then we'll be between both our partners, us and the HKC, will be willing to put in the balance 25%. So we are still awaiting for that approval. My sense is it will take some more time, I would say, for the government.
Is it right? I mean, there were some numbers floating that this could involve, this facility, including the fab, could involve a capex of 3 billion. Is that right? So, and you're hoping that the government kind of pitches in with 75% of that?
That's right. That's right. So 3 billion and our outflow would be 750 million. And within that, the partner should put in, say, 1/4 of that. So Dixon's outflow should be 500 million, which should happen over a period of 3 years because this is a large, big gestation project. This will take a couple of years to 2-3 years to come in, which we feel confident seeing the balance sheet and seeing the earnings visibility that we have and the growth that we have. We feel confident that can be funded from the internal accruals. And even if some debt is required, our debt to equity is hardly there. It's almost negligible. So we can always take some little bit of debt, but large part of it can be funded from internal accruals. But that can add a significant more to our business because that is not only for mobiles, that is also for notebooks, that is also for LED TVs, and also for automotive displays. So automotive displays is also something that we will be getting into very shortly in the next couple of years.
Sorry, Saurabh, the fab is that you're talking about, that is for what?
So fab is the, so as of now, Prashant, we're getting into the display modules.
I see.
Which is part of the component PLI, which is again with HKC. Fab is another one level more extension by getting into the display, absolutely display manufacturing, which would include the semiconductors and the other deepened manufacturing process. So HKC has a fab in China. So if the government comes out with a policy on ISM2 with a committed budgetary outlay, then we will look into get into that.
ISM1, I think there were four awarded, right? 4 companies were given.
Yeah, it was given to Tata, CG Power, and I think so
Keynes was one, and there was one more.
That's right.
But but under that there is no. I thought there was some more which got spilled over, and there are still limits left out of what the government said wanted to allocate.
I think so. The budget was exhausted, Prashant. That was a $10 billion commitment from the government that was exhausted. So we are hoping that another ISM2 should come in because any semiconductor or display is a very critical component which goes into any electronic product. So of course, our play will be more into the display fab. So let's wait from the government to come that, and then we will finalize our plans on that side.
Just one thing just to go back to the phones, basic bread and butter, what percentage of what you make here is exported, Saurabh?
So this year exports will ramp up significantly. Last year we were at 1,700 odd crores out of 39,000 odd crores. This year we hope to do an export of closer to 7 to 8, anywhere between 7 to 9,000 odd crores. The first quarter number is already 1,700 odd crores. And one, of course, for our anchor customer to US markets, where clearly there's a big arbitrage now. And secondly, for another customer, which is also our partner, we are working on a large export order to Africa markets. So let's see.
So just to again, since percentages help us understand this very simply, exports as a percentage of your total revenue this year would be how much? And exports to US as a percentage of the pie would be how much this year, Saurabh?
Yeah, so large part of this 8,000-9,000 crores will be for US, Surbi. A small part will be for the other brand for the Africa markets. But we see that number growing in the coming years. So all put together, my sense is if last year that number was 5% of our revenues, this year broadly that number can be 14-15% of our revenues, if not more.
Okay. By the way, you're also doing a joint venture with the, in your telecom business. Apparently that's something, you mentioned something in the call for again, some high-end, perhaps a tech collaboration. Can you just give us some more details there?
So Surabhi, those details are still in the works right now, and I'll be able to share that. But yes, it will be for another electronic component, which is part of this electronic component scheme. So yes, hopefully you should hear some more announcement from us on the telecom side. Yeah, it is a component which goes into data centers as well as for telecom products. So we are working with a company which is very big into that and has a very good technology on that.
And Saurabh, I'm sorry, back and forth. I forgot one point since we were talking exports. Now, especially with your US client, we still don't have final contours of a deal. If you look at our regional, markets here, so between 15% Japan, some are at 20%, South Korea is at 25%. Now, if the final tariff for India ranges somewhere in this vicinity, if it's more than 10%, 15 or 20 or whatever, I mean, how does that impact you, or is it all completely built into the deal with your US client? I mean, does it impact the offtake in any way?
So Surabhi, I think so more than Japan, I think so we should look at manufacturing nations which are manufacturing mobiles, which is majorly China and Vietnam for us. So China, we feel confident that there will always be a decent arbitrage, and like the way it is today, and hopefully it should remain that even if the deal is not closed with India today. And the other is Vietnam. Vietnam deal is already announced. So let's hope that our numbers with Vietnam should be lower. Yeah, so that's we are hoping for.
Okay. Just one last question, Saurabh. Rare earth, any impact? Restriction on rare earth?
Not specifically in mobiles or per se, but yes, it has some kind of impact in our variables business, but there are alternatives being worked out. So not a big impact for us as of now.
Okay. All right. Saurabh, good discussion. I think we covered a lot of ground, and thanks very much for all the details. Appreciate it. Good luck. That's Saurabh with Dixon Technologies with some perspective. Markets, by the way, are down about 35 points. Just look at Idea Forge, another name which is seeing a bit of a crack now. So Idea Forge is down about 6% at this point in time. Tejas Network is down about 3%. Actually, in the mid-cap side, there's a lot of stuff which is moving. I mentioned Ion Exchange. Volumes are large on this one. I will check if there was earnings or something else. Oberoi Realty is down about 3.5%. India Cements is down about 3% or so. Raymond is down about 2.5%. Jana Small Finance Bank is another one. I think it's down 6% at this point in time. Kajaria is down about 3%. And these are all large liquid names which are seeing some activity as things stand right now. On the way up, if I can spot any outliers, Nigel mentioned Bombay Dyeing, which is up 9%. Anthem is up, the recent listing, 30% pop on day one. It's up another 3.5%. It's got very large volumes on it. Credit Access, of course, we mentioned. Sapphire Foods is up 5% at this point. There's a stock called Infobean. It's just coming up with very large volumes. 533, stock's up 19%. Not Infobean. Ends with an N.
I didn't know that existed. I thought you were talking about Infobeam.
I don't think we have it, but it's showing up. But I think it's the 6th or 7th largest volume traded name on the NSE. So yeah, things are popping all over the place. Leela, we just had the management with us, about 2.25% higher. Godrej Agro is up about 3%. So yeah, there is a lot of action, a lot of
Sapphire is running very, very hard.
Sapphire is up.
Sapphire is up 5%. You have Anthem Bio as well. It's given you a big listing pop and it's building onto those gains as well. So massive move out there. And we were talking about the refiners a couple of days ago. MRPL, the numbers look very, very disappointing. But it seems, the street liked what they had to say in their con call. And that's why, actually the stock is now above what it was prior to the earnings. So it's recovered all of those losses, and CPCL is the one that we'll watch out for in terms of their numbers in the coming days. So we'll keep an eye out on that name. For the time being, it's down 1.5%.
Nigel, Hormuz has spotted that stock for us. We'll get it added. It's Infobeans, right? Ends with an N again. 2.5 lakh shares traded, and that's why I spotted it. 20-day average is 600 shares, and that's why it came up on my screen. That's the one I'm talking about. 600 average and 2.5 lakh shares today. It's a software development company, Hormuz tells me. So we'll have more on this one in Hormuz's unusual mover segment a little later in the day. But it's a pretty vibrant screen with enough up and down as well. Market breadth, though, is slightly negative. We take a quick break here. Mitesh Thakkar joins us on the other side.
Welcome back. Well, the market's still holding with a gain of close to around 50 points. However, the mid-caps are doing a relative underperformance in today's trading session. Let's get in Mitesh Thakkar to help us out with his take on the markets. Mitesh, I don't know whether you've observed, but Bombay Dyeing, that stock is now up 10%. There's a massive move that we're seeing on that particular counter. Very, very high volumes on that name. There are close to 2 crore shares that are traded in 1 hour of trade. Anything you're looking at on the charts? I highlighted a few days ago that there was massive delivery-based buying on this name.
Nigel, you're right. I think this is one stock which has given a breakout on short-term as well as medium-term charts. The minimum target I'm looking at is about 190, 195 zones. But logically, I think the stock could even head towards 220 plus. So extremely positive over here on the medium-term chart basis. Slowly accumulated because the stock has already moved up today. But yeah, I think, traders should look to get into this. And as long as the stock is above 165, 164, good chance that we'll eventually see 220 over the next few weeks, maybe a couple of months.
Okay, got it. Quick word then on the markets as well, the Nifty price action, and give us your couple of stocks as well.
Nifty, nothing much. We've had a opening and then we've been kind of very flat. And I've said this, that, we are most likely doing a range of about 25,300 to about 24,900. So we're still in the middle of the range. But Bajaj Finance is something, which comes on my list. It was a buy a few days back as well. Good setup over here in terms of hourly and 2 hourly charts. So keep a stop at 950, look for targets of 990 plus. And a lot of real estate names have broken down. Today we are seeing some negative movement in Lodha, DLF, as well as Prestige Estate. So Lodha Developers, which is Macrotech, despite the fact it's down 5%, slowly shorts can be taken with a stop about 1380 and a target of 1300 is what I'm looking at.
Okay, all right, great. Thanks a lot for that, Mitesh. Well, let's focus on SBI then. They raised 25,000 crores by India's largest QIP. Our colleague Yash Jain caught up with the SBI chairman, Mr. Sethi, and asked him about how will these funds be deployed. Let's listen in to what he had to say.
We always had adequate CRAR, the capital ratio, which helped us to achieve the credit growth. Maybe, we were saying 6 to 7 lakh crore credit growth could have been supported without raising this capital. But this augments our common equity tier 1 capital. So the CET1, as you know, will improve up to 11.5%. Our end objective is to take the CET1 to 12%, and also the CRAR increases to 14.9%, and probably we will have 15% CRAR through the cycles.
Correct.
Which means that these two capital ratios, while not very significant from the credit growth point of view, but will definitely provide the confidence to the system, investors, regulators. This is the purpose of that.
The second question, sir, the major investors which come through this?
I think there's very diversified investors. Obviously, there has been a good demand from the overseas investor, and that shows the confidence in the Indian economy and SBI in particular. Very diversified customer base, and of course, there's been a good demand from the local AMCs, DIIs, what we call. I think it has been a very diversified one.
Okay, second question, sir. As far as the 25,000 crore is concerned, now the need to value unlock some of your subsidiaries, SBI Mutual Fund, SBI General, does that go out of the window at least for the next 1 year? And what happens to the deal with Yes Bank?
So we did mention earlier that our various components which we have, it could be S Bank or NSE or subsidiaries, all these are still on the table. Nothing is off the table. Our end objective is to further strengthen the CET1 capital, and we will use all the components at the appropriate time.
Okay, all right. Well, let's focus then on some stocks on the move. Dalmia Bharat, well, that's reacting to its Q1 performance. And at the start of today, we said that the numbers were good. But now that surprise element actually is missing. And the stock in the last 1 month or so, today it's come in for profit taking. Pull up a 1 month chart. The stock actually has seen a big rise of more than 10%, even after this 2% pullback. And it was closer to around a 52-week high. The numbers look fairly okay. Top line was a small miss. The EBITDA number actually was better. What played out here? If you pull up the EBITDA per ton, it came in at around 1,261 rupees, which is a sharp improvement both on a sequential basis as well as on a year-on-year basis. The problem was on volumes. They have degrown by close to 5%. That's, even if you exclude the JP volumes, which was at around 0.4 million tons, then as well, the number is more or less flattish. So no volume growth is something that the street will be disappointed on, because that means they're losing market share. Though on the realization parameter, there was a positive surprise. Since they have a fair bit of exposure to South India, realizations went up by close to 9%. Their longer-term time horizon is good. Currently they're at around 50 million tons. They've laid out a plan to get to the mid-60 million tons or thereabouts with the plan that they've raised. They've already announced a capex as well at roughly around $65 on a per-ton basis. And the capex spend that they've earmarked is close to around 3,000 crores for a 6 million ton capacity with a 3.5 million ton clinker capacity as well. So the trajectory is good. They're going to be becoming a larger size cement player by 2028, when they're saying they're going to be a 75 million ton unit. However, lack of volume growth seems to be plaguing the street, and lack of a positive surprise as well, is the reason the stock is coming for profit taking, because the street sniffed it, had already run up in anticipation to these numbers. That's about Dalmia Bharat. I'll tell you what, we'll slip into a short break, but Manisha is waiting for us on the other side. She'll tell us all that's going on in the commodity space.
Welcome back. Well, let's shift the focus now to the commodity markets. As promised, we have Manisha joining in with the latest. Manisha, good morning. So what are you tracking today?
Oh, it's a silver lining to silver, really, because we've seen very strong gains come in for this one. Silver actually is outperforming gold when you look at the last 1 month or YTD numbers as well. There you have it on your screens. So in last 1 month, we've seen gold prices gain up by 3%. Silver is up by 9%. In this year now, silver clearly is taken over on gold. With 32% of gold gains, we've seen silver gain up by 36% there. So when you look at the gold prices, we did see an all-time high in this year, in the first quarter itself. And even at this point in time, so gold is trading at around 5-week highs into the markets. When you look at the gold prices, we're just about $60 away from that all-time high of around $3,500 an ounce. We seem to have slipped slightly more from those kind of levels. But when it comes to silver, well, we are trading at a 14-year highs in the international markets, and for the Indian markets, it's an all-time high at around 1,16,000 rupees a kg there. Well, a lot of supportive factors onto this one. To begin with, China has been pledging, talking about a lot of push when it comes to infrastructure projects coming in from the government itself, whether it is in space of auto or electric equipments, and that's exactly where silver usage will go higher. The global silver industrial demand in 2025 is expected to be at record highs. This would be a 4th straight year of industrial demand hitting record numbers in the global markets there. Also, the global gold and silver ratio trading at around 84 or 87 thereabouts is quite supportive for silver buying further from here in as well. The strong silver fundamentals are in case of supply and demand numbers as well. 2025 is the 5th straight year of deficit in the global markets there. The street is also looking at demand and supply numbers for this year, which are on the positive side. So when you look at the demand, it's expected at 1.20 billion ounces, while supply is at 1.05. And there's no carry forward from last year because this is the 5th straight year of deficit, and that clearly is giving support to silver prices there. Also, when you look at the ranges that the silver has put in, you can see it's on the higher highs. In 2023, $19 to $27 an ounce of a silver range is what we saw. It gained up to 22 to 35 in the previous year. And in this year until now, we've seen a higher range of around 29.5 to 39.5 or thereabouts for this year, with Street anticipating that you could be looking at higher highs going forward. And that's exactly what most of the banks and brokerages seem to be putting out. From JP Morgan to Bank of America to UBS, $39 to $40 an ounce is an expectation of an average silver price for 2025. And that just continues because when you look at the other banks like Citi, Stancy and Saxo Bank, they're also talking about 40. We're not too far away from there, but 40 of an average is what they're talking about. So if we've done 29 and 39 is where we're trading at right now. Markets do believe that you could be looking at 42, 45 on the higher side before this year ends.
Okay, so silver continuing to sparkle and shine. Thanks for that, Manisha. Well, with that, we're coming back to the equity market. The Midcap correction is now well entrenched. The Midcap index is down about 0.5%. The Nifty is holding on to gains of about 35 odd points now. So we've cooled off from the opening highs. Onto some stocks. Vinny is tracking Aurionpro this morning. Stocks under a bit of pressure. Vinny, what's happening?
Hi, good morning. So this is coming in after their earnings that were reported late last night. Now, when you're looking at it, the Q1 FY26 number on a quarter-on-quarter basis, revenue has just seen a growth of 3%. Profits are up marginally by 2%, while margins have remained almost flattish at 20.3% this time versus 20.2% in the last quarter. This is the EBITDA margin I'm talking about. They've added 16 new clients. But what is the factor that comes into play? Sequentially, when you're looking at this 3% growth rate, that is one of the lowest growth rates that the company has seen, or the slowest growth that the company has seen in almost 2 years. And on a year-on-year basis also, the growth is just coming in at around 28.7% for Q1 FY26 versus Q1 FY25. So that growth is also significantly lower. And the last time we'd seen such slow growth rate for the company was somewhere in September 2022 on a year-on-year basis. Now, when last we spoke to the management as well, they'd given a growth guidance of 30% CAGR growth for FY26, full year growth. Now, clearly, 28.7% is slightly below that. So that is a bit of a concern. But in the press release, the management has highlighted that, they are on course to meet that full year growth guidance. But we'll have to wait out for more factors coming in from them in terms of banking. How is that doing for the company, as well as the tech segments? These are important for the company. As of now, a weak number coming in at least on the top line front. PAT margins are in line with their guidance that they're given.
Okay, all right, Vinny, got it. Thank you very much for the details over there. With that, we do have to take a very quick break. Coming back on the other side, Lata will be in conversation with Santanu Chakrabarti of BNP Paribas on the Q1 banking results we've seen so far.
Welcome back. We are still tracking results, banking results in the first quarter. So far, both public and private sector have largely been above market estimates. ICICI at one end has, of course, been exceptional, while Axis Bank disappointed with higher slippages, albeit technical, they called it. But are the numbers all priced in? And how will the rest of the year pan out? Joining me, Shantanu Chakrabarti, India analyst, BFSI at BNP Paribas. Good morning, Shantanu. Thank you very much indeed for joining us. Well, you know, your best pick is HDFC Bank. I would have thought, going by the results, ICICI Bank with margins, which is about 70 basis points higher than HDFC Bank's, would steal the cake. But anyway, let's go one by one. HDFC Bank, what makes you so confident that the mean will revert and they will come back to that near 4% margins?
Right. Good morning, Lata. First of all, it's a pleasure to be here. And you're right. I mean, if I have to name a leader in the entire banking pack today, I think the baton has arguably changed hands from HDFC to ICICI a while back. Some of it may not be within HDFC's control. After all, when you get a full, large wholesale liability franchise merged into you, your liability strengths on a percentage basis do not remain what they were. My argument in HDFC Bank rests on the simple premise that there are certain new realities with the new balance sheet, which is basically that fundamentally this is now going to be a lower margin business. But at the same time, thanks to the scale that comes in, it is also going to be a lower operating cost business. And finally, within the next 2 years, you will see exit ROAs and ROEs converge with its pre-merger levels of 2% and 17% respectively, which should drive the full re-rating. In fact, the anticipation of the same or visibility of the same should be enough to drive the re-rating back to something, if not the older multiples, something fairly north of where things stand today.
Okay.
Having said
that's
that,
very important. Yeah, sorry, go ahead. Sorry.
I said that having said that, I have, no reservation in calling out that as of today, on landed cost of liabilities, even adjusted for scale and operating cost, etc., ICICI has a clear edge over everybody else. It has the greatest privilege in banking, which is the ability to pick and choose the risks that you want because you have a cost edge. As far as HDFC Bank's results go, frankly, Lata, I think post the results, markets have probably treated the bank stock a little better than I would have expected it to. Because on margins, just you were pointing out, ICICI's margin performance. Quarter on quarter, the dip for HDFC Bank was a little sharper than most people expected, right? I mean, it's not a deal breaker in terms of a long-term thesis, but the immediate reaction being positive despite that is something which is quite interesting.
Okay. No, I agree with you. I think everyone is believing what you are saying, that even if the margins don't come back to the 4% plus, they will manage on ROE because of other reasons. But even the ROE is about 14.5, isn't it?
Right.
Compared to, I think, ICICI 16 plus, almost 17. So by when do you think HDFC Bank gets to its old ROE? Is that happening end FY26 exit of this year? Is it happening exit FY27?
Right. So, Lata, to answer that question, the first thing we have to keep in mind is the amount of legacy liabilities which are high cost, which they have inherited from their erstwhile parent. This comes in two primary sources. One is the non-convertible debentures, which HDFC had issued. On that, the expiry schedule is available with us. And therefore, we know we have about 1,90,000 crore kind of numbers still outstanding at about 8%. And similarly, there's, of course, term deposits, which have been grandfathered in from the erstwhile parent, which would also be typically at 50 basis point, 25 to 50 basis point higher costs than what HDFC's equivalent cohort would be. So both of these, I think the expiry schedule on both of these ensures that on a secular basis over the next 7-8 quarters, each quarter HDFC Bank has an incremental tailwind of 2-3 basis points building up sequentially every quarter on margins. Now that may not sound like much on a per quarter basis, But if you add up, it adds up to almost 15 to 20 basis point of margin tailwind over a 2-year period. Now, other than that, there are, of course, cyclical factors at play. Please understand that if I calculate CASA as a percentage of total liabilities instead of deposits, HDFC Bank's CASA today is below 30%, right? So, and of course, there's a CASA engine out there, which even though in the last year has been outshone by ICICI Bank, in the 3 previous years before that has done a fantastic job of shoring up whatever little was available in the system. So from that point of view, as the easing continues and low-cost funds become more and more available, HDFC Bank should be in a good position to take advantage of that. And I think in management commentary also, you can see allusions to that factor. When management is saying that, that we are basically now willing to accelerate in the first stage, bringing it to 95% credit deposit ratio and mobilizing money was the key, while now we become more selective, more aggressive, better cross-sell to clients and so on and so forth. Now, obviously, they have the machinery to get that done. So I think, they remain a very counterintuitive beneficiary of easing, even though they are 70% floating rate assets.
Okay. Yeah, we are forgetting that even if you look on a year-on-year basis, that stock has given about 15% returns. It was around 1,700 same time last year. So it's a fairly decent return in terms of stock price as well. Obviously, most people believing what you are saying, that the ROE will come in good time. Now, I have a more general question before I delve into the specific of Axis and ICICI. Do you think that the banking system or banking investors are not prepared for a much lower credit growth? The credit growth numbers, fortnightly numbers, are still single digit. Now, is it likely to remain that way for the rest of the year, given that credit offtake is... most bankers are telling you credit offtake is not happening.
So, Latha, the way I look at this is that whether any future rate cuts pan out or not, simply from the amount of liquidity available and the soft indicators that RBI is putting out, the subtle change in tone that you see in commentary of the banks, where they are saying, we are well poised for growth, etc. I think we are at the cusp of a small growth acceleration, but let's keep that in context. I'm not saying that we are going to go back to 17-18% credit growth. I think we exit this financial year with about 13% credit growth, which is still almost 300-350 basis point acceleration over where things stand today. Now, what gives me that hope? This quarter was the last quarter where a high disbursement number was in the base for retail loans. The next 3 quarters of the financial year actually have low disbursement numbers for retail loans, mainly because of the pullback that happened within unsecured loans and credit cards in this corresponding period last year. So I think for the full year, the banking system should be able to deliver 14 to 15% credit growth in retail. Just from normalization, not from going back to the gung-ho days of 25 to 30% growth in, personal loans. I'm just talking of a normalization. We, of course, remain constructive on the SME sector, and their 17 to 19% kind of growth seems to be holding on very well. The only laggard is going to be the corporate sector, in our opinion. I'm sure, the 101 arguments can be made as to why, it's just right at the cusp of an acceleration, etc. But I think given where the global macros are, if you talk to most promoters in India, very few people have the appetite to be jumping into large projects with long-term bank financing right now, especially when, a lot of foreign financing in the debt markets is available to them, right? So I think 6-7% corporate loans is what you should be budgeting for the year. But that still gives you a very solid 13%.
Okay.
And since
I agree with your 13% exit, maybe not 30, at least 12, but the average for the year could still be single digit, is what everyone, every banker after banker tells me, we have money, but whom do we lend it to? That seems to be their problem. But anyway, we are running out of time. Axis, is this the last of the accidents? This came out of nowhere. would you still, you're still betting the house on Axis. Where does this confidence come from? Even the loan growth has been muted.
Right. So, I mean, Axis has disappointed continuously for the last 4-5 quarters by small measures, which is why the hope has not died, but it has been frustrated again and again and again. So firstly, let me highlight what are the two things working in its favor. One is, of course, the valuations. If anything's trading at 1.6 times 1 year forward, and it's a 40% CASA bank, which still can do mid-teens ROE, without huffing and puffing too much in terms of what risks it takes. It looks like good risk reward. Second is on the liability side, given the degree of short-term funding that they have available, they remain one of the early responders on cost of funds as far as an easing cycle is concerned. That's what's working in its favor. What's not working in its favor is ever since the merger and having digested the merger, in the last, especially in the second half of the last financial year and this year, headline growth numbers, whether they be on deposits, on loans, on low-cost deposits, that is CASA, it's been a bit of a disappointment. And there's just no squaring that circle. Even on credit costs, I will take you back to first quarter of the last financial year when the first spike happened. And they had, they didn't call it technical, but they said specific assets, we had to do some recognition. And, large part of it, they implied that it's going to get clawed back. But adjusted for, what happened with NARCL in the last quarter, where they got a release purely because of, change in regulation.
Yeah.
Otherwise, the true credit costs have averaged at about 83 to 85 basis points, right? Which is significantly higher than where the other large banks are posting. And they are talking of a retail asset cycle in a period where others see it normalizing, the minor cycle we have had in the last year. So, yeah, it's been frustrating, but I still think it is one of the better options for beta. Is it as at high in our pecking order as HDFC and ICICI? No. But it is one of the smarter beta plays, especially in a situation where, IndusInd Bank in itself is a harder buy for most people, given, the uncertainties around the name.
Okay. Yeah, if one is perhaps looking at a beta, then maybe Axis has a better chance, but still you are looking at an almost 40-45% jump from the current 1,100 rupees to 1,600 plus, which is your target. Right. That looked ambitious to me. Actually, I have more questions for you in terms of the MSME loans, but out of time on another day. Shantanu, thank you very much for joining me to analyze the results of the big banks that have reported so far. There are many more to come, especially the big SBI. We'll analyze that as and when. For the moment, a short break and then Chartbust.
Shares of Lodha Developers fall over 5%, and we have Oberoi Realty as well trading with cut for both companies. Equity is exchanged. Sources say existing investors sold stake in both companies.
Dixon Technologies trades higher on the back of a steady quarter in June. The profits rise 68%. The revenue is nearly double. The management tells CNBC-TV18 the order book looks healthy and guides for 40 to 45% revenue growth in FY26.
Shares of Idea Forge trade with cuts of over 5% after reporting an 85% dip in revenue year over year. The company has also reported loss for the last 4 quarters.
Cyan DLM trades lower after reporting its first quarter revenue and profit, which missed the street expectations, even though margins expanded.
IRFC trades higher on the back of its June quarter numbers. The company reported its highest ever revenue, while profit nearly rose 11% year on year.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. In the markets, though we are trading high with a gain of around 50 points, maybe your portfolio is not looking that great because the Midcap index actually has come in for some profit taking. Nothing too much to worry about, but I think the street is waiting for further clarity with regard to Trump's tariffs on India and also earnings season. Looking for a positive surprise, can Infosys provide that positive trigger? Hey, Mangalam.
We'll watch out for how Infosys does, but some of the earnings are fairly well received by the street. Case in point, Dixon Tech, it's moved to the high point of trade. Was a good set that came in. The street was expecting a good set, but I guess the management commentary and the outlook has the street excited. That stock's moved to the high point of trade. Whirlpool is the other one which is spiking right now as we speak. And alongside that, we have Biocon, which too has moved to the high point of trade. So there are a few stocks which are doing well currently in the green as against a lot more which are in the red. And Apollo Hospitals from the frontline end also moving higher. But by and large, the market still in that range of 24,950 to around 25,250 thereabouts. Dharmesh Shah of ICICI Securities joins in for a quick technical check on the market. Dharmesh, we find buying at the lower levels, we find some resistance at the higher levels. For how long will this band continue, and what will it take for the band to actually move?
Good morning, Mangalam. Yes, definitely. If you look at the market, I think since last 3 to 4 trading sessions, we seems to be finding the resistance around the 20-day moving average. But going forward, we believe, I think the way the technical setup seems to be forming, it seems to be the way we move from 24,500 to almost 25,700. It looks like it's a slower pace of retracement happening on the Nifty. So indicating, I think, the robust price structure. Now, the question is whether we see the directional. Yes, definitely, I think so. The way the VIX seems to be trading at 10.75, it looks like, I think so, we are near some bit of a big directional moves. Maybe in the next week, we should see some directional moves for the Nifty. But overall, if you look at the technical setup, it looks like the market breadth, again, a good indicator to understand the market sentiment. Currently, the total CNX 500, total stocks, around 65% of the stocks are trading about 200-day moving average compared to 50% of the last month. So even after we have seen a 3% cut in the Nifty, the market bet seems to be improving. So overall, the technical setup looks more positive. Maybe buy the dip should be the strategy going forward, but 24,500 to 24,700 remains to be the strong support. But we expect Nifty to head towards 25,700 to 25,800 in the coming few weeks.
Got it. Hi, Dharmesh. Good to see you in. Let's get to individual stocks then, because it's a stock-specific market. What's in your radar?
Yeah, so as far as stock-specific is concerned, Nigel, it looks like, I think the power space looks positive. Among the power space, JSW Energy is something which we like. I think so. The more of a stock has already witnessed a symmetrical triangle breakout supported by 50-day moving average supporting. I think so. The way the volume seems to be setting up for JSW Energy, it looks like it should be looked for a target of around 572, keeping a stop loss of 495. So JSW is one which we like. Apart from JSW Energy, we also like PFC Power Finance. Now, again, Power Finance, a falling trend line breakout of last 7 months of corrective phase and sustaining above 100-week moving average. Looks like, I think so, Power Finance should be looked for a target from 478, keeping a stop loss of 388. So PFC and JSW Energy remains to be a top pick.
All right, we take that point. Thank you so much for joining in, Dharmesh, and giving us your views on the market. Just keep an eye out on a couple of these stocks before we move forward. We have Bajaj Auto, which has moved higher. And from the broader markets, a couple of stocks which are worth mentioning right now, the ones which are spiking along. Bombay Dyeing up 10.5% on that counter. And SML Isuzu for the last 2 trading sessions has been continuously moving higher. In fact, post it reported its numbers, the stock has rallied about 18% odd itself. With that, let's get you an important programming note. We talk about the workplace. As it transforms, so must leadership. In the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like, how women are powering the future of work, capital and innovation. You can catch it live on July 29, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com and our YouTube channel.
Welcome back. You're tuned into Chartbusters here on CNBC TV18. Well, the company that's on our radar is Sagar Cements. They reported a strong showing in the first quarter, good pricing, good execution, and it came on a weak base. Now, they reported a profit after 4 consecutive quarters of losses. Mr. Srikanth Reddy, the Joint Managing Director of Sagar Cement, joins us on the show. Hi, Mr. Reddy. Good morning. Thanks a lot for joining on the show. We would request you to actually join us more often. But it's a good time that you're joining in because the numbers have been fairly good. And I think I understand that you're joining in from your Andhra cement plant, if I'm not mistaken. But good to see you have good connectivity. Now, a couple of points out here. You know, the street has always said Sagar Cement, there is good value out there on an EV per ton basis. Good promoter as well, good pedigree. The problem is delivery. Now, for this year, tell us what kind of volume number are you going to deliver, which you're confident about. And also tell us on an EBITDA per ton, you've done 850 rupees per ton. Looks quite good, but now input costs have moved up a little bit. You have the monsoon season, that will be a bit of a dampener as well. Steady state, what kind of EBITDA number should we work with on an average for the year?
Yeah, good morning, Mr. Nigel. Thank you again for hosting us. I think it has been a long overdue kind of performance from us. Of course, last 2 years was tough. One, the market pricing was relatively lower. And at the same time, we doubled our capacity from close to 5.5 million to 10.75 million over last 2 years. So most of the ramp-ups happened during last 2 years. I think on the expected lines, the cycle changed, the demand cycle, and so is the price cycle. So that helped us to perform relatively better. But I think we are yet to catch up with the best cycle, which we believe is yet to come, because most of the neighborhood, especially Amaravati and Andhra and Telangana demand, likely to pick up from here on. So that should help us perform even better than what we have done so far. In the current year, we believe that we could do close to 6 million tons. With an EBITDA on an average at around 600 to 650 rupees EBITDA per ton kind of a number, Mr. Nigel.
600 and 650. The first quarter you did about 851, and you believe that going forward prices will only improve from here on. So what stops you from doing at least 800 to 850?
Yeah, internally, again, I need to pencil in something with a lot more realistic kind of numbers. Of course, in the first quarter, we also did receive an incentive, which is almost close to 32 crores of it. So that also helped us to show a better number. But we are trying to be, realistic in terms of 600 to 650 is definitely achievable.
So
we don't see a challenge with the pricing environment, but I think we need to be cautious too, right?
Yeah, I understand that. So all things considered, close to 400 to 420 crore EBITDA for this year is a relative possibility here, right?
Yes, sir. I think those numbers look doable realistically.
Got it. All right. A quick question, sir, in terms of capacity. As you said, in the last few years, you've steadily increased your capacity. And from being a marginal player, now you're a relatively larger player. In your core market, what is your current market share? And where do you see that number headed? And in terms of absolute capacity as well, from around 10.5 million tons, where do you want to go?
Yeah, the stated goal for us from a medium to long-term perspective is to double every 10 years. So the indicated number was to reach 10 million by 25, which we could achieve slightly ahead of time. So the immediate target is to reach 12 million by FY27 and 15 million by FY30. And by FY35 to reach to 20 million, Mr. Nigel. That's the stated goal. At the same time, though the market share is not a big KPI for us internally, but fortunately, we are one among the top 4 players in the markets that we operate, especially the AP and Telangana. Yeah, we are one among the top 4 to 5 players, Mr. Nigel.
Things are heating up in AP and Telangana. You are increasing your capacity, etc. as well. How much of this planned capacity increase would be organic and how much of that would be inorganic?
Yeah, I think Andhra, post-acquisition of Andhra, sir, we are currently expanding from a 2.25 million to 3 million. The first part of the expansion is likely to be completed before 30th of September. 0.75 million ton grinding capacity to be added either end of Q4 current year to the middle of Q1 next year. So that would be, this is purely a brownfield kind of an expansion at Andhra. And as you know, Andhra is more an acquisition for us. We did acquire Andhra close to 2.5 years back. So most of it, except for Matampalli, rest of all our assets in the entire portfolio has come through M&A.
Okay.
So this 30 million also happens through M&A only, is what we are saying.
I think up to 15 million, we are very clear it is going to be mostly on brownfield. Yeah, beyond that, we need to really strategize as we come close to that milestone of 2030.
Okay. All right. Mr. Reddy, let's get to the chase then. Let's go straight to that. Since you spoke about Andhra Cement, what if someone gives you, Mr. Reddy, a good valuation and says, Mr. Reddy, we want some presence in Andhra, and you have turned around the asset. If they write a check, how big the check has to be to make you sell that asset?
I think it's we are in business, Mr. Nigel. I think that is something which is very relative. It was a strategic acquisition from our side.
Correct.
Fortunately, the asset turned out extremely well.
Yeah.
There were many positive surprises from what we have expected to what it is, especially on the resource side.
Yeah.
When we started looking at this asset from an NCLT perspective, from then to now, we expected some amount of increase in terms of resources. But fortunately, since we started getting into detailed prospecting, the resources turned out to be a very, very positive surprise. And secondly, the asset ramp up is happening at a pace and a quality of kind of an asset. We believe that this would be one of the best asset in the
Mr.
market.
Mr. Reddy, phenomenal turnaround, everything, resources good. Will you sell it? You know, if there is a good, if someone gives you a good enough, I think what you bought it at, if you could, if you could help us jog back the memory, I think you bought it at $25-30 per ton. You could help me out with the number. What if someone gives you, say, $80 per ton? Will you be a seller?
No, I think at 80, less than 100, I don't think we would look at any of those discussions, sir.
So at 100, you're a seller.
More than 100, you will sell, right?
No, anything beyond, again, it's something which we have to see how the discussions are going to happen.
No, but you are in business, sir. So you wouldn't buy an asset just to turn it around and flip it over for a much higher price, or would you consider that if that was to happen?
No, that never happened in the past, sir. But
But now things are heating up, right? People are eyeing Andhra. They are looking at Andhra as a potential, and in there you've turned this business around. Over $100 per ton is something that is attractive. At least people can get to the table, right?
I think beyond 100, we would then start discussing with our internal stakeholders, sir. But less than that, I don't think we are engaging in any way.
Okay. Has anyone made an offer?
Has anyone made an offer, sir?
See, I don't think we have any offer on the table, Mr. Nigel.
Got it. Okay, so that's out of the way then. We'll get back to Andhra. I have a few more questions. But since you're talking about increasing capacity and suddenly Deccan Cement, we are here on the opposite side of the country, on the west coast. But out there is plenty of buzz for the last many years. Deccan Cement could be on the block, could not be on the block, maybe on the block. Would you consider writing a check to buy Deccan Cement? Does it fit into your scheme of things, or you would avoid it?
I think it's a very good asset, sir. But I think it is not a strategic fit for us, sir.
Not a strategic fit.
Not a strategic fit.
No, because I'll tell you why. Suddenly, South India is heated up. We had the Ultratech management saying that South could be the new North. So there could be some interest out there. What if someone writes a big check for you, sir, and says, I want to buy the full of Sagar Cement? I've asked you this in the past, but would you be a seller?
Yeah, Mr. Nigel, when Holcim themselves sold here, not many people expected. I think it's all something which we have to see as it comes. But we are very close to completing more than half a century of our existence in the business, sir. But we are not very emotive when it comes to the business. But we have to be very realistic in what is likely possible. Yeah, as you know, that we strongly believe that South is a good market. Perceptions apart, that's the reason why we have been investing heavily into some of the asset making itself, Mr. Nigel. I would leave the answer there and leave less for you to.
Right, we understand that. The one thing that I've learned over the last few years about North and South is North is a lot more consolidated and South has a lot more fragmented players as well in the cement space. Sir, just a couple of questions before we let you go, sir. One, you said that you are, willing to talk to people if it is over $100 per ton in terms of Andhra cement. Let's not get into what may happen or what may not happen. But would you ever consider the possibility of merging Andhra into Sagar, making it one entity itself? Because the shareholders of Sagar can then enjoy that turnaround directly. That's one. And secondly, what does your balance sheet position currently look like? Debt, repayment plans here?
Yeah, now the question is, I think this is 90% owned by Sagar Cement, sir. Ideally, and technically speaking, it would be good to merge. There were a few issues in the past because this asset we acquired through NCLT. There were certain constraints. We actually kept the minority interest in our mind, and we ensured that all of us would get the benefit out of it. And there are certain other issues which actually kept the merger not a possibility during the NCLT. Okay. But at this point of time, we would be more than happy to merge. But again, there are certain regulatory constraints because, as you know, we need to first comply with the minimum shareholding regulation.
So first, so Mr. Reddy, if I got it correctly, you'll bring the shareholding down first to 75%, and then you could probably look at the merger. Is that correct?
I believe that's what regulation is. So we would first like to comply with the minimum shareholding. Yeah, and would be more than happy to merge at the first instance.
I know the Vizag land that you've got is in process of getting cleared. Keep that aside. What is the rough value for the Vizag land at current estimates?
Andhra definitely has a land of close to 107 acres in Vizag city, sir. This was a 50-year-old kind of an asset which was partly acquired from the government. So at that point of time, the agreements were that we should get government clearance for us to do anything other than putting up the plant there. So given that, we are awaiting for regulatory clearance for us to
sell that land.
No, sell that asset because we are not into real estate. So it's
five crores per acre is a rough estimate. 5-6 crores.
I think the government reckoner rate at this point of time is around 4.25 crores per acre.
Got it. So it could be around 500 crores the overall value of that asset.
Yeah, at around 450, and we have been consistently disclosing to the market that net expected could be somewhere around 350 crores net of the capital gains.
Got it. Take that point. Thank you so much, sir, for joining in. Nigel?
Yeah, that's it. Thanks a lot, Mr. Reddy, for joining in. Join more often. Good set of numbers. We'll track you to all these numbers. Rough estimates suggest close to around 400 crores of EBITDA is what you're penciling in for this year. Take that break, come back, continue our focus on markets.
Welcome back. You're watching us here on Chartbusters. The stock on our radar is MCX. Why is that? Because trading on MCX began with a slight delay in this morning on the back of a technical glitch at the exchange. Whether that's fixed or not, Manisha joins in to tell us more. Manisha.
Well, thank you so much for that. Well, it's a day when, the commodity market traders would have wanted to start on a good note because you've seen silver at all-time highs, gold prices surging, even the metals are doing well. But we did not get to, or the traders did not get to trade in the Indian markets. That is because the exchange started trade instead of 9 a.m. at 10:20 a.m. approximately. So a delay of an hour and 20 minutes there. Well, we did see those updates coming in on the MCX website, telling us on what time the exchange would open. But I have spoken to a lot of brokers since then, and they say that there have been concerns in the last few days where they have seen errors, anomalies coming in from the exchange. Well, today there was a delay in receiving margin reports from MCX is what the brokers tell us. And the member files have seen delay in much of last week as well. The other thing is about available margins and blocked margins, which displayed incorrectly. And then again, brokers tell us that the disaster recovery site in the last couple of days has seen some issues there. Also, when you look at the member payout files from exchanges, they have had amount errors or mismatches as well. Some places the payouts have been more, sometimes less. So clearly there has been excess and gap when it comes to payouts as well. This is all brokers and members telling us right now. And then apart from that, many of the brokers also said that because MCX was not functioning, there was a push from many of the brokers to start trading on NSE commodity segment as well. Now remember, MCX takes or stands with nearly more than 90% of market share when it comes to trading in case of commodities, the non-agro ones, whether it's about energy, precious metals or base metals for that matter. Much of that volume, as I said, 90% of the lion's share goes into MCX, while NSE also has a lot of commodity segment and a lot of commodities listed on their platform. Today was a day that there was a push coming in from brokers to kind of make use of NSE since MCX was not working for more than an hour in the morning.
All right, Manisha, thanks a lot for that. So that's about the MCX technical glitch that took place, but trading has resumed, Manisha says, after an hour of a bit of a problem. But let's look at Colgate before we wrap up on this edition of Chartbusters. Colgate, the stock is under a wee bit of pressure. It's actually lower by about 3%. After having underperformed from its peak, it's down almost 40%. This on the back of poor numbers that came in yesterday, but more importantly, thereafter, the management commentary wasn't very inspiring as well. They expect gradual recovery only to happen in the second half of this year. There was weak demand, high base, and higher competitive intensity that impacted their overall business, even as the premium end of the business continued to do well. Brokerage is not very happy with that as well. We've got a couple of downgrades coming in from a lot of the brokers. They've revised target prices lower as well. So HSBC, for instance, has a target price of 2,600, which they've revised lower. And alongside that, we have Goldman Sachs as well, which estimates that the volume decline has been close to around 3 to 4%. And there is structural weakness in the overall business. The only buyer on the stock is Nuvama, which has a target price a little over 3,100 rupees. They believe that recovery in the second half could come by, even though they expected the first quarter volumes to be lower by about 2%.
All right, Mangalam, that's about Colgate. By the way, there were some flashes at the bottom of your screen. Sudarshan just alerting us on that. There was some relief that came in for SpiceJet. Yes. The Supreme Court has rejected the plea by Maran own KAL Airways, seeking damages of around 1,300 crores. So because of the relief that's coming for SpiceJet, we saw a bit of a spike up. Remember, the stock is a far cry away from the price at which they issued shares at. And the market share losses has been something that's plaguing them. They've turned around the asset a little bit, but this is additional news besides operations that has come at a bit of a relief for investors, up 3.5% as we speak. But we have completely run out of time on Chartbusters. You stay with us. Trading Hour comes up next.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormiz Fatakia, and Reema Tendulkar will be joining us in just a bit. And while we are waiting for Reema, Hormiz, let's quickly take a look at what the markets are doing. Yesterday was a range-bound session, of course. We ended largely flat. But today there is some uptick that we are seeing. Nifty is up 61 points right now. It has maintained those opening gains that we saw. And in terms of the broader market movers, that's where we are seeing some pressure that has come by. 140-point downtick in the Midcap index today, and it has seen some recovery from the lows but continues to be an underperformer. Midcaps have been under pressure for quite some time now. Nifty Auto, the top gainer today, 0.7% higher there. IT is also contributing to some of the gains that we are seeing. And, it's a very stock-specific market again in terms of results that we've been getting. In the Nifty pack, as I said, Nifty Auto is doing really well. So Tata Motors is the top gainer, 2.5% there. Maruti Suzuki, you have a Bajaj Auto which is doing well. And apart from that, some of these financial names as well doing well. So we have Bajaj Fin and Jio Financials, two of these names which are in focus as we speak. But again, we are in the midst of earnings season. We got those big banking names, and that continues to be the case. IT is almost over, I think, now.
It'll be over today, at least the larger ones, yes. And we count down to the big Infosys results later this evening. And not just Infosys, the two major mid-cap IT names, Persistent and Coforge, also report results later this evening. It's a huge list of companies that are reporting results today, be it Persistent, Coforge, SRF reporting results today, Bajaj Housing Finance reporting results today, Dr. Reddy's, Tata Consumer. So it's a really long list. And you take a look at some of the earnings reactions as well that have come in today's session. Take a look at Jana Small Finance Bank, 7% lower on that stock now on the downside. Idea Forge too, now down 6%. Now remember, Idea Forge was one of the biggest listings of 2023. It had doubled on its listing day, which had a listing day high of around 1,350. And since then, the stock has now just collapsed to 510. So that is one of those stocks that you need to keep an eye out for. The other one, Blue Jet Healthcare, the earnings accident of yesterday was down in a 10% lower circuit yesterday. Is down another 5% in today's session. So that continues to make losses in today's session as well. So 5.5% lower on Blue Jet Healthcare as well. And I was just, since as we on the subject of stocks, say hi to Reema Tendulkar as well, Reema.
Hi. You said on the subject of stocks, say hi to Reema.
We'll continue with more.
Okay, so with IT, we had to talk about you. So let's talk about stocks, but this time from the capital goods sector, because it's time for our special segment, Quarter Se Quarter Tak. We'll get you the earnings expectation. Vamakshi is here to tell us how Q1 FY26 will shape up for the capital good companies. Vamakshi, take it away.
Well, absolutely, Reema. A steady quarter is on the cards for capital good players as healthy order books begin converting into revenues. To start with, all eyes are on order inflows. Momentum was held up well this quarter, supported by sustained traction in power T&D, renewables, and the buildings and factories segment. After a prolonged lull, the railway sector is finally showing signs of recovery since April. Early days, but the trend is turning positive. The standout performer, though, Hitachi Energy, with order inflows expected to surge fourfold. BHEL is likely to post a strong 37% year-on-year increase, while CG Power is set for a solid double-digit gain. On the other hand, we do have Thermax as well as ABB. They may see mid-single-digit growth, and Siemens could be the only name in the red with a slight dip in order inflows, a rare miss in an otherwise upbeat sector showing. Next up, revenues. Capital good companies are set to post an average year-on-year growth of 19%, clear evidence that the order backlog is translating into billing. Hitachi Energy once again tops the list with a 37% surge in revenues, thanks to the execution of the Mumbai HVDC project. BHEL and CG Power also stand out with over 20% growth each. Even Cummins, for that matter, is expected to clock 12% growth despite dealing with a high base from last year's pre-buying cycle. ABB and Siemens, after reporting low single-digit revenue growth in the previous quarter, are likely to post revenue growth ranging between 11 to 12%. Thermax is likely to maintain its 12% growth trajectory too. Margins, though, tell a more divided story. Commodity prices, copper, aluminum, zinc, pig iron have dropped, but margin expansion, not for everyone. Expect margin compression at ABB, Siemens, Cummins and CG Power, largely due to high base effects and moderation of pricing power. But three names buck the trend. Hitachi Energy with sharp margin gain of 750 basis points, BHEL with a 600 basis points improvement thanks to improving operating leverage, and Thermax aided by lower losses from bio-CNG and some of the other projects. Profits mirror this margin divide. Hitachi Energy is expected to steal the show with a 13.5 times jump in profits. BHEL is likely to stage a turnaround, swinging from a 211 crore loss last year to 71 crores in profit this time around. Elsewhere, Thermax is set for a 26% plus jump. CG Power may rise 18% and Cummins should post double-digit growth in profitability as well. ABB India is likely to report over 7% growth. Siemens, however, might lag with the slowest net profit growth among some of its peers. As far as valuations are concerned, there's been a reset, a moderation for most players, reflecting the impact of slowing order inflows and weaker infra spend. Hitachi Energy still trades at a premium of 125 times, but the broader peer group, including ABB, Cummins, CG Power, BHEL, as well as Thermax, are more reasonable as compared to earlier levels. In summary, strong order inflows, healthy revenue conversion, and selective margin improvement set the tone for Q1. With valuations not as overstretched as earlier, this quarter will be about operational delivery and who's best positioned to turn the backlog into bottom line strength.
Okay, all right. Thank you so much, Vamakshi, for joining us and telling us what to expect from the capital goods space this time around. To take this discussion forward, we are now joined by Pulkit Patni, who's India Industrial Analyst at Goldman Sachs. Pulkit, good morning. Thank you so much for joining in. You know, we heard Vamakshi right now talking about what is being expected from the sector. And there's a divergence in order inflows as well that we have seen. Order inflow is expected to be tepid for ABB India, Siemens, Thermax, while it is expected to be robust for other companies, the likes of BHEL, Hitachi as well will do well. What does that indicate about the underlying capex cycle going forward?
Sure. Thank you for having me. So we had published a report in April where we had highlighted that in light of the whole tariff-related uncertainty, we expect that private sector capex momentum in India will slow down in Q1 FY25 and things to recover after clarity emerges. Now, what we've seen and what we've flagged in a recent publication is that this seems to have played out. Power sector, which spans across renewables, transmission, distribution, is where award activity has been robust in Q1. Conventional power has been relatively soft because FY25 was very strong, and government-driven infrastructure ordering has been modest in Q1 as well. New manufacturing-related capex is expected to be soft as well, but as I highlighted, power and related infrastructure is going to be strong, and we expect that momentum to continue.
Pulkit, hi, Rima here. What about the outlook on exports? Considering the geopolitical uncertainty that's reigning currently, we're still navigating a deal with the US. Which companies would be impacted and what could be the extent of the impact? And would that be a bit of a problem?
Sure. In Q1, we've actually seen exports get a push as companies wanted to front load their export orders ahead of implementation of any tariff. And hence we expect industrial companies to report pretty strong export growth in Q1. Part of it could just be front loading from the second quarter. Based on the companies that have reported so far, if you look at the cable companies, both of which have reported, they've actually reported very strong numbers on export. And that is a reflection of what we've seen in terms of front loading of the capex, of the export capex in the quarter.
Pulkit, good morning. Thank you for joining in. You know, a lot of these capital goods companies have run up significantly over the last 8 to 12 months, and be it across sectors, be it the likes of Siemens or be it the likes of the railway names. Does the valuation surge mean that the margin for error this time around is almost zero, if you could call it that, and very little disappointment on either front could maybe trigger a valuation derating in any of these stocks?
Valuation did correct in the earlier part of the quarter, and obviously recently stocks have run up with valuations again looking towards the expensive side. However, our view is that companies where end market outlooks are strong, as I highlighted, sectors like power, its ancillary, transmission, distribution, we think even if Q1 order inflow is relatively weak, market should use that as an opportunity to actually buy into some of these names,
given the fact that power cycles don't tend to be small, in which case the order inflow outlook will pick up going forward. Obviously, this would vary stock by stock, but broadly, we think wherever the fundamentals in terms of the demand cycle is strong, they should be good stocks even at these levels.
So Pulkit, when we talk about order inflows, they will get better. Is it coming in from any new segment? A lot of new segments are also being introduced by these capital good names. There have been a lot of regulations, be it the emission norms, be it new gensets that these guys have been talking about. How do you look at the entire new diversification strategy taken by these companies, and all of this, would that be margin accretive as well?
Sure. So if you look at the past few years, a large part of the order inflow is actually coming from government infrastructure. While government ordering continues to be decent, we've obviously seen moderation on those high levels. Now, when we talk about specifics of where private sector orders have been coming up, as I highlighted, it is renewable power, it is transmission distribution, data centers, and in many cases, even new energy businesses. We've also seen some strong ordering from the electronic manufacturing sector, but the capex intensity of those sectors tend to be relatively light. And from an old economy perspective, ordering in sectors like cement, etc., continue to be fairly strong. So I think it's pretty broad-based in terms of where orders have come through for these companies.
So Pulkit, which would be your top bets from all the companies that you track at Goldman Sachs? Which are the buy calls? And also give us a picture of the earnings growth expected for the next 2 years and juxtapose that with the valuations.
Sure. So while we don't talk about stocks, we've spoken about the cables and wires sector, where we expect strength in terms of the demand outlook, both from the domestic and the international markets. And while valuations are broadly expensive, as I highlighted, as long as companies can deliver on their earnings, which in most of these cases is between mid to high teens, we think market should be okay with these rich valuations.
And since we are on that subject of the cables and wire space, Pulkit, competition is one such factor which has been a major trigger in the derating of a sector like paints. You've seen the competitive intensity rising there. A similar trend is emerging, at least in terms of competitive intensity rising in the cables and wire space. But do you see that as a paints moment for this sector, or do you believe that this entire space is big enough to accommodate more players and that the incumbents still have a long runway before the newer entrants eventually start playing catch up?
And this is something we'd also flagged in February this year, that there's a lot of capacity coming in the cables and wire sector. However, a lot of the final outcome on margins will hinge upon how the export market picks up. Let me just remind you, we're talking about a $24 billion export that happens from China and $1 billion of export of cable that happens from India. If we see any shift in that direction, which companies are talking about, then the capacities that are getting added in India could get absorbed. However, if the numbers do not pan out as such, there could be margin compression going forward, because in commodities, typically, when capacities get added, there is margin compression. So this is something we have spoken of in December last year, as well as in February this year. So far, companies that have reported earnings have actually shown robust margins, which means we are probably a little early to have that conversation.
Okay, all right. Take that point. Thank you so much for joining us today and telling us what is expected from the capital goods space and the outlook going forward as well. That's the word coming in from Goldman Sachs. For now, we'll slip into a short break. When we come back, we'll talk about the commodities space with Manisha Gupta.
Welcome back. 70 points higher on the index, currently still in that very narrow range that it has continued to be in over the last few sessions, almost in what, 80-point trading range that we have had all through the day, and it continues to remain. So the broader markets have seen some bit of recovery at the start of the session from the lows of the day. Had the mid-cap index recovered almost more than 130 points now from the lows of the day. So keep an eye out on the mid-cap index. But shifting focus to commodities, Manisha is here with us, and she is here to talk about metals, and they are buzzing in today's session, aren't they, Manisha?
Oh, well, yes, they are. It's a third straight day, by the way, Hormuz, in this week that we're looking at metal prices continue to trade firm. There are three macro numbers that really seem to be supporting the prices. One is, of course, China building 1.2 trillion yuan, biggest hydroelectric dam, and that would mean a lot of use of cement and glass and all kind of metals, and is the reason you've seen these sectors do quite well in the international markets. Apart from this, the China ministry is pledging to grow in sense of auto and electric equipments, the demand therein and the supply as well. So that has been supportive as well. And then you have the US dollar and the treasury yields continuing to decline, in turn supportive for many of these dollar-denominated commodities. So when you look at the nickel prices, we are trading at a one-month highs on this. Indonesia, remember, has cut nickel mining, and it has cut it by 120 million tons to almost 150, and that has been supportive. And then you're looking at copper prices trading not too far away from its all-time highs that we saw in the US markets. Even LME has seen some support coming in. The tariffs that are expected to take cognizance from 1st of August will include refined copper and cathode as well. So this is where you've seen extra price premium coming in as well. So it's not just about nickel and copper. Take a look at aluminum prices, lower supplies, improved European Union demand, and China production bound to have an annual cap around 45 million tons has been supportive for aluminum as well. Markets also are looking at ferrous metals doing quite well. So you have iron ore prices trading at around 5-month highs, steel prices trading at a 3-month highs as well. This is because China's public expenditure is supposed to be higher, and then China is working on reducing overcapacity, also cut excessive competition between steel mills. So it's about individual fundamentals and macros as well that has been supportive for metals.
Thank you very much for that. You guys were talking about how today will be the last of the IT earnings, the big ones at least. So Infosys today, and as you rightly said, Persistent and Coforge, these are the two fastest growing mid-cap companies, and all will be reporting numbers post-market hours. Now let's get to Infosys. Now, if you remember that all the four other IT companies that reported numbers, the TCS, Wipro, HCL Tech, TechM, all reported a revenue decline in the current quarter, negative quarter-on-quarter revenue growth. But Infosys will be the only one in the large cap IT space with a positive growth, 1.5% constant currency revenue growth, in dollar terms, 3.2%. There will be a benefit of the acquisitions that they did last quarter. They had announced so a 2-month benefit coming in from the Missing Link and MRE acquisition. So that, according to some analysts, will contribute about 30 basis points. EBIT margins are seen slightly lower, 20.7 versus 21%, while profits will be up nearly 4.5%. The key is going to be the guidance. The current guidance stands at 0 to 3% top line. Because they've done 2 acquisitions, which will contribute, analysts say the company will raise the lower end of the guidance. 0 to 3 becomes 1 to 3. But unless they touch the upper end, a 3%, it's unlikely to be a positive signal in the market. Margin guidance is likely to remain at 20 to 22%. What else will you watch? The usual, right? Like, how is the macro environment? How are the companies behaving? What's the deal pipeline, decision making? Generative AI wage hikes this time has been a topic of conversation because so many of them, companies citing uncertainty, have deferred or pushed forward the wage hike decision. So all that will be tracked. But in terms of numbers, the guidance for FY26 will be very, very crucial. If they can change the upper end of the guidance, that would be read very well by the street.
Okay, all right. So that's what we're expecting from Infosys today. From one tech, let's go across to the other tech now and get in Mitesh Thakkar for a quick technical check on the markets. Mitesh, thank you so much for joining in. There's been some recovery on the mid-caps, Nifty holding on above the 25,100 mark for now. What are the next important trades to watch out for?
See, to be very honest, I think, on the Nifty, I believe that we are still in some kind of a contraction and consolidation, broadly 25, 250, 300 to about 24,900. And the way the indicators are shaping up, this range could be in force for some time. So I would avoid trading the index, but be worried in case we get below 24,900. and look for a breakout about 24,300, 340 zone. So for the time being, I think avoid the index. I don't think it's giving you a very strong directional bias.
What about specific stocks, Mitesh?
I have NTPC on the radar. I think that's another stock which, if you look at the last about 8-10 days of price movement, has been doing a range of 350, 340, and now is showing first signs of expansion. So buy about 345, it's at about 343 half right now. Buy about 345, keep a stop at about 341, and 355, 360 should be the target range for the stock. And a couple of realty names, that's something which is slightly on the negative side. So earlier I had a sell on Lodha Developers. Now I think Oberoi Realty is a sell with a stop at about 1782 for targets of roughly around 1710.
What about Paytm, Mitesh? It's seen a very significant run up, right, from the Feb 2024 lows that it had. Is reacting to results today from almost 300 levels. The stock has gone up to 1100. Where do you see that now? Has it run its course for now, or are the charts still indicating some more strength?
So I think to me, Paytm, has had a very good rally. In fact, we had 2 or 3 times buy calls also over there. The important thing is that the stock is breaking above the highs which it made in December of 24. That was about 1022 to 1030 zones, which is where we had the highest monthly and the weekly closings. So as long as above that, good chance that the stock is looking at targets of around 1200 plus. So if you have hold it on, in case you get a mild decline, pull back to about 1040, 45 zones, that's your entry point with the stop below 1010.
Thank you very much for joining in. Get into a break. On the other side, we'll be joined by the management of Jana Small Finance Bank to discuss their Q1 earnings. Stay tuned. Welcome back. You're still tuned into Trading Hour. Jana Small Finance Bank, the stock is on our radar now. It is down over 6% after its Q1 earnings. The company's profits have fallen 40% while gross NPAs have risen too. To understand the quarter gone by and most importantly, the way forward, we are now joined by Ajay Kanwal, who is the MD and CEO at the company. Mr. Kanwal, good morning. Thank you so much for joining in. The general suggestion has been that the worst is over for the industry. That is something that you mentioned in the last quarter conversation as well. We spoke to Mr. Mishra of MFIN recently. He said maybe the worst is behind the sector now. But still, we have seen a spike in gross NPA for Jana Small Finance Bank by 20 basis points. Can you explain what went wrong here and which category particularly led to that spike in gross NPA?
So good morning to you and the viewers. Yes, the 30% of our book as of March 25 is MFI book. 70% is non-MFI, which is largely property-backed, affordable housing, micro-lab and others. And we have seen the first quarter, the increase of delinquency in NPA in our MFI book. I guess all of us were a bit more optimistic about when it will plateau out. And it has carried on a bit more than we all anticipated. Certainly we did. And that is where it's been an increase of gross NPA to 2.8%. It was roughly 2.7, so it's, or rather 2.6% as we finished March. Nothing that shakes us significantly, but it certainly makes us work harder.
What was the extent of pain, particularly in the MFI segment, 30% of your book? And do you think in Q2 that pain persists, lingers, or are there signs that it's peaked out now?
So the gross NPA for the MFI book is 5.7%.
Okay.
The gross NPA for 70% of our book, which is a secured book, is 1.5%, with a net NPA of 0.8, and in the unsecured book, the net NPA is 1.2. So we are very well provided, and we have taken additional excellent provision of 150 crores in Q1, which is why you see the PAT is at 100, to make sure that we are very well provided as we go into the next few quarters. We do see a small drop in Q2 and a significant drop in Q3. So what we saw, flow of customers both from Jan to March and a bit in April. So these are the 4 months which will then flow into NPA, which is why it will go up into Q2. And then there is no fresh incidents of any change externally. Our collections in May and June are at 98.6, 98.8, 98.6. So I think we are now looking at a very reasonable output after that. So Q3 will be a significant decline. Q2 will be a small decline. And there's nothing else which tells us that this should get worse then.
So what are the numbers? 5.7% in Q1. What could Q2, Q3, Q4 look like if you had to, make an estimate?
Tough to answer that because it's a denominator and numerator also.
Yeah.
And one of the things that has not helped the MFI business for us is our total book, which was around 10,000 crores, is down to about 8,680 crores. So the denominator has shrunk. So obviously the gross NPA looks more elevated. How much we grow the denominator will be one question. We would like to grow that very, very carefully. It's a short-term pain for sure, because when your MFI book drops, you do lose revenue. On top of it, you do have increased credit cost. And of course, for collection, you put in extra collectors. So the cost line also doesn't help you. So all three lines have not worked for us in the first quarter. We'll see some relief on the cost side because we are fully capacitized for collections. We should start seeing some positive shoots on the MFI book, on the growth side, and on Q3, then we should see the drop off in the NPAs. Q4, if all goes well, as you know, MFI does reward very well in good times. So if all three lines go right, then I think it should be very positive. But importantly, you see our secured business is doing extremely well, which is where our primary focus has always been. That's 70% of our book. It has moved to 71% in the first quarter. Numbers on gross NPA, like I mentioned, is 1.5%. And we do expect this book to continue growing at a 35% rate for the year. So asset growth will be strong. NPA numbers are good. Yes, we will have to live with the MFI book pain for a quarter, at best two, which is Q3 should get better, but we should really see back to growth in a full form probably in Q4.
Right. Mr. Kanwal, thank you for joining in. Since we were on this subject, your credit costs also went up this quarter, right? What is now the ideal range that you see? Now you're anticipating some relief to come in from the third quarter. What is the ideal range for credit costs that you envisage for the full year? And the fact that you have 30% of your book as your MFI book, do you see that mix changing since your secured segment is doing so well, as you mentioned? Would you want to increase that exposure and that part of the mix to say around 75% or maybe even higher going forward?
So we have stated upfront a few years back that our secured book should be 80%. So that doesn't change. Secondly, we've said our unsecured book, we would like to put it under the CGTMSE and CGMFU program to prevent any event risk. So as we speak, as of June, 36% of our unsecured book is already under the guarantee program. So two things. We're at 71% secured. We would like to get to 80. We would like to put more and more of our unsecured book into the guarantee programs. 36% achieved. It was 28 in March. It is 36 in June. We'll probably see a 45 to 50 range by September. So two activities. Third, on the credit cost, I think it's very important to understand. See, a regulatory provision that is required is 46 crores for the quarter. On top of that, we have done accelerated provision, which is not required by regulation, of 150 crores. So the only way to think about it is, yes, we would like to create buffers for provision.
Right.
Unless we don't see a very clear environment ahead of us on the MFI piece. So is the credit cost really 150? I don't think so. With the accelerated provision, I'm sure there'll be some better answers coming up in the next 2 quarters. But to ensure that we are having a gross NPA of less than 3 and net NPA less than 1, which has been our stated stance, we have paid an accelerated provision of 150.
Got it. Okay, so Mr. Kanwal, then before we wrap up this conversation, what is the outlook for FY26? You had an ROA guidance of 1.6 to 2%. Currently, it's 1.1%. Are you on track to achieve that? What would the credit cost look like by the end of this fiscal? And what about net interest margins as well? They have fallen 50 basis points quarter on quarter. Can you tell us the FY26 plan? What are the numbers looking like broadly?
So let's start with the last one first. Gross yield of the asset book is 16.5 in March. It is 16.5 in June. So there is no drop off on customer yields. Due to a variety of HDMs and OMOs, some of the high yielding treasury book has been sold. The buyback is of low yielding, which is where the NIM challenge has come. Positive side is, you've seen the repo rate cuts. We have cut our deposit rates by 50 basis points from a 825 to a 775. So we should see cost of funds for the bank coming down in Q2. As we said, we will see some MFI growth. Maybe it's 2%, 3%, depending on how it all pans out. There'll be again a climb back of NIM because that is the highest NIM book. So yes, from a drop of 50 bips, which is largely not led by pricing of customers on the existing book, we will see some recovery back. We would expect a 7.2, 7.3, and which is what we said in the investor call yesterday. So that's on that piece. See, on the two important things, which are very strategic and clear in nature. We had said in our guidance 20% asset growth. We are reiterating that. We had said we will move secured much more than 70 to a 73, 75 range. We are committing to that. Last year, we could deposit book at 29%. This year, certainly we have reiterated 20%. That won't change, and we are saying cost of funds will also drop. So we are getting the two parameters right. A secured business gross NPA, which is the largest book, gross NPA, net NPA remains in very good shape. That doesn't change. I think the only variable which we have to address are the two variables, which one is how fast does the MFI stress come down? And second is, do we grow MFI? And if yes, how much? So just two really, that's a smaller part of a book, but takes majority of our time in this interview and of course for the bank.
It does, because that's something that the shareholders have been worried for as well, right? And that explains the 7% fall in the stock price as well. But thank you so much for joining us today and clarifying on a lot more aspects and talking about the future of the MFI industry as well. With that, we'll slip into a short break. We'll get more on the markets on the other side. Stay tuned.
Welcome back. There are a lot of movers in the broader markets though. ION Exchange is one such mover among the top losers on the small cap index today. 11% lower on that stock at 482 is ION Exchange. It's some of the big volume movers though. Green Panel Industries is one of them. That stock is up 5% among the top volume-led gainers today on the index. So Green Panel Industries is one of them. Bombay Dyeing continues to build on to those gains, now 13% higher on that stock as well. But our research team is here with some of the other movers. Winnie is here to tell us more about Orion Pro Solutions, which is under pressure. Winnie.
Hi, good morning. So yes, we're seeing Orion Pro that is under pressure. This is after their Q1 FY26 numbers. First, taking you through the numbers. On a sequential basis, the revenue's just seen a growth of 3%, profits are up just marginally by 2%, and EBITDA margins have remained largely flattish at 20.3% on a quarter-on-quarter basis. Now, when you're looking at these numbers on a quarter-on-quarter basis, this is one of the slowest growth that we've seen coming in for the company in almost 2 years. And on a year-on-year basis also, the growth is just at 28.7% for Q1 FY26. This is a revenue growth I'm talking about. Last when we spoke to the management, that given a guidance of around 30% CAGR growth for the full year of FY26. So it's below that 30% that what we are watching out for, but we still have the remaining quarters left, though the company has highlighted that they are holding on to their full year growth guidance. It will be interesting to see in terms of specific sector-wise performance that has come in for the company in terms of banking as well as tech. But as of now, the management is saying full year guidance is what they're maintaining, but growth is slower than what we have seen in the past. So that is why you're seeing some bit of a pressure coming in. A miss on the operational front. Client addition has been interesting at 16 client wins during Q1 FY26. So that was a positive, but operationally a weak performance.
Operationally a weak performance. Winnie, thank you for that update. The other one that has been moving around today has been Paytm. And it's been the stock that has been in focus over the last month or so now ahead of its results. The stock fell almost 2% and now has recovered from those lows and is now trading 2% higher. There was an upgrade from Jefferies. On the flip side, there was a downgrade from CLSA. Gaurav is here to tell us about both the bull and the bear on Paytm. Gaurav.
Well, yes, when we talk about Paytm now, we are seeing some kind of mixed reaction from the investors. And the reason being that first is that the results were very strong. Paytm in fact reported profits of around 120 crores in this quarter, which was actually not expected by any of the consensus players. But now there are two cases, bull versus bear. First, let's talk about bull, where Jefferies has upgraded the stock to buy and also increased the target price to 1250. What they're saying is that EBITDA definitely was higher than what the street is expecting. MTU, which is monthly transaction user growth, that was actually encouraging. And on the other hand, what another point that they have put is that when it comes to valuation, they believe that it is trading at a discount to a company, tech company like PB Fintech, and that is the reason why they are being bullish, because they believe that there is a compounding story from here on in terms of Paytm. In fact, Citi also maintain their buy rating and increase the target price to 1215 rupees. On the other hand, on the bear side, we have got CLSA who downgraded the stock to outperform and gave a target price to 920. Now this downgrade is specifically because of the outperformance that we have seen for the stock. Let's not forget that in the last 1 month itself, stock has rallied more than 20%. So what they're saying is that definitely the stock performance was actually higher than the street's expectation. But there is another point that they have highlighted. It is that when we talk about the loan distribution, Paytm has actually discontinued their default loss guaranteed loans from one of their largest lending partners, and this is the reason why they believe that the upfront cost has come down because of the DLG loans are not there. But on the other hand, in terms of revenue, the deferred revenues are still reflecting, and that is the reason why they also believe that the EBITDA can actually come down. In fact, they have also cut down their EBITDA guidance and EBITDA expectations almost by 4 to 8% for the next 2 years. So definitely that is another case that they have put in. We also have Macquarie, who has maintained their target price of 760 rupees. So as a result, we are seeing some volatility in that stock. So definitely in terms of numbers, they were good. But in terms of brokerages, we are seeing two groups which are forming right now.
Thank you very much for that. Let's talk about Colgate. The numbers seem to suggest that fewer Indians have brushed in Q1. There is a volume decline. Mangalam now joins in. Mangalam.
Well, I'm not sure if fewer Indians brushed in the first quarter or not, but what I can tell you is that fewer Indians perhaps brushed using some of the popular products of Colgate, because the company attributes a higher base, higher competitive intensity and weak consumer sentiment in the popular version of their products. But premium products have been doing well. They expect gradual improvement in the second half of this year. It was not as much the numbers which were expected to be weak, and they were weaker than estimates. It was a management commentary that spooked the street, and thereafter there were a lot of brokers as well which have downgraded their estimates and outlook on the stock along with lower prices. So you have, for instance, HSBC, which has a hold call. They've cut the target price to 2,600 rupees. They're saying there is improvement which is anticipated, but the structural potential for growth is low. Nomura has reduced their call, and their target price too is at around 2,350. They expected the volumes to have declined by about 3 to 4% in the first quarter, not just 2%. And Goldman Sachs has lowered their estimates by about 3 to 4%. They have among the lower target prices on the street. Citi too has lowered their target price from about 2,300 rupees to 2,175. They are saying that challenges are likely to persist in the second quarter as well. Nuvama, one of the sole buyers on the stock, they believe that recovery could lead the stock higher. They have a target price of around 31.35. But be that as it may, for Colgate, the bigger challenge apart from category growth is the lack of growth coming in from ancillaries. Management has been speaking about 2x growth coming in for their Palmolive vertical, but we're not sure whether that's become substantial enough to drive overall growth for the company right now or not. Weak consumer sentiment one side, but on the other side, we have competitive intensity and lack of growth in the category, which is hurting the stock.
Okay, so it's a category problem, not a toothpaste particular problem. It would be scary if people are not brushing enough in the country.
But we were talking to Rahul Arora of Nirmal Bang on Editors Roundtable, and he said that, well, the penetration of toothpaste is 90% plus. The only problem is we brush once.
Yeah,
a large part of the population is still brushing once a day, and they haven't moved. Sorry, Mangla?
No, I was saying that I was looking at data coming from Colgate itself, and they've said that there are only 20% rural population that brushes once a day. 80% doesn't even do that. And in the urban population as well, more than half or closer to 60%, if I remember that number correctly, brush just once a day. And the comparable numbers for other countries with similar, GDP per capita is close to 4 times, 5 times a day, etc. So, all you have to do is brush more than once. The product is there in everyone's house, but not necessarily being used.
Maybe dentist ka sujaya one number one brand, but I don't think the street is very convinced.
But we forget there are other brands as well. It's not Colgate. That's exactly the point. We need to talk about that as well. It's just not Colgate which has a toothpaste brand. Thank you so much, Manglam, for joining us with all those insights. We'll do one thing. We'll slip into a short break. When we come back, we'll get to you more on the markets on the other side. Stay tuned.
Welcome back. Tata Consumer is amongst the big losers today, down over 1%, and the stock has breached the 100-day moving average on the way down. 1% down, not down by a whole lot, but it's slightly on the weaker side. Mangalam is back with us to set the expectations for Tata Consumer.
Well, we don't know about toothpaste, but more salt was definitely consumed this time in the first quarter. Why do I say that? Because Tata Consumer, the stock has done well this year so far, up around 18%. But importantly, the street is expecting double-digit revenue growth to come by. 11.5% on the top line, close to 4,850 crores what the street is working with on a consolidated basis. EBITDA declines by about 7%, but that's largely on account of some of the key input inflation, be it tea, be it coffee, or at the same time, we are seeing some sort of inflation coming by in the salt portfolio, where the company has gone ahead and taken price hikes. Net profit comes in at 330 crores versus 290 crores, so that's a jump of almost 14% year on year. India foods business revenue growth seen likely between 13 to 15%, led by price hikes in the salt portfolio and premiumization out there. Beverages should grow 8 to 10%, and that would largely be on account of price hikes taken in the tea portfolio. Capital Foods and Organic India, the acquisitions that the company had made, could do about 350 crores in a quarterly, in this quarter's revenue, where the company expects this number to jump to almost 500 crores per quarter by the second half of this year. Narishco, that was the growth driver of the company, may report a muted quarter this time around because of unseasonal rains and the beverage portfolio being impacted by overall summer. But by and large, the management expects Soulful, Narishco and Sampann, the growth drivers of the company, to grow upwards of 30% with double-digit revenue growth this year with increasing margins. Whether that happens in the first quarter or not, well, the street will keep an eye out on that.
I can say that with certainty that the salt was found in our food items more than the toothpaste for sure. Mangalam, thank you for that. The other major Nifty name reporting results today is Dr. Reddy's, and Ekta is here with what the street is expecting from that stock. Ekta.
Thanks for that. Well, yes, for Dr. Reddy's, this quarter we are expecting a revenue growth of around 13-odd%. The margins should probably come in at around 25-odd% this quarter, and a profit growth of around 6-odd%. Now, the revenue growth is expected to be led by the integration of a recent acquisition, the Nicotinell acquisition. North America sales are expected to be under pressure because of price pressure in key drugs such as Revlimid generic, and estimates are quite wide for North America. It's all the way to a decline to a marginal growth. So do watch out for that. For Revlimid generic, sales estimates are wide, so anywhere between $140 million to $180 million versus $150 million year on year. Expect India to grow around 8 to 10%, aided by the licensing of the Sanofi vaccine portfolio and a joint venture with Nestle. Margin range again is wide, anywhere between 23 to 28%. A semaglutide opportunity, commentary will be watched out for that. Estimates are they could generate around $280 million in terms of sales in FY27, driven by Canada. More details on the Delhi High Court restraining Dr. Reddy's and OneSource from selling semaglutide in the domestic market, and the update on a couple of biosimilars that they have in their portfolio, the launch on that front.
All right, we'll be watching out for that one. Important earnings expected today. But time for a short break now. We'll get more on the markets and the stock-specific action that we've been tracking on the other side.
Welcome back. Some more result reactions coming in. Sant DLM is one of them. Reported numbers after market hours last evening, and Upasana is here to take us through the results for Sant DLM. So Upasana.
While the companies reported a mixed set of numbers, the revenue and PAT are below the street estimates, while the EBITDA margin is above street estimates of 8.5%. Now, coming to the numbers first, the revenue saw an uptick of just about 8% on a YoY basis. EBITDA saw an uptick of nearly about 25%, and EBITDA margins stood at 9% with an uptick of nearly about 120 basis points. This is on the back of the change in the product mix of the company. PAT saw a downtick of 30% on a YoY basis. This is mainly because of the downtick in the other income of the company, which has impacted the PAT. Now, looking at the other key highlights of the results, the revenue growth, mind you, for this quarter has slowed down to single-digit 8% after the record double-digit growth seen in the past 4 quarters of the company. The company said that the revenue growth is impacted mainly because of the completion of the large order in FY25 itself. Now, defense segment, which was in focus for the past few quarters, this has seen a degrowth of nearly about 82% due to large order completion in FY25 as highlighted earlier. And next up is aerospace segment of the company, which has seen a healthy growth of nearly about 63% on a YoY basis. Now, EBITDA margin has seen an improvement of 120 basis points due to better revenue mix. And the other key positive is the order backlog. The order backlog increases resulting from a record order intake of nearly about 515 crore during the quarter, and this is the highest quarterly order intake seen in the past 10 quarters is what is highlighted by the company. So overall, mixed set of numbers coming in from Sant DLM.
Okay, all right, mixed set of numbers. There's been a recovery in the stock, now down 2%. By the way, from the broader markets, if you look at some of these names, Lodha Developers, Oberoi Realty, of course, there's this block deal that has come by. So both these stocks are in focus. Lodha is down 6.5%. We have Oberoi Realty, which is down 3.5%. Z Entertainment reported numbers during the dying hours of trade yesterday. It was a weak set. The stock was down around 5% yesterday, continues its down move today. So those are some broader market movers. But for now, we'll take your leave on trading hours. Stay tuned. Halftime report will take all the action ahead.
A very good afternoon. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Patra and with me is Mangalam Malu as well as Vinny Motiwala. It's turning out to be another day of wait and watch for our markets at this point in time. So we have the Nifty, which is just about trading with a 70-point gain, and we have the Bank Nifty, which is up around 0.2%. What stands out is maybe the little bit of pressure on the broader markets. The Midcap index down around 0.2%, and the Small Cap index also, which is in the red at this point in time. Overall, let's see, a lot of earnings to watch out for, a lot of news to deal with.
A lot of earnings, so let's go straight to the earnings itself. We had United Breweries. The stock is 4% off its highs after reporting a mixed set of first quarter numbers. Revenue and premium volumes came in above estimates. In fact, I caught up with Vivek Gupta, who's the managing director and CEO of the company, and asked them about the quarter gone by, more importantly, how they see growth going ahead. Listen in.
We are very excited about the 11% volume growth and 16% net sales growth. Our growth is very broad-based. Our premium business grew 46%. I think, the Telangana we did grow shares in Telangana and we did have double-digit volume growth. But as I mentioned, the growth is quite broad-based. On premium business, we continue to grow high 30% because last quarter we grew 26%. Last fiscal year we grew 34%. Quarter is 46%. Our plan is to continue this momentum because we are making fundamental interventions which really drive the category growth. On the overall volume growth, actually, it is the tale of two halves. One is, there are states which are declining double-digit on category, and there are states which are growing higher than double-digit on the category. So I think whether this volume momentum sustains, it really depends on how much recovery happens in states like Karnataka, West Bengal, Odisha. And that it all depends on how much policy interventions we are able to work with the government. West Bengal, for example, was really rocking on the category, and last few quarters have been tough for the category because of the duty increases. Karnataka has been few frequent duty increases, and the category is down double-digit. We have to really see where the new interventions stabilize. So I think the going forward outlook, in my view, is quite mixed on the volumes. It really depends on the interventions which state governments are able to make the beer more affordable.
Got that. So mixed on overall volumes, but 30% on premium continues. The last time we spoke, premium was high single digit in your overall contribution with an aspiration for you to go to 20%. Where does that number stand at right now? And what's your aspiration for the end of this year?
See, we continue to make progress on the premium business. Like, our shares on premium are 20%. It is still 10% of our business. But, it is growing. The salience of premium is growing every quarter. We have a lot more to do on premium. We now have 20 share on the premium business. And this growth momentum will continue.
Okay, so 20% is the share on revenue of premium and 10% is the volume share, right?
Yeah, no, what I mean is that 10% is actually our revenue share.
Got it.
And we are 20% of the premium market.
Okay, you're 20% of the premium market and 10% of revenue share. What about margins? Because Telangana has taken a price hike, but you said Karnataka frequent duty increases and you've not, chosen to pass them on to consumers as well. You've taken a hit on your margins. Then you have premium products that's margin positive, but at the same time, that's immediate margin negative because you have to introduce newer bottles into the system as well. So look at all of this. Where should one look at your margins by the end of this year?
See, I think first thing is, I'm not too worried about quarter-on-quarter progress on the margins because our strategy is to be the category maker and drive category growth. I think as you would see that double-digit volume growth and 16% net sales growth is quite impressive in a full summer season where we grew shares in every single month on all India basis. We were very customer-centric. We had to serve customers in many states like Andhra Pradesh. We had to actually import beer from other states because we didn't have enough manufacturing capacity there. Now we are making a capital investment in Andhra Pradesh to make that happen. We also are immersing new bottles to drive premium growth. So I would say that, and then also there's a state mix issue as well in Karnataka because Karnataka, the category is down double digit and I think we declined almost 16 to 18% in Karnataka last quarter. So putting all of this thing together, I'm quite okay with the progress we are making on margin. I think it's a glide path. I think, as I said, sequentially, we will improve margins. We are also investing more CapEx. You see our CapEx numbers this quarter are much higher than last quarter in the similar year, in the previous year. So I think we can always do better, but I think our focus will always be on growth and sequential margin improvements.
All right, so double-digit growth not off the cards, irrespective of the volumes, right? Because even if you do high single-digit volume, irrespective of whatever states do, you still have that 4-5% coming in from price mix from this year and also the premiumization. So that's not ruled out for sure for this year.
Absolutely, and we're also investing more in the brand building because I'm very happy to say that Kingfisher brand is back. You know, we measure brand power, and for after many quarters, Kingfisher brand power is back at one of its peak numbers. So the investment which we are putting together on consumer awareness, on IPL, on in-store execution is working. So our focus will be to continue to strengthen this investment so that we continue to get the operating leverage once the capabilities are built up in the organization.
What are the numbers on bottle returns right now? How many did you introduce in this quarter, and what does that ratio stand at, returned versus reused?
We introduced almost 30% new bottles. In certain states, we had to do it even more because there was mismatch in the bottle supplies as well. And they were heavy rains. So I'm pretty sure you would have been understanding from other industries. This time, the rains were higher than last similar period last quarter. So we had to actually introduce more new bottles because return bottle system gets impacted when there are heavy rains.
So what is your target by the end of this year, give and take all things?
We want to actually make sure that the return bottle improve to 73%. So we actually reduce the new bottle by 27% in continuation with our focus on premiumization as well.
And what about your updated market share and your target here? Because in some cases, the category is lower, but are you outpacing the category at least?
I would say this quarter, our internal estimate is we have actually grown market share with more than 300 basis points.
And
so it has been a rock at an all India level.
Yeah, but this is across premium and popular. Could you give us that breakup?
Yeah, on premium, you know, I don't have the numbers offhand, but we have grown shares on both premium and popular, what you call it as mainstream. Our premium share growth, because it's a small contribution to the business and to the category, is almost around 400 to 500 basis point of share growth, and mainstream would be 200 basis point of share growth. But I can give you the exact numbers later on.
All right. Final question before we let you go. What about Amstel Grand and the other products? How many Visi coolers have you added during this quarter? Where does that target by the end of this year lie? And the new launches, how have they been doing versus your expectations?
I must tell you, we are extremely proud of our execution on Visi coolers. We have actually tripled the number of Visi coolers which were there in the market in the last 12 months. In fact, in this first half of this year, we have put more Visi cooler than what we did in the last full year. So most stores are having cold beer, which is helping the category growth. Amstel Grande, we have just launching in Karnataka. It's already there in Maharashtra. Mumbai, West Bengal is doing extremely well. Heineken Silver is also, we are expanding Heineken Silver as well. So in all, I think we are quite excited with the innovation pipeline we have. And our focus is on excellent execution and making sure consumer try the great beer we have.
Okay, an interesting conversation there. United Brewery is expecting to grow in double-digit in FY26 as well. But Ekta, we do have Natco Pharma that's coming in terms of flashes also.
Yes. So interesting news which is actually coming to us from CNBC Awaaz at this point in time, where they have written to Natco. They're waiting for a comment from them, and maybe we'll hear more once they come out with their earnings as well. But they have plans to acquire South African-based company Adcock Holdings. Now, Adcock Holdings is basically based in South Africa. It is involved in divisions such as consumer, OTC, which is over-the-counter, prescription and hospital products and services, with a presence in Southern Africa as well as India. So it'll be interesting to see what their plan would be in terms of, this particular acquisition, considering that that isn't really one of the biggest strong points in terms of geographies for Natco Pharma. And Natco is primarily based in terms of the US as well as India. That's mainly where their focus is, as well as in terms of specialty generics. Remember, they were the first ones to launch Revlimid generic. And that's the kind of focus that the company has. So it'll be interesting to see what they are planning to do in terms of this geographical diversification and this particular acquisition as well. But this is so spaced at this point in time. We're waiting for the final verdict or comment to come in from Natco Pharma. Stock, however, is reacting positively, is up around 1.6%.
Absolutely. Will be interesting to watch out for the final comments. But on that note, let's just slip into a very short break. But here's a programming note for all our viewers as we slip into this break. As the workplace transforms, so must leadership. In the Bangalore edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC TV 18, CNBC-TV18.com and YouTube.
Welcome back. We're talking about a lot of stocks which are moving around. The Nifty is currently, put on some weight. It's up almost 100 points, so closer to 25,160 thereabouts, and that's led higher by the Nifty Bank, which has moved higher. So the Nifty actually has moved to the high point of trade. Banking stocks doing well, and a couple of these financials as well are picking pace. So Bajaj Finserv for one. But the largest up move has come in on Infosys, and IT stocks are actually off lows. Infosys reports its numbers today. How the IT pack performs will be crucial for the Nifty to go past the resistance zones that we're looking at. But amidst all of this, there are stocks which are trading with deep cuts. Idea Forge is one of them, down nearly 7.5% after reporting an almost 80% plus dip in their revenues. Ria joins in to tell us more. Ria.
Well, yes, Mangalam, Idea Forge has tanked over 7% in trade today after reporting a very weak set of numbers in Q1 of FY26. We've seen a very sharp fall in revenue, down about 85% on a year-on-year basis and down 37% sequentially as well. The gross profit margins have expanded by a lot in this quarter, coming up to 61.7% versus just 33.3% in Q1 of last year. But this margin variation is largely dependent on the product mix of the orders that the company has delivered. We've also seen heavy EBITDA and net losses of around rupees 15 crores and rupees 25.5 crores respectively in this quarter. And remember, the company has been loss-making over the last 4 to 5 quarters, and the losses have been widening in each quarter. But this time around in Q1, we've seen the losses improving, narrowing down a little bit on a sequential basis. Coming to the orders, the order book has also expanded quite significantly to rupees 144.8 crores versus This is just about rupees 13.6 crores in Q4 of FY25, and this is largely because of a rupees 137 crore order that the company had won as part of the emergency procurement cycle from the Indian Army, and this was for mini UAVs. Now, going forward, the company has said that they do have an L1 opportunity pipeline of over rupees 400 crores, and that remains largely intact for them. They're expecting to close this within this and the next financial year, and this is X of the emergency procurement orders that they're expecting in this year as well. They've also said that they're targeting to turn profitable in the near term, and they're expecting an improvement in the working capital cycle as well once the emergency procurement orders get executed. And another thing they've mentioned is that the next phase of the PLI is expected to be rolled out soon for drone manufacturers, and that will act as a big trigger for the entire industry and for Idea Forge as well. But nonetheless, the street is not liking the numbers, and the stock continues to trade lower in today's session.
Okay. All right. Thanks very much for that. So that's an Idea Forge. That stock is down around 7% at this point. But Vinny, you're looking at Orient Pro.
Yeah, it's a weak set of numbers actually on the operational front, what we're watching out for. And that's why we're seeing that reaction coming in on the stock as well. Look at it, it's down almost 5-6% in today's trading session. So when you're looking at it in terms of numbers, quarter-on-quarter basis, revenue growth of just 3%. Then we're seeing profits grow by just 2%, and margins have remained flattish at 20.3% on a quarter-on-quarter basis. Now, this 3% growth that you're looking at it's the slowest growth that we've seen coming in for the company in the last couple of years. So that is important to watch out for. And even if you compare it versus last year, that's Q1 FY25, revenue growth has been the slowest that we've seen for the company since September 2022. So operationally seems a bit of a subdued performance that came in from the company. Now, other than that, software services, that saw decent growth this time. Order book also managed to see a growth. 1,460 crores is what the order book is at. Clients addition was also there this time. 16 new clients were added. But the miss that came in on the top line, as well as a bit of a miss on the bottom line front as well, is something that is impacting the numbers. The management has given a guidance for themselves for FY26 of around 30% CAGR growth full year. Now, obviously, this 28.7% year-on-year growth that we're seeing for the revenue is lower than that, and that is the main reason we're seeing a fall coming in as well right now.
All right, so that's about Orient Pro, lower in today's trading session. Let's move on. The Ministry of Finance has rejected a key recommendation made by the Ministry of Corporate Affairs to actually exempt loan waivers granted under the Insolvency and Bankruptcy Code from being treated as taxable income under the proposed income tax bill. Timsy joins in with more details on that one. Timsy, can you explain it?
Well, yes, as we know, the Select Parliament Committee has submitted their report on the income tax bill, which was tabled in the Parliament on 21st of July. The over 4,500 pages of report actually lists out a very key proposal here. Ministry of Corporate Affairs on 17th of April in a committee meeting had proposed a suggestion that the exemption should be given to a potential bidder who picks up stressed assets under IBC. Basically, the loan waiver that they get is taxable under the IT Act right now, and this should be waived off. Now, this particular proposal has been rejected by the Ministry of Finance, and it is documented in that particular report. The rationale that Finance Ministry has given over here is that Section 79 of the IT Act already incentivizes the companies undergoing IBC proceedings by permitting carrying forward and setting off accumulated losses, even if there is a change in shareholding. IBC cases, the accumulated losses would be sufficient to absorb any income arising from loan waivers under Section 28(4) or 41(1) of the IT Act. The accounting standards require any loan waiver amount to be routed through profit and loss account, which supports the taxability. Also, it says that the government has already given up a large share of dues under IBC waterfall mechanism when this bidding is done. And several High Court decisions have held that loan waivers, even one-time settlements, are taxable. Thus, they have rejected this proposal. And let me remind you that this proposal was actually, this suggestion was given by MCA Secretary herself in front of the committee, and Ministry of Finance in writing replied to it. Also over here, important to note that both MCA and Ministry of Finance are headed by the same Minister, Nirmala Sitharaman. Meanwhile, industry had been demanding this exemption for quite some time, and they said that this was a key demand to make IBC more lucrative. So a big setback when it comes to MCA's proposal. And yes, to the industry's demand, where industry had been pitching that this loan waiver would make IBC more lucrative. But yes, IT department clearly not in favor, and Ministry of Finance giving it in writing to the select panel.
Okay, all right, Timsy. Thanks very much for that. Just want to point out that for Natco Pharma, just watch out for what they said in their annual report. Interestingly, they have indicated that they are looking for opportunities to expand into emerging markets, specifically in the Middle East and North Africa, which is the MENA region. And they have also said that they are they have been actively looking for inorganic expansion opportunities in the international market. So there is a likelihood that, this particular acquisition could probably come about. Remember that Adcock shares have in fact gained ahead of their board meeting today. So that'll be interesting to see in terms of what takes place for Natco. Stock is up around 1.2%. We'll take a short break. Pritesh Mehta from Yes Securities will join in with some trading calls on the other side.
So century for the Nifty, 111 points higher on the frontline index, and that's led mostly higher by the IT pack. So look at Infosys go ahead of numbers at the high point of trade, and that was something that the street was anticipating already, largely because the IT index has been a major underperformer, and for the markets to move higher, the IT pack had to actually put its hand up. Now the Nifty closing in on that 25,200 mark. It's extremely important because if you look at it, the Nifty bank is consolidating around that 57,000 mark. It's crossed past that 20-day moving average for that frontline index as well. The mid-caps too, which were marginally in or deeply in the red, are now just marginally in the red and have recovered from the lows. So I'm keeping an eye out on all these three indices as we look at the F&O setup of the day. The broader markets, we need to watch out for that as well. Do we see the red and green lines come closer and intersect at some point? The green going over the red is something that the street will watch out for in terms of next cues coming in for the frontline index. 25,100 put. Those writers are fairly active, telling you there is strong support at lower levels. 25,000 itself has seen a fair amount of writing. So between 25,000 to 25,100, you are expecting support for the frontline index come in. Now, I'd be very curious to know what happens to the call writers at 25,150 and 25,200. Why do I say that? Because there is still a premium of 60 rupees available at 25,150 call. They're hoping for resistance coming in at around 25,200. If the market, with the ferocity with which the IT stocks are moving higher, does go ahead and cross past that 25,200 mark, then we have both the 25,200 call writers and the 25,150 call writers being a little jittery and perhaps thereafter cover some positions. So that may not rule out a move all the way up to 25,300 if the market was to sustain the current up move coming in from the IT pack. Couple of stocks which are on our radar. A lot of long positions added on names like IRFC and Paytm. Both of them reported good results.
Okay, all right, Manglam. Well, that's on the F&O space. We do have Pritesh Mehta now joining in from Yes Securities to tell us what he's tracking today technically. Pritesh, well, it's been a tight range for the markets. So tell us, is it an index call or are you more confident on stocks?
Good afternoon. See, this as far as index is concerned, this market is choppy. It is like that zinc or bigger at this moment. Even when you look at a customized top 10 Nifty index, which is made of highly weighted top 10 Nifty stocks, it is showing structure of lower tops and lower bottoms. It tells us that it's not the right time to look at, to hope for a leadership stock or sectors to lead from front. In fact, it's not a right time to go for a top-down approach in this market. Being stock specific or looking out for stocks from the broader markets would be the right way to put this market because it is lacking the leadership direction at this moment.
Okay, Pritesh, and what would be the stocks that maybe you would look out for today?
So we have two ideas, both on the buy side, because the support of the index is holding on of 24,900. So first recommendation is buy on LTF. Now see, after 1 year of consolidation, in fact base consolidation, it finally broke out in early June. Thereafter, we are witnessing follow-through moves coming in. In fact, we are witnessing bullish data breakout, bullish sector column follow-through. So from here on, it tells us that it is trending higher. It is outperforming when the market is not showing much strength. So buy for a target of 245. The stop loss would be 203. The second one is buying on M&M. Now, since the month of May, the stock had been consolidating because finally it broke out in third week of June. Thereafter, we have seen follow-throughs coming in. So buy for a target of 3550 and the stop loss would be 3150.
Okay, Pritesh, thank you so much for joining in with us this afternoon, talking to us about the markets as well as individual stocks. On that note, we're going to slip into a break, but now it's time to recognize the champions. Get ready for an evening that honors India's most promising SMEs, the champions behind our nation's remarkable progress. From a groundbreaking innovation to grassroots impact, these businesses have powered growth, inspired change, and redefined ambition. HSBC presents CNBC-TV18 SME Champions Award Season 2, India's most coveted SME awards platform. Is all set to finally announce the winners on 25th of July, 3 p.m. onwards.
Welcome back, and joining us on the show now is Mr. R.S. Sodhi. He's president at the India Dairy Association. Mr. Sodhi, hi, thank you so much for joining in. A very relevant subject that we're talking about right now is ghee and the GST on that. And I was reading a lot of reports which say that olive oil has 5%, but ghee has a GST of 12%, 15%, 12% on it. How are you tackling this issue, and how are you representing it to the council?
Yeah, Manisha ji, you're right. Unfortunately, all the imported edible oils, whether olive oil, have only 5%, but Indian farmers' produce of 80 million families is taxed at 12%. So, Indian dairy industry is basically trying to convince the council and the member that ghee is not a luxury product or butter. It is a farmer's produce, 100% pure, no other ingredients other than the milk. So any tax, if you tax it high, it impacts the farmer's income. And second, ghee in India is not consumed on the people who live in at Pedder Road and South Delhi, etc. It is consumed by everybody, whether you are a delivery boy, you are a security man, you are an auto rickshaw driver, or you are driving a Mercedes. So it's a basically staple food. So we are trying to convince that you are impacting the farmer's income, that you are impacting the small people consumption, and you are encouraging the imported edible oil so that people shift to there. So somehow, and also, you see, by taxing it more, and pure natural product, organized players are not able to promote it aggressively. Not only in India, abroad. See, India, this ghee is a golden, or I guess, a product for food. Like olive oil, they're promoting from Italy to India, or canola oil from Canada to India. Why we do not promote ghee all over the world? But there's no money. Organized Indian dairy industry is pressed so much for the taxes.
Well, absolutely. So, Mr. Sodhi, one, what is the kind of conversations that or representations that you already have with the council right now? That's one. And second is, what is the overall ghee market in India, and what is the GST that the industry has paid, let's say, in the last 1 year?
Manisha ji, in dairy industry, after milk, ghee is the biggest category. It's more than 3.2 lakh crore. But organized, out of this may not be more than 15% on which the council is getting taxed. Remaining mostly is unorganized or adulterated ghee industry. And that is what we are trying to convince the council that, look here, you are encouraging the unorganized, unbranded, loose ghee. You walk into any city store, especially in tier 2 or tier 3 cities, hundreds of small local brands have come. People have started packing ghee in a small warehouse and trying to promote it, trying to sell it at a high margin because it is adulterated and they are not making any invoice, etc. So by taxing it higher, we are encouraging unorganized, unbranded, adulterated market. And let me also tell you, before this GST came, when VAT was there, in most of the consuming states, whether you take it Gujarat, you take it all the southern states, etc., ghee was taxed only 4 to 5%. Only after the GST coming, it has been taxed at a higher level just to fetch more GST from the organized sector. But overall, we are losing in the GST.
So, as you said, while the conversations are on, and hopefully the council will look at this as well, what is also your sense, since we have you with us, what kind of a growth rate have we seen when it comes to ghee consumption or the ghee market within India?
Ghee is growing on volume basis around 8 to 9% per annum. And everybody has realized that ghee fat is best for human being. First is for the brain development cells. Second is for the skin. Third is for all the joints, and also for the immunity. So now ghee is consumed by everybody. Everybody is like that dairy fat is good for human health.
Oh, well, absolutely. So, Mr. Sodhi, as you said, there are representations made and expecting that a fair reform is what the industry can see within this. So, how are you pushing it? Where have the conversations landed until now? And what is your next step on this?
Indian Dairy Association has made representation to GST Council. Okay. And we have also tried to convince the various state finance minister because they are the member of the council. And 3-4 GST Council meeting, it has been discussed. But the buck has stopped because people feel, the member feels that they will lose the GST on the existing, because when you reduce from 12 to 5%. But they are ignoring that the unorganized or unbranded market will come to them, because everybody wants to follow the compliance. Everybody wants to pay. But because of higher taxes, unorganized trade is growing and the organized trade is under pressure.
So what is the kind of GST that the council seems to be collecting at this point in time? And the other factor clearly would be, Dr. Sodhi, that the GST collections, if cut from 12 to 5%, would go down considerably. Is that something where the buck as well stops?
Yeah, I think that is the main. Right now, you see, I believe around 40 to 50,000 crore market is paying the GST at the rate of 12%. So you can say around 5 to 6,000 crore rupees is the maximum they are getting. And if they start charging lower tax, so they'll be able to collect on the all 3 lakh crore, multiply by 5%. So you can imagine they will collect around 15,000 crore per annum, which is very high. And more than the GST, please imagine on 1 kg of ghee, farmers is paying around 70 to 80 rupees per kg GST, and 15-liter milk makes 1 kg ghee. So if you reduce GST from 12% to 5%, that is 7%, you can increase farmer price of milk by 2 to 2.5 rupees. So a farmer's income will increase more than the second side. The government or the GST Council will able to collect more GST from the unorganized and unbranded markets.
Oh, well, absolutely. There are a lot of steps that can be taken if this is corrected. And absolutely get your point, Dr. Sodhi, on that. And wouldn't you? Because wherever you stay, well, ghee is a daily diet here. And I'd rather pay GST on sesame oil and olive oil and avocado oil, where you don't have a GST, but you have a 12% GST on ghee. So I think I'm with him on this one.
Well, Manisha, I just want to leave our viewers and you with some statistics. India comprises of 70 to 80% of the ghee consumption in the world. We dominate it, and each person consumes around 2.8 kgs per year of ghee themselves.
Wow.
So that's the amount of ghee Indians eat. We dominate it. It's around...
And we're paying 12% for what we're making at home. That's a bit expensive over there right now is what I'm feeling.
So majority of consumption of ghee and sugar is in India. But in any case, those are some statistics for you. Mr. Sodhi as well as Manisha, thank you very much for taking us through that conversation on ghee. Very interesting and great time actually to be talking about it, just about lunchtime. But nonetheless, we need to take a short break. But as we do that, a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18. Access our premium members only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses and curated lifestyle benefits.
Welcome back to Halftime Report on CNBC TV18. As of now, Nifty is trading at the day's highest point. So yes, up 0.5% in today's trading session. What we're seeing in terms of the move that is coming in for some of these names, let's look at some of the Nifty 50 names today. We have Tata Motors, Bajaj Finance, Shriram Finance, which are managing to hold on to strong gains. While among the losers, we have Tata Consumers. That's under pressure ahead of its numbers. So keep an eye out on that. And with that, HL is also out. Dr. Reddy's will be reporting its numbers today. That's a bit muted in today's trading session. So yes, that's how the market setup is looking like as of now. But Nifty almost near the day's highest point. But we have Akasa Air that is aggressively aiming at capacity expansion and plans to increase its fleet to 226 aircraft, and this is by 2032. My colleague Abhimanyu Sharma actually caught up with Airlines CFO Ankur Goel to talk about the growth plans and Indian aviation outlook going forward as well. Listen in.
We have got 226 planes on order. All of these are Boeing family aircraft. We're expected to get all of these aircraft by 2032. Right? So you will continue to see us add a lot of capacity, lot of planes every year. We're currently at 30 aircraft. We'll add 1/3 of the capacity of last year this year. So you should see a 33% growth sort of a capacity in the available seat kilometer that Akasa generates in FY26. We grew at 50% last year in terms of ASKs. So what you will continue to see us, as we add this capacity, we will have probably a CAGR of around 25 to 30% year on year.
What is the current cost versus revenue gap? How are you looking to narrow it? And what is the kind of profitability you're looking at? When are you looking to break even?
So compared to last year in FY25, our unit revenues grew by 13%. This is unit revenue is a measure of the quality of revenue, a measure called RASK. Our unit cost went down by 8% Y on Y. So what we saw in FY25 compared to FY24 was a 13% improvement in the unit revenue, 8% reduction in the unit cost, as a result of which our EBITDA margins improved by 50%. Right? This is something that we anticipated. This is something that we thought is going to happen. As we continue to scale up, as we continue to add larger aircraft, higher capacity aircraft, you will continue to see that our quality of the revenue will increase, our cost will continue coming down. And as the two merge together, as a unit cost becomes lower than the unit revenue, you suddenly see us get profitable. So this is a time when we focus on margin expansion. So our margins are improving every year. So typically a new company will typically have a U curve in which the margins will improve offset by higher capacity. And then comes the stage wherein the margin improvement is more than the capacity that you add, and that's when you're done profiting.
Even as several airlines plan to expand, plan to gain in capacity, we can't ignore the reality that the sector has witnessed several shutdowns in the past few years or even the past few decades. What are the kind of key asks from the government as far as ensuring a red carpet for airlines, both domestic as well as foreign airlines is concerned, to also ensure more profitability for them and more penetration into a largely underpenetrated market like you alluded to India?
So India has always been an extremely underpenetrated market. There's always been a demand-supply mismatch, and that is only widening now. So despite all the aircraft order that's coming in, we are just not adding capacity fast enough. What we are seeing is a very strong push, a very strong regulatory push with the government, in which there's a lot of things that the government has done to enable airlines not just exist, but also thrive. We have seen the regulatory processes become a lot more transparent, a lot more faster. We have seen reduction in fuel VAT across multiple cities. We have seen tax subsidies to the MRO. GIFT City has been set up to enable leasing. There's more and more capex getting deployed towards airports, both towards modernization and towards creating new airports. So the government has really worked behind the scenes to ensure that the sectors in the country really live up to the expectation that is there. Because aviation is not just for travelers. This is an infrastructure. And that's how we view this. This is a great opportunity for us to contribute to the GDP of the country.
All right, interesting conversation there with the management of Akasa. In fact, we take that short break. As we do that, let's tell you about our new offering, CNBC TV18 Prime, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune into CNBC TV18 Prime at 12 noon for Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m. on weekdays and weeknights. Welcome back. Let's talk about a couple of numbers that are likely today. We have Sky Gold reporting numbers. The net profit has doubled. We'll watch out for that. But Tata Consumer reports its first quarter numbers. The street is working with a 11.5% sort of revenue growth coming in for the company. And a large part of that would be price-led. Some part of that would be led by about 350 crores revenue coming in from organic India. The stock has been an outperformer, trading at around 53 times FY27 earnings. What is it that we need to watch out for? Margins. I'll be watching out for that very, very crucially, because a large part of the revenue growth has been on account of price hikes taken in the tea portfolio, and tea prices have rallied. So that may continue to impact the margins of the company over the next couple of quarters. That's what the management has been speaking about as well. So to that extent, there would be a decline in the EBITDA and the margins. Net profit grows at around 14% year on year. We're looking at a number of 330 crores. The India beverages business, led by tea, should grow between 12 to 15%, and that's largely on account of price hikes taken in that portfolio. Foods business should grow mid-teens as well, again led by price hikes and premiumization in the salt portfolio. Capital Foods in Organic India should be about 350 to 330 sort of crores per quarter. The company believes that this can scale to around 500 crores in the next couple of quarters. And finally, we'll watch out for Narishco, which is supposed to be the growth driver for the company, but this time around, because of weakness in the summer portfolio or unseasonal rains, this business could grow no more than 2 to 3%. All in all, management commentary crucial for Tata Consumer. But Ekta, apart from Tata Consumer, you also have another Nifty company. Dr. Reddy's is reporting their numbers. What is the street expecting?
Yes, for Dr. Reddy's, we are expecting a revenue growth of around 13%. EBITDA to probably come in at around 2,201 crores, and that would result in margins of around 25%, and a profit which would be around single-digit growth, so up around 6% is what we're anticipating. Revenue growth is expected to be led by the integration of their Nicotel acquisition, which they've recently made. North America sales are expected to be under pressure, led by price pressure in this drug Revlimid generic, which most of the players are going to see this quarter onwards. So estimates are wide for the North American market, from a decline to a marginal growth. For Revlimid sales, estimates are wide. Again, 140 million to 180 million versus 150 million year on year. Expect India to grow around 8 to 10%, aided by the in-licensing of the Sanofi vaccine and the JV with Nestle. Margin ranges anywhere between 23 to 28%. Commentary on the semaglutide opportunity. Delhi High Court restraining DRL and one source from selling semaglutide in the domestic market, and also the biosimilar launch. Remember, for FY26, the guidance was double-digit top-line growth and flat margins. They're confident of 25% margins even post-Revlimid generic. So one will have to see what Dr. Reddy's will eventually report.
All right, so that is about Dr. Reddy's. With that, we'll talk about the entire sector now instead of just two stocks. The quarter tak segment, where we get you expectations from each sector. Vamakshi joins in to tell us what capital goods companies are likely to do in the first quarter. Vamakshi.
A steady quarter is on the cards for capital good players as healthy order books begin converting into revenues. To start with, all eyes are on order inflows. Momentum was held up well this quarter, supported by sustained traction in power T&D, renewables, and the buildings and factories segment. After a prolonged lull, the railway sector is finally showing signs of recovery since April. Early days, but the trend is turning positive. The standout performer, though, Hitachi Energy, with order inflows expected to surge fourfold. BHEL is likely to post a strong 37% year-on-year increase, while CG Power is set for a solid double-digit gain. On the other hand, we do have Thermax as well as ABB. They may see mid-single-digit growth, and Siemens could be the only name in the red, with a slight dip in order inflows, a rare miss in an otherwise upbeat sector showing. Next up, revenues. Capital good companies are set to post an average year-on-year growth of 19%, clear evidence that the order backlog is translating into billing. Hitachi Energy once again tops the list with a 37% surge in revenues, thanks to the execution of the Mumbai HVDC project. BHEL and CG Power also stand out with over 20% growth each. Even Cummins, for that matter, is expected to clock 12% growth, despite dealing with a high base from last year's pre-buying cycle. ABB and Siemens, after reporting low single-digit revenue growth in the previous quarter, are likely to post revenue growth ranging between 11 to 12%. Thermax is likely to maintain its 12% growth trajectory too. Margins, though, tell a more divided story. Commodity prices, copper, aluminum, zinc, pig iron have dropped, but margin expansion not for everyone. Expect margin compression at ABB, Siemens, Cummins and CG Power, largely due to high base effects and moderation of pricing power. But three names buck the trend. Hitachi Energy with sharp margin gain of 750 basis points, BHEL with a 600 basis points improvement thanks to improving operating leverage, and Thermax aided by lower losses from bio-CNG and some of the other projects. Profits mirror this margin divide. Hitachi Energy is expected to steal the show with a 13.5 times jump in profits. BHEL is likely to stage a turnaround, swinging from a 211 crore loss last year to 71 crores in profit this time around. Elsewhere, Thermax is set for a 26% plus jump. CG Power may rise 18% and Cummins should post double-digit growth in profitability as well. ABB India is likely to report over 7% growth. Siemens, however, might lag with the slowest net profit growth among some of its peers. As far as valuations are concerned, there's been a reset, a moderation for most players, reflecting the impact of slowing order inflows and weaker infra spend. Hitachi Energy still trades at a premium of 125 times, but the broader peer group, including ABB, Cummins, CG Power, BHEL, as well as Thermax, are more reasonable as compared to earlier levels. In summary, strong order inflows, healthy revenue conversion, and selective margin improvement set the tone for Q1. With valuations not as overstretched as earlier, this quarter will be about operational delivery and who's best positioned to turn the backlog into bottom line strength.
Okay, all right, Vamakshi, thanks very much for that. So that's on the entire capital goods space that and what we can expect this time round for this quarter. Well, it's definitely been a pickup in terms of the markets at this point in time. So the Nifty is currently up around 105 odd points, so up around 0.4%. Remember that when we started the show, it was absolutely flat and just about consolidating. And what's taken place is that there is buying at lower levels for the mid caps, which has taken place as well. So the mid cap index is also flattened out a little bit. Let's see whether it pushes into the green just about at those levels. So down around 15 odd points currently for the mid cap index. The advanced decline ratio currently trending on the declining side. So let's see whether that probably crisscrosses based on what we are seeing for the broader markets. Maybe that further recovery and buying at low levels will result in a crisscross taking place. If you're talking about specific stocks, it is a lot about Tata Motors as well as LTI Mindtree this afternoon. So both the stocks are the top gainers on the Nifty at this point in time. Tata Motors up around 1.8%, LTI Mindtree up around 2 odd percent, but you really can't leave behind KPIT Technologies, Apollo Hospitals, all of these stocks up anywhere between 1%, 1.5%. On the downside, Tata Consumer Products ahead of its numbers. To watch out for Dr. Reddy's as well, which will be reporting along with the likes of Syngene. But on that note, it's a wrap on Halftime Report. Business Lunch will take all the action forward. Stay tuned.
Index heavyweights notch up some gains, but mid-caps feel the heat. Auto and utilities are the top gainers, while realty and capital goods are the big drags.
Paytm posts a profit in Q1 on the back of lower direct and indirect costs and a lower ESOP charge. And while some analysts see this as a positive sign, others point to concerns on the revenue front. The stock slips.
A block deal in Lodha developers of nearly 2,000 crore rupees and one in Oberoi Realty of nearly 1,400 crore initiated by an institutional seller drags down both these real estate names.
MCX has been facing order processing and settlement issues over the past few days, and today trading on the commodity exchange started late. The delay spelled advantage NSE as brokers redirected clients.
And even as Donald Trump announces what he believes is a massive trade deal with Japan for the US, Japanese auto stocks like Toyota, Honda and Nissan leap as the 15% tariff gives them a cost edge over American automakers. Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormis Patakia. With me as always is Vamakshi Thoria. Vamakshi, good afternoon. We started off on a bit of a sluggish note, but it seems that we're picking up the pace and we're counting down to some really big earnings towards the close of the session.
Well, absolutely, Hormaz. You know, Trump has been signing a lot of trade deals. It has been pushing the Asian markets higher, and we're not exception, but we're hoping for one to come for India soon enough. The market's rejoicing definitely. The Nifty is up almost 113 points, inching closer to the 25,200 mark. We're just 25 points shy of that. The Sensex 2 up in trade. The mid-cap end of the market, though, has been flopping between the red and the green. For now, it's trading flat, absolutely flat on the mid-cap index. The advanced decline ratio, that will also come up for you on the screen. That will indicate how the broader market is actually faring, and in fact we do have the declines outpacing the advances in today's trading session. Now let's take a look at some sectoral indices then. It's Nifty Auto that is leading the gains this time around. Tata Motors, Motherson Sumi has some counters that are flying high in trade today. On the flip side, we do have some realty stocks in focus. The realty index has taken a sharp knock in today's trading session after the blocks announced in Lodha as well as Oberoi Realty. Now on the flip side, lots of earnings reaction, like you were pointing out, Hormaz, continue to dominate the limelight today. Credit Access is up almost 6%. It has surged, it's coming on the back of very strong volumes. IRFC is one other counter that is flying high in trade today.
And that you can see visuals there of the Prime Minister Narendra Modi embarking on his visit to the United Kingdom, where it is slated that the free trade agreement between the two countries is likely to be signed tomorrow. And that is an important development when it comes to the deal between the two countries, even as clarity is still awaited on an impending trade deal with the US. But these are visuals of the Prime Minister departing to the UK for his two-day visit, where he's likely to sign on the FTA between UK and India. Meanwhile, the Indian cabinet has approved a free trade agreement with the UK set for signing on the 24th in London. And as the Prime Minister has just departed for that, Parikshit is joining in with more details as to what is likely to be in store in this deal. Parikshit.
Yes, Prime Minister Modi will be heading to UK to sign that all-important trade deal with Keir Starmer. This deal has been in the works for more than 2 years now, and it was announced by the two prime ministers on the 6th of May. And since then, the legal scrubbing, the working out of legal modalities of the FTA has been on. Around noon tomorrow is when the deal will be signed in London in the presence of the two prime ministers. Piyush Goyal is also accompanying the prime minister for the signing of this trade deal. What we're learning is that this trade deal will give 95% of goods traded between India and UK almost zero duty access. From the UK side, Scotch whisky, automobiles, which were key asks for the UK industry, they will get market access in India at lower duties, and the duties will come down in a graded manner. For automobiles, there will be lower tariffs for high-end electric vehicles, high-end luxury vehicles, and there will be quota systems there. Indian MSMEs will get preferential access to the UK market. From the Indian side, labor-intensive sectors such as automobile parts, pharmaceuticals, gems and jewelry, textiles, footwear, they are likely to get better access to the UK market.
Well, thanks so much for those details, Parikshit. An important development out there, something that the street had been waiting for since the last couple of years, if not months, at least some trade deal in our, in our favor. Well, moving on then, the US President Donald Trump has announced a massive trade deal with Japan that includes a lower 15% tariff that will be levied on US imports from the country, including autos. Take a look at this report.
Donald Trump says he's struck another trade deal.
But I just signed the largest trade deal in history. I think maybe the largest deal in history with Japan.
The deal sees a 15% tariff on the country's exports to the US, including cars. They had previously faced a 25% levy. In a post on Truth Social, Trump said the deal would also see Japan invest $550 billion in the US. And he said it would secure access to the Japanese market for US products, including rice. One analyst said it was a better outcome than expected for Japan and would allow the country to avoid recession. In Tokyo, Prime Minister Shigeru Ishiba welcomed the deal. He said it marked the lowest rate set for countries that have a trade surplus with the US, and added it would not sacrifice Japanese agriculture, even if it did allow more access for US produce. It all marks the biggest agreement yet struck by Washington since the tariff turmoil began. Japan is America's fifth largest trading partner in goods, with two-way trade between the pair worth almost $230 billion last year. The news sent stocks higher in Tokyo on Wednesday, with the Nikkei index up around 3% by lunchtime. Automakers were among the top gainers, with Mazda and Subaru both surging more than 15%. Trump also flagged the possibility of more deals to come.
And we have Europe coming in tomorrow and the next day. We have some other ones coming in.
Trump aides are now scrambling to do more deals before his August 1st deadline for agreements. However, the president has said that many countries will simply get letters telling them what their rate is.
Now, even as the US continues to strike trade deals with other countries, the deadlock over a similar deal with India continues. Now, the farm and dairy sector, which employs over two-thirds of India's labour force, have reportedly been sticking points during these negotiations. And earlier, we did speak to Mukesh Aghi, the president and CEO of the US-India Strategic Partnership Forum, on the US striking deals with Indonesia and Vietnam, but being unable to do so with India. Listen in.
Cabinet of US government had recommended a deal to the president, and president basically came back and said that I want a deal which is similar to Indonesia and Vietnam. When you look at the Indonesian deal and Vietnam deal, they are basically one-sided deal, where in the case of Indonesia, basically zero tariff on US goods coming into Indonesia, full market access to agriculture, dairy, and also Indonesia will buy roughly $15 billion worth of US energy and place order of over 50 777 Boeing planes, and almost 20% tariff on Indonesian exports to the US. So it is not a reciprocal deal. 60% of the population working on the agriculture and producing roughly 16 to 17% of GDP. So they are on subsistence, and you don't want to expose them. On the dairy side, it is important to understand it's a religious issues because the cows are fed meat products in the US, and you can't basically take the same product and feed it to the Indian population. I think the US side understands that. It's just a matter of trying to work the process within the administration. So when you go from 10 to 26%, yes, it's going to be challenging. It's going to hit the profits. It's going to make Indian goods more expensive in the US. But that is not the end of the world. You have to understand that there are certain principles that has to be adhered to, and there's certain protection and red lines which you cannot be crossed.
Well, moving on then, before we look at the stocks that are buzzing around in trade, take a look at Ola Electric. That stock has seen a very sharp surge in the last couple of minutes. The stock is up almost 7% for now. There you go, trading at 43. But, some more stocks that are flying high in trade today. Ria is here to brief us on all of them. Ria?
Well, yes, let's take a look at the stocks that are buzzing in trade today. First up is Credit Access Grameen after its Q1 numbers. Stock up around 6% after the net profit has gone down by around 85% on a year-on-year basis. But the credit cost has also gone down to 9.2% versus just about 9.6% in the last quarter. For Idea Foods, that stock has also tanked about 7% after reporting the Q1 numbers. Revenue has gone down by around 85% on a year-on-year basis. The EBITDA loss and the net loss this time around have come in at rupees 15 crores and about rupees 23.5 crores respectively. But the EBITDA and net losses have narrowed on a sequential basis, but just marginally. Dixon Tech has reported an inline set of numbers. The stock is up around 2.5%. The net profit this time around has come in at about rupees 225 crores versus our estimates of 228 crores, up around 68% on a year-on-year basis. For JSW Infra as well, good set of numbers here. The stock is also up around 2%. The net profit is up around 31% on a year-on-year basis, and the management has said that they're aiming for a 10% volume growth in FY26. Paytm has also reported a very strong set of numbers this time around. The net profit this time around has come in at around 122.5 crores versus a loss of 839 crores in Q1 of last year. EBITDA also at 71.5 crores in this quarter versus an EBITDA loss of 793 crores in Q1 of last year. The last stock that we're keeping an eye out on is Cyient DLM, down about 2% in trade. The revenue and net profit were below the street estimates, while the EBITDA margin was above estimates at around 8.5%.
All right, Ria, plenty of stocks that are buzzing in today's trading session, but take a look at Sky Gold as well. There's a very sharp knock that the stock has taken after the results announcement just a few minutes earlier, and as you can see at the bottom of your screen, there has been a slew of block deals that have taken place in the stock as well. We'll get you more details on those deals in just a bit, but for now, Sky Gold, which had just moved into the green after the earnings announcement, has now slipped 5%. So keep an eye out on all of these names. Take a short break here on Business Lunch, but just before we do that, it's time to recognize the champions. Get ready for an evening that honors India's most promising SMEs, the champions behind our nation's remarkable progress. From groundbreaking innovation to grassroots impact, these businesses have powered growth, inspired change, and redefined ambition. HSBC presents CNBC-TV18 SME Champion Awards Season 2. India's most coveted SME Awards platform is all set to finally announce the winners on the 25th of July, starting 3 p.m.
Welcome back. You're watching Business Lunch on CNBC-TV18. Let's put the spotlight on silver then, as this precious metal surges to an all-time record highs on the back of strong fundamentals. My colleague Manisha Gupta joins us with more details on this. Manisha?
Oh, it's a silver lining to silver, really, because we've seen very strong gains come in for this one. Silver actually is outperforming gold when you look at the last 1 month or YTD numbers as well. There you have it on your screens. So in last 1 month, we've seen gold prices gain up by 3%. Silver is up by 9%. In this year now, silver clearly is taken over on gold. With 32% of gold gains, we've seen silver gain up by 36% there. So when you look at the gold prices, we did see an all-time high in this year, in the first quarter itself. And even at this point in time, gold is trading at around 5-week highs into the markets. When you look at the gold prices, we're just about $60 away from that all-time high of around $3,500 an ounce. We seem to have slipped slightly more from those kind of levels. But when it comes to silver, well, we are trading at a 14-year highs in the international markets, and for the Indian markets, it's an all-time high at around 1,16,000 rupees a kg there. Well, a lot of supportive factors onto this one. To begin with, China has been pledging, talking about a lot of push when it comes to infrastructure projects coming in from the government itself, whether it is in space of auto or electric equipments, and that's exactly where silver usage will go higher. The global silver industrial demand in 2025 is expected to be at record highs. This would be a 4th straight year of industrial demand hitting record numbers in the global markets there. Also, the global gold and silver ratio trading at around 84 or 87 thereabouts is quite supportive for silver buying further from here in as well. The strong silver fundamentals are in case of supply and demand numbers as well. 2025 is the 5th straight year of deficit in the global markets there. The street is also looking at demand and supply numbers for this year, which are on the positive side. So when you look at the demand, it's expected at 1.20 billion ounces, while supply is at 1.05. And there's no carry forward from last year because this is the 5th straight year of deficit, and that clearly is giving support to silver prices there. Also, when you look at the ranges that the silver has put in, you can see it's on the higher highs. In 2023, $19 to $27 an ounce of a silver range is what we saw. It gained up to 22 to 35 in the previous year. And in this year until now, we've seen a higher range of around 29.5 to 39.5 or thereabouts for this year, with Street anticipating that you could be looking at higher highs going forward. And that's exactly what most of the banks and brokerages seem to be putting out. From JP Morgan to Bank of America to UBS, $39 to $40 an ounce is an expectation of an average silver price for 2025. And that just continues because when you look at the other banks like Citi, Stancy and Saxo Bank, they're also talking about 40. We're not too far away from there, but 40 of an average is what they're talking about. So if we've done 29 and 39 is where we're trading at right now, markets do believe that you could be looking at 42, 45 on the higher side before this year ends.
Well, silver is possibly the new gold. Manisha, thank you for that update. Now, India's largest commodity derivatives platform, MCX, resumed trading at 10:20 this morning after facing a technical disruption which delayed the market opening by over an hour. The exchange normally starts trading at 9 a.m. Now, brokers noted the delay in receiving margin reports from the exchange, with member files seeing a delay over the past week now. Brokers also noted available margins and blocked margins displayed incorrectly, as well as disaster recovery site issued notices in the past 2 days. Now, amidst these issues, the brokers gave options to clients to trade commodities segment on the NSE. In an official statement, the exchange confirmed that it started trading at 10:15 a.m. after a delay caused by technical processes and file sharing.
Well, moving on then, the Ministry of Finance has rejected a key recommendation made by the Ministry of Corporate Affairs to exempt loan waivers granted under the Insolvency and Bankruptcy Code from being treated as taxable income under the proposed Income Tax Bill 2025. My colleague Timsi Jaipuria joins us now with all the details. Timsi?
Well, that's right. Parliamentary Select Committee tabled its report on the new proposed income tax bill on 21st of July, and a closer look at the 4,500-plus page report takes us to a key development. That is, the Finance Ministry rejected the proposal suggested by Corporate Affairs Ministry to exempt income tax on loan waiver under IBC. To be precise, and it is documented in the report, that MCA Secretary on 17th of April at a meeting with Select Committee had proposed this suggestion, and Finance Ministry rejected rejected the suggestion, giving a detailed explanation. The rationale given by the Finance Ministry is that, firstly, Section 79 of the IT Act already incentivizes the companies undergoing IBC proceedings by permitting carry forward and set off of accumulated losses, even if there is a change in the shareholding. Secondly, they said that for IBC cases, the accumulated losses would be sufficient to absorb any income arising from loan waivers under Section 28(4) and 41(1) of the Income Tax Act. Thirdly, the accounting standards require loan waiver amount to be routed through profit and loss account, which supports taxability. Next, they said that the government already gives up a large share of dues under IBC's waterfall mechanism. And lastly, that several High Court decisions have held that loan waivers, even if one-time settlement, are taxable. Thus, this suggestion cannot be accepted. Meanwhile, just to remind our viewers that industry has been pitching this demand, they said if this demand is accepted, it will be more lucrative for IBC cases. Let's see what happens now.
Timsy, thank you for that update. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now shifting focus, it is a relief for SpiceJet. The Supreme Court has rejected Kalanithy Maran's backed Kal Airways plea seeking 1,300 crore rupees against the airline. Ashmit is now here with more details. Ashmit, tell us what transpired in this hearing.
Well, this is nearly a 10-year-old promoter dispute between Kalanithy Maran, the former promoters, as well as SpiceJet. Now, as a part of that ongoing dispute, there was a claim made of 1,300 crore rupees by Kal Airways, a company owned by Kalanithy Maran. That company had made claims of 1,300 crore rupees, but that claim was rejected by the arbitral tribunal. It was rejected by the Delhi High Court as well. And then subsequently, this appeal had been moved before the Apex Court, the Supreme Court. Today, this morning, we understand that the Apex Court has rejected this claim once again. has clearly held that these petitions are liable to be dismissed. There is no case made out for grant of any relief or grant of 1,300 crore rupees. And in doing so, upholding the earlier rejection of the Delhi High Court of this entire claim of 1,300 crore rupees, the claim that had been made by Kalanidhi Maran-owned company Cal Airways. So the long and short is, SpiceJet, that was staring at this large claim of 1,300 crore rupees, that worry is over, that claim is over. The Supreme Court having the final word, saying there's no requirement to consider this demand of 1,300 crore rupees against SpiceJet.
Well, Ashmit, stay on with us. The Supreme Court has agreed to hear plea by Justice Yashwant Verma. Could you tell us more on this front?
Well, Justice Verma has been in the thick of headlines for very many weeks and months now. Importantly, ever since there were disclosures made by the Apex Court itself of cash being discovered, half-burnt cash being discovered at his residence. Now, what we understand is that facing impeachment at the hands of the Parliament, Justice Yashwant Verma, has filed an application before the Supreme Court. It was mentioned today by his lawyers. The Supreme Court has agreed to hear the matter. The CJI is saying, I will not be hearing it. That will not be proper. But the Supreme Court will definitely be hearing this matter, and this will become critical, especially in light of the Parliament contemplating impeachment motion. What Yashwant Verma is essentially saying as a part of his petition is that there has been huge media trial against him, saying that there was breach of confidentiality, information against him was leaked by the Apex Court itself, that this is not tenable, this is a violation of principles of national justice, going on to say that this report which went against him, the in-house committee panel report that went against him, he said that the CJI had not even given him a hearing at that point, and without giving him a hearing, that report had been forwarded to the Parliament for taking further action. Also going on to say that his reputation has faced irreparable harm. There's been violation of judicial norms, and that this is something that requires the intervention of the Supreme Court, seeking quashing of that in-house panel report, which led to the impeachment motion finally. So clearly, relief being sought. The Supreme Court for now not saying anything on the matter, but that it will be hearing Justice Verma's concerns going forward. Back to you.
Ashmit, thanks a lot for that update. And in some tragic news now from the world of music, a rock legend, Ozzy Osbourne, the Black Sabbath frontman turned popular reality TV star, has died at the age of 76. Osbourne kicked off his career in the early 1970s as Black Sabbath's lead singer. Now that, along with several solo releases, have sold over 100 million records worldwide. Osbourne held his final concert on the 5th of July in Birmingham, where he thanked visibly emotional fans for one last time.
Well, that's all we have on this edition of Business Lunch. Don't go anywhere. We're leaving you with the Nifty trading with a gain of 100 points. The Midcap index visibly in the red. Don't go anywhere. Midcap radar comes up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. Well, good gains in the markets is what we are seeing right now. Nifty very close to the 25,200 mark. Of course, it's still that 25-point gap that we are seeing there. But nevertheless, it has picked up from the lows. We did see it maintaining those levels, the opening gains being maintained, and there's a slight uptick from those levels. Mid-caps, they have recovered sharply now, but still in the red.
That's right, still in the red. The mid-cap and small-cap end of the markets continue to trade with minor cuts. Advanced decline ratio over there slightly muted. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks edge higher as Nifty trades near day's high. Mid-caps also recover from the day's lows. Auto, healthcare and utilities register gains, while realty and defense stocks under pressure.
Shares of Lodha developers under pressure after 1% equity changes hands in a block deal. Oberoi Realty also trades with cuts after 3% equity is exchanged. Sources say existing investors sold stake in both companies.
Idea Forge trades with cuts after reporting an 85% dip in revenue on a year-on-year basis. The company has also reported a fourth straight quarterly loss. Cyient DLM also trades lower after first quarter revenue and profit failed to meet street expectations, even as margins expand.
Dixon Tech trades higher on the back of a steady set of June quarter results. Profit rises 68% while revenue nearly doubles. The management tells CNBC-TV18 the order book looks healthy and guides for 40 to 45% revenue growth in FY26.
Jana Small Finance Bank shares feel the heat after Q1 profit falls and asset quality deteriorates. The management tells CNBC-TV18 that stress has carried on a bit longer than their expectations, but they are hopeful of a significant drop in NPAs over the next 2 quarters.
Okay, all right, those are the top headlines. We do have earnings which are trickling in thick and fast. And a lot of reaction to those earnings as well. We'll discuss that through the course of the show. For now, Nifty closer to the day's high. We have a rate of 25,167, 170 around that on the Nifty currently. It has swiftly seen gains from the lows of the day as well, or the opening gains, so to say. Mid-caps, that's where the major recovery has come by. It is seeing some red, but from the lows of the day, it did get into the green for a bit, saw some more losses from there. But yes, it's a recovery nevertheless. Sapphire Foods numbers flashing for you at the bottom of the screen. EBITDA is down 7% for now. The stock is seeing cut of around 4%. That's a sharp fall from the highs of the day as well. Margins, a 300 basis point contraction that has come by as well, explains the move that we are seeing on the stock right now.
That's right. Good afternoon. So Sapphire Foods down almost 4%. One stock that actually was under quite a bit of pressure in the early part of the session was NCX. Reports indicated that trading there, especially as far as the electricity futures, was halted. But that stock has made a very sharp recovery. In fact, now up almost 1% in the session. But a whole host of mid-cap stocks is what Hormaz has on his radar. He's standing by the wall to take us through our special segment, Mid-Cap Movers.
A lot of these broader market reports are just giving us one takeaway that the margin for error is almost zero and the slightest bit of disappointment is getting punished, as you can see from the Sapphire Foods results on the bottom of your screen. But with the recovery that you have seen in the broader markets, you start out with the gainers, and MRPL now is up 7% at the highest point of the day. And take a look at the spike that we have seen in Ola Electric. There was a very small block that took place just a few minutes back, and since then the stock is now up 6.5%. LG Equipments, and at the same time as Ola Electric, Electra Green Tech too has moved to the highest point of the day, 0.25% higher there as well. The earnings reactions, we just spoke about Sapphire Foods, but take a look at some of the other earnings reactions. Look at Credit Access Grameen. Idea Forge from its listing levels of 1350 is now down to 500, and Jana Small Finance Bank, we heard from the management earlier in the day, and since the stock has even extended its losses, now 7% lower on that stock. With the newsmakers of the day, there were two real estate names that were in focus after the block deals. Oberoi Realty is seeing some choppy moves, but Lodha has now declined to the lowest point of the day, 7.5% lower there on the stock, and Blue Jet Healthcare was down 10% yesterday, is down another 8.5% in today's session after the results, and Bombay Dyeing, of course, among the top among the top gainers in the volume-led front, 12.5% higher here as well. Speaking of the volume-led movers, look at Green Panel Industries here, look at Shalby, Godrej Agrovet and Nava, all of them seeing gains on very strong volumes of anywhere between 3% to as high as 9%. And lastly, stocks that are at a 52-week high, in today's session as well. I look at Datamatics is one of them, 9.5% higher on that stock. JM Financial continues to move higher. A lot of these capital market names, at least one of these names is at a 52-week high one of these days, and Paradeep Phosphates too continuing to move higher, 6% higher in today's session as well. Back to you guys.
Okay, some interesting names there. Thank you so much for joining us as always. It's now a good time to welcome Jay Thakkar from ICICI Securities for a technical check. Jay, good afternoon. Do you think we'll build on to the gains that we've seen now and some more recovery in the broader market as well?
Hi, good afternoon to you, Sonal and Vivek. As far as Nifty is concerned, I mean, we have seen a good recovery coming in market in this week, particularly after, last week sell-off. And, the good recovery has been because of the Bank Nifty. We have seen the two private sector banks, or maybe, the Bank Nifty doing quite well. The kind of recovery which we have seen, coming back there has supported the Nifty, because we did see that, the Reliance had kind of a correction, 3 to 4% kind of a correction. But despite that, Nifty managed to hold on to 24,900 levels on a closing basis, and now it's back to 25,200 levels almost. I think this bounce, Sonal, can continue until the levels of 25,400. I mean, that is the level which I am eyeing for in the short term, until this 24,900 to 25,000 range is held. More or less, still it doesn't clearly indicates that market is out of the range, or the breakout has finally come, because if you look at the IVs, is still around the levels of 10. The IV percentile is still at 0.4, indicating, or maybe one can look at the Indianomics as well, indicating that there can be a jump in or a spike in volatility going forward, maybe near to the monthly expiry, which can trigger the volatility, and then you can have those volatile moves. So you can have the downward moves as well as upward moves, unless we have a very clean breakout on the upside. 70% of the time it has happened so that we have seen the volatility, and 30% of the time it has been observed or witnessed that we have seen an uptrend. So if at all Nifty breaks above the levels of 25,400, Sonal, it would be safe to assume that it will resume the uptrend and maybe inch towards 25,800 to 26,000. Likewise, for Bank Nifty, the levels to keep in mind are 57,500. Above those levels, one can safely assume that the breakout finally is there after 1 month or 1.5 month kind of a consolidation, and thereafter Bank Nifty can inch towards 59,000 to 60,000 levels as well. Else, you can see that volatility spike in market. So these are the levels to keep in mind. Now, since in the short term, Sonal, my view is a bit positive for a bounce back, I have two buy recommendations from the mid-cap segment. The first one is on Chambal fertilizer. One can buy Chambal at around the levels of 558.59, placing a stop loss below 550, and one can target 575 to 590, mainly on account of short covering. We have seen a positive divergence here, but we have seen short getting covered as well. So on account of short covering, Chambal can see a good bounce back. In second short covering candidate is Syngene. It has managed to take off its previous swing highs of around 680. Momentum has turned positive with a positive divergence. But interestingly, from the pharma pack, we have seen a good short covering out here as well. So one can see the levels of 710 to 725 on the downside. 670, 75 is a good support range. Till those levels are held, short covering cannot be ruled out in Syngene as well.
Thank you so much, Jay, for joining us, giving us your view on the markets as well as your individual trading calls. Syngene, remember, reports its results later today. Let's now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned in a Midcap Radar. A lot of stocks in the broader markets which are reacting to their earnings. Idea Forge, it's trading with a cut of over 6%. Ria is joining us now to tell us what did the numbers look like and what is the management saying. Ria.
Well, yes, Sonal, Idea Forge has reported a very weak set of numbers in Q1 of FY26. They've seen a sharp fall in the revenue, down about 85% on a year-on-year basis and down 37% sequentially as well. The gross profit margins have expanded by a lot in this quarter, up to around 61.7% versus just about 33.3% in Q1 of last year. But this margin variation is largely dependent on the product mix of the orders that were delivered during the quarter. They've also seen heavy EBITDA and net losses of rupees 15 crores and rupees 23.5 crores respectively in this quarter. Remember, the company has been loss-making for the last 4 quarters and the losses have been widening in each quarter. But in Q1 of this year, the losses have slightly narrowed sequentially in this quarter. Coming to the order book then, the order book has expanded quite significantly to rupees 144.8 crores versus just about rupees 13.6 crores in Q4 of FY25, since they've secured a very large emergency procurement order from the Indian Army worth about rupees 137 crores for mini UAVs. Now, going forward, the management has said that they have an L1 opportunity pipeline of rupees 400 crores, which remains relatively intact going ahead, and they're expecting to close this within this and the next financial year. And remember, this is excluding the emergency procurement orders that they're expecting to receive in this year as well. They're also targeting to turn profitable in the near term, and they're expecting an improvement in the working capital cycle as well once these emergency procurement orders get executed this year. And in fact, they've also highlighted that the next phase of the PLI is expected to be rolled out soon for drone manufacturers, and this will be a big push for the industry and for Idea Forge as well. But nonetheless, the street is not liking the numbers, and the stock is still down over 7% today.
Thank you so much, Ria, for joining us and giving us a sense of how exactly the results of Idea Forge panned out. Well, a couple of stocks of the radar. M&M, Mahindra and Mahindra shares, at one point of time, they had crossed over the 3,300 crore mark, have seen a bit of a dip and now trading near the day's lowest point. And another stock, which is Loda, earlier known as Macrotech Developers, that particular stock, remember earlier today, it saw a 1% block deal from an institutional equity investor. And that stock now near the day's lowest point, again, over 7.5% lower. Another stock from the small finance bank space, which is Jana SFB, is down over 6% and continues to remain under pressure. This is after the management told CNBC that they continue to see some stress going forward as well, and their NPAs will only come down significantly Q3 onwards. Let's listen in.
It's a short-term pain for sure, because when your MFI book drops, you do lose revenue. On top of it, you do have increased credit cost. And of course, for collection, you put in extra collectors. So the cost line also doesn't help you. So all three lines have not worked for us in the first quarter. We'll see some relief on the cost side because we are fully capacitized for collections. We should start seeing some positive shoots on the MFI book, on the growth side, and on Q3, then we should see the drop off in the NPAs. Q4, if all goes well, as you know, MFI does reward very well in good times. So if all three lines go right, then I think it should be very positive. We are at 71% secured. We would like to get to 80. We would like to put more and more of our unsecured book into the guarantee programs. 36% achieved. It was 28 in March. It is 36 in June. We'll probably see a 45 to 50 range by September. So 2 activities. Third, on the credit cost, I think it's very important to understand. See, a regulatory provision that is required is 46 crores for the quarter. On top of that, we have done accelerated provision, which is not required by regulation, of 150 crores. So the only way to think about it is, yes, we would like to create buffers for provision, unless we don't see a very clear environment ahead of us on the MFI piece.
All right, that's the word coming in from Jana SFB. We'll slip into a short break now. When we come back, we'll get you more on the markets and a lot of stock-specific action that's been happening. Stay tuned.
Welcome back to Midcap Radar. Well, the recovery that we're seeing in the markets continues. Two very important results as far as the midcap IT space is concerned. One company that market will be watching out for is Persistent Systems. Rima joins in with what the street is expecting from this particular set of numbers.
Thanks so much for that. So for Persistent, expect a steady and a strong performance this time. Dollar revenue growth seen up 4.3%. Constant currency revenue growth higher by 3.8%. So approximately about a 3.5–4% kind of a top line growth. And that's been the run rate for the company over the last couple of quarters. That trend will come up for you. Last year, it was closer to 5–5.5%. But things have been tougher. And this time, the street is working with 3.5–4%. EBIT margins flat with a positive bias. Profits seen up close to about 3.5%. What to track in terms of management commentary, whether they hold on to their $2 billion revenue aspiration by FY27. And the longer aspiration is to get to $5 billion of a top line. And they're also looking at some margin expansion.
Okay, all right. So that's about Persistent Systems. What about Coforge, Rima?
So, Coforge has been the best performing mid-cap IT company in terms of revenue growth and even stock price. This quarter too expects industry-leading revenue growth at 6.5% on a sequential basis, and growth rates for the company have been exceedingly strong. Now, the top line that we're talking about will be driven by the large $1.6 billion Sabre deal that they had announced very recently. Plus, there were some acquisitions, TM Labs, Rhythmos. They will all contribute to the top line this time around. Margins are seen at 13.5% versus 13.2%. Profits seen up close to about 10%. As I said, the stock has done very well, up 50% in the last 1 year. In the last 3 years, it's given a return of 150%.
Thank you so much, Rima, for joining us and giving us a sense of what exactly to expect from Persistent as well as Coforge when they report their results later today. Well, it's now time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, Vamakshi will tell you on how Q1 FY26 is expected to be for the capital goods companies. Over to you, Vamakshi.
Well, a steady quarter is on the cards for capital good players as healthy order books begin converting into revenues. To start with, all eyes are on order inflows. Momentum has held up well this quarter, supported by sustained traction in power T&D, renewables and the buildings and factories segment. After a prolonged lull, the railway sector is finally showing signs of recovery since April. Early days, but the trend is turning positive. The standout performer, Hitachi Energy, with order inflows expected to surge fourfold. BHEL is likely to post a strong 37% year-on-year increase, while CG Power is set for solid double-digit gains. On the other hand, Thermax and ABB may see mid-single-digit growth, and Siemens could be the only name in the red with a slight dip in order inflows, a rare miss in an otherwise upbeat sector showing. Next up, revenues. Capital good companies are set to post an average year-on-year growth of 19%, clear evidence that the order backlog is translating into billing. Hitachi Energy once again tops the list with a 37% surge in revenues thanks to the execution of the Mumbai HVDC project. BHEL and CG Power also stand out with over 20% growth each. Even Cummins is expected to clock 12% growth despite dealing with a high base from last year's pre-buying cycle. ABB and Siemens, after reporting low single-digit revenue growth in the previous quarter, are likely to post revenue growth of 11 to 12%. Thermax is likely to maintain its 12% growth trajectory too. Margins, though, tell a more divided story. Commodity prices, copper, aluminum, zinc, as well as pig iron have dropped. But margin expansion? Not for everyone. Expect margin compression at ABB, Siemens, Cummins and CG Power, largely due to high base effects and moderation of pricing power. But three names buck this trend. Hitachi Energy with a sharp margin gain of 750 basis points, BHEL with a 600 basis points improvement thanks to improved operating leverage, and Thermax aided by lower losses from bio-CNG and other projects. Profits mirror this margin divide. Hitachi Energy is expected to steal the show this time around with a 13.5 times jump in its profits. BHEL is likely to stage a turnaround as well, swinging from a 211 crore loss last year to 71 crores in profit this time around. Other than that, Thermax is set for a 26% jump, CG Power may rise 13% and Cummins should post double-digit growth in its profitability. ABB India is likely to report over 7% growth. Siemens, however, might lag with the slowest net profit growth amongst its peers. As far as valuations are concerned, there's been a reset, a moderation for most players, reflecting the impact of slowing order inflows and weaker infra spend. Hitachi Energy still trades at a premium at 125 times, but the broader peer group, including ABB, Cummins, CG Power, BHEL as well as Thermax, are more reasonably compared to earlier levels. In summary, strong order inflows, healthy revenue conversion and selective margin improvement set the tone for Q1. With valuations not as overstretched as earlier, this quarter will be about operational delivery and who's best positioned to turn this backlog into bottom line strength.
Okay, we take that point. Important analysis of what we can expect from the capital goods space this time around. For the markets, continues to be a good day so far. If we talk about individual movers, MRPL, for instance, should come up for you on the screen. It is up 7% right now. Remember, it reported weak set of earnings this time. The stock was down 7% on Monday after it reported numbers, but since then it's been a one-way move. The indication is that maybe the refining scarcity is something that would aid GRMs going forward. Not enough refining capacity is being added, and that's something that could aid standalone refiners like CPCL and MRPL as well. If we look at the Midcap index, it has made further recovery from when we started the show. It's down just 40 points right now. And even the advanced decline ratio, that should come up for you on the screen. That is the one which is indicating the it is in favor of declines right now. That continues to be the case. If we talk about the movers in the broader markets other than what we spoke about right now, Sona BLW Precision, that stock should come up for you on the screen, 3.5% higher. We had Vivek breaking that story, which was later confirmed about a Chinese player, collaborating with Sona BLW, and that seems to be exciting the stocks even more.
Last couple of days, there was some news flow regarding, some worries as far as the family was concerned, especially post the unfortunate demise. So that kept the stock under pressure. Today, the stock has recovered quite sharply. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much as always for tuning in. And Nifty is climbing up slowly, moving towards the day's highest point, 25,191, approximately 190 levels is what the Nifty is trading at. 0.5% of gain is what we're seeing coming in for the Nifty 50. Other than that, in terms of the broader end of the market, that doesn't seem to be doing too well, right? A bit of a pressure that we're seeing coming in, especially on the Nifty Midcap and small cap. That's seeing a sharper fall. 0.2 to 0.3% of decline is what we're watching out for in terms of the Nifty small cap. Sectors that are managing to hold on to gains, banks is doing well today. We have autos that's managing to hold on to gains, and the other one is pharma and IT. These are the ones that are managing to hold on to green. Other than that, realty is among the top sectoral loser today, coming in the trading session. So important to watch out for a lot of earnings today from the Nifty front. We'll have IT, Infosys reporting their numbers. Pharma, we have Dr. Reddy's and Tata Consumers on the FMCG side. So let's keep an eye out on all those earnings as well. As of now, we'll see some bit of a move that is coming from most of these stocks. Tata Consumers almost at the day's lowest point. Wait out for the numbers. But let's get started with the show. And this is the show where we solve all your stock-related queries. And we're going to be doing that with our experts for today. We have Asta Jain, research analyst at Hem Securities, as well as Saumil Mehta, head of alternate research, capital market strategy at Mirae Asset Sharekhan. Asta as well as Saumil, good afternoon and thank you so much for joining in with us. Let's get started with the queries for today. The first query is coming from Weber, who's writing to us from Pune. He's holding 8,000 shares of Ola Electric. This is at a price of 42 rupees per share. So right now also it's around that buy price. He's asking whether he should hold or sell. What should he be doing now? Asta, Ola Electric, what are we watching out for? Are those worries that were there for Ola Electric behind them? And could we expect a better move coming in going forward?
Hi, good afternoon to all of you. So, talking about this counter, I think management commentary was looking very promising because they were telling that now they are transitioned from the aggressive expansion strategy to more comfortable or a decent production strategy. So this is one of the point which we like about the management. In fact, they were claiming that they will be continuing with the EBITDA positive strategy because for the first time they have turned out to be EBITDA positive in the quarter gone by. So I think all these factors are pointing out towards more upward direction for this counter. Maybe not sooner, but maybe later. So idea here is to stay invested at least till the level of 45 to 48, and then one can make exit from this counter. So right now we are recommending hold on this counter.
Okay, recommending a hold on this counter. Saumil, what's your view coming in for Ola Electric as well, right? We're not seeing anything exciting in terms of a return. Only the side that the stock has moved is the downside. But now on the charts, is there any indication that is giving some hope that maybe we could see a up move coming in? Medium to long term also is fine for us in terms of a view.
Hey, hi. Good afternoon to everyone. Ola Electric has been struggling to go above 40 daily moving average for a very long time now. It's almost 6 to 7 months that Ola Electric hasn't closed above 40 daily moving average, just struggling below to go above 40 daily moving average. Very clearly, there's a lot of weakness in the medium term, in the very short term. If there is any close above 50 levels, only then I think there would be a good trend on the upside only in the short term. But in the medium to long term, I would avoid the stock. I would not go in and buy. But in the very short term, you can trade above 50 and for a target of 60. But I would definitely avoid it.
Okay, avoid as of now. That's the word coming in on the technical front. Let's move on to the next query then. We have Matthew who's writing to us from Kochi. He's holding 1,000 shares of Zaggle Prepaid. Price is 442 rupees per share. So he's making a loss on this one. Wants to know if he should hold or book his losses. What is your view on this one, Asta? Zaggle Prepaid?
Zaggle Prepaid is looking okay to us, not very much optimistic, but I think one can, wait in this counter before fetching any sort of losses, because right now we believe that this counter can move till the level of at least 450 to 460. Now, if I talk about the fundamentals, they have got a very established presence in the digital expense management solutions. In fact, with the growing network, partnerships, strong partnerships, and their users are also increasing. In fact, they have got the customer from the diverse industry. So all these factors will be helping the company in giving good financial performance in the coming quarters. So on that basis only, we are recommending hold on this counter for the price target of 450 to 460.
Okay, keeping an eye out on that. And Saumil, your view for Zaggle Prepaid?
Very range bound. However, in the medium term outlook, trading about 200 daily exponential moving average, which is a good sign, but very range bound, 400 and 440. This is the range where it is trading. I'm optimistic in the medium term outlook, but in the very short term, very sideways. If the stock goes above 440, I think then the next rally starts and the next targets would be around 500. But I would definitely wait for a breakout above 440.
Okay, you will wait out for a breakout about 440. We'll keep an eye out on that. We have just some numbers flashing at the bottom of your screen. PCBL Chemicals, net profit has seen a decline of 20%, just at 94 crores for the quarter. We have EBITDA that's down 11% as well. Revenue a bit muted as well. So seems like some bit of a pressure is coming in, and we've seen the stock also decline once the numbers were reported. Look at the sharp fall that's suddenly come in. As of now, the stock is down 3.5%. So yes, we'll wait out for more internals coming in on this front, but as of now seems like a weak number. Even margins have seen a sharp fall coming in, 15.1% versus 16.7% last year. So keep an eye out on this one. Bit of an operationally weak performance clearly that is seen, but more details is something we'll await. But let's move on to the next query for today. Then we have Shashank, who's writing to us from Delhi. He's holding 100 shares of Gujarat State Fertilizer and Chemicals, GSFC. And this is at a price of 280 rupees per share. He's also making a loss on this one. He wants to know whether to hold or to sell at the current levels. Your view, Asta, for GSFC?
So in fact, they have entered Q1 FY26 on a very cautious note, although monsoon is favorable. In fact, the government is also supporting in the form of subsidies, etc. But what we have to see is that the other players in the same industry, they are facing the challenge regarding the elevated raw material cost. Although this company has tried to align their production activities and hence they are not very much negative about the cost structure, but overall we have to see how this pan out to be in the coming financial performances. So overall, I think this counter is such that one should remain invested in, but not very much positive. Although we are setting the price target of somewhere at around 250 at the initial levels, although cost price is 280, so it is very far away from the current levels. But one has to wait. This is what we believe, at least for the 250 levels to come in, and then again review the query.
Okay, so wait out for the 250 level is the word coming in from Asta, and then maybe one could actually look at it look at the query again and see where it's headed from there. But Saumil, on the charts and technicals, what's your view coming in? Last 1 year, 14% decline is what we're seeing. Now, what should the viewer do? Any hope that it could maybe come back to that 280 level anytime, or is it better to just get out of the stock right now?
I think I'm positive on the stock in the short term, in the medium term, both. A very crucial level, 192, that can be a stop loss in the medium term outlook, in the short term as well, both. There's a triangle pattern forming exactly about 200 daily moving average, and I think this triangle pattern will break on the upside. My targets on the upside would be around 220 in the short term and 265 in the medium term outlook. So hold would be my strategy on the stock.
Hold is the strategy coming in on both the fundamental and the technical front. Now let's move on to the next query for today, IRFC. Asta, IRFC has reported their numbers as well. Now Sagar is writing to us from Raigad and it's an investment query. He wants to know whether he should make an investment now in IRFC. What's your view coming in? Because this time we've seen that NIMs have seen a bit of an improvement. NPAs are at 0%. So what are we watching out for now from IRFC, and is it a good investment bet?
I think so, because in fact their debt to equity ratio has also improved to 7.44. So yes, I think this is a good investment option at this point of a time, but not at the present level, maybe at the level of 130 to 132. Not very much down from here. But yes, buy on dip strategy can be applied to this counter. However, our price targets are somewhere at around 165 to 170 at the initial level. So yes, one can make an entry into this counter because of the kind of performance this company has posted with a price target of 165 to 170.
Okay, and Saumil, your view for IRFC, is it a positive counter on the technical front as well to enter the stock?
I think at this point of time, avoid would be my strategy because it's been a very range bound between 130 and 145. Till the time it does not break out above 145, I think that will be the right time to buy in for a target of 165, but not right now, only above 145.
Okay, 145, wait out for the number before you enter. That's the technical level that Saumil is highlighting. And then maybe, if 145 and above that breakout comes in, then you could look to enter. 165 is the level that we can keep an eye out on as well. That's a view on IRFC. But on that note, we're going to sip into a very short break, but a small programming note for our viewers as we sip into this break. As the workplace transforms, so most leaderships in the Bangalore edition of Future Female Forward, Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on 29th of July, 5:30 p.m. onwards, only on CNBC TV18, CNBC-TV18.com and YouTube. Welcome back to Your Stocks on CNBC TV18. We have the numbers of Westlife Foodworld that have just come in. Look at it. Net profit this time is under pressure, down 63%. We'll wait out if there's a one-off or something that we can see coming in. But as of now, the net profit is down 63%. Revenues are up 6-7% approximately. While in terms of the margins also seems like, we're seeing that EBITDA overall, 8.5% uptick on a year-on-year basis. Margins also is expected. I think we saw some bit of an improvement there as well. 13% versus 12.7%. So 30 basis point improvement in terms of margins. But look at the stock, once the numbers were reported, we saw that spike up coming in for the stock, up 0.6% as of now. And on the flip side, Sapphire Food, that also reported its numbers a short while ago, where we saw some weakness coming in terms of the numbers over there in terms of overall result, where revenue was up 8%, but the company reported a loss of 1.7 crores this time. And impact that I'm reading, what Mangalam has also highlighted, was that EBITDA margins were impacted by operating deleverage, lower gross margins and higher delivery mix. We'll wait out for more details for Westlife also. But as of now, the stock did see a sharp spike up post the numbers were reported. Wait out for the internals coming in there. But let's keep it going with all your stock-related queries then. We have Pranav Jain, who's writing to us from New Delhi. He's holding 85 shares of NBCC. This is at a price of 30 rupees per share, making a profit on this one. Now wants to know if he should remain invested on this one or book out his profits. Asta, your view.
Remain invested in this counter because we believe that this counter is poised to go to the level of 140 to 150 odd levels. So a very good investment option this counter is giving right now. Now talking about the fundamentals, what is major attraction of this company is that they have got a threefold jump in their order inflows. In fact, 691 billion of order inflows is the highest ever which this company is getting. And in fact, we are expecting their earnings to grow at a CAGR of more than 20% in the top line and bottom line from FY25 to FY28. So for 3 years CAGR growth is also expected to be in the double digit. So I think all factors are signaling towards more upside for this counter, and hence recommending a hold with a price target of 150 at the current levels.
Okay, 150 is your target price. Somil, what is the target price that you are giving? Because, after that consolidation we saw till somewhere around last year to April this year, then we have started seeing the stock finally come up, right? And in the last 6 months, almost approximately 24% uptick that has come in for the stock. What are we watching out for now on the technical level?
Absolutely. I agree. 150 would be my target levels as well. In the short term, there could be a small dip till 110 or 105. But overall, in the medium term outlook, I think buy on decline should be the strategy. Medium term outlook, trend is up, high top, high bottom formation. Everything is good on the higher degree time frame. So 150 would be my target. 105, to be very specific, 200 daily exponential moving average, which is around 102. That will be a very crucial level to watch out for.
Okay, keep an eye out on those levels over there. Buy on dip is the strategy. 150 is what we could watch out for. So the view should continue holding, make some bit more of a profit at 150 at least is what we're watching out for right now. Let's move on to the next query for today. We have Damodar Reddy, who's writing to us from Telangana. He is holding 500 shares of restaurant brand Asia. This is at a price of 82 rupees per share. Wants to know if he should continue to hold or look to sell this one. Asta, we just had the numbers come in for Westlife Food World, Sapphire as well. And what are we expecting in terms of restaurant brand Asia? Does it merit holding the stock? He's bought it at 82 rupees.
I think it does, because what we believe that they have got a very strong jump in their dine-in app through digital platforms, and because the company has made a huge investments there and they are now getting the results on that part also. So we believe that this counter has a potential to move more upside from here, and hence we are recommending hold, although he's already into the profit. So if he can take risk and have a patience, then definitely he can continue his holding for the initial price target of 89 rupees. We are not giving a big target as of now, but I think 89 is the target which we can set for this counter.
Okay, 89 is the target that you're setting. And Somil, what is the target that you are keeping an eye out on? Last 6 months, we're seeing that the stock has not done much, right? Not much of a move that's come in there. So now is it time for a better up move that we're watching out for?
In the very short term, if you see in the last couple of months, it's been trading in a range between 75 and 90. I'm expecting this range to break on the upside because medium term looks okay, but I will wait for the breakout. Breakout is above 90. If it goes above 90, only and only then I'll be holding on to the stock for a target of at least 120 and above. But I think the strategy should be to wait for the breakout.
Okay, strategy should be to wait for the breakout. That's the word coming in there. Next query for today is coming in from Prasad, who's writing to us from Chennai. He is holding 104 shares of Spandana Surti. This is at a price of 460 rupees per share, making a loss on this one. A long-term investor. So he wants to know if he can average now or wait for a further correction? He's not looking to sell. He wants to know when he should average. Asa, your view.
So I don't think that he should average at this point of a time, wait for more correction to come in. Although I'm recommending hold on this counter. The reason being is that what management has guided for the 20% growth in their AUM and disbursements for FY26 is holding the key importance to me. And hence we are giving it a chance and therefore we are recommending hold on this counter. So idea here is to remain invested, although we believe that averaging out should be done at the lower levels and not at the present moment.
Okay, sure, at lower levels, not at the current moment, even if you are looking to average. Somil, your view for the long term as well. I know you don't believe in averaging, but buy on dip strategy, at least that is what one could watch out for.
Yes, I think in the very short term, I'm expecting a good rally on the upside till at least 360. But overall, if you see the medium term outlook, it's struggling below 200 daily exponential moving average, and I don't see any positivity in the medium term outlook. So in the very short term, yes, there could be a spike up, but overall trend is down. I'll be expecting the stock to go below probably the previous swing lows of 225 levels. So yes, medium term outlook negative, but in the short term, there could be a spike.
Okay, in the short term, there could be a spike, but medium term, negative on the overall outlook for the stock. Let's move on to the next query for today. We have KS Rao, who is writing to us from Andhra Pradesh. He's holding 400 shares of Nalco. Price is 50 rupees per share. He's a long-term investor and he wants to know, and he can hold this for one more year as well. So he should continue to hold, sell. What is the view coming in on this one? 196 is the current price and he's bought it at 50, so he's making a profit on this one. Asta.
Hold is a strategy from my side for this counter with a price target of 220 at the initial level. Now, talking about the fundamentals, they have set a very strong capex plan, and I think on that basis, we believe that this company will going to show good financial performance in the coming times. So I think it's better to wait for some more time, and hence we are recommending hold with the price target of 220 at the initial level.
Okay, hold with 220 as the target that you've given. And Somil, your view coming in for Nalco?
Absolutely positive in the short term, medium term, both. In the very short term, it has just broken out of a small triangle pattern about the 200 daily exponential moving average, so which is a very good sign. High top, high bottom formation. I think the next level to watch out would be 220, 230 levels in the medium term outlook. I'll be expecting the previous swing highs of 260, 270 to be taken off in the medium to long term outlook.
Okay, keeping an eye out on those levels over there for Nalco. But, with that, we're absolutely out of time on this edition of Your Stock. So thank you so much, Somil, as well as Asta, for joining in with us. And viewers, Nifty as of now has reached and gone above the 25,200 level. So keep an eye out on that. We'll wind down this edition of Your Stocks. But up next, you have Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei holding on to gains of 2.6%. That's the Japanese index.
Largest trade deal in history. I think maybe the largest deal in history with Japan.
The Nifty first, support 24,882 does not change.
But I'm going to keep an eye on some pre-positioning on the IT pack.
67 points on the Nifty, 195 on the Sensex.
So the order book for Q2 looks very healthy, and it's also the festive season, ahead of the festive season.
We always had adequate CRAR, the capital ratio, which helped us to achieve the credit growth.
Silver actually is outperforming gold when you look at the last 1 month or YTD numbers as well.
There is some uptick that we are seeing. Nifty is up 61 points right now.
Infosys will be the only one in the large cap IT space with a positive growth.
Well, good gains in the markets is what we are seeing right now. Nifty very close to the 25,200 mark.
Well, that was the day so far. Things are picking up. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me, Surbhi Upadhyay and Nigel D'Souza, and you're watching Closing Bell. And at the day's high now, it's a good 130-point gain on the Nifty, up 0.5%. Midcaps are flat, but again, there is that little bit of a recovery.
Well, that's right. And results keep coming in, right? The last one that came out is Westlife. Looked a little bit pretty much inline set of numbers, but that stock has moved to the high point of the day. Mahindra Holidays is the other one that's come out of that set of numbers. So select stocks reacting to numbers and reacting favorably as well. Both those two stocks should come up for you currently at the high point of the day. Pretty much in a range. Stock-specific action does continue, but I think we need to get closer to around the 25,250 odd mark, because that's where a lot of calls have been written. If you can get past that mark, then the bulls will feel that they are in control. Remember, tomorrow you have expiry that will play out, so it's going to be an important mark. What's good today actually is both the the heavyweights are doing well. The Nifty Bank is up 400 points. That's managed to defend the 50 DMA. It's crossed the 20 DMA. You like that. And the IT index, everyone's pinning their hopes on Infosys delivering some kind of positive commentary, some kind of positive surprise. As Reema has been telling us, that's going to be the lone one that will be growing, among the large cap names. And there is already an expectation that they'll go ahead and tweak the guidance, which that's on expected lines. But some kind of positive cue is what the markets are searching for. Explains why the tech index is still holding up.
Actually, all the three numbers that come today are expected to be good. Persistent, Coforge, and Infosys, right? So if anything is to do well, it's got to be these three, guys batting for the IT bulls.
They say save the best for the last. This is pretty much the fag end of IT and Reema's earnings season.
Yeah, and mine is starting.
Get ready. And hopefully, some of these tail enders will actually take things higher. By the way, guys, I have to point out that today what we're seeing this green on the screen, it's got a bit of a global flavor to it as well. Global markets are doing very well. And there is excitement beyond Japan. The Japanese excitement has spilt over pretty much in all global markets, because now Japan is a huge trading partner of the US. Japan gets a deal which is favorable, better sounding than 25%. Now they're at least at 15% tariff. This has given participants hope, particularly in Europe, because remember the next in line is this Europe agreement. Mr. Trump said it's coming tomorrow. European stocks, look at the French market, the German market is soaring there. Even European auto stocks are soaring higher, hoping that they can get better, terms of reference. The earlier indicated level for Europe was 30%, which was very high. Markets keeping its hopes alive that it will be a far more measured number, the eventual number that will come in that deal. US futures are higher. US futures are higher about 0.5%. So some of this global goodwill is rubbing off on our screens as well. Well, we've got an action-packed next 1 hour for you. So let's quickly talk about some of the key stocks that we're going to cover on the show today. Sapphire Foods is definitely in focus. KFC, Pizza Hut, Taco Bell, they run all of these brands, and the stock is trading flat. Numbers are not very, very hot, and we'll talk about some of the internals in just a bit. The focus remains on FMCG. We'll talk about Colgate. The management commentary didn't inspire too much confidence, and the stock has sold off today, 4.5% lower. So what's the street view on this one? We talk about it. We then move on to IT. Infosys is the poster boy, and can it really, spur things up, turn things around in terms of sentiment for the IT sector? We'll get you the preview. as well as the street positioning on this as we go along. Other Nifty heavyweights that are on the radar today would be Tata Consumer, Dr. Reddy's. Both these companies are reporting today, and we'll get you a heads up on both those numbers, the expectations, in just a bit.
Okay, let's just quickly run our viewers through some of the big movers that we have, at least on the large cap screen right now. We spoke about IT doing well, banks, and even Reliance Industries has bounced back after 2 days of losses. So Reliance Industries is up close to about 0.7%. So that's providing support. Bharti Airtel is moving up. Tata Motors is your top gainer, reversing some of yesterday's losses. Bajaj Finance up and about. In fact, quite a few of the auto names are higher. So Bajaj Auto, Maruti Suzuki also in the green. We spoke about Infosys ahead of the numbers. It's charging ahead with a 1% gain. On the way down, Tata Consumer is struggling. That's the top loser ahead of numbers. Stock down more than 2%. Street is a bit skittish. HUL, BEL, ONGC are some of the drags. But how should you position yourself in the last hour of trade? Mitesh is now joining in with a few closing strategies. Mitesh, we've seen a bit of a pickup, 25,200 now on the index.
Yeah, so I think I've been maintaining this at 24,900, which we tested a couple of days back, could be the lower end of the range, and we could even go back to 25,300 odd levels, give and take a few points. That being the upper end of the range. I think it's just that volatility within this range, and we're just kind of chopping around. Once we start getting past 25,320, 340 zones, then I think we can look at a stronger up move. Till then, on the index, while the bias is not negative, it is not overtly positive, but on the stock side, yes, we are trading with some kind of long bias. I have a trading recommendation on Naukri or InfoEdge. Buy here with a stop at about levels of 1445 for targets of around 1520 to begin with. Then maybe eventually we can look at higher levels. And the other one which I like, and it's making a fresh high, it's come off a little bit from the highs, is Myntra and Myntra. Buy here with a stop below 32.35 for targets of 33.10.
Okay, all right. Thanks a lot for that, Mitesh. Well, we'll welcome Prakash Diwan as well on the show, and let's discuss a couple of numbers. First up, Prakash, all eyes are going to be at the IT pack. Rima is going to have a busy evening. But Rima, before we get to discussing about the tech-related names, let's go through the expectations on the big boy, right? First out of the blocks will be Infosys. Tell us, Rima, what do we expect on that one?
Well, Infosys expect growth. A top-line growth of close to about 1.5% on a constant currency basis. What could be driving growth this time is also some of the acquisitions that they had done. There were two acquisitions which, according to analysts, will contribute to the top line. So growth is going to be there. Margins are seen at 20.7% versus 21%, so on the flatter side. But again, the key is going to be the guidance. The current guidance stands at 0 to 3%. But because they did two acquisitions and they announced it last quarter, there will be some upgrade to the full year numbers based on that. So Street is saying 1 to 3% though is a given because of these acquisitions. But the question is, do they have the confidence to up the upper end of the guidance? Unlikely, because things are still uncertain. Maybe perhaps in Q2, once we speak 3 months later, they would have the confidence that the upper end could be tweaked. Margin guidance is likely to remain the same at 20 to 22%. But the more interesting ones would be Coforge and Persistent, because these two have been growing very well. And again, for Coforge, if that poll comes up, we're working with a 6.5% top-line revenue growth, in constant currency terms. And here it would be driven by the large Sabre deal, plus again some acquisitions contributing to, Coforge. So that's going to be one number to watch. 6.5% for Coforge. For Persistent, it should be a growth about 3.8, 3.9% in constant currency terms. Prakash is now joining in. Prakash, what's the positioning like in IT ahead of numbers?
Difficult question because none of them offer great solace at this point in time. But the only stock that one were to look at if there was to be some allocation made is Infosys. You mentioned Infosys would probably be expecting 0 to 3%, which could be up to 1 to 3%. But there's growth. That's completely missing in all the other big boys. Coforge and all could probably continue to, sparkle. They've done that in the past. But I think for a consistent improvement to happen in the sector, you might have to wait for some more time, maybe another quarter. So this quarter is just gone. There's nothing much to write home about. But if there's some allocation to be made, it could be Infosys, given where it stands, and probably be first off the races once things look up in the US.
Okay. So that's the take on IT. Looking at some of the other movers and shakers of the day, let's see. Credit Access reacting well to numbers, 4% higher. MRPL is surging 7.5%. Remember, earlier in the week, Nigel had told us that people in the market are looking at a tactical, at least a short-term tactical play on some of the refiners. In fact, Nigel, you want to revisit that? I mean, the triggers, because since then, Chennai Petro, MRPL, these stocks have seen a fair amount of trading bounce.
I'll give you a couple of details, just basic details out here. Why the first 2 quarters could look good for both these two companies. First, one, you had that Russia-Ukraine conflict that took place. A lot of global refining capacity got shut down. Then there were some refiners, I believe, that also got hit in the Israel-Iran conflict as well. So global refining capacity itself is short. So because of that, GRMs have seen a bit of a perk up. And GRMs tend to move in line with Brent crude prices. So if you're saying the Brent crude prices as well have seen a bit of a bottom, then this GRMs as well could hold steady. And besides that, since there is lower capacity available, that's why, in fact, you'll continue to see that these GRMs will remain high. Now, besides that, these companies have been focusing on reducing the fuel losses, that is there. So they have been doing some operational efficiencies. Plus, you have the global refineries as well that are in short supply, which will help the GRM stay elevated. And for CPCL in particular, we'll have to watch out for their Q1 numbers because MRPL got hit, owing to the shutdown. CPCL doesn't have that shutdown. Besides that, on the operational front as well, the losses that they have cut down, it used to be around 10.5%. And there's a percentage they give on the annual report.
Fuel and power.
It's fuel, FNL, I think so. So that's come down to around 8.5%. Every percentage point is a few hundred crores to the PBT. So that's why it is a tactical play. Just in the near term, the street could be sensing a refining, opportunity out here, because suddenly you look at valuations. Case in point being, if you look at CPCL, their interest cost every year used to be 450 crores. It's come down to 250 crores. And if they're going to make a lot of money, that debt that is there of around 3,500-4,000 crores will come down by half. Which in turn, on a replacement basis, if you look at the recent capacity, HPCL, I think, was setting up a capacity. And if you compare the cost that they're putting up that refinery and you compare it with this, then these are trading at a sharp discount.
And I guess I take your point. These end up being purer in terms of pure play refining, because with HPCL, you have to deal with the baggage of the margins and the marketing margins and what's happening with fuel retailing. With a company like Reliance, it's a giant, it's a juggernaut. It has so many other businesses. It's not a pure play on just global refining, like some of these names, MRPL and CPCL.
MRPL, we should pull up the 7-day chart. Yesterday also it was up. Monday it was down post numbers.
Reacting to numbers.
Yesterday it bounced back 5% up, and today it's added on another 7.5%.
Yeah.
But I think Manglam is now joining in. Manglam, first let's talk about Sapphire.
Well, you guys have been talking about oil and gas, etc. I thought I'd just lighten things up and speak about some of the brilliant, product numbers that have come in. Numbers not necessarily brilliant. So we start with Sapphire Foods. Of course, they are the franchisers for Yum in India, along with Devyani. Weak numbers coming in. Revenue growth at just 8% and EBITDA has actually declined by 9%. Margins have come off as well, and as a result of which the company has reported a loss as against a profit, and this is led by higher other expenses. So the EBITDA margins, as per the company, impacted by higher operating expenses, lower gross margin, and higher mix coming in from the delivery products as well. Key internals not, inspiring much confidence as well. We have Sapphire KFC, where the same-store sales growth has been absolutely flat. KFC same-store transactions, however, have increased, so that's a positive trend I'll be keeping an eye out on. And Pizza Hut same-store sales growth down by about 8%. They've added 11 restaurants, 8 KFCs, 2 Pizza Huts and 1 Pizza Hut in Sri Lanka. Sri Lanka has been doing well, but that's a smaller part of their overall business. So what is the trigger that we have to watch out for? Two things. One, in the very near term, weakness can come in from the fact that this is the month of Shravan, where a lot of, Indians turn vegetarian. So that is seasonally weak for a brand like KFC. And secondly, a positive trigger perhaps could be any potential development around consolidation with Yum franchisers. There has been this talk always. So whenever or if at all that happens, could be a positive trigger. On the other hand, Westlife Food reports numbers just came in on the exchanges, so they don't have the same store sales growth, but the initial reported numbers are good. Why do I say that? Because one, revenue has grown around 7%, but EBITDA has grown a little more. So we have an 8.5% jump in the EBITDA, margins improving by 20 basis points. That implies that there could be an element of positive same-store sales growth coming in out here. The net profit is, however, lower, but that's largely a non-cash expense, an increase in depreciation. So good for McDonald's, not so much for KFC and Pizza Hut.
That's really interesting, Anglam, because I remember when I think you were talking about the Jubilant update, the first quarter business update. I mean, Jubilant's been inspiring a lot of confidence as well, right, with those pizzas. But Sapphire is a bit of an exception. Westlife is good. So maybe it's a Sapphire-specific story, not sure. Just hang on, because we want to talk to you about Colgate as well. But let's discuss QSRs with Prakash. Prakash, pizzas, burgers, do you like anything?
Actually, none. But on the stock, I think Jubilant probably stands a far better chance to move beyond this consolidation that they've painfully endured for the last 18 months. And you know why I'm saying that is because the rationalization that has been undertaken there is something that started showing on the numbers. You know, while Westlife and Burger King and I mean RBA and Sapphire and all will continue to be jostling for that space. That's one, pizza is one space where Jubilant probably still has a very strong sway, and it'll just kind of, the raw material side is much more benign and is expected to do better as the monsoon kind of progresses. So you'll probably start seeing that getting captured in margins. And the moment margins change, you'll probably have a very clear reset for the stock in terms of multiples as well.
Okay. The problem seems to be people are having all these pizzas and burgers and colas and maybe they're not brushing enough. No, they're just being silly. We're moving on to Colgate now because Colgate's numbers have not been that hot and I don't think the management commentary has done much to assuage those concerns either. The stock's been down 4.5%. So far, you can probably classify it as, the not such great FMCG earnings so far in the season. But Manglam, tell us more. What's gone wrong?
Yeah, I'll just tell you about Colgate, but to complete the point on quick service restaurants, if you notice, a couple of years ago, we had this massive burger wave that happened. So Westlife and KFC, along with the sandwiches, the chicken products, were doing extremely well, whereas pizzas weren't doing well on account of a couple of factors. One, people had, stopped eating as many pizzas as they were eating burgers because burgers are snack, pizzas a meal. But now, increasingly, what has happened is Jubilant FoodWorks has, along with Pizza Hut, they've come up with newer options, more pizzas as a snack, lower valued options. So that impacts their gross margins, but increases their volumes. And a lot of the competition on pizzas, the ones that sprung up immediately post-COVID, have now shut. There are reports that said that, over 100 pizza outlets which were from the unorganized space, which had sprung up post-COVID, as inflation came by, all of them shut. So now pizzas are claiming their share back from the stomach than burgers. So that's why you've seen, pizzas do a little better than burgers after the outperformance that burgers had shown earlier. Having said that, let's talk about Colgate. Weak numbers coming in. Yesterday we had pointed out when the numbers came in as well that, it was a weak set that was expected. The company reported an even weaker than expected numbers, and the stock price is reflecting that. Going into numbers itself, it was down about 38% from the highs, and now it's lower a lot more. The management commentary not inspiring much confidence as well. They are expecting gradual recovery, and that to happen in the second half of this year, which implies the second quarter is not going to be very good for them. There's been weak demand, high competitive intensity, and a high base. Remember, same time last year, the volumes grew by about 8 to 9% as well. So on that base, difficult to grow for a category that is as penetrated but less utilized in a country like India. Brokerages on the back of management commentary have cut their target prices, have cut their outlooks as well. HSBC, for instance, believes that improvement is anticipated, but structural growth potential for this category remains fairly low. The other problem with Colgate is also, it's Colgate-Palmolive, and they've been hoping for Palmolive to grow at 2x the pace of toothpaste, and that itself hasn't been happening, or Palmolive hasn't reached critical enough mass to grow the overall business of the company going forward. And then you have, other brokers also writing on it. Goldman Sachs, for instance, they've pared their estimates by about 3 to 4%. The only bull on the stock is Edelweiss, or Nuvama, so to say. They have a buy rating and a target price of close to 3,135 rupees, and they believe that there could be recovery in the second half of this year.
Okay, all right. So there's one bull and perhaps more bears on Colgate. Got that, Manglam. Thanks very much for the comprehensive wrap there. Just going back to Prakash. Prakash, FMCG, the street is really pinning its hopes on some improvement, right? And it's a delta from a 0% growth, even if you do 5%, and if the market positioning is in your favor, then you could play for that, at least a tactical flip, right? Would you be calling out any FMCG stock? Any specific thoughts on Colgate, if at all?
So I think Colgate, it's being punished for not just weak numbers, but absolute lack of, any kind of an enthusiasm to change things. The committee didn't have anything which builds up hopes and promise. So that's where, this gash of 5% or whatever. But my sense is FMCG the real numbers, improvement in numbers will be, and we discussed this about 15 days back, and then there was this whole run on FMCG, more out of sector rotation. I think the numbers will probably only improve post-monsoon. And that also coincide with a timely festive season this time around. And you'll probably have all the top names start doing well, whether it's Marico, Britannia, HUL, Nestle, Dabur. But if you had to take an all-weather kind of an FMCG approach at current valuation, one of the best available options is ITC for various reasons, and we all know the reasons. But it's a matter of getting into a dividend yield stock which continues to throw up cash. Most of its businesses are doing much better than what their peer group is doing. It is on the non-tobacco side. So I think that's the only way to look at this space. Otherwise, give it some time before you allocate money.
Blue Jet, healthcare services, 20% gone, Prakash, in 2 days. I know Street is disappointed with the margins, but 20%, 2 days? Is that too much? Is it a buying opportunity?
Absolutely, Rima. I mean, I think the reaction is overdone. This is what happens when you start, building an expectation which are very unreal. And it may not be unreal from a percentile perspective, but the market has got so used to some of these companies that it's like a Titan not delivering numbers at some point in time. Now we've got used to the ups and downs, but initially when this used to happen, we used to punish the stock. This is an opportunity for long-term players to go. Look at what guidance they've given in terms of capex and the kind of revenue that will come through, the newer areas that are building up. I think the commentary had everything which was positive. If I didn't look at the stock price and just heard the commentary, I would believe it's a great story that I need to allocate some money to. But when you look at the stock and the reaction, you keep wondering what is it that's not gone home well. But I think it's a great opportunity to answer your question in very simple terms.
Prakash, Tilaknagar Industries, what's the view out there? These tier 2, tier 3, not the top of the rug alcohol companies. You normally, I think, Som Distilleries, you've got the timing pretty well on this. Tilaknagar Industries stock has rallied more than 20%, I think, in the last 1 month or so. If you compare it from January's price, where it is flat, but probably there could be a deal on the cards. If yes, what is your view? They have a fundraising later today.
Exactly right. We'll have to wait. What is it that they plan to do with it in terms of acquisitions and all? But this entire space hasn't done much, probably in sync with the FMCG trend that's existingly playing out. But I keep saying, be with the leader here. Cement space, you are with Ultratech. You haven't gone wrong all these years. Spirits, you remain with United Spirits, you won't go wrong. So, that's the way, and UBL numbers, United Brewery numbers give you that indication that once things start repairing themselves, it's always like a very fast clip at which the change happens. So I really would not worry too much about getting into right now into the second, third rank players. There was an era when you could have bought a Radico Ketan, you could have argued about some distilleries being promising. But at this point in time, I think United Spirits is the way to go for this particular thing, especially from the long-term perspective.
Got it. Going with the leader, Ultratech. But what about Dalmia Bharat? You have been spot on there, Prakash. Numbers look good, but the street anticipated it. And, we mentioned earlier today that the numbers looked good. Only thing that positive surprise or that zing factor was missing. And even X of JP's volumes, the volume growth is flat, which means that profitability is good, but market share is being lost in all probability. Your view, with the stock down close to 2-3% today, seen some profit taking, good entry opportunity, or it's no longer that 1,700 mark, you rather stay away for now?
Yeah, I mean, the risk reward is maybe not as promising as it used to be when we started talking about it at that point in time. But they've done a lot of things right, Nigel. To be fair, even the acquisition that they've done, that will take some time for them to be able to focus on volume growth, the right alignment in terms of geography. So, it's happened. Look at how India Cements and Ultratech are behaving. Look at how, some of the other acquisitions have been made in the recent past. So I would give them time. They will not disappoint. It's a great management, knows what they're up to. But yeah, at the levels at which it is, you'll probably be better off wanting to wait for some softer levels to get in. As I said, the risk reward is just not the same, but it still is positive from an absolute return perspective.
Okay. All right, Prakash, we'll leave it on that note then for today. Thank you so much for joining in. Good conversation. And we'll catch up again soon. Well, as we get set to take a break, here's a small programming reminder for our viewers. As the workplace transforms, so must leadership in the Bengaluru edition of Future Female Forward. Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch all of this live on the 29th of July, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com and YouTube. Welcome back. I just want to point out that a lot of auto stocks are revved up in the Indian market action as well, while, of course, auto stocks overall worldwide have been doing really well because of that Japan trade deal, starting with the Japanese giants. It just seems it's a feel-good factor. Tata Motors, you can still argue. I mean, if Europe gets a better favorable deal with the US, perhaps it helps their cause in case as well, or even the China deal for that matter. But for what it's worth, not just Tata Motors, Bajaj Auto, Maruti, a lot of these stocks are on the green side of the screen. Now, that's the large cap space, but there's a lot buzzing beyond the Nifty names as well. And as always, let's go across to Hormuz for a better understanding of all the other action out there. Hormuz, take it away. What's on your radar today?
Oh, plenty of them. And earnings reactions, there are volume-led movers. We spoke about the first name early in the morning, and that was Info Beans. And that stock early in the day was up, but it's now locked in a 20% upper circuit. This is the 7th straight day of gains for the stock. It's up 50% during these 7-day period. It is an earnings reaction as well. And this is on volumes like this. 4 lakh shares have already been traded today, and a 20-day average at this time of the day is just 3,000 shares. So it shows you the kind of volume-led moves that you've seen on this stock. And in fact, it has some significant institutional holding as well. And Mukul Agrawal has stake in the company. Kotak trusteeship has a stake in the company as well. So Info Beans is one mover. The other one is Sky Gold. It came out with numbers just a few hours earlier, and just immediately after the numbers, there were some block deals that were seen in the stock, as a result of which the stock is locked in a 5% lower circuit. Here, 0.5% equity was exchanged. Promoters had sold stake in June as well. And take a look at the returns that the stock has delivered in the last 4 years. Now, Before we get to that, of course, 30 lakh shares have been traded here. The 20-day average is 5.6 lakh shares. Now, take a look at the returns that the stock has had in these last 3 years. 2022, 150%, 2023, 365%, 2024, 285%. It actually came into the spotlight last year when the company had announced a 9-for-1 bonus issue of shares, and that's when it had come to the spotlight. So Sky Gold is one of them, a 5% lower circuit. The other one is Ion Exchange, and that is also seeing its biggest single day fall since October of 2023, 10.5% lower on the stock. We've had 23 lakh shares traded here already compared to a 20-day average of just 1 lakh shares. So another volume-led mover on the downside. The stock has broken below its 100-day moving average, and this is the first likely negative year return since 2019 that the stock is supposed to have. Now, the other on the downside as well, from between this 2019 to 2024 period, the stock has gone up almost 1700%, the move in Ion Exchange. Now, the other mover on the list today is Pitti Engineering, and it has snapped a 5-day winning streak and down 7% on very strong volumes here as well. They have seen 9 lakh shares traded compared to a 20-day average of just 23,000 shares. So it's almost a very, very significant move, and it's down almost 30% this year, and this is after the last 5 years the stock has jumped almost 25x. And the last name on this list today is another mover from the broader markets, and that is Datamatics, but this is on the gaining side. This is the 10th day of gains for the stock. It's up at a 52-week high in today's session. The stock has gained almost 30% during these last 10 trading sessions, and today it has seen almost 35 lakh shares traded compared to a 20-day average of just 3 lakh, and this is the best month that the stock has had in 2025. So movers on the downside, movers on the upside as well, but a lot of volume-led movers that we are seeing in the broader markets.
Thank you very much for that interesting list as always. And now the Midcap index is firmly in the green. When we started the show at 2:30, the Midcap index was flat. Now it's up 150 points. Aeroflex Industries has started an up move. Sapphire is getting stronger. Ola Electric has a gain of nearly about 8%, so that's popping up. Bellrise Industries is up nearly about 4%, and then you've got names like Bombay Dyeing, which has been strong from the morning, 14% up. Very, very large volumes on Bombay Dyeing. You've got Datamatics, Shalby, Green Panel Industries, PNB Gills. These are some of the big stocks with price and volume action today. Alok Agarwal of Alchemy Capital Management is here with us on the show. Alok, thank you very much for joining in. This is Rima here. Globally, there is a lot more optimism today because the sense is that perhaps we're closer to the end when it comes to the entire tariff episode. But back home, the Indian markets have been in a bit of a range, in a bit of a funk. Like, what's your overall view of the global markets, the Indian markets, and where we're headed and where we are right now?
Yeah, hi Rima, thanks for having me here. Completely taken that point that the global markets are actually doing much better in the short term. But if we really look at our own markets, after that sharp correction in the months of Jan and Feb, from early March till now, we are up about 20% at the broader index level, Nifty 500. So 4 straight months of decent gains and followed by a consolidation month like July. Actually, it's very difficult to complain out there. And it's all this happening amidst the fact that the macro numbers on growth and liquidity and interest rates and inflation all were improving. So many events like the tariff announcements to the warlike situations between India, Pakistan, and then actual wars like Iran, Israel, all these were happening. Corporate numbers were improving. So after 4 strong months, a consolidation month is quite welcome.
But are we likely to continue to consolidate? Are you sensing a breakout? What's been the read from the earnings season?
So we are quite constructive on the markets. For us, this is just a pause amidst a larger rally. So we remain positive on the markets. The fact remains that despite 2 quarters of slowdown in the previous financial year, corporate earnings still stands at a 17-year high compared to as a percentage of GDP. So the numbers are rising. That was a shallow period wherein the GST collections and some macro numbers started decelerating, but the things seem to be back on track. The negative liquidity in the system early in this calendar year has also been addressed. The various proactive steps taken by the RBI are also yielding fruits now. It's too early in the earnings season so far, but whatever numbers, like around 16% of the companies have reported numbers. And when we see those numbers, they are decent double-digit numbers so far. And it looks like the earnings season is likely to go ahead with that double-digit earnings growth to come up, with slight improvements seen in select sectors. And going forward in the year as well, we remain positive.
Okay. By the way, those are good-looking numbers from SRF. At least year-on-year performance seems to be improving. EBITDA is higher by about 37%. The profit, I think, is higher by more than 70%. And the margin has improved substantially over the last year. But the question is, is the sequential recovery still keeping pace, still looking as strong or not? These companies have been coming out, a lot of the specialty chemical companies have been coming out of a long period of a downturn. Above pole at least. The revenue, you can argue, revenue at 3,800 odd crores is slightly shy of our estimates. But at the EBITDA and the operational front, the company seems to have done well. Stock a little volatile, sold off a bit, then it's recovering. Alok, hi, great to have you on this afternoon. So tell us, when the market continues to be in a range and we know that valuations aren't easy or cheap anywhere. So what is your portfolio looking like right now? What is getting top billing and what are you avoiding?
Hi, Subhi. The interesting part that we're noticing, especially in the recent quarters, has been that some of the index heavyweight sectors, they are the ones that are not really showing too much of growth, both in the near-term reported numbers as well as the near-term estimates. And the broader sectors which are really showing growth and the visibility and certainty of it, they are not adequately represented in the indices. What I'm referring to is that the heavyweight sectors like oil and gas, FMCG, banking, and IT, they are the ones that are kind of struggling on the growth front, being slightly below the overall corporate earnings growth, almost slightly below the nominal GDP growth as well. But broader area sectors, things like financial markets, capital market services, the real estate, the aviation, the hotels, the hospitals, some of the manufacturing and industrial areas like defense, power plays. So a lot of these areas which are not adequately represented in the key indices, they are the ones that are showing a lot of strength, including the recent ones which are showing turnarounds like chemicals and cement. So these sectors are the ones that are actually dominating the portfolio and also having a larger share in the overall earnings growth that is coming in the markets.
So chemicals, cement and power, right? These would be your top three?
I would say top three out there would be the capital market plays, the industrials led by defense and power, and the real estate as well.
Okay, all right. Just stay with us. We'll just hop across to Sonal, who's here to quickly dissect those SRF numbers. Sonal?
Well, SRF numbers are largely in line. You can look at the margin number and say, oh, it is higher on a YOY basis. But that is because this time around, the revenue number is lower than what the street was working with. Absolute EBITDA is absolutely in line with what the street was working with. So EBITDA has come in at 831 crore rupees, in line with our poll of 832 crore rupees. Profits as well at 432 crore rupees is in line with 421 crore rupees of poll. Yes, it is higher on a YOY basis, but the stock sold off from the highs because the expectation was of a higher growth. Now, if we look at the segments as well, specialty chemicals was expected to do really strong. 37% revenue growth on a YOY basis was expected from the specialty chemicals division. This time around, it has grown only by 24%. So all hopes were piled onto the specialty chemical space because refrigerant prices had done well. There was front loading of purchases because of US tariff wars. So that is where some disappointment has come by. In terms of the other segments, packaging has grown by 4% on a YOY basis. The expectation was that packaging will grow really well on a lower base. So the revenues were expected to grow by 18% on a YOY basis for the packaging segment itself. In terms of the technical textiles business, it was expected to see a decline in revenues, down 11%. EBIT also has gone down by 45% here. So yes, it is a growth on a YOY basis, but the expectation was of a much higher growth. And that's why maybe the stock came off from the highs of the day. Of course, management commentary, very important because usually they talk about how they see the year going forward. So inline set of numbers, specialty chemicals is the segment where we have seen some sort of disappointment that has come by.
Thank you very much for that. That's SRF for you. Get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls from our technical expert.
Welcome back to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. By the way, just keep an eye out on, the pipe makers. You have stocks like Astral. That's suddenly moved to the high point of the day. There seems to be a bit of a positive fillip that's come in there with regard to anti-dumping. So Astral has moved to the high point of the day. You pull up, just take a look at that. Massive move is what we're seeing out there. And the other one is Finolex Industries as well. That one as well has seen a bit of an up move, in the last few minutes. So just keep an eye out on both those two. Big move. I understand that, there's a central bank has accorded permission for extension of time period by 4 months to September 2025 for completing the subject anti-dumping investigation and notifying the final findings. So that's been pushed a little bit. I guess that's why, in fact, these stocks are seeing a bit of a relief rally. Earlier it was still May, which has been pushed to September. So that's why we're seeing these stocks move up a little bit, particularly in the last 30 minutes. That said, time to move to D Street Chatter. Nimesh is with us to give us an insight. Nimesh?
Hi, Nigel. After many days, you're seeing a big up move in this fashion in today's market. So the Nifty is up 170 points. And again, it looks like more like a global risk on, which is helping India as well, because there is no specific reason for such a big up move in today's market. Not it's very news or not it's very large FI buying or a DI buying as well. So looks like more of a short covering as well in today's market. But I was just looking at some data in the last 50 days. Nigel, the Nifty has been in the range of 5%. That shows that there has been such a large consolidation for the Indian markets in the last 2 months. So looks like a bit of breakout could be on the cards here. From a flow perspective, again a mixed day, but the number may look large because of the two large block deals today, both Macrotech as well as in Uber Realty. So it has to account for those large blocks as well. Overall, the realty index is under pressure today, largely on back of those two block deals. But in general, there is a bit of profit booking as well across all the real estate names in today's market. The breadth, unfortunately, is not that great. So again, a weak day as far as broader markets are concerned. And that's been a bit of a worry in the last couple of days, that the breadth has turned a bit negative in the broader market. So a bit of profit booking, you can say. But largely, today's move is in the Nifty and looks like it's more of a short covering than large buying from large institutions.
Okay, all right. So more of short covering then. Got that point, Amish. What about stocks? Always action on your list. So what is it today?
Well, a lot of forgotten names are back on my list today. So the first stock is SpiceJet. Big move on that stock and large volumes as well. We saw that news about the Supreme Court order, but there was a large block as well, is what I understand. 3 crore shares got changed hands in SpiceJet. I understand one of the long-only fund, which was one of the QIP investor, they sold out in today's block deal. And one wealth fund was a buyer in today's block. So if there is a disclosure, could be interesting in SpiceJet. Similarly, is the case with Ola Electric as well. After a long time, seeing a big move on that name as well, up 7%, large volumes as well. I understand there was a clean-out trade from a leading long-only fund. They have been a seller in the last couple of days, but today it looks like it's a clean-out, and hence you're seeing a big reaction in that name as well. So expect very high delivery volumes in Ola Electric today. The third name is Jaiswal Nico. We saw a small block yesterday. The ARC was a seller, and there was an anticipation of further large blocks coming in, and you see the reaction in today's market. The stock is locked at 20% upper circuit, and even there the volumes are quite large in Jaiswal Nico today. So that's the third name. And the last one is Bharat Dynamics. It's been under pressure in the last couple of weeks post. There was an initiating report as well from Motilal, I think 10 days back. But for Bharat Dynamics, there is a very strong indication that maybe the company is likely to bag a large order very soon. So that's the buzz in Bharat Dynamics.
Oh, interesting. Okay, got it. And that explains, this big move on Ola. Even I was wondering that, okay, it's probably because of this big block, like Nimesh explained. So thanks for that, Nimesh. Plenty of stocks, as always, catching our attention, 7% on Ola.
Yeah, that's right. I'm just looking at the Jaiswal Nico stock. That's moved to the high point of there. It's one of the fallen angels, right, in the last few years or so. But as Nimesh is saying, there is a large trade that's taken place. On an EV basis, it appears that you put the debt and market cap together, it's around 8,000 crores. Last year, they did close to around 1,000 crores of EBITDA. Now, the street is hoping that they've taken various measures. On the cost side, they've got some captive iron ore as well. So the hope is that the EBITDA number improves from here on. There's an ARC that has 25% in the company. So we'll have to see if there's any kind of supply overhang. No notable name out there. But for the time being, because of that large trade and optimism that there's going to be captive iron ore that will flow through, margins will improve as well. And they're undertaken a shutdown last year and they've upgraded the furnace. So a hope is that profitability improves from here on. So that could be another reason why the street is hopeful. That said, let's go across to Mitesh Thakkar. Mitesh, what do you have for us at around 3 p.m.?
Vedanta is something, which I like as a BTSC call. So take a stop at about 452, look for a target of around 460. And the other one is, UPL, that's been a recommendation earlier as well. But today, after giving a pullback for the first half, it's kind of come back again near the day's high. So BTST here with a stop at about 722 for targets of 738.
Okay. All right, got that. Mitesh, thanks very much for that. So, yeah, those are some of the trades that one can look at as the day closes. The Nifty is actually holding on quite nice and steady. Almost 170 points up on the index, and it's managing to sustain above 25,200 for what it's worth right now. And the Bank Nifty continues to, of course, be in top shape and form. It's actually the financials, not only the Bank Nifty. That's the Bank Nifty. Now look at the Nifty PSU Banking Index or the Private Banking Index or Nifty Financials, which is up on your screen. So all parts of BFSI are firing really well today. It's good day for financials overall. Well, let's go back to earnings then. And apart from Infosys, the other major that we have to watch out for is Dr. Reddy's, which will be declaring numbers later today. Ekta is here with a heads up for us. Ekta, what are we expecting?
Well, for Dr. Reddy's, we're expecting a revenue growth of around 13%. Margins should probably come in at around 25%, which would be a downtake of around 200-300 basis points year on year, and a profit growth of around 6% year on year. Revenue growth to be led by the integration of their acquisition, Nicotinell, the portfolio of nicotine replacement therapy drugs that they had bought last year. So that would be one piece which would really aid in terms of numbers. North America sales are expected to be under pressure, led by price pressure in the cancer drug Revlimid generic, as price pressure starts setting in before it sees more competition come in soon enough. Now, estimates are wide for the North America business, from a decline to a marginal growth. Revlimid generic sales estimate is wide, $140 to $180 million versus $150 million year on year. Expect India to grow around 8 to 10% aided by the licensing deal for the Sanofi vaccine portfolio and the joint venture with Nestle. Margin range is wide, 23 to 28%. Commentary with regards to semaglutide as well as their biosimilar portfolio in the US will be watched for.
Okay, all right. Thanks a lot for that, Ekta. Well, Tata Consumer as well reports its numbers. Manglam joins us to run us through what to expect. Manglam.
Well, for Tata Consumer, it's a double-digit revenue growth that the street is working with, but a large part of that would be led by price hikes, particularly in the beverage portfolio, which is, the tea business, because over the last year or so, tea prices have risen by between 25 to 30%. The company's been sitting on that sort of inventory as well. So notwithstanding any change in tea prices from the highs right now, because of them having old inventory or high price inventory, the margins would reduce. So 11.5% revenue growth is what we're working with. EBITDA actually declines by 7%, which implies a sharp contraction in the margins. The net profit at around 330 crores compares with 290 crores the same time last year. Let's talk about the segments. The most important segment for them, India Foods, grows anywhere between 13 to 15%. This too would be led by price hikes in the salt portfolio, along with increase in value-added products in the salt portfolio itself. And thereafter, you would see, anywhere between 8 to 10% increase in the beverage portfolio, led by price hikes taken in the tea business itself. Finally, we'll watch out for their growth drivers, which is the likes of Sampann, Soulful, as well as Nourishco, and the acquisitions that they made of Ching's and Organic India. Ching's and Organic India likely to do about 350 crores in quarterly run rate before it, moves to about 500 crores in the latter part of this year. For Nourishco, because of unseasonal rains and impacted summer, the growth could be limited to 2 to 3%, but the company's long-term goal for these businesses, growth businesses, is to grow at around 30%.
Okay, all right, got it. Manglam, thank you very much for that. So that's with respect to the upcoming earnings. Tata Consumer is going to be in focus as well. For the time being, we have to take a break. But as we take that break, listen into a conversation that Prashant earlier had with former RBI Governor Raghuram Rajan on Trump's tariffs and the uncertainty around the August 1 deadline.
The worry is that the growing revenues from tariffs and the fact that so far the labor market in the US has not shown any signs of weakness, growth doesn't seem to be falling off a cliff. All this will convince the administration that this is indeed a good strategy. And since the tariffs are only showing up in goods prices gently, I think they are going to believe that the strategy is working. And as a result, we may see more action on August 1st, levying tariffs across the rest of the world. The key question here is, what about the countries that are in the midst of negotiation? And there, I think it's anybody's guess. Is there a number which is set out for India, which is a statement of intent? Or does India get the same treatment as the rest of the world and go up to whatever numbers envisaged for the rest of the world? Right now, it's 10%. But could it go higher? Yes. I mean, the deal with Vietnam is 20%, around 20% for most goods, which then suggests that that may be the baseline, or the baseline may be a little higher than that. So lots of worries about August 1st.
Welcome back. Last leg of closing bell, 7 minutes to go. Mayuresh Joshi, Director Research at MarketSmith India, is now with us on the show. Mayuresh, thanks so much for joining in. Your pick from the earnings season so far, what stands out?
Afternoon, Rima. No, I think quite a few cable and wire companies have posted a decent set of numbers. And yes, we all have heard from a lot of managements that impending competition might be there. However, I think the kind of numbers that have probably come through for a whole host of players, including the KEI management that was on your show in the morning, sounds very encouraging, because as recovery takes place specifically in the second half, my own sense is that the numbers can be even better. Because of the capex needs that will probably happen across the public and private sector. So I think cable and wire companies, I think, have posted a decent set of numbers. Within banks, ICICI Bank, the behemoth, has posted a very decent set of numbers, and that continues to be our top pick as far as the financial space is concerned. And as a disclaimer, we continue holding that stock, both in our local and domestic as global portfolios as well. Let's not forget, I think, a few of the fertilizer companies, I think, they might also start posting decent set of numbers. And we hold quite a few of these companies in our local and global portfolios as well. So again, I think BFSI generally decent set of numbers. Cable and wire companies, decent set of numbers.
Marish, on BFSI, let me ask you about tier 2 and tier 3 names, because that's where the market was very excited, right? Because you're hoping they'll grow better and bigger than the big banks and offer a better, if not a big investment opportunity, at least a good near-term trading opportunity. But what have you made of it? I mean, look at Jana Small Finance today. Wherever there's asset quality stress, then market is not touching stocks with a barge pole. Credag, on the other hand, is being rewarded because things seem to be stabilizing over there. I mean, what stood out for you? There's RBL. A lot of tier 2 stocks have come out. AU Small Finance Bank, there was a credit cost issue that showed up. So anything that you like?
So I think afternoon, Survi, I think within the space, again, I think the tier 2 names we keep on, we are holding Karur Vysya Bank as part of our mid-sized bank portfolio. Our take is that the numbers that Karur has probably posted so far, the show should be reasonably good enough for going forward as well. Obviously, I think commercial and corporate banking, which are the two main facets of Karur Vysya Bank, they have held up pretty well. And the expectation largely is that balance sheet growth in both these segments with minimal asset quality damage should probably continue. So this is one stock that we keep on holding in our portfolios. Within the mid-sized banks, outside of the private names, I think Bank of Maharashtra, in my opinion, has posted a decent set of numbers on all counts. When you're talking about deposit growth has been decent, the NIM compression was on expected lines, generally for the system as a whole. And if you probably look at the expectations in terms of asset quality pressures, the provisioning that they've done on their balance sheet seems to be pretty robust. So Karur Vysya Bank, Bank of Maharashtra, I think remain in our global and local portfolios.
All right. What are you making of the metals pack, Mayuresh? You know, you have suddenly that Zing is coming back in. The hope is that, you know, pricing has bottomed out, and that's why things should improve. And now Trump's tariffs, well, the street has digested. What do you like from there? You know, you have Vedanta that's moved up in the last few minutes. Nalco has moved up as well. Any take?
Afternoon, Nigel. No, again, I think as a pack, I think we are equal weight as we speak, Nigel, because the expectation is that the recovery might come through in the second half, both in terms of demand and as the demand recovery starts being a little bit more prominent. The prices which are depressed, you're absolutely right. I think they shall start getting they shall pull up as well. And therefore, I think we probably look at realization-led volume growth. That might improve as we head into the second half. At the same time, I think inventory levels across the pack, whether you're talking about ferrous, whether you're talking about aluminium, zinc, copper, are at low levels. So if demand starts coming back slowly and steadily with inventory levels being low, LME pricing might start inching higher. So again, I think Hindalco is something that we continue holding in our global portfolios. One stock that we've kept on our watch list is Lignite. Our own sense is that the dominance that NBL probably has in the market that it operates out of, the expectations in terms of renewable component for Lignite is pretty large as well. And therefore, I think operating leverage can start playing out with meaningful expansions that are expected to happen and meaningful growth expected to come back. So Hindalco is something we continue holding. Neville is something that we've kept on.
Mayuresh, Eternal, 17% up this week, continues to ride higher and higher. Is it a part of your portfolio? 300 rupees now on Eternal. Can someone go ahead and make fresh investments?
So Rima, I think for fresh investments, as we see it at Markets with India, the rating rankings are fabulous. Again, I think the set of numbers that have come through are very, very encouraging. And again, I think in the succeeding few quarters, if they're able to replicate this performance with losses coming off, specifically in the quick commerce business, and the expectation of the target setting that they've probably done, overall, as far as the business component is concerned, if they're able to achieve these milestones every passing quarter, I think a re-rating is definitely warranted. Obviously, valuations and the market cap that Eternal trades at this juncture makes us believe that if there is some element of correction that comes through for whatever reason, I think that might become a better opportunity to enter the stock. But yes, I think with the numbers that have come through, anybody holding should continue.
By the way, look at Infosys and the way it's turned. It was going into the numbers with a fair degree of optimism, and now it's suddenly collapsed from the highs. We've seen it come off nearly 2%, and all that has happened in a matter of 2 minutes. So big fall in
Someone is sniffing a weak one.
Someone is sniffing, a weak set of numbers.
And if they're wrong, that could be a blessing in disguise. Yeah, I'll tell you what, because the expectations weren't very, very great till, maybe 48 hours or so ago. Yeah. Now you're talking about that guidance, etc. And now the stock, if the stock went into its numbers 2.5% higher, then you would say, okay, maybe if...
So some positioning, for tomorrow, perhaps it won't...
unless it's a howler.
Yeah, unless it's a howler. Year to date,
Rima will tell us tomorrow morning.
Year to date, the stock is anyway down close to about 17%.
Yeah.
On a year-to-date basis, so it's underperformed the Nifty. We should pull up the Nifty IT too. The Nifty IT year-to-date is down 14%. Infi is down close to about 17%. But generally, compared to the index, IT, large cap IT has disappointed. But clearly, the market is sniffing
maybe it's just that people don't want to take too much of a bravado position finally in the last minutes of trade.
And just wait.
Just neutralize.
Let the numbers come.
Neutralize your position, let the number come, and then we'll deal with it. Maybe it's just some of that, just some profit taking after a 1% rally, but we'll see.
I think the result of the last 60 minutes was the one that Sonal addressed. SRF zooming away 2.5% higher. The street likes it. It appears there's a bit of a margin beat on that one. That said, let's start SRF. Let's get it up. For our viewers, it should come up. Let's take a look at some of the stocks that did do well as we wrap up trade. The Nifty goes home with a gain of around 150 points. Infosys lost its way in the final hour of trade, but otherwise the markets went home with pretty good gains. Tata Motors led the way, up 2.5%. Shriram Finance as well was up close to around 2%, while you have Bharati Airtel that was up 2%. So all those three stocks in fact did pretty well. What else? Apollo Hospitals, well, that goes home with a gain of around 2%. On the losing end, though, from the Nifty pack, Tata Consumer a little bit nervous, down close to around 2% ahead of its numbers. HUL as well did come in for some profit taking. And Infosys, from trading in the green, that goes home with a cut of close to around, 0.5% or thereabouts. From the broader markets, what did well? Jaiswal Nikko, there was a large trade out there. That's why that stock was up close to 20%. You had Bombay dying. Well, there's a change at the top in all probability. Mr. Badia, returning to the helm and wants to make the real estate business, a big one. So that's why that one was up 13.5%. MRPL, all those losses that we saw on the day of the result reaction, well, that's completely U-turned, and the stock is up 10% from the lows that we saw on the result day itself. Ola Electric was up 6.5%. Large trade getting cleaned out there. Anthem Bio, that stock in fact, was down 3%. It ended with a cut of close to around 4%. So massive move out there. On the flip side, Lodha and Oberoi go home with cuts because of large trades, while Z Entertainment as well posted its numbers, was down 5%. Another 3% in today's trade as well.
Okay, well, that brings us to a close in this edition of Closing Bell. Don't go anywhere. On the other side is Markets Forward. Stay tuned. Nifty and Sensex end over 0.5% higher. Buying in large banks helps the Nifty end above 25,200. HDFC Bank, ICICI Bank hit record highs. Midcaps underperformed the blue chips.
Paytm posts a profit in Q1 on the back of lower direct and indirect cost and lower ESOP charge. And while some analysts see this as a positive sign, others point to concerns on the revenue front.
A block deal in Lodha Developers of nearly 2,000 crore and one in Oberoi Realty of nearly 1,400 crore initiated by an institutional seller drags down the two realty stocks.
Hello and welcome to Markets Forward, your go-to show where we aim to get you up to speed with regard to today's trading action and we set you up for tomorrow. I'm Nigel, with me is Rima. Hey Rima.
Hi, all in all a good session. The Nifty closes above the 25,200. The global setup helped. The trade deal with Japan helps. Asian markets were higher. Europe closed up with significant gains. And then you had those two, HDFC Bank, ICICI Bank, continuing to bat for the bulls.
Well, that's right, Rima. And, Trump is talking about making America great again. But for today, the Japanese index was much greater, because the index went on with gains and the automakers were there. They were up anything between 8 to around 15% or thereabouts. But let's give you a quick run through of what went on today. The Nifty, as Rima said, hit 150 points. Good news. Both the pillars of the market did pretty okay. You had, the Nifty Bank as well as the tech index. Both of them put on some weight. So that was good when both the pillars do well. In terms of advanced decline ratio, well, that should come up for you. It was pretty much even Stevens by the time we did wind up. And there were plenty of stocks actually that were moving around.
Okay, we'll discuss all this in greater detail on our show. We'll get you all the big news, the key developments in Dalal Street, the top corporate voices, the key events to track. But first up, as always, let's get to the big movers of the day. It's over now to Hormus, who joins in. He's at the big wall. Hormus?
Well, it was an interesting session for the bulls and it was the index heavyweights that continued to bat for it. Both HDFC Bank and ICICI Bank ending at a record high in today's trading session. And Infosys, until the last 10 minutes of the trading session, was among the top gainers. And then it saw a very sharp reversal towards the close of trade. And Reliance Industries too, aiding HDFC Bank and ICICI Bank in the upside in today's session. A lot of earnings reactions took place during the day. Some of those that were reported last evening as well. Take a look at these. Aditya Birla Real Estate earnings came out today. Sky Gold saw a slew of block deals after its results. Blue Jet Healthcare down 10 yesterday, down another 10 today. Idea Forge continuing to take an 8% knock, and Jana Small Finance Bank too after its results down 7%. Some of the other newsmakers in today's session dominated by block deals. Ola Electric is one of them, 6.5% higher. Bombay Dyeing saw a block deal in the dying minutes of the trading session, 14% higher on that stock. SML Isuzu, well, another 500 rupees and the stock will be now 3x from the open offer price of M&M. And Lodha and Oberoi Realty, the two block deals of the morning in today's session. Stocks that ended at a 52-week high today. Some interesting names here. Datamatics, Credit Access Grameen is an earnings reaction, and JM Financial ending at a 52-week high today with a 5.5% pop. And lastly, volume-led movers today. Green Panel Industries was one of them, 8.5% higher here. PNB Gilts is an earnings reaction, but on very strong volumes. Shall be moved higher today with a 7.5% move, and Godrej Agrovet and MRPL2 seeing healthy gains on very strong volumes. Back to you guys.
Thank you very much for that. Let's zero in on Paytm because that posted a Q1 profit driven by lower costs. Some analysts viewed this as a positive sign, but some are concerned about the revenue outlook. So it seems to be a mixed house when it comes to Paytm. Gaurav now joins in with the details and the bull and bear argument on Paytm.
Well, yes, when we talk about Paytm now, we are seeing some kind of mixed reaction from the investors. And the reason being that first is that the results were very strong. Paytm, in fact, reported profits of around 120 crores in this quarter, which was actually not expected by any of the consensus players. But now there are two cases, bull versus bear. First, let's talk about bull, where Jefferies has upgraded the stock to buy and also increased the target price to 1250. What they're saying is that EBITDA definitely was higher than what the street is expecting. MTU, which is monthly transaction user growth, that was actually encouraging. And on the other hand, what another point that they have put is that when it comes to valuation, they believe that it is trading at a discount to a company, tech company like PB Fintech, and that is the reason why they are being bullish, because they believe that there is a compounding story from here on in terms of Paytm. In fact, Citi also maintained their buy rating and increased the target price to 1215 rupees. On the other hand, on the bear side, we have got CLSA, who downgraded the stock to outperform and gave a target price to 920. Now, this downgrade is specifically because of the outperformance that we have seen for the stock. Let's not forget that in the last 1 month itself, stock has rallied more than 20%. So what they're saying is that definitely the stock performance was actually higher than the street's expectation. But there is another point that they have highlighted. It is that when we talk about the loan distribution, Paytm has actually discontinued their default loss guaranteed loans from one of their largest lending partners, and this is the reason why they believe that the upfront cost has come down because of the DLG loans are not there. But on the other hand, in terms of revenue, the deferred revenues are still reflecting, and that is the reason why they also believe that the EBITDA can actually come down. In fact, they have also cut down their EBITDA guidance and EBITDA expectations almost by 4 to 8% for the next 2 years. So definitely that is another case that they have put in. We also have Macquarie, who has maintained their target price of 760 rupees. So as a result, we are seeing some volatility in that stock. So definitely in terms of numbers, they were good. But in terms of brokerages, we are seeing two groups which are forming right now.
Thanks a lot for that, Gaurav. Well, let's get in our guests. Then we have Shrikant Chauhan of Kotak Securities, as well as Mayuresh Joshi, Director of Research at MarketSmith. Hi, gentlemen. Thanks a lot for joining in. Mayuresh, Paytm करोगे ना?
मैं Google पे करता हूँ. But however, I think the numbers were encouraging, Nigel. No two ways about it. Two things I think that stand out in the bear and bull case argument that has been put forth. I think what will be the proof of the pudding will be the coming quarter. I think if in the coming quarter you see a similar trend emanating from Paytm's numbers, specifically when it comes to the EBITDA and the bottom line, I think the street will then recognize that there is a strong turnaround case that is happening in Paytm. But till that point of time, I think the street might just consider, because of the huge outperformance in terms of price, that a lot was gestated over the past few weeks and months on whatever has happened in terms of the operating parameters that Paytm has delivered so far. And therefore, our sense is that we are having a neutral rating on the stock as we speak. Anybody holding can continue holding. But I think the next quarter's numbers are going to be extremely, extremely important for Paytm. If they're able to deliver, I think there can be a huge move even from the current levels if that sustains till the next quarter numbers come.
Okay, all right. Shrikant, what about you? How's it looking on the charts?
Yeah, it looks really a very strong candidate to buy and hold with a positional view, because currently the stock is very close to its overbought level. And the company has also announced its quarterly numbers. So broadly, I am of the view that it is very close to the overbought level. So for short-term traders, it's not that easy to trade in this stock. But if there is a positional view of, let's say, 3 months, then I think it is heading for the levels of 1400. So it is into the pullback mode of its entire fall that we saw from the, I can say, after the listing of the stock. So it is retracing to that particular level, and in case if that happens, then the stock can move towards the levels of 1400 or 1450.
Okay, guys, Infosys numbers are flashing for you on your screen, and the first take is it's a revenue beat. The company has reported a constant currency revenue growth of 2.6% quarter-on-quarter versus estimates of 1.5%. Anyway, Infosys was expected to be the only IT company in the large cap space to report growth this time, but the growth is much better than expectations. So 2.6% is the top line revenue growth, a beat. Margins have come in at 20.8% versus 21%, so a drop of 20 basis points sequentially, but that comes in line with expectations. Now to the FY26 guidance. The revenue guidance stands at 1 to 3% versus 0 to 3%. That is in line with market estimates because the street was saying that anyway the company, had done 2 acquisitions, the MRE acquisition and the Missing Links acquisition. These 2 were expected to contribute to the FY26 outlook, and therefore the lower end of the guidance was likely to be raised. So the guidance doesn't come as a surprise. It's an upgrade at the lower end. It stands at 1 to 3%, but it's in line with expectations and expected, courtesy on account of the 2 acquisitions, small tuck-in acquisitions, which they did in the prior quarter. So that was going to benefit. Margin guidance has remained unchanged at 20 to 22%. Again, in line with street expectations. The deal wins have come in quite strong at $3.8 billion. Now, this compares with about a $2.6 billion in the prior quarter, and the last 4-quarter average was also about $2.5 billion. So deal wins has seen quite a bit of a tick up, and the company says that the large deal win TCV is 3.8 and 55% of it is net new. So all in all, it's a good quarter for Infosys. There are no big misses right now. Revenues beat, margins in line. FY26 guidance on expected lines has been narrowed on the revenue end to 1 to 3%. Margin guidance has been upheld. Just trying to read the statement that Salil Parekh has made, and if you can glean anything from his statement on the environment. Okay, so our performance in Q1 demonstrates the strength of our enterprise AI capabilities, the success in client consolidation decisions, and the dedication of all our employees. Our large deal wins of $3.8 billion reflect our competitive positioning and deep client relationships. So that is, the statement that's coming in from Salil Parekh. But the growth this time has been industry-leading at 2.6%, much ahead of expectations. The company has executed very well, and they've largely managed to protect their margins. And deal wins are also very promising, $3.8 billion. So it's a good start, to the year for Infosys, and it's a good way to end the IT earnings season, at least for the large caps. Prakash is now joining in. Prakash, through the day, Infosys was going into its earnings with strength. It's only towards the end that you saw the stock falter. There was some nervousness which kicked in and the stock fell in the dying minutes of trade. Your thoughts on Infosys Q1 numbers?
I think very, very heartening to see these numbers. As you rightly said, the word growth could only go with Infosys, not with the other 3 major IT players. And what it also does is it probably starts, bringing up the possibility of a very disproportionate allocation to Infosys within fund portfolios. Institutions have been really, I'm sure they're worried about the lack of growth and the negative growth and all that in some of the other names. But here you have something which continues to deliver. And remember, the new orders, 58% is from, the order book is from newer orders, which is exactly diametrically opposite of what others have been reporting. So I think on all counts, it's done well and it's promising to do well. As of course, we'll see the fine print within the commentary, hear them out. But my sense is that this is a stock that will see serious allocation come its way as compared to the others.
Okay, I remember last quarter, Infi was a miss. The street was disappointed. So it's good to see the company make a comeback in Q1. Rahul Jain from Dolat Capital is now with us. Rahul, share your initial thoughts on Infi's numbers. How do they compare versus your expectations?
So we have to see it from 2 perspectives. A, vis-a-vis what we were anticipating. So it's definitely a beat on that front because we were anticipating 1.5%. And that too driven by the inorganic contribution. This is much higher than that. And secondly, also from a relative point of view, the way we have seen other companies report in this quarter, this look significantly premium to that. However, one thing which is difficult to comprehend at this point is that the guidance they have scaled only on the bottom end at 1 to 3%. So that 3% number which has not gone on the top end is something to watch out for, because this would mean the implied growth for rest of the year may not be very exciting. So if they say that the inorganic contribution was higher and the guidance is X of that number, then it still looks better. So that is one thing we need to see in the numbers.
Generally, when they change the guidance, it's always including the acquisitions because it's very hard to separate out the impact of the acquisitions, especially once the integration is done and you've got the whole year. But you know, Rahul, what they had said in the prior quarter when they gave that guidance of 0 to 3%, they said lower end, that 0% assumes a deterioration in the macro environment. The upper end, 3%, assumes steady to slight improvement in the macro. Now, between Q4 and Q1, we haven't seen the macro deteriorate. It's not improved, but it hasn't gotten worse. So maybe that also, along with the acquisitions, has given the management confidence about upgrading the lower end. And on the, when it comes to the upper end, though Q1 was a beat, they've still not gone ahead and raised the upper end. Perhaps it's just, one quarter and the dust is still not settled on the entire, on macros. It's not that clients have come out and started spending their unallocated tech budgets. So maybe they'll wait by to see one more quarter before tweaking the upper end of the guidance. But this is the fifth large IT company to report their numbers. Now, based on the first four numbers that we had, there was no confidence in IT or buying into the IT stocks just purely based on the numbers that we had, negative revenue growth, companies are not giving wage hikes, margins came under pressure for a company like HCL Tech. In fact, they lowered the margin guidance too. Do you think Infi's numbers, because they're, it's a good set of numbers, right? No negative surprises. Investors will once again have confidence back in the sector, or do you think it's going to be very specific to Infi?
Yeah, we have seen this in the previous quarter also, that only Infi, HCL Tech at that point of time was confident on growth versus the rest of the pack. And this time HCL remained confident on the growth, but yes, margin they have disappointed. Now, with this, we won't see this helping anybody else because we are seeing that divergence in performance right from the previous commentary as well. So this is right now a positive for Infosys alone, but it definitely adds up to confidence if the commentary overall improves for them, because that will be reflected in others' commentary in the gradual period. But that we would learn once we see what they have to comment across vertical and geographies.
But it's definitely going to provide investors a sigh of relief because if you remember in Q4, Infosys revenues had dropped 3.5% quarter on quarter. So it was a low base sequentially. But, the performance and execution has been on the stronger side. Mayuresh, you want to chime in with your view on Infosys? How does it stack up versus the rest? What's the positioning in your portfolio?
So as far as IT stocks are concerned, we are positioned in a couple of mid-cap names, Persistent and Coforge, in our portfolios. But as far as Infosys performance is concerned for this quarter, relatively better compared to the rest of the pack. And therefore, I think the revenue beat is something which, as you rightly pointed out, is a huge sigh of relief. The expectations in terms of margins remaining in the 20 to 22% band is a sigh of relief as well. And though I think the constant currency guidance growth of 1 to 3% has been up on the lower end, I think there is some expectations that at least for this year, assuming tariffs, discretionary spending, etc., that they'll still be able to manage some reasonable growth. So yeah, reasonable numbers compared to the rest of the pack. The stock should open positively too.
Expect the stock to open positively. Shrikant, what's the technical positioning in Infosys?
See, for Infosys, the stock has managed very well to sustain above the levels of 1550, 1530, despite there was weakness in the entire IT pack. So I'm of the view that the stock is again heading for the levels of 1640, 1650, where it has next leg of resistance. But broadly, I am of the view that this one is the relatively outperforming stock, and this may even also move towards the levels of 1700 or 1750. So broadly, I am of the view that we should look for creating a long position, even if it is like opening higher to the levels of 1630 or 1650.
The company's hiring headcount addition has been muted. It's added about 210 employees on a quarter-on-quarter basis, and attrition has ticked up by 30 basis points to 14.4 versus 14.1% in the prior quarter. But attrition has steadily inched up for the company over the last 5 quarters now, from 12.6% in Q4 of FY24. It's now at 14.4%. Still perhaps in the comfortable range, but you have seen attrition pick up a bit. Rahul, the press conference is at 4:15. What would be the key watch points? What would be the questions if you had a chance to ask the management?
I mean, there are a couple of smaller print. One, of course, as you said, the commentary, the client sentiment, that is an obvious one to ask for. Within operating metrics, we would like to see, as you highlighted, the headcount has remained same. Utilization has gone up by 120 bips. So their thought process on further hiring and utilization is something which would add up to the confidence on how they are seeing the environment. So that would be another thing. And TCV win has been strong, but what we have seen in the past is a timely ramp up and customer confidence on that. So some of the feedback and those elements would be crucial. And of course, the inorganic element within the current numbers.
Got that. Mayuresh, deal wins are very strong, and they have been for a lot of the IT companies. Yesterday, when Zensar did their call, they said, in a way, I may be paraphrasing, that they're avoiding vendor consolidation deals because it's a race to the bottom. They're so competitively fought that even Wipro said that, right? These deals, cost consolidation, the cost optimization, vendor consolidation are competitively fought. There is pressure, and it's then up to the IT companies to try and optimize margins over the life of the projects and try and protect the margins. But, as, Zensar in a way said, it's a race to the bottom. So although you are seeing these large deal wins by the IT companies, do you think it's going to start hurting at the margin level? Because plus this, AI in a way is deflationary.
It is, Rima. And therefore, I think companies which will have a niche offering specifically in this space, I think they are going to benefit quite significantly. Because at the end of the day, if there is pricing-led pressures that probably come through at some point of time in the areas that a lot of these companies operate out of, and there are a lot of interlinked areas for a lot of these IT companies at play as we speak, that might create some element of hassles as far as the overall margin performance is concerned. And therefore, in my opinion, again, I think niche companies which have niche offerings are operating out of niche areas. I think they might actually be winners over the next few quarters.
Mayuresh, Srikanth, Rahul, thank you very much for joining us. It's the first day coming in from Infosys. Infosys clocks in a good Q1. Revenues come in higher than expectations at 2.6%, margins in line at 20.8%, profits too ahead of consensus expectations. The company goes ahead and raises the lower end of its revenue guidance for the full year. For FY26, they're now penciling in a growth of 1 to 3%, with the margin guidance unchanged at 20 to 22%. Strong deal wins perhaps gives the company confidence. Deal wins have come in at $3.8 billion. And also important to note that Infy is the only large cap IT company which is clocked in growth in the current quarter. This has been a tough quarter with the tariff uncertainty looming large on all macro decision. Clients have held back on their decision making. Many projects have been paused across the board in the industry. So it's been a tough quarter. Infosys has executed well and clocked in a growth of 2.6%. Well, that brings us to a close in this edition of the show. Thank you very much for watching. We'll come back with more news and updates.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Infosys beats estimates in Q1. Revenue accelerates by 2.6%, making it the only large IT company to report a growth in revenue. The company also increases the lower end of its growth guidance by 100 basis points. Positive global cues lift the Wall Street. The Sensex up over 500 points, in Nifty above 25,200. Midcaps relatively underperform the blue chips. The U.S. strikes a flurry of trade agreements with Japan, Philippines and Indonesia. Japan faces a 15% tariff instead of 25% proposed earlier. The Nikkei rallies to a one-year high. Indonesia and Philippines face a 19% tariff rate. Prime Minister Modi embarks on a two-day visit to the UK to sign the much-awaited free trade agreement. The deal is expected to bring down costs of British cars and whiskey in India. Indian textile, gems and jewellery will become cheaper in the UK. The Indian Union Cabinet has formally approved the deal. The government initiates a discussion to impose a minimum import price on key pharmaceutical products. Sources say the centre wants to protect domestic manufacturers from a surge of cheap Chinese imports. A tech glitch at India's top commodity exchange, the MCX, affects trading for over an hour. The exchange has been facing delays in order processing and settlement issues over the past few days. Relief for SpiceJet. The Supreme Court upholds the Delhi High Court order, rejects a plea filed by Kalanithy Maran's Carl Airways seeking 1,300 crore rupees in damages. The High Court had dismissed the plea, citing a case of deliberate and willful concealment of facts. A 29 lakh rupee GST notice to a vegetable vendor in Karnataka sparks a debate. Several small vendors who received notices claim they are being punished for using digital payments. Facing criticism, the Karnataka government blames the central GST regime. No business in Parliament for the third day. Both houses adjourned after opposition protest. The deadlock continues. Rahul Gandhi raises questions over the government on US President Trump's claims of brokering a ceasefire between India and Pakistan. The Supreme Court agrees to hear a plea by Justice Yashwant Verma in the cash at home case. The CGI recuses himself from hearing. Justice Verma's plea alleges media trial, claims the former CGI Khanna didn't even grant a hearing before recommending removal. Also asks, and I quote, "Where's the half-burnt cash?" High-end cars with diplomatic number plates, foreign currencies and a posh bungalow in Ghaziabad that serves as the embassies of so-called West Arctica, Saborga, Bolivia and Ladonia. The UP Special Task Force claims to have uncovered a fake embassy scam, arrests Harshvardhan Jain, the alleged mastermind. Well, let's go straight to the big story this evening. President Trump has announced a flurry of trade agreements, this time with Japan, Indonesia and the Philippines. After months of turmoil, these deals ease the tensions for some of Asia's largest manufacturing hubs. Now, a deal with India remains stalled, and sources have said any deal before the 1st of August deadline is unlikely. President Trump announced a deal with Japan. This will involve the U.S. imposing a 15% tariff. Now, this is lower than the 25% tariff announced earlier. More importantly, automobile imports from Japan will attract a 15% tariff. All other nations face a 25% tariff. Now, this is crucial for Japan as automobiles account for 30% of all shipments to the U.S. President Trump has also announced that Japan will invest $550 billion in the U.S., largely in energy projects. Trump claimed that the U.S. will keep 90% of the profits from these investments without providing any further details. Now, the U.S. will also reduce the tariffs on Indonesia. As per the deal, tariffs will come down from the 32% proposed earlier to 19%. For the Philippines, the cut in tariffs is minor. According to the deal announced by President Trump, tariffs will be cut from 20% earlier to 19%. With this, the U.S. has now signed a framework for trade deals with at least half a dozen countries. A 3-month interim deal with China reduced tariffs to 30%. China is imposing a 10% tariff on U.S. goods in return. But this deal expires on the 12th of August, and the U.S. has already hinted at a potential extension. The UK, meanwhile, faces a 10% tariff, and Vietnam faces a 20% tariff. The EU, South Korea and India are the large trading partners with the US who are yet to strike a deal. The EU faces 30% tariffs from the 1st of August. India is staring at a 26% tariff rate, and South Korea faces 25%. India's peers in the region, like Malaysia, also face a 25% tariff. Bangladesh, Cambodia and Thailand are facing tariff rates higher than 35% from the 1st of August. Now, in a move that could ease the tensions between the world's two largest economies, President Trump hinted that he could travel on a bilateral state visit to China in the coming days. The date, of course, has not been announced just yet.
President Xi has invited me to China, and we'll probably be doing that in the not too distant future, a little bit out, but not too distant. And I've been invited by a lot of people, and we'll make those decisions pretty soon.
A visit to China in the not-so-distant future, that's President Trump. Now, the Indian government will resume issuing tourist visas to Chinese nationals. This will start from the 24th of July after a 5-year pause. The government had suspended all tourist visas to Chinese citizens in 2020 following the clashes in Ladakh's Galwan Valley. A Chinese Foreign Ministry spokesperson called the initiative from India a positive move. China had resumed issuing visas to Indian students and business travelers in 2022. Now, Prime Minister Modi has embarked on a 2-day visit to the United Kingdom to sign the free trade agreement. The Union Cabinet has already cleared the deal, paving the way for deeper economic ties between both countries. Sources tell us that the agreement is expected to benefit nearly 99% of Indian products. That's not all. The deal is expected to bring down costs of British cars and whiskey in India, so that deal will officially be inked tomorrow. The big earnings today. IT major Infosys delivering in Q1. The company's revenue growth in constant currency terms is at 2.6%. Now, this makes Infosys the only large IT company to report a growth in revenue. TCS, Wipro, Tech Mahindra and HCL Tech reported a contraction in revenue in the first quarter. Margins in line, and Infosys also increased the lower end of its guidance band by 100 basis points. Rima joins us now with more on Infosys' earnings. Rima, a beat on most fronts.
Indeed, it's a good start to the year for Infosys. Good Q1, dollar revenue growth up 4.5% quarter-on-quarter. In constant currency terms, it was a growth of 2.6%. Big beat versus the 1.5% growth that we were anticipating. And even on a year-on-year basis, the company has clocked in a growth of about 3.8%. As you rightly pointed out, in the large cap IT space, Infosys now is the only IT company to report growth. But bear in mind that this also comes in on the base of last quarter when revenues had fallen 3.5%. So after last quarter's shock, the negative surprise, this time they've managed to reverse and clock in a good quarter. So margins are a clear beat. Revenues are a clear beat. Margins have come in line with estimates at 20.8%, a small drop of 20 basis points on a quarter-on-quarter basis. Profits ahead of estimates are led by the revenue beat. The company for the full year is now guiding for 1 to 3% revenue growth. It perhaps includes the 2 acquisitions that they have done, and plus the macro environment has not deteriorated in the prior quarter. Operating margins remain in line with estimates at 20 to 22%, no change there. The other positive is the deal wins. The deal wins are up nearly 45% on a quarter-on-quarter basis at $3.8 billion versus $2.6 billion the prior quarter, and 55% of the large deal wins are net new. So all in all, it's a steady and strong quarter for Infosys, meeting the mark on profitability, beating on the revenue front.
Yes, certainly there. A good start there for Infosys for the year. Many thanks, Rima, for joining us. Straight to the day's market action. Positive global cues lifting the large trade today. The Sensex gaining over 500 points and Nifty moving above 25,200, 160-point gain there. The Nifty Bank up by about 450 points, 200-point up move there as far as the Nifty Midcap is concerned. Surbi standing by to wrap up the market action for us. Surbi.
It was a good day of trade for the bulls, and we had a bit of a, joy rub-off happening from the US-Japan trade deal, and this was a joyful rub-off on all global markets, actually. It gave basically global equities the hope that the eventual tariffs, once these deals are in place, will be lower than some of the headlines that have been announced. For instance, originally, Japan was handed out a 25% tariff rate, but finally now they've settled at 15%. So that spread through most of Asia. Most of European markets were rallying away. US futures were higher while we were trading in the afternoon. And as a result of all of that, plus some decent earnings, the Nifty managed a good close. In fact, the Nifty had a good recovery from the morning opening lows. We rallied very smartly to a close above 25,200. So what led the rise? Well, financials, and all parts of it. Whether you look at the Nifty Bank today, which was a tall leader, almost a 1% gain coming in, or the Nifty Financials Index, look at the Nifty PSU Banking Index, or even the Private Banking Index, it was green all the way through. So solid gains coming in. There was some help in the form of auto. Auto stocks are also doing pretty okay. Healthcare and hospital names are fine. it was actually FMCG that was under some pressure. So let me show that up in the way the Nifty sort of tally played out. So if you're talking about gainers included names like Tata Motors, Bajaj Auto, Maruti. There was Shriram Finance, Bajaj Finance ahead of numbers tomorrow, looking quite smart. Bharti Airtel and Apollo Hospitals, all these stocks gaining between 1% to 2.5% in some cases. The financial gainers included the large banks, ICICI Bank, HDFC Bank, SBI, all higher. Reliance stopped dragging its feet today, which is a good thing for the bulls. And imagine Eternal, third day running, managing some gains. What a stupendous run, almost 16% so far this week on Eternal. The losers included names like Lever, Tata Consumer, and some PSUs like BEL and ONGC. Now let's talk about midcaps. Midcaps had a day of underperformance. The index was actually negative in the morning, but at least it then closed positive, but lower than the Nifty for sure. The advance decline ratio was also even Steven, 1:1. So let's come to some of the interesting midcap earnings. Credit Access moves higher because of some improvement in the asset quality stress out there. Dixon had a decent close. Sapphire and Westlife Food, though the numbers very different. Westlife was better than Sapphire, but both of these stocks managed a bit of green. SRF also finally turned in a gain of about 2% after earnings. Let's talk about some of the earnings that did not work. Colgate was down 4%. Poor management commentary as well. Ditto for a Jana small finance bank where there is an asset quality stress that showed up in the first quarter. And that stock was down about 7%. Then you had large block trades moving stocks. So whether it was Lodha or Oberoi Realty on the way down, on the way up, Ola Electric and SpiceJet. So big blocks are keeping the action truly alive.
Surabhi, many thanks. India's largest commodity derivatives exchange, the MCX, faced a technical glitch earlier today, which brought trading to a halt briefly. The opening time was initially revised to 10:10 a.m. However, trading did not resume as planned and rates remained static during the halt. According to MCX's statement, the delay in trading was caused by clearing technical processes and file sharing. Brokerage firms like Zerodha informed traders that they can place orders in the NSE commodity segment. Shares of Lodha developers down in trade after a 1% equity changed hands on the bourses. Sources say that an existing investor is likely to have offloaded about 1% equity worth $165 million via block deal. Details on the buyer and the seller have not been disclosed yet. Over 3% equity of Oberoi Realty changed hands in a $230 million block deal. Sources tell us that the floor price was set at 1,762 rupees a share. The deal has been structured as a clean-out trade, but the seller's name has not been disclosed just yet. The government has initiated discussions to impose a minimum import price on key pharmaceutical products. Sources tell CNBC-TV18 the centre wants to protect domestic manufacturers from a surge of cheap Chinese imports. Timsy standing by with the details. Timsy, take us through why the government is proposing a minimum import price.
In a strategic move to safeguard the domestic pharmaceutical manufacturing ecosystem, the government is considering the imposition of a minimum import price or MIP on select pharmaceutical raw materials, particularly those being produced under the PLI scheme. Sources told CNBC-TV18 that internal discussions have been initiated to evaluate the feasibility and structure of this MIP mechanism. This particular decision or move is aimed primarily to discourage low-cost imports from China that are undercutting Indian manufacturers. The proposed step is expected to provide critical support to companies investing in the domestic production of bulk drugs under the government's flagship PLI scheme. Currently, sources say that the move is at a deliberative stage and the proposal is being coordinated through high-level consultations involving Department of Pharmaceuticals, PMO, Ministry of Health and Family Welfare, Commerce Ministry and Ministry of Finance, along with key industry stakeholders. The initial proposal focuses on safeguarding the manufacturing of basic and essential APIs and raw materials that are heavily imported from China and are integral to antibiotic production in India. Industry has raised concerns on these Chinese imports, and based on this, for MIP, the government is considering keeping at least 8 to 10 such key raw materials, which are part of the overall 40-plus basket of PLI scheme, where drugs should get protection, is what they feel. Now to be seen is what shape this proposal actually finally takes, whether it goes through or not, something that we'll have to wait and watch for.
Timsy, many thanks. President Trump has warned foreign pharma suppliers that they will face import restrictions if they do not lower drug prices. Speaking at a White House event overnight, President Trump said that pharma players in the U.S. will face a lot of problems if they don't agree to cut prices. President Trump also claimed that his administration's policies will lead to a 1,000% fall in drug prices for Americans. Take a look.
We're going to get the drug prices down, not 30 or 40%, which would be great, not 50 or 60. No, we're going to get them down 1,000%, 600%, 500%, 1,500%, numbers that are not even thought to be achievable because I've used a certain talent that I have and convinced the drug companies that you have no choice. The drug companies were selling drugs, same company, in Europe and other places, based on what Europe told them to sell them at. And they said, let America pick up the difference, and I wouldn't let it happen.
Well, that's President Trump, but let's revisit the Infosys numbers. The management is speaking to the media on the first quarter results. As we told you, it's a beat on all fronts.
And our current outlook, our guidance for growth for financial year 2026 is revised from where it was 0% to 3%. Now it'll be 1% to 3% in constant currency terms. Our margin guidance remains unchanged at 20% to 22%. With that, Rishi, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Jayesh Shankarajka, Chief Financial Officer, Infosys. The first question is from Ritu Singh from CNBC-TV18.
Hi, gentlemen. Thanks very much for the question. You're talking about how the numbers have been very strong. The performance has been good. The first quarter revenue is above what the street had factored in. Two questions on this. If the numbers are so good, why have you not raised the upper end of your guidance? Why just the marginal revision from 0.3 to 1 to 3%? And how much of this, upward revision that we're seeing, and including the kind of constant currency growth, 2.6% in this quarter, has come from your inorganic, from your acquisitions that you've made? That's one part of the question. Also, how would you guide the street to look at these numbers? Would you really say this is a turnaround that you're seeing, in the current macro environment, that going ahead this kind of performance would be sustained? And a word, last time we didn't hear much from you on the whole tariff conundrum and how that is impacting discretionary spend, specifically in sectors like manufacturing, retail. What's your sense on, the clients? And, if you could also add a word on your hiring plans for the year. Thanks very much.
Thanks. So first, on the guidance, what we have seen this quarter is a strong performance in terms of where we have delivered the 2.6%, as you pointed out. With that, and with the current outlook, where we have seen a lot of the discussions on the economy worldwide having come to more stable situations, but still seeing that it's not fully settled. Given that, we've increased the lower end of our guidance as we go closer into the, progress into the year, closer towards the end of the year. We typically narrow our guidance, and that's first part of what we've done, which is increase the lower end. We still see things within our guidance where we look at some things which will give us good traction. For example, what we've seen in the consolidations. We've seen very strong work that we've done on AI with agents, and we see that. And we also see the economy globally, both in Europe, US, going through changes. So keeping that in mind, we've narrowed the guidance and increased the lower end. On the inorganic part, I'll let Jayesh mention how much of it is inorganic.
Yeah, so inorganic in this quarter has been around 40 basis points within our 2.6% that we reported. And for the full year also, it will be similar number.
And then back on the sort of economy, we talked about it last quarter and also in addressing it today. There are overall changes in the economic environment, and we mentioned last quarter, we share that again. We see some of that impact, for example, in logistics. We see some in consumer products and some in manufacturing. But equally, we have seen benefits, especially because we've seen good traction with the work we're doing with agents in AI, and a benefit from consolidation that we've looked at, that the clients have looked at us and been positive. And that has given us some of the positive growth that we've seen in this quarter. So there on the acquisition, as Jay shared, it's a small part of it. Even if you keep that aside, we are well over 2%, 2.2 in terms of constant currency growth in the quarter. The way I would look at it is it's very differentiated performance because we have what we believe to be one of the best ways that we are deploying AI, enterprise AI, into our clients. So these are active projects where we are using agents, different types of agents that clients are leveraging, whether it's in their supply chains, in their customer experience, where they're getting productivity benefits, where they're getting improved customer service. That's one aspect of it. And the other aspect is we are seeing clients are selecting us more and more when they're looking at consolidation, because inherently we see clients see Infosys's delivery as very strong and stable, and also providing new ideas, especially on AI, for improvements into their business. So that's the differentiated performance that we're seeing in the way that we see it.
Hiring. So if you look at our hiring numbers, our overall headcount has remained constant at this point in time. Our utilization is at its peak at 85%. So we will continue hiring, and we expect to continue hiring in line with what we've announced at the beginning of the year. There's no change there.
Thank you, Ritu. The next question is from Haripriya Suresh from Reuters News.
Good evening, gentlemen. One quick, I wanted to understand, America has not growth has been sort of flattish, but Europe has grown really well. Just some color on the specific markets. Is Europe client-specific? What is happening on that end? And, in terms of the employee headcount, like you mentioned, I know it's been flat, but I know there's a lot of talk about how Infosys is using AI. Do you see, if utilization's at its peak, do you see productivity increasing where you don't need to hire as much going forward? And will this sort of be the level that we will see it at? And I wanted to get some color on what the wage hike scenario will be for this quarter as well. Thank you.
So coming to your second question on headcount, as I said earlier, headcount has remained flat. Despite that, we've been able to deliver 2.5%, 2.6% on growth. Large part of that came from the RPP increase or the pricing increase that we got and the seasonality benefit that we got. 40 bips came from the acquisition, and the balance came from the volume increases, which we've been able to manage within our current headcount through utilization. Now that we are at a peak, any further volume increase will need to be, we do need to come from the hiring, right? So that's where we are. In terms of US and Europe, I think Europe has been strong footing for us for many quarters in the past. That's on the back of the investment that we made a few years back in Europe. We had identified Europe as a geography to invest into, and all of that I think is working well across sectors. And sorry. Because Europe is growing faster versus America, to that extent it's changing, but still US remains, the largest sector for us, largest geography for us. Sorry, you had a third question.
Wage hikes.
Yeah, so we did a wage hike already. First wage hike, first part was that effective January. The second phase is already rolled out effective April. First, the impact of that is already baked in the margin of this quarter. We had 100 basis points of impact on account of wage hike, as well as the higher variable pay that we paid to our employees this quarter. So that's already done. Having done the wage hike very recently, next one we'll have to decide when.
Thank you, Haripriya. The next question is from Beena Parmar from the Economic Times.
Hi, Salil. You mentioned about, the revenue being stronger. Some of your peers have pointed out that there has been some revenue cannibalization that they are seeing. Are you also witnessing it, and are you seeing some productivity gains, benefits that you're passing on to your customers? And is that also leading to change in pricing? I think we spoke about it briefly, but has there been any change in the first quarter? And secondly, is that also impacting your margins? What were the factors that led to the margins? Because I think it has declined. So could you
let me start on the revenue one. I think we are seeing with AI a lot of productivity benefits. We also saw productivity benefits that we were already working on from automation and lean, which were coming through. Typically, all productivity benefits, a part of that is shared with clients and a part of that is shared with us. We see, if you look at the overall level, what Jayesh was sharing, we have seen our productivity of our revenue, the way our own pricing is working at a macro level, improving. And this is more because we are doing work which is creating more impact, in addition to the productivity which is making some of that benefit being shared with clients. So these are two different factors, but on balance, we see an improvement. And that's what we are seeing into the quality of the revenue that we are seeing now.
Gains you're passing on?
So there, we are not discussing the amounts we are passing on, but in terms of what we're seeing as a benefit, we are seeing between 5% and 15% through AI programs where we are working with clients where typically there are disparate systems. Internally, there are some things we've done which are slightly higher than that, but those are on internal, like if you look at our Finacle product, it's one uniform sort of a code base in which we can get better productivity.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Have you ever felt as if you are running on a financial treadmill of sorts? By that I mean you work hard to earn adequate income, but then your expenses also keep shooting higher and higher, burning your finances. I call this the earn and burn syndrome. Yes, I've coined it myself. There's no such official term. But it's something that many in urban India seem to be feeling as of now. And that's exactly what we're addressing on the show today. How do we exit this syndrome and how do we move to a path that creates real assets and lasting wealth? Well, joining me to talk about this are two experts, two women who've watched the financial landscape, personal, financial planning landscape for a long, long time. I have Preeti Rathi Gupta, founder of Lakshmi, right here with me in the studios, and Rin Agrawal, who's a well-known financial educator. Ladies, thanks so much for joining in. So I want to get your first opening thoughts on whether you think this is a problem that affects only a very few, maybe young, or is this something that you come across a lot as well when you speak to, your catchment area, your clients, and your circles? Preeti, let's open with you.
Absolutely. First of all, love the topic, the earn and burn syndrome, because that's what we see all around. And just like we were talking, Surabhi, I think the realization also that I'm earning and burning happens after a few years you've got into earning your money, right? Yeah. Because the first few years are normally spent in saying, okay, I've got money in my hands. How do I make the best of it? Yeah. The world doesn't make it easier because every morning you open Instagram and it's pushing something towards you, right? Yeah. And you are impulsive at that moment, right? Yeah. It's only when you get into your late 20s, early 30s that you realize, oh, now this is catching up. I can no longer keep pace with my spends. So absolutely. First of all, I think this topic by itself needs to be something that we teach in schools or have household, conversations on. Because the day you start earning is the day you start your journey towards your, what I call your financial map. Yeah. Right? Yeah. That's the starting point where you say, okay, these are my financial goals, and therefore these are my money maps. Yeah. It's only when you know a destination that you know exactly how to get there. If you have no destination in mind, then you obviously are saying, okay, I have the money, let's just spend it.
Money maps, I love that term. We need to find our individual money map, and no, you can't go to Google and ask for it. You have to sit down and do some homework on this, and that's what we'll get to in just a bit. But Rin, on that, you're based out of Bangalore. What do you hear around? I don't know if it's a Bombay-specific thing because rentals are high here, housing costs are high, or whether you hear this among your community as well.
Absolutely, Surabhi. And I think this is playing out in the numbers as well that we are seeing on household savings, right? Where household savings as a percent GDP is at its lowest, whereas the liabilities are just moving, household debt is moving up and up and up. So yes, very, very common for people to be saving less than 10% of their income. In fact, I see a lot of early wage access companies, which are also coming up, and, good amount of demand from people to actually take a loan against their wages. So, this is where the situation is that there is absolutely very, very little focus on savings at this point in time.
Imagine us saying that. And I'm not saying that, the experts are saying that. And we were such a savings-driven economy, but so much has perhaps changed in the last 2 decades or so. Okay, let's kickstart this with a question that one of our younger viewers sent in to us. Isha is now joining us on the phone line, and I think her query really symbolizes what a lot of people are feeling or expressing or going through, especially in urban India. Isha, so glad that you can join us on the show. Tell us, what is exactly your question?
Hi, I'm Isha. I'm 24 years old and I currently live in Mumbai. Every time I get a hike, my spending seems to outpace my earnings. Now, how do I break the cycle?
Okay, there you go. Sums up exactly what we're trying to discuss over here. So let's start with the beginning, with the problem itself. How do you look at it, Preeti? This facet, is it just about we're spending too much, or is it intrinsically our behavioral problem, or is there something more to it?
I think, like I said, once we start earning, there is a lot of pressure, whether it is the financial world, which is selling us credit cards or saying, buy now, pay later, or just, the access to money or to sort of postpone your spending is just so high, right? Which is why people feel that, okay, this is the great time for me to buy this. This is a great time for me to spend here. So your lifestyle takes over more pragmatic goals. And I think to Isha's query, you know, the best way to do this is really sit down. It takes you about half an hour to say, okay, these are my financial goals. This is what I want to do. You're 24, you may want to study more, you may want to start your own business, you may, irrespective, whatever, right? But there are 2 or 3 important financial goals, which are your emergency fund, start creating it, build your safety nets, because those are very important. I think one of the things that a lot of people don't do, and actually which can dent your savings and investments, could be not having the right insurance. Look at tax breaks efficiently, because you're starting earning. Ask the right questions, you know. When you're renting, for example, we spoke about how costly it is to rent a house in Bombay. Can you actually look at how paying a rent could actually be, you know, it could be used to save tax for you. So look at all of that, and most importantly, start working on your retirement. And I think once you have, sometimes when we don't have a financial goal, I tell young women that, you know, if you saved 5,000 rupees every month for 40 years, you would actually have 7-8 crores by the time you retire, right? Sometimes just having that big number and then saying, how do I work towards it, right? So I think financial goals, financial mapping, and then budgeting very effectively. Once you know the destination, it'll encourage you to budget, right? Then you say, okay, I know that I have to save. There is a golden rule of budgeting, which is proven that if you follow that, you will get to where you want to go, right? Which is at least put aside 20%. Of your earnings when you begin, especially at Isha's age, to start putting aside 20% as your savings and investment, and do it before spending. What most of us do is we spend, and then we say, okay, whatever's left behind, maybe I'll think of saving, right? And that also rarely happens at this age. So, you know, I've automized, and I really suggest this, that instead of making it a chore, automize your saving and investment process by just mandating your bank that 20% of all my earnings that come in will go into an investment instrument. And then you sort of are able to spend with less guilt, because you know that my savings have already gone.
That's an interesting idea, just automate it. So whatever hits your bank, or if you're a salaried person, whatever hits your bank on the 1st or the 2nd of the month, 20% just goes out. Maybe in a different, you know, maybe in an investment product or a savings account or whatever, something else. It's just not there for you to spend. That could be an interesting aspect. What you've mentioned, Preeti, is very interesting. So you're saying at least 20% of your income must go towards savings and investment. Actually, we have a query from another viewer on precisely this. Let me take that up and we'll ask Bryn about it as well. This is Bala. And he wrote into us on Instagram. You can, of course, reach out to us, to me specifically, or you can any of our channel handles as well on Instagram with your question. He's saying, what is the best method or rule to ensure savings? So we've just heard from Preeti. She's given her basic rule of thumb, at least 20%. Mrin, come in on this. I think this is a bare basic beginning. I have to divide between how much I can spend and how much I need to invest or save. What's your math or formula to this?
So I think the first thing is to always remember that savings is always the foundation of your financial life. And unless you have a good amount of savings, you know, you really cannot think of having a good financial life. So I think first is that realization that savings is really, really important, and it is not one of those old-fashioned things that used to happen in the past. Now, I have always propagated the 30-30-40 rule, which is 30% of your take-home going towards expenses, 30% going towards EMI. So that is like a maximum of 30% going for expenses, a maximum of 30% of take home going towards loan repayments, and try to save 40% of your take home. I know trying to save 40% of the take home is a big ask, you know, given just large expenses like rent alone. But I think, you know, start with the 20-25% and have that goal, right? So I also truly believe that it's always important to think beyond, you know, what you're doing today, and really look at the larger picture and think big. And the only way that you can fire or, you know, have financial freedom it starts with actually having a good amount of savings. So while you can start with a 20-25%, your ultimate goal needs to be about 30 to 40% going towards savings. Now, on the discretionary expenses, because you see, we do see a large amount of the spending going towards non-essential expenses, which are not essential expenses, right? So I think, within the whole expenses gamut, have a percentage that you're going to keep aside for non-essential expenses, which is your fun expenses. It could be 10% of your take home. It really depends. But, somewhere it's like your physical health, right? So if you know that you have to remain fit and there are a set of things that you need to do, as much as you would like to, have your fun, but you know that you have to have it in limits. So it's the same thing with money. Have these basic numbers in mind, saying maybe 10% going towards fun expenses, 20% for essential expenses, 30% for low payments, and then the rest of it for saving.
Mrind, I think the question is, I think you raise a great point, at least thematically having a division in our heads of what is essential, what is non-essential. Though people will ask these days, right? I want a new sneaker. Is that essential, non-essential? I want to upgrade to a better gym. Is that essential or non-essential? So I think these lines, Preeti, especially, and that's what we're grappling with, right? They're really blurring in terms of what is essential, what do I deserve? I deserve this, I should upgrade to, whatever, a better bag or something like that. That's why we get really confused.
No, I think first of all, let me lay it out that financial planning or planning for your future doesn't have to be boring, right? It doesn't have to be a drab conversation. You have to have fun with yourself doing it, right? And one of the things that we do is that apart from automizing, saying just automate it.
Yeah.
So you've put aside money for your savings. Make sure that those savings are going into inflation-beating instruments, growth instruments, because you are young. This money definitely needs to grow. You don't want to save and then realize, oh my God, I lost. Anyways, that money is depreciated, right? So I think that is the first thing. Second, I also believe this conversation between needs and wants. There's a very difficult line, and all of us are guilty, right? So therefore, having broadly a budgeting tool, right? Let's automate that also. There are a lot of budgeting tools that are available. Use that to say, okay, these are my limits. Right? And then once in a while, it's okay to allow yourself those limits, but I think a tool will highlight to you how many times you've, stepped over that budget. And I think one of the things that people should do, which I feel we don't do enough, is have these money conversations. Because why do you need a new pair of sneakers? Why do you need a new handbag? Is because that's what you're talking about. Right? I mean, I sit with my friends, we're talking about, okay, where do we go for a holiday, or what is the bag that you buy? Why don't we have conversations around saying, what are you doing with your investments? How much have you saved? So have those conversations. I think make it more fun. Gamify it for yourself. Compete with yourself every month. Have I saved a little bit more? And the second thing, I think, again, to our viewer Isha's question, is that every time your salary or your package gets upgraded, the first thing to do is to upgrade your investment.
We upgrade a lifestyle first.
Yeah, but we upgrade our lifestyle first, right? Now I've got more money to spend. So instead of that 20%, I think, how can you upgrade that? How can you increase that percentage?
Investment part of it.
I think take care of that piece first. So then you don't feel guilty about living your life in the today.
I think it's a great way to go about it, that the way you can strike that balance is just think investments first and then think fun and spends and all of that. I'm completely with you ladies on it. So what we'll do is after the break, we pivot this conversation to the investment side and the question, the toss between taking a loan to fund an expense versus saving for it, investing for it, and then funding that expense. How do you get the right balance? We'll discuss this after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are talking about how to escape this earn and burn syndrome, which affects all of us living in urban India. How do we break beyond forever chasing rising expenses and move to real long-term wealth creation? Well, we've discussed how obviously budgeting and cutting back on unnecessary expenses is the first step towards it. The second step is getting smarter with your borrowings and your loans and asking the right questions every time you're heading to the bank to take a loan. Rin, let me open with you because I know you've run some numbers on this in terms of how EMIs can either contribute positively to asset and wealth creation or contribute negatively and take us away from our goals. So what's the framework with which we can look at it?
Yeah. So let's take this example of a person, let's say, earning 55 lakhs. So, the net take home would be somewhere about 36 lakhs. Let's just assume some nice round numbers of saying that a person has a net take home of about 3 lakhs per month. Now, there are two ways to go about it. So typically what you will see is that with that sort of a take-home income, I have seen people having 50 to 70% going towards home loan EMIs, right? So I have taken one example where, let us say a person has taken a 1.5 crore home loan. They've done some down payment, so they've got 1.5 crore of home loan. The EMI on that actually works out around 1,40,000 rupees per month. And then, when you add up all the essential and the non-essential expenses, what you actually see is left over is only 10,000 rupees per month. So, just to give you an example of the percentage allocations, you will typically see about 30-35% going towards expenses. You have about 50%, which is going towards the EMIs. And then you have about 17-18% that you're saving for other large expenses like vacation, right? So end of the day, what is typically happening is that you're left with 3% of money that's going towards expenses. Towards investment. And towards investments. And what is happening over here in this case is like when you look 20 years down the line, right, the interest that you've actually paid is far outstripping the interest that you're earning on your investments. And at the end of 20 years, and of course, you will have salary increases and stuff like that. But what happens is that when you have the salary increase, again, a very large portion goes towards, luxury expenses. And of course, you upgrade your lifestyle and everything, right? So end of the day, with this very large allocation to loans, you're actually ending in a negative territory. Now, the same thing, where I said live within your means, and let's say you try to follow the 30-30-40 that we are talking about, so just to give you an example, like, with this 3 lakh stake and with 10,000 rupees going into investments, at the end of 20 years, you're ending up negative 1.5 crores. Of course, you have the house, the asset in your name, you're probably living in it, right? On the other hand, if you actually had 30% going towards investments and taking into account the home loan, you would actually end up with 17.5 crores at the end of 20 years, right? So that difference of having that 30% going towards investments.
It's all a toss of the coin. I mean, really what you want to do. And, we're running out of time, but really, weigh in on this. This choice of how much a loan to take, should you take it for an asset only like a home? Should you take it for other expenses? Say you want to fund a holiday. You get loans for everything in the market today.
Sure.
Again, a loan can be your friend. It can also be your worst enemy. What is your approach to taking on borrowings?
Absolutely. I think loan is a double-edged sword.
Yeah.
You've got to use it. In fact, you can use it very wisely for your financial planning, right? I think, first of all, you have to ensure, like I said, when you budget, you say, okay, maybe 15% to 20% of my earnings will go into EMIs. Once you put a cap there, I think it helps you understand affordability, right? Now, when I say affordability, it also means what is the right time to buy a home, right? And what is the home that I can afford? For example, I do choose at 27 to buy a home. Can I afford a home in like the, in Worli, or should I buy it slightly further away. And what does that do to my finances? I have a very classic example of a couple who actually moved from renting in Parel to, Kharghar. They bought a home because the pressure to buy a home was so large, and it was a little early in their career. Now, what they landed up doing is taking an EMI, which put a pressure on their lifestyle. They started living very far away, so their travel expenses, commute, all of that increased. So I think first put a cap. Take loans only. There are good loans and bad loans. The good loans means typically where you are paying interest lower than what your money otherwise would earn you in a fixed deposit, for example, right? So a home loan, a car loan. But does that mean, when do I buy a home? When do I buy a car? Is when I can keep that EMI within, 10 to 15% of my outflow. That will help you make a decision on what kind of loan, for what do I take it. When it comes to, I think, loans for holidays, there's a new category, loans for weddings, right? I think all of these, to me, is what we bucket under the not so good loans. These are typically loans that are not going to increase, your productivity or your asset, etc. So therefore, think very, very deeply when you take these loans. Again, if they are between your 10 to 15%, you can still consider it. But holiday, wands, bag, consumer products, wedding lehenga, all of these, save, plan for it. I think you'll enjoy it a lot more. And that's the right way to sort of look at credit and loans.
You want the glow to last. You don't want it to fade with the thought of, oh my God, I have to pay all these EMIs.
Well, I tell young women that, you'll buy a lehenga, but, you'll be paying EMIs, and this day and this age, you don't even know whether the wedding will last, but your EMI will last. Be very, very careful about it.
Absolutely. Okay, ladies, this is a fantastic one. Just very quickly, last 10 seconds left. So, Mrin, let's recap the rules and those percentages which help us budget better and live within our means. Go on.
Yeah, so 30-30-40, which is 30% going towards expenses, 30% going towards EMIs, and 40% going towards savings. And I think, as long as we are very clear that we are kind of doing this on, a regular basis, I think, it should be good. Of course, automating investments goes a big way in ensuring that the money is not spent on anything else. And I think this whole question of, should I buy a sneaker or should I upgrade? I think as long as it fits between, in these numbers, I think it's okay to do it.
Got that. So 30-30-40 is Mrin's rule. Preeti is a little more lenient. She's saying, okay, at least 20% should be investment, if not 40. Final advice, Preeti, from you.
So I think that's where it is. First, draw out your financial maps, right? I think keep that, because sometimes it always helps to have that larger goal in mind when you're saving. Otherwise, saving can become very daunting, and it can be something you deprioritize. So keep that. To me, I think keep it easier. Begin with 20%, automating the rest of the money. You decide how you want to spend it, as long as you keep your EMI bucket between the 10 to 15%, right? And of course, as your career grows, upgrade that 20% to maybe 25, 30, because your liabilities will grow, your expenses will grow, and it'll be very easy to move money from the savings bucket to the spend bucket. So I would want people to keep it really simple and not make it too complicated. Just say, okay, every time I begin with 20, every time I earn more, I upgrade my investing, and I keep my EMI bucket to 10 to 15%. Yes, in places like Mumbai, or when you're buying a house, it could go up to as much as 30%, but that should be your cap and not beyond.
Not more than 30%. Got it. Very, very helpful rules. I think we all need to keep this math at the back of our heads as we go about planning our investment savings and, of course, our spends. Ladies, thanks very much. Very, very enlightening conversation. And viewers, we'd love to know your feedback, what you think about it, and whether you're willing to follow some of these rules. So keep writing into us. And of course, we'll see you same time, same place, with another financial conversation next week.
Let's talk money.
Welcome back. You are watching News Centre. No business in Parliament for the third straight day. Both houses adjourned after opposition protests as the deadlock continues. Rahul Gandhi raised questions to the government on US President Trump's claims of brokering a ceasefire between India and Pakistan. Gandhi also claimed electoral theft in the country by the ruling party. Yes, we are getting you more news now, and traders and business owners in Karnataka are on the edge over GST notices with demands running into lakhs of rupees. The Karnataka GST department recently issued show-cause notices to nearly as many as 13,000 small taxpayers, including street vendors and micro businesses, for alleged GST evasion. So what was the trigger? State commercial taxes. Tax officials had found that several businesses using UPI transactions had crossed the GST registration threshold, but neither were they registered nor were they paying taxes. Vendors who have received such notices are in turn alleging a witch hunt, saying they have been punished for going digital. From milk booths to vegetable vendors and tea stalls across Bengaluru, they are switching to cash-only payments due to fear of GST scrutiny. The issue has now spiraled into a political controversy, with the state Congress government blaming the central GST regime.
बेंगलुरु वाला नोटिस दिया मेरे को आप 4 साल से इतना बिजनेस किया 1.5 करोड़ रुपया बिजनेस किया 1.5 करोड़ रुपया को आप 29 लाख रुपीस टैक्स भराने के लिए बोला मैं इसलिए ऑफिस जाके जीएसटी ऑफिस जाके पूछेगा वो बोल रहा हूँ आपको सब्जी व्यापार करते हैं फल का बिजनेस करते हैं उसका प्रूव करने के लिए बोला इसलिए मैं दुकान का लाइसेंस और फूड सर्टिफिकेट और सभी क्या क्या है डॉक्यूमेंट पूरा दिया कराया तो वेरिफिकेशन करके बोला अभी भी कुछ भी कोई नहीं बोला.
All right, Harish Upadhyay joins us now from Bengaluru. Harish, you have been speaking with the vendors on the ground. Clearly, they are concerned. They want a relaxation in this GST notice. Are we seeing traders, small vendors across Karnataka holding a bandh right now? Are they selling their goods? What is the government saying?
Well, today they had a symbolic protest. Many of these vendors were wearing a black armband to protest against these notices that have been issued. The key concern here, Parikshit, is that several of these vendors are saying that the money that's being shown as turnover is not actually any profit that we are making out of it. In fact, they are saying, for example, a milk vendor from Bengaluru says that he does not make profit from selling milk. He says, I get a commission per liter of milk that I sell, so that can't be calculated as my turnover. For example, there is a vegetable vendor from Haveri who's been issued a demand notice of roughly around 30 lakh rupees. He says that he did specifically go and ask for GST registration when he started his shop in 2021, and he says the department itself told him that he's not required to register and pay GST. So he says suddenly, for 4 years later, if the department turns back and says that I should pay anywhere around 60 lakh rupees as GST, then I will have to shut shop. That's been the crucial concern for several small vendors and traders across Karnataka. Now, just a while ago, Parikshit, the Karnataka government has intervened. The Chief Minister did hold a meeting with the Commercial Taxes Department officers and some of the trade bodies. Now, the consensus or the decision by the government is that they will not go after people who are dealing with exempted goods. Even if notices have been issued, the state government has made it very clear that the Commercial Taxes Department won't go for a recovery. The traders too have now decided to drop the bandh that was called for the 25th of this month, and the government has now taken assurance from trade bodies that those who do not come under the exempted goods category but are having a turnover of in excess of 40 lakh, they will compulsorily register for GST. That's the agreement that's been reached after this particular meeting with the Chief Minister of Karnataka.
All right, Harish Upadhyay, thank you very much for joining us. Let's now go across to Subhash Chandra Garg, former Secretary of Finance and Economic Affairs. Mr. Garg, thank you very much for joining us. Clearly, vendors in Karnataka are a worried lot, and I'm sure that these must be concerns among small traders across the country as well. The argument that they're making, that they always believed that fruits and vegetables were not covered under GST. They were not aware that they are being tracked. Do you think this argument is good enough? Do you think there should be some relaxation in this case as the first warning perhaps, or should the letter of the law be implemented because the law is clear and the taxman is acting as per law?
See, the taxman might be acting as per the little word of the law, but the devil is in the detail about the actual implementation of the law. So, for example, in this case, if you take it that if they're dealing with exempted goods, then the turnover doesn't really count as taxable. Secondly, what exactly is their turnover? Many times a same thing can be repeatedly sold or bought. So, and the further problem is that you may have up to 40 lakh plus kind of turnover, but then you have other options like a composition scheme for turnover up to 1.5 crore. The key thing is that the right kind of turnover of the dealer need to be computed, and what is the GST applicable thereon, composition or without composition, need to be worked out. Now, the tax officials, if they only sort of aggregate the UPI or other kind of digital turnover and slap a notice, that's not fair. It's also the duty of the department to correctly work out that, yes, in this case, how much is the turnover? How much is actually belonging to the exempted kind of goods, and what is the other turnover which is subject to tax, and at what rate is it subject to tax? Offer the option of composition there. That detailed working, if the tax department does, and then goes to the vendor with a notice. That notice is a right kind of notice, and it should be done. I don't think anyone should throw the baby with the bathwater, saying that no, all of them should be exempted or the vendor should not be assessed. So that is not the kind of right solution. The right solution, to my mind, is correctly assess it.
Okay, correctly assess them. Now, this could be a nationwide issue. The Karnataka Chief Minister has said and assured traders that he will take up this issue in the next GST Council meeting. In order to avoid certain similar situation in other parts of the country, what should the government be doing now? On one hand, in Karnataka, GST authorities are running a campaign, know your GST, know your liabilities, know your responsibilities under the tax law if you are a trader, if you are a businessman. Does this need to be done on a pan-India basis with small traders?
Yes,
those who are unregistered?
And the government should come up with a kind of friendly intermediary system which can help record the turnover of all these small vendors, work out in a simpler way what their tax liabilities, etc. are. You have now on the credit side, a lot of entrepreneurial people who provide services for making these the small vendors avail, or the MSMEs avail the loans from them. That accounting is being done. Similar kind of accounting, helping services for tax assessment and liabilities need to be done. So the government, instead of treating them as a kind of tax evader or somebody who is trying to deliberately escape the tax, should come up with the mechanisms to help them. And it's an all India issue. Everywhere this is the kind of thing. In fact, this, to my mind, provides an opportunity that very large segment of Indian businesses, we have, as per a rough estimate, about 8 crore MSME, so to say, whereas the GST system records about 1.5 crore. So there is a vast amount of small traders, vendors, and service providers who need to be brought in within the tax net, but in a way which they can understand and easily comply with.
You know, what we are also noticing, and one of the reasons why this campaign, Know Your GST, has been started in Karnataka is because there's been a noticeable drop in UPI transactions. What traders are ending up doing when they're noticing that they're getting tax demands from GST authorities, they are stopping UPI payments. Will this make evasion, tax evasion, difficult to track?
Of course, if there is a cash transaction, if there is no digital footprint of the transactions left, the tax department's ability to sort of aggregate the transactions and the turnover becomes still weak. But that's a very dysfunctional response to a very legitimate progressive taxation system. You may go to the tax or the cash economy. You may even go for non-generation like the other registered dealers do sometimes, of not issuing invoices, etc., to avoid the taxes, or making transactions in the cash or other forms. All of those are symptoms of a situation in the businesses where people feel that they can't pay taxes and they should avoid the tax. That becomes part of their profit system, so to say. A very mild or fair GST system, a mild and fair income tax system collected through a mechanism which these illiterate, semi-literate people can actually comply with, is the need of the answer. India has a very special problems, but those special problems demand special solutions.
Okay, now keeping in mind the views of traders, what can be done at this stage? What are the options available to Karnataka government, GST authorities in the state? There is also a political war brewing with the BJP attacking the Congress, saying that these small traders are the backbone of the economy. You're making unreasonable tax demands on them. This should not be a political issue, but realistically, what are the options available before the state government right now?
I think the opposition there, BJP, which is a ruling party in most of the states, shouldn't be fishing in such troubled waters. If the small traders have turnover which is taxable of 40 lakhs if it is goods, 20 lakhs if it is service, it should be in the tax net. Whether it is in the BJP state or outside is immaterial. And therefore, the right solution is not to say that or to hit at any government which is trying to sort of bring the legitimately taxable people within the tax net by raising kind of political agitations or otherwise. The right solution for everyone, including the Karnataka government, is to, as I said a little while earlier, is to look at everybody's turnover which they have calculated through digital footprints. Look at very careful. They should appoint some internal organizations taking help of the outsiders if necessary, to go into very carefully into the entire turnover, that what part of it is actually amounting to a taxable turnover, and what is the tax implications for that. In fact, the government would be doing a big service if it does for everyone a very systematic but empathic kind of assessment for all of them, and assess and help them.
Mr. Garg, it's quite simple. Whenever the tax is collected from the consumer, the trader collects it and gives it to the government. It is not like the trader himself has to pay GST on the goods that he's selling, or the tax on the goods that he's selling. Having said that, there are 13,000 show-cause notices which have been sent. Will it be easy for the government to recover these dues from these small traders?
See, that's the other complication. Most of these traders sell at a composite price, which implicitly is understood to include the tax element. They don't bill the consumers or the buyers with the tax separately, and therefore, in these cases, the trader has no recourse to go to the buyers. It's also, from business point of view, impossible for him to collect or bill it to the consumers now. Therefore, whatever is a legitimate tax has to be borne by the trader himself. And therefore, again, the solution would be that if you work it out for the past, let us say, one of the notices says it's for 4 years. So for the past, if you worked out after doing that careful analysis that actually this much tax is due, you should take a decision that for the past liabilities, should you exempt it? Should you grant a waiver? Should you treat as part of the education cost and make the trader sort of responsible for collecting or pricing his products correctly and then depositing in the government?
All right, Mr. Garg, thank you very much for joining us on the program. That's all we have time for on this segment. Small vendors under GST lens, what's the government going to do about that? Mr. Garg saying that we should take a larger view, a more practical view, and educate the small traders rather than implementing the law on a broad brush basis. We're taking a break, but coming up on the other side, the Supreme Court agrees to hear pleas by Justice Yashwant Verma in the cash at home case. CGI recuses from hearing. More details on the case on the other side. You're watching News Center. The Supreme Court has agreed to hear a plea filed by Justice Yashwant Verma in the cash at home case. CJI B.R. Gavai has recused himself from hearing the matter. Justice Verma's plea claims that former CJI Khanna didn't even grant a hearing before recommending his removal. Ashmit Kumar is here with more details on the hearing. Ashmit, what's likely to happen now in this case?
Well, we're all awaiting the bench that will begin to hear this matter, this application that has been filed by Justice Verma. Remember, he hit the headlines with cash being discovered, half-burnt cash being discovered at his residence. Subsequently, there was an in-house panel that was constituted. That panel arrived at findings against him, eventually leading to the impeachment proceedings that we understand will shortly be underway in the monsoon session of the Parliament. Now, that is the entire issue which is at the heart of this petition. In this application that he has filed, he's essentially seeking quashing of this entire in-house panel that led to subsequently the impeachment proceedings before the Parliament. In this petition, what he's essentially arguing is that this information that was leaked from the Supreme Court, that went out, that was put in the public domain, led to a media trial. It has caused irreparable harm to him as well as to his reputation. Also, in fact, directly questioning the CGI, former CGI rather, CGI Khanna, where he's essentially saying that this in-house panel report, which had arrived at findings against him, there was no hearing that was granted to him by CGI Khanna, that Justice Khanna recommended his removal without even giving him a fair hearing, that's a violation of principles of natural justice. And finally, in his petition also raises the big question, who put the cash there? Who took it away? How much money are we talking about? And where exactly is that cash? These questions, Justice Verma has argued in his petition, is that there is no finding, there is no assertion, there is no finding with respect to answering these questions as to where is the cash gone. Now, basis all of this, this petition was mentioned today before the Supreme Court. CGI Khanna said it would not be, CGI Gavai, I beg your pardon, said it would not be appropriate for him to hear this matter, and subsequently another bench will be constituted. So essentially, Supreme Court agreeing to hear this case. Justice Verma's counsels are, of course, yet to argue these claims. Back to you.
All right. Thank you very much, Ashmit, for joining us. Moving on, Tata Capital is seeking a valuation of $18 billion to $20 billion in its planned initial public offer. Sources tell CNBC-TV18 that the company could launch the IPO in the first half of September. Rachna Dhanrajani is here with more. Rachna.
Tata Capital is now targeting a valuation between $18 and $20 billion for its upcoming IPO. This is a notable increase from its earlier target of around $11 billion. The updated DRHP is expected to be filed as soon as tomorrow or by the end of this week is what our source is telling us. But Tata Capital aims to raise about $2 billion through this IPO, which is expected to launch in the first half of September this year. Now, this valuation hike would actually position Tata Capital as India's fourth largest shadow bank. For context, Bajaj Finance currently commands a market value of around $69 billion, followed by Bajaj Finserv at $38 billion and Jio Financial Services at $23 billion. But this revised valuation reflects a buoyant sentiment bolstered by Tata Capital's recent rights issue and the strong performance of other recent IPOs that we've seen in this sector. A key example of that is HDB Financial Services that raised about $1.5 billion. And shortly after its debut, we saw that it reached a valuation of about $7.7 billion. Now, Tata Capital is a subsidiary of Tata Sons, which is a diversified NBFC offering commercial finance, consumer loans, wealth management, and the distribution of Tata cards. It serves over 5.2 million customers across 900 branches. But the urgency for this listing stems from a regulatory requirement. In September 2022, the banking regulator classified Tata Capital as an upper layer systematically important NBFC, mandating a public listing within 3 years, and the deadline for which is September of this year. Tata Capital has consistently received capital support from Tata Sons by the virtue of being their subsidiary, with 6,000 crores being infused over the last 6 years, including 2,000 crore rupees in FY24 and 500 crore rupees in FY23. Now, what we gather is that the IPO may include a fresh share sale of 21 crore equity shares, with Tata Sons and other shareholders offloading around 26.6 crore equity shares. Specifically, Tata Sons, they plan to sell about 23 crore shares, and International Finance Corporation will offload about 3.58 crore shares. So we will be keeping an eye out for Tata Capital's IPO, and we will get back to you as and when we gather more information. Back to you.
All right. Thanks, Rachna, for joining us on Tata Capital's IPO plans. Moving on to a story about urban infrastructure. Only 5% of India's urban infrastructure is financed by the finance sector currently. That's the word coming in from World Bank's India Country Director. Speaking to my colleague Shivani Bazaz, the World Bank official also said that India needs to double its urban infrastructure to sustain population growth in the coming years.
Of the urban infrastructure in India is yet to be built from scratch. What is the kind of opportunity that you see there, and what are the challenges that we have already seen in building these resilient cities?
So yes, we estimate that 50% of infrastructure that will be needed by 2050 has not been built yet. In fact, this number is, in my view, underestimated. Why? The urban population will double between now and 2050, from less than 500 million today to 950 million. And this urban population could reach 1.1 billion by 2070. So when you have the urban population doubling between now and 2050, you basically need to double urban infrastructure, at least. And if you assume that currently urban infrastructure is undersupplied, meaning the current level of urban infrastructure is not sufficient for the current level of the population, and if you want to reach a level that is adequate by 2050 in terms of urban infrastructure per population, you will need to more than double the urban infrastructure by 2050. So a lot of the infrastructure will need to be built now. The challenge in building this infrastructure, first, is financing. It costs a lot to build urban infrastructure. The return is high, but it costs a lot to build them.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
I think frugality drives innovation just like other constraints do. One of the only ways to get out of a tight box is to invent your way out of these. Words from Jeff Bezos will echo with my guest today, a man who's invented and innovated his way to building profitable brands from commodities. A self-confessed lifelong learner, Harsh Mariwala's journey is unique in many ways. But perhaps what stands out the most given his peer set is his ability to step back and hand over the steering wheels of the company that he built over 3 decades to a professional, and in doing so, he believes he stayed true to his rule that the organization comes first.
Sometimes you win, sometimes you don't lose. You always learn. The family promoter thinks that he knows it all, that he has to be in control, you know. And I think that's wrong, and that his children has to follow him, you know.
Was the conversation that you had with your son about the decision that you took probably one of the hardest things that you've done?
With my son as with my wife, yeah. It was tough. Socially also, when you go out, how come you didn't appoint your son? At that time, he was not fully ready. I am completely against Jugaad, because Jugaad is coming out of a certain necessity, but it cannot be scaled up. India cannot be
a Jugaad nation.
Jugaad nation.
What are the non-negotiables when you acquire a company?
I think each acquisition has to be read differently. In some of the D2C brands, we have allowed the promoter to continue. So it's important to be flexible when you acquire it.
It's interesting that you talk about emotional connect as one of the things that you've incorporated now into culture.
So I used to hear from many of my colleagues who had joined from outside, oh, this company, there is so much of bureaucracy, there is politicking, there is backbiting, there is gossiping. Because a lot of workplace pressure, a lot of workplace mental health issues can be tackled if you have the right culture. A right culture where there is high degree of openness. If I have to say something to you, I don't like something about you, I should be able to tell you on your face.
What is it that you don't know about your dad? See, now.
He'll write down the minute details of things that he has to do.
Really?
Yeah, it'll be
he has a diary or something?
Like a daily sheet, and he's got really bad handwriting, only he can understand. He write it down and then he erase it, or he start tearing those pieces. He's his best buddy on the golf course is his caddy, the guy who carries his thing. All his golfing buddies know that
he's a keeper of all secrets,
exactly,
isn't it? Exactly. Sir, you can come in.
Okay.
What is the best piece of advice that you've given him? You think, in your view, and I'll ask him what he thinks is the best piece of advice.
He will not like it, but I think he was in Dubai for the last 4 or 5 years. And I told him to come back.
Come back home. So was that a contentious decision?
It was.
It was?
Very.
Yeah. So you wanted him back and you didn't want to come back.
Correct. But I said,
But
all the businesses,
pretty much like your father, right? You wanted to do an MBA, he didn't want you to study abroad.
That's very different.
How different are the two of you?
Very different, I think. I'm not. I think he's more what I call a 5-star army general. With discipline, structure, punctuality. I'm more of an investor, so I enjoy living vicariously through other entrepreneurs and seeing their journeys.
Joining me today to talk about his mantra for success, scale, innovation and well-being is the man himself, Harsh Mariwala. Many thanks for joining us here on The Leadership Language. It's a pleasure to have you join us here on the program today.
Thank you, Shirin, and thank you for having me over in this program. So I'm delighted and thrilled.
This wall here perhaps encapsulates the many mantras that you've lived by or used to drive Marico. But there was one that I saw there on the extreme right, which said that faith is when you take the first step before having the ability to see the full staircase. And that's what I want to start with. Your ability to let go. Your ability to step back, hand over the reins of the company that you built as a first-generation entrepreneur. And I say first-generation entrepreneur because you didn't do what your family business was doing. How hard was that? Because this is not usual.
So, very good question, Shirin. And I think if you look at Indian businesses, there is an expectation that your children will step into your shoes in terms of the role. My son also thought that he will step in. My wife also thought that he will step into my shoes. But I deviated from the normal practice of putting my son in my role. And I did it because of one, I use the thumb rule, and that's the thumb rule I always use. There are always conflicts between an organization's interest and any stakeholder's interests, whether it is the promoters or the employees. And the key thing which thumb rule, the organization interest comes first.
Yeah.
And that's the thumb rule I use when Shogata, who was the current managing director, came to me and asked me whether is there an opportunity for him to play or to become the MD, because that's his ambition. And I discussed that with my board at that time, and the board felt that, yes, I had steered the company for many, many years. I founded the company, and now it was time for me to step down and give him the reins. And most promoters think that they know it all, and there is nobody better than them. And I disagree with that. There are always individuals you can find, and you should try and find who could be better than me. So I was not expecting this from my personal time spent, because I can't relax. I don't know
how to relax.
The habit of doing nothing, I cannot just not do anything. I have to be occupied on a perpetual basis. And my wife, and I discussed with her, saying, you are not sitting at home. So it was very clear that I'm going to go to work, even if I step down. And it's almost now 11 years I've stepped down. It's been a very good decision, because at one level it has helped me do a lot of things which I never thought I would do. So for me, every moment is different. Whether it is a new business I've started, or whether I'm helping my son in his own business, or philanthropic issues, or on boards, or writing a book, or speaking at various events. So my diary is full. And I still spend time on the business, but it's about 20%, 25%. I manage the board. The CSR part of Marico Innovation Foundation reports to me directly, because I wanted the managing director to concentrate more on the business. So that reports to me directly. But I went through a lot of struggle in terms of the decision itself. What will I do? What will I tell my family? And of course, my wife and my son were unhappy that I did this. And socially also, when you go out, how come you didn't appoint your son? At that time, he was not fully ready. And I decided to take this step. But as I said, it's worked out well. It's worked out well for the organization. Our overall valuations have gone up. And the most important thing is my son has started a new business, which if he had stepped into my shoes, he would not have started. And the best thing is that the business is done well. So now he can claim that this is my baby. And our equations have improved dramatically over a period of time. At one point, we were like, not adversaries, but we had our own set of frustrations in dealing with each other. But now we are completely aligned. And now I am grooming him to take over Marico chairmanship from me over a period of time.
In hindsight, the decision worked out.
Yes.
But at that point in time, when Shogata had that conversation with you and said, look, my ambition is to become the managing director, you could have very well said, and I know that you were not ready to give up at that point in time. What made you say that this is the right thing to do for the organization, knowing fully well that you wouldn't have the buy-in of the family, you wouldn't have the buy-in of your son and your wife and others?
So I think two things. One is we had to retain him. If he had not given him that role, he would have left. And he had made it very clear that he is ambitious, and which is fair. I think every person has their own ambition, and if that ambition is not fulfilled by the current organization, then that person should leave. So he would have definitely left. And I think he was a very prized asset in terms of his capabilities. So we had to retain him. Number two, the company also needed a new set of thinking. And I think that also came in, because I think they say you have to change the CEO or the leader every 10, 15 years. But here in this case, I had built the business from scratch, and I was managing the business from the time its inception for 30, 40 years. So it needed a new lens. So I think, and then the board also felt that I should do this. So I think a combination of these three made me take that step. But I think the more important thing is, after that taking a step, the board said that you promoted him, but there is a tendency amongst most promoters to interfere on a day-to-day basis. So the MD on paper is not empowered. There is constant interference and
the backseat driving.
Correct. So the board wanted to avoid that. And they asked me to have a statement in terms of role clarity. What will I do? What I want to do? What will the MD do? What he want to do? And when will he come to me for decisions? So the document is so much in detail.
Did you draw it up?
We jointly drew it up. I drew it on my own. He drew it on his own. We exchanged notes. And it's working wonderfully well. So things like I will not participate in any investor meetings. I will not do anything, any PR about Marico per se. I will talk about macro issues, about my own journey. But Marico related PR, I will not part. So that's his baby because he's managing that business. I will not go into day-to-day functioning at all. But there are certain things I will manage, like the culture of the organization. Like I'll do skip level meetings. I will interview people who are going to report to him. I will have review meetings every month, but most of my work will be done through the review meetings of 2 hours, and not on day-to-day basis interference. Some of the acquisitions, key decisions will come to me. So it's worked wonderfully well.
I think part of why promoters hold on well beyond they need to, well beyond perhaps in a crude way, the expiry date, is to stay relevant. I think the fear of being irrelevant often drives an ego, drives the decision to stay in the seat, to stay in the saddle. Was that a concern for you?
Not really, because I'm staying relevant because I still do a lot of outside and I go market visits, which is not a day-to-day work. So I get my inputs from there. I read a lot.
You still go on market visits?
Yeah, I still go on. Once a month I go on market visits. I interact with the customers, shopper behavior and things like that. So I do all that. I review meetings at all our international locations once a year. Just 2 days back I went to R&D. So once in 6 months we have a review meeting with R&D. So there is structured involvement, not day-to-day basis. Nothing comes to me for decision. And I think the biggest problem with most promoters is that ego, which is driven by the fact that they think that they know it all, which should not be. You should, because the organization will have to continue on a long-term basis, even when you're not there. And I believe in perpetuity of an organization. I don't believe that the business is to be built and then sold. And I'm not the serial entrepreneur type. So if that organization has to last much beyond me, you have to create certain values, culture, talent, and I think that can only come in when you start delegating, empowering people.
Was the conversation that you had with your son about the decision that you took probably one of the hardest things that you've done?
It was tough with me, for my wife, with my son with my wife. It was tough.
How did you repair that relationship?
So I think over a period of time, things just
fell into place. He
started doing well. So it got accepted initially. That acceptance is still at that time it was hard, but over a period of time that...
one of the other things that is often associated with you is the focus on what is called frugal innovation. And I don't know how you describe what frugal innovation means to you or what it's meant to you through the course of your journey and through the evolution of Marico. But, when you look back at how your journey shaped, the role of the kind of innovation that you decided to focus on, would you attribute Marico's success in large measure to that?
So if you look at our own journey from the time we started, and much before Marico, also at part of Bombay Oil Industries, when I started our Parachute and Saffola brands and scaled it up over a period of time, the most important times when we had a massive spike in our sales or market shares was when some innovation succeeded. And mind you, many innovations have failed, so everything doesn't succeed. But that just reinforced in me the need to innovate on a perpetual basis, because you'll innovate. It's a matter of time others will copy. You're bound to copy, which is fine. But you have to be 2 steps ahead of others. So you have to continuously go on innovating. And my belief in innovation just went on getting reinforced. So the frugal innovation sometimes is mistaken for the jugaad. I am completely against jugaad, because jugaad is coming out of a certain necessity, but it cannot be scaled up. India cannot be
a
jugaad nation. I mean, it's okay. You're taking some shortcuts, but that's fine. It's good to talk about it, good stories, making lassi in a washing machine and whatnot, but nothing beyond that. So, but I was very clear that we had to make Marico an innovative organization on a perpetual basis. And that can only come in when you create a culture of innovation, where innovation is thought by each and every person within the organization. Each person thinks, what can I do it differently? Each person is willing to experiment, doesn't have the fear of failure, because the biggest deterrent to innovation is the fear of failure. You don't want to take a risk. What will happen if I fail? So you have to give an assurance to your talent that it's okay to fail. Many experiments will not succeed, but it's okay, because you can't go on determining your future journey based on market research. There is no shortcut to actually testing your product in the market.
You're not a big believer in market research?
I'm not a big believer. Yes, you're right. But sometimes market research is just done to confirm your certain thoughts. You can't arrive at a strategy-based market research. I'm not in favor of. But yeah, if you have certain thinking, you may just confirm that, okay, market, and then say, okay, this is my thinking. It's getting confirmed by this research. But you can't say, I want to do a market thing on, launch a product based on market research. That I'm not. I think that can only be done through consumer insighting, which is different than market research. You have to actually go and meet the consumers on your own and go deep into consumers' mind in terms of what's the latent need which is missing at the consumer. And whether it's health related or whether it is beauty related, we are seeing certain trends in the environment coming in from either from developed countries or now from a lot of from Korea also. You can see skincare, food coming in from Korea. You have to continuously keep track of those trends and try and find out what will work with the Indian customers.
course of the journey, what would you say have been some of the most significant innovations that you made, that you decided to bet on, that changed the trajectory of the company, and those that you thought would work but actually failed?
Yeah. So if you look at a brand like Parachute, we just started with coconut oil, and then at that time it was in tins. We converted the whole market in plastics. We again rolled out all the innovations in Bangladesh. In that market, we have 80% market share. And then we used the property of coconut to go into other skin, hair care products. So I think that's the whole journey of Parachute and its extension. And now we are seeing it at a global opportunity in terms of leveraging coconut as a superfood in other developed markets. Hair oiling in other countries also is catching on in developed markets. So can we tap that opportunity? So through the Parachute brand name is something which has evolved quite a lot. And similarly with Saffola, started with oils, we went into blended oils, and now we have cold pressed oils also, and then into foods also. So we've gone to oats, masala oats. We have a whole range of Saffola honey, Saffola muesli. So I think leveraging those brands into related areas through extensions has played an important role, But we failed also. We thought we launched fabric softeners, and we launched it at that time. I'm talking of 30 years back. We were too ahead of our times.
Yeah.
Now the fabric softener market is caught on, but we launched it. So timing also plays a very important role in terms of when to launch. And you do it too prematurely, and then the market is not ready.
Yeah.
So the right timing is now it's become a big category.
As you look at where Marico finds itself today, and the market has changed, consumer habits have changed, consumer behavior has changed.
Yes.
What excites you about the opportunity, but also what worries you about the change that you're seeing?
So I think you are absolutely right that the consumer habits are changing very fast. Earlier there was to be brands which were for family, then became quite personal. And in terms of marketing language, we used to call it segmentation. Now there is micro-segmentation with the emergence of D2C brands. So there is a huge discontinuity because of technology, because of consumer habits. And I think you have to look at it from two windows. What is the threat to your organization? You have to protect that. And what is the opportunity arising out of those discontinuities? And I'll just give you an example of D2C brands. FMCG as a sector is perceived to be very defensive because you needed big money to create a brand through television, through press, and the kind of budgets you needed to launch a national product would be in upwards of 20 crores. You needed a huge distribution network to tap into all of India in rural area and going into millions of outlets. Very difficult for any newcomer to get that, to spend that money unless one is willing for a huge long-term sacrifice. So in a way, we were in a cocoon where we didn't see any new competition coming in.
Yeah.
Come all of a sudden D2C brands, and
the competitive landscape has changed.
Changed completely. You can do digital marketing. Your budgets could be 1/10 of the FMCG budgets. You can go through marketplaces, social media, then you go to Amazon, e-commerce initiatives. Now Q-commerce come in. So all of a sudden, because of those entry barriers going away. So there are two ways of looking at it, as I said. One is threats. So how do you protect your current businesses? Of course, you take what was action is needed. But more importantly, what are the opportunities arising out of D2C threats? So we acquired 4 brands in the last 3 years.
Yeah.
And today, annualized turnover of those 4 brands are upwards of 1,000 crores. All of them have scaled up very well. But we have managed that very differently because the mindset required to manage a D2C brand is very different than the mindset required to manage an FMCG brand. So different team, much younger, very digital savvy, small budgets, a lot of fast reaction time.
So they're islands within the Marico universe.
Yes. And I'm glad we did it that way because if you had combined with the FMCG marketing, it would have not worked out because they have abundance in terms of budgets. Here you have frugality in terms of the budgets and the way you work, very, very fast pace of action. And we also have our own D2C brands.
Yeah.
So I'm just giving, so this was a threat and we turned it into opportunity. I think we may be the most, if you look at all the FMCG companies, we may be the most aggressive in terms of acquisitions, in terms of number of brands we acquired.
So do you believe that given the landscape that you see today, as well as the fast-paced changes, that building is perhaps harder to do versus buying? Do you think that it's easier to buy your way to market share or build your way to market share and new categories?
So I think you're talking about acquisitions, which is, and I strongly believe in growth, okay? So growth has to be the most fundamental part of any organization. Growth has to be sustainable, it has to be profitable. And acquisitions, sometimes, many companies think that acquisition is very sexy because it gets talked about.
Yeah.
You get a lot of visibility. But I think you should be clear why you're acquiring a brand. Is it to get into new category? Is it to consolidate your market share? Is it to enter a new country? So we've made something like 25 acquisitions. And I think overall our success rate in acquisitions is much, much higher than the perceived success rate of overall global acquisition success rate. They say is roughly about 30%. And failure rate is 70%. In our case, it's more than 80% is successful. Because we are very clear why we are acquiring. Not to answer your question whether should we look at organic or inorganic growth, I think you have to perceive both. You can't just say I will only look at acquisition because you may not get an acquisition. Or you may get an acquisition which may be very, very expensive and you may not want to pay that kind of price. So you just can't say, I think organizations have to look at organic, inorganic, because once you acquire a company, again, it has to go through an organic route of expansion.
Exactly.
So organic capabilities have to be there. In some of the D2C brands, we have allowed the promoter to continue. So it's important to be flexible when you acquire. You can't say everything I want from day one. Because if I told that promoter that please sell 100%, they would never ever agree. They want to continue participating in that journey for 2-3 years. They want to see an upside. And also have patience when you integrate acquisitions. You just can't behave like a cowboy that day one you acquire a company and start changing, because that company has certain strengths, certain people strengths also. And you can't just create that fear in the people that, okay, we are going to change everything. You have to go deeper and then, of course, over a period of time, what's not working well, you have to change. But you can't from day one start changing things. The other thing which we say is that governance play a very important. Some of the companies we acquired had very bad governance. On that, we will not compromise.
And that brings me to the question on culture, because I know that you see yourself as the custodian of the culture that you've helped create and build here at Marico. And culture is not just compliance with what the regulation wants you to do or mandates you to do. It's much more than that. Why has culture meant so much to you from the very start? I know that you believe from day zero that governance should be part of your preamble, as a company. What made you so conscious of that?
I don't know what made me conscious, but maybe a lot of reading. I read a lot. So because of those readings, I got a little bit more influence for the need to build a strong culture. And because of the innovations which succeeded prior to formation of Marico, I wanted to build a very strong culture of innovation. So how do you create a culture of innovation was the biggest challenge. So I wrote down a lot of thoughts on my own and shared with my team at that time. I'm talking of early 90s, where culture was not talked about. And they took a very positive response. Then I went to a consultant from Delhi, Dr. Mrityunjay Atreya, and with his help, we internalized the culture. I went and talked to people, but culture doesn't start, starting point was me. Ultimately, it has to be owned by the whole organization. And the top leadership has to play a very important role. If they say that this is MD's culture, I don't agree with it. It's a disaster. I don't want to paste our values in the reception and down the line people say that this is not the organization which it is. It has to be exactly based on, it has to be lived. And for that living to happen, the top management, the senior management has to set an example. So there is a lot of in-depth, shall I say, attention given to culture, because ultimately in any organization, strategy plays an important. Strategy and culture has to fit in with each other. Culture has to help strategy.
So how different is that handwritten code of conduct that you took to Professor Atre? How much of that has been translated into actual reality over the course of the last 3 decades?
Good question. I think over a period of time, cultural values, there may be a need to change because the business has changed. Those days there was no digital, the agility was not there. So every 10, 15 years, we look at our values and change the values. Some of the new values which have come in are to do with agility, to do with emotional connect, to reduce bureaucracy. So to have a global mindset, because we went global at that time, we were only Indian company. So it has to, you have to relook at what has the business gone into and what are the new needs.
It's interesting that you talk about emotional connect as one of the things that you've incorporated now into culture. Why is that?
See, some of the new things through COVID, we realized that the need to emotional connect was very high. The need to interact with people when they were living with COVID in terms of insecurity, somebody in the family, older person expiring, or so there was a lot of fear, and also realized that agility is very important, because vaccines which used to take about 10-15 years to develop were developed within 2 years. So we can be agile, and I think we have tried to do that. Earlier a new product process was like 2 years. Now you condensed it, all that.
What did you change? What are you doing differently versus,
so I think
versus previous?
So normally organizational bureaucracy slows down agility, and the need to, especially interfunctional authorization helps. So we did a study in terms of over a period of time in any organization, new processes come in, new bureaucracy comes in depending on the change of the new person who's coming into the role. So we had a review of all the processes and cut down a lot of processes, which just made things much, much faster. On top of that, the overall top management has to move fast, and sometimes perfection and agility don't go hand in hand. So depending on the issue, if you try to be very, very perfectionist, you may just spend 1 year extra, and that higher degree of perfection may not be truly relevant for your success. So you need to take a call on that person.
So you're saying time to market has to be given more significance than the perfect product to market?
Yes, because if you don't do it, somebody else will precede you, So you may be missing out on an opportunity.
mental well-being, and I know, again, that's not something that has typically been a focus area for leaders, especially, leaders in India. Of course, post-COVID, it started to be talked about, but you've been doing it well before that. Again, why this focus, this emphasis on mental well-being? Where did that come from?
So I've never worked anywhere else, so I used to hear from many of my colleagues who had joined from outside, oh, this company, there is so much culture, there is so much of bureaucracy, there is politicking, there is backbiting, there is gossiping. So I was like puzzled. I said, why? And then half the time they would waste in doing all this nonsensical kind of thing just to... So if you want to get a promotion, you have to find out whom will you back in terms of leadership.
So this is happening in other companies, you're saying?
That's what I meant on hearing. And I said, I don't want to have this kind of culture in the organization. I don't want all these pressures to come in. Because a lot of workplace pressure, a lot of workplace mental health issues can be tackled if you have the right culture. A right culture where there is high degree of openness. If I have to say something to you, I don't like something about you, I should be able to tell you on your face, rather than telling 20 other people that she's like this, So try to build in the culture of openness, trust, meritocracy, empowerment, and I think that's played an important role in people enjoying this journey, and hopefully our mental health issues, because the workplace pressures are lesser. Of course, there will be some other mental health issues. It could be because of certain relationships. It could be anything. It could be some health issues in the family, but at least try and improve the mental health quotient within the organization.
But how did you make it a two-way street? Because very often leaders expressing their own vulnerabilities is not something that we see.
I know that, but I realized that when I expressed my vulnerability, I was able to get very close to my team, because they said, oh no, you've never heard any leaders talking openly about their set of issues,
You talked about giving up control. And you've demonstrated that through the course of your career. But what are the deterrents that come in the way of actually giving up control? What were the demons that you had to battle with?
The biggest deterrent is the talent quality. It's the talent quality you have. Suppose a new recruit, you've taken somebody, and the quality of that or capability of that person is not there. Then you just can't empower that person, because then you are delegating, which means you are accountable for decision. You're not abdicating your responsibility. So delegation comes out of a certain confidence and trust you have in that person's capability. So initially when I take a new person coming in, there will be high degree of involvement of mine. But the moment that person gets confident, gets trust and gets my confidence, then higher and higher empowerment will take place. So I think the biggest deterrent to giving up control or empowering people is the quality of talent and how that person is functioning, So if he is very caustic with his team, then I would be very reluctant, because then you're creating a culture of empowerment, participation. People have to enjoy working in the organization. And when you enjoy working, this work-life balance, I think it gets missed out.
What does work-life balance mean to you?
You have to enjoy your work. If you rightly put it, if you enjoy your work, you don't have issues of work-life balance.
So you're not looking at your watch whether you've clocked a certain number of hours. You never did that, and you never did that for your team either.
Yeah, not at all. In fact, we have done away with musters. As used to have musters earlier, In early 90s, so you don't have to write musters. We trust you. We've done away with sick leave. If you're sick, you're sick. We don't have to you're not entitled to a sick leave or casual leave. So you're absolutely right. It has to come from within, because in today's times, when everybody can be sitting, but they can doing something on their own on their computer. Nobody will know. So no point forcing people to work hard. It has to come from within. You have to make people enjoy work. The moment people enjoy work, they will work and they will stretch themselves. And they will not have complaints of work-life balance. Of course, there will be some time in certain businesses which mean that you have to work much higher. But it cannot be on a perpetual basis, because then what happens is then you need to lead a certain lifestyle, certain habits, health, sleep, all that are equally important.
How important is that to you?
Very important.
Sleep, health.
Very important. I am wearing this gadget.
What is that?
This is Gabit.
Okay. What is your sleep score usually? What an average?
Last night was, I just started wearing this. Last night was one of the highest, 85, which is not bad.
So you were not nervous about this interview?
No, not nervous. It measured your stress score also. I can show it to you right now.
So you're not stressed?
I don't get stressed much because if you do things right in the right way and you don't break laws and all, then you have the business which is strong enough because you're focused and you become market leaders.
So what's the Harsh Mariwala health regimen or routine? Like what is it that you do on a daily basis?
Okay, so morning I do, I have 10 minutes of posture exercise, just 10 minutes because I have a little weak posture in my back. And then I do 10 minutes of breathing and meditation. In the evening is my field workout time, which is 1.5 to 2 hours every day.
1.5 to 2 hours?
1.5 hours every day, minimum. So it's a combination. It varies every day. So sometimes it's Pilates, sometimes weight training, functional training, then swimming or cycling in the gym, and then play golf.
So that keeps you healthy and rejuvenates you as well.
You don't do the same thing. Otherwise, it's very boring. So every day is different. Yes, of course. I can't sleep if I don't exercise. It's like exercising to me is like having a shower every day.
Market share. What have been some of the rules that you have adopted, not just to gain market share, but to keep market share intact? I mean, you've been a category creator, but to hold on to the lead, because as you said, there will be somebody who will come in taking your idea and perhaps even executing it better than you did. So what has been the mantra to hold market share?
So I think first of all, who is your competitor? You are losing market share. You have to be clear about it and you have to protect your market share, sometimes it may mean that you have to sacrifice profits, but it all depends on the context. Who is the competitor? To what extent are they going to get market share? And that's what happened when Levers launched coconut oil. I'm talking of 30 years back. And then they're much larger than us at that time, better distribution. There's a lot of fear that, okay, what will happen? They bought Tomco, one brand, they acquired one more brand. So we decided that this is our resource generating engine. At that time, it was Parachute was forming about 70% of our turnover and more than 70% of our profits. So we were very clear that come what may, we will protect. If it needs more advertising, it needs better distribution, lower pricing, we will do it. And at that time, we were a public company, but we gave a guidance to the capital market that please, this is our financial performance for next 1 or 2 years may not be growing in terms of profitability, but this is what we decided to do. And I think that we were able to protect our market share because we adopted that kind of a stance and we gave that guidance, and the market also luckily bought into that argument. And again, I say transparency plays very important. You have to be transparent, even your capital markets. If you're going through a bad phase, whatever, you tell them. You have to earn their trust. The moment they earn their trust, then they are with you, saying, "Okay, this company is sharing their issue with us."
Speaking of lever, I want to talk about how things changed from almost having to fight off lever to then eventually going out there and acquiring a brand from lever. I mean, what was that like?
It was a great story. I think I enjoy talking about that story because at one stage we were very vulnerable. A lot of people told me that you will sell out this brand, and because Lever was desperate to buy it, they had also announced in the capital markets. A lot of fear in the organization. So we took all the steps to protect our brand, but including I went, Uday Kotak told me to meet Karsanbhai Patel, who was at that time fighting Lever through his Nirma brand. I went and met him and concluded that we will take them on. And we know this business inside out. They are new entrants. For us, starting from me to the top team, there will be full attention given to this threat. For them, it will be some 3 layers lower than chairman will be handling that brand. And we'll take them on. And we took them on and nothing happened to our brand, our market share. Some of our competitors lost market share. So at some stage, they started losing interest because of Unilever globalization initiatives. And then they decided to sell the brand. We were very aggressive in acquiring. And again, the board played a very important role in saying that you have to acquire the brand. You don't try and double guess what others will come. You go all the way. Because you should not regret if you lose this brand. And we got this brand, and it has been one of the best acquisitions for us.
What will be the most relevant organizational structure? What do you believe the role, the job, the responsibility of a CEO today will need to be?
So I think this role and the responsibility of CEO has dramatically become more complex compared to the times I was a CEO, because the whole world is changing so fast. Whether it is technologies like AI or multiple technology, robotics or whatever, the impact on the business. Whether it's geopolitical developments, leadership in countries like US and all of a sudden things are so volatile and difficult to predict that you have to be on top of what's happening in the environment. On top of that, the organization needs have increased because of cybersecurity, because of AI, digital technology, governance, DEI, sustainability. So there are a whole host of new things which have come up on the horizon, which the CEO has to take care of. The structure has to take care of that. And within the structure, of course, you can't have too many reporting relationships. So what has happened at the CXO level, the responsibilities have increased dramatically.
So Harsh Mariwala transitioning from CEO to now virtually a strategic investor, if I could call it that.
Sure.
To many others who may be considering the possibility of doing so, but perhaps haven't yet made that decision, what would you like to share? What are the 3 or 4 things that you believe they should consider and they should emulate in making that journey from CEO to strategic investor?
So I think a lot depends on the family and the owners. It cannot be for every individual, every family to become a strategic investor. In my case, I was the only person managing the business. In some cases, there may be a family member who may be fully ready to take over, and there may not be any need for a strategic investor. But wherever a promoter has stepped down or the family has stepped down from managing the business, you have to become a strategic investor, which is a little more than just investor, little more than just a board member or chairman. Of course, because your stakes are very big in the organization. So the role which I have played in terms of empowering the individuals, but a structured way of getting a grip on what is happening in the business.
You're also helping other entrepreneurs build their businesses and build their dreams through what you are doing at Accent and what you're doing at the Marico Innovation Foundation as well. What excites you about what you're seeing in India today?
I think what is most exciting is the entrepreneurial journey and the number of new entrepreneurs which have come up in India from rural areas, from non-business families, leveraging their education, with, of course, the help of all the private equity and the eco support system. To me, India's future is going to be determined by these entrepreneurs. Because up to a point, the government, you can ask them to invest in whatever infrastructure. But beyond a point, the entrepreneurs will drive the India growth story. And I think that's what is exciting, is that we are seeing such a huge action at the entrepreneurial level, so many entrepreneurs and so many students wanting to get into that. To me, I'm most excited by that.
I know that leaving things in perpetuity is a big part of what you believe in. What would you like your legacy to be in perpetuity?
In terms of the company or
in terms of company as well as at a personal level?
So at a company level, I would say that the company should continue to be strong and, more importantly, respected. I strongly believe that you have to earn respect from all your stakeholders and not just your shareholders. So you have to do something for each stakeholder, whether it's your own employees or whether it's society or your associate. They should say that the organization has made a difference to them. At a personal level, I also feel that I think I have to make a difference to whoever I've interacted, whether it's an entrepreneur or whether it's a mental health initiative. And I think my journey is to make a difference to others, and I would like to be remembered for that. I would say that sometimes you win, sometimes you don't lose. You always learn, So there is always failure in experimenting, but use that failure for learning, And I've seen that many times we failed and it has applied that learnings from the failure to something else we've done in the future. That has worked wonderfully well, So don't be afraid of taking risks.
So sometimes you win and sometimes you learn. Harsh Mariwala, it has been such a learning experience for us listening to you. Thank you so much for sharing very candidly your insights with us here on the Leadership Language. It's been an absolute pleasure. Thank you very much for your time. Well, with that, it is time for us to wrap up the Leadership Language. From all of us here on the team, thanks very much for watching. If you enjoyed this conversation, then do visit CNBC TV18 Access. We'll see you again next week. Goodbye. Many thanks for watching.
Hello and welcome to Startup Street. I'm Arundhati Ramnin, and with me as always Shruti Mishra. These are the top headlines from the startup world. Good Glam is being dismantled. Founder Darpan Sangvi says lenders have enforced their charge and the group's brands will now be sold individually. Restructuring attempts failed despite exploring refinancing, investments and partial sales. Sangvi has taken full responsibility and made a personal commitment to repay employee dues using 25% of his future post-tax earnings.
Big trouble for Myntra. ED has filed a FEMA complaint against the fashion e-commerce major, alleging a 1,654 crore rupee violation of India's FDI policy. According to the ED, Myntra conducted multi-brand retail trade while claiming to operate as a wholesale cash and carry business, a violation under FDI norms. In response, Myntra says it hasn't received the complaint yet, but remains fully committed to cooperating with authorities and upholding all applicable laws.
Conversational AI platform Gupshop has secured over $60 million in a fresh round of equity and debt funding from Globespan Capital Partners and Evolution X Debt Capital. The firm is looking to list on Dalal Street in 18 to 24 months and is also exploring to shift its domicile from the US to India.
Elon Musk's artificial intelligence startup XAI is working with a financier to secure up to $12 billion more for its expansion plans, the Wall Street Journal reported. Valor Equity Partners, an investment firm whose founder Antonio Gracias has close ties to Musk, is in talks with lenders to raise the capital, according to the report.
The European Commission will not ask Alphabet, Amazon, Apple, ByteDance, Meta and Microsoft to pay the cost of monitoring their compliance with a new digital law. The EU tech chief said Germany and European Parliament lawmakers have lobbied for a supervisory fee to be levied on big tech to help EU antitrust regulators better enforce the Digital Markets Act.
Well, those were the headlines we've been tracking for you this evening. The top story this evening, the Good Glam Group, that was once one of India's most celebrated D2C bets, backed by top investors with over $250 million in funding, had a vision to build the country's first digital, first FMCG conglomerate. Well, that dream has officially unraveled. In a LinkedIn post titled, "To all my Good Glam stakeholders," Darpan Sangvi, founder of the Good Glam Group, has confirmed that the company's lenders will now enforce their charge on individual brands. That means the group structure will cease to exist and brands like the Moms Co, Organic Harvest, Saint Botanica and others will be sold off one by one to new owners. At its peak, Good Glam was valued at nearly $1.2 billion, had acquired 11 brands in under 3 years, and aggressively expanded into content and commerce with the acquisitions of Popexco, Scoop Whoop and Baby Chakra. The financial troubles at Good Glam Group began late last year when a near final deal to sell one of its brands fell through at the last moment due to the sudden resignation of the acquiring company's CEO. In another LinkedIn post 2 weeks ago, Darpan said that the breakdown of this transaction led to salary and operational payment disruptions, hampering business continuity and making it harder to raise fresh capital. The company has already sold off some brands, feminine hygiene brand Serona back to its founders. It has also sold Scoop Whoop to WLDD and Miss Malini to Create a Fuel, all for a fraction of the price it originally acquired them for. Now, Darpan has taken personal responsibility, pledging to repay dues to employees using 25% of his future post-tax income and repaying vendors and partners by creating a Good Glam restitution fund in the next 60 days, which would receive equity from his future ventures. It's surely a defining moment, not just for the company, but for the house of brand structure of companies, which has failed to take off, not just in India, but globally as well. Arundhati, over to you.
The Enforcement Directorate has filed a complaint against Walmart-owned fashion e-retailer Myntra for allegedly violating foreign exchange rules involving 1,650 crore rupees. Timsi Jaipuria joins us now with those details. Timsi, what are you picking up?
Enforcement Directorate's Bengaluru zone has filed a complaint under Section 16(3) of FEMA against e-commerce giant Myntra Designs Private Limited and its related companies and directors for alleged contravention of forex rules to the tune of 1,654.35 crores. According to ED's press release, inquiries in the matter were initiated on the basis of credible information that Myntra Designs Private Limited, or Myntra, and its related companies are doing multi-brand retail trade in the guise of wholesale cash and carry, allegedly a violation violation of the FDI policy. The investigations under FEMA revealed that Myntra Designs Private Limited had declared itself engaged in wholesale cash and carry businesses and received FDI amounting 1,654.35 crores from overseas investors. However, they sold majority of their goods to Messrs. Vector E-Commerce Private Limited, who sold the goods in retail market to ultimate consumer. Thus, both Vector E-Commerce Private Limited and Myntra Designs Private Limited are related parties and belong to the same group. Vector E-Commerce was just created as a corporate conduit to bifurcate the actual B2C transaction into two layers, first a B2B and then a B2C. ED asserted that this structuring allowed Myntra to circumvent India's FDI constraints and restrictions on multi-brand retail. ED also said that this practice helped them to route 100% of its good to Vectors as a clear direct violation. Meanwhile, ED has filed a complaint before the adjudicating authority under FEMA, and Myntra spokesperson reacting to the development said Myntra is deeply committed to upholding all applicable law of the land, but they haven't received a copy of this complaint as yet. Let's see what happens finally in this matter.
Tim C, thank you for those details. Appreciate you joining us. Also on what's brewing, conversational AI platform Gupshop has raised over $60 million in a fresh round of funding combining equity and debt from Globespan Capital Partners and Evolution X Debt Capital. The funds will fuel the expansion of its conversational AI and messaging platform, as well as accelerate go-to-market execution across high-growth markets, including India, the Middle East, Latin America, and Africa. Joining me now to decode what's next for Gupshop is its founder and CEO, Beirut Shade. Beirut, welcome to Startup Street. Powering 120 billion messages a year and now raising over $60 million, you clearly seem to be doubling down on global growth. You've called this an inflection point. So what are the key growth levers this funding unlocks, Beirut? Where will the capital be deployed first? Product innovation, GTM, or market expansion?
Well, firstly, thank you for having me here. Yes, it is indeed an inflection point, which is a rapid and dramatic acceleration in growth of AI adoption around the world, and including in India and other markets. So I think the first and most important area to invest in is certainly product innovation. Unless you have new product that takes advantage of all of these new capabilities. And if you've been reading the headlines, the AI models are becoming so much more better and credible. So we are investing in that, building new tools for enterprises to use these capabilities. And then we've also expanded globally in many other markets like Latin America, Middle East, Southeast Asia, and so on, which, like India, are all mobile-first, messaging-centric markets where these things are being adopted very widely.
All right. Previously, Beirut, you've also spoken about AI agents evolving from experimental to essential. Break that down for us. What's changed in tech or enterprise readiness that's driving this surge now?
Yeah, I think, exactly. It's gone from curiosity to conviction, right? Or a nice to have tool to absolutely a must have. And the reason is, again, if you've been seeing the headlines, I think the models have gotten very, very good AI models, right? It sort of passes the Turing test, as it's called, meaning an average person cannot tell the difference between whether it's a computer software on the other side or a human, right? So it can mimic human capabilities so well, and especially in terms of having a natural language conversation through text or voice with consumers. So yeah, so I think what used to be little experiments in the beginning, now businesses are seeing the early results. It's becoming a source of competitive advantage. You can provide personalized, individualized service to every consumer at massive scale, and that's really hard for most businesses, without using AI tools. So this is really transforming the adoption of AI across the business world and how businesses interact with consumers.
Yes. So tell us, what is the kind of business growth you're seeing currently, both in terms of engagement and revenue? Also, Gupshop's conversational cloud spans marketing, commerce, and customer support. Tell us which verticals are seeing the fastest adoption today, and if you could take us through some of the interesting trends that you're seeing.
Yeah, I think, look, AI can basically replicate sort of the human brain and the human ability to have these conversations, right? So, and because it's trained, it can have perfect knowledge, it can be consistent, be 24/7 available, can handle multilingual capabilities in text or voice. So once you take that kind of powerful capability, a business can provide like I said, personalized service to consumers. So if it's a bank, it's as if a virtual relationship manager that's interacting with every consumer. If it's a retailer, it's like a shopping assistant for every consumer. So, they're adopting it and marketing. It could be things like, lead gen or product discovery and recommendations. In commerce, it's transactions and payments. In customer support, it's handling queries. All of these use cases are driving great results. Yeah.
All right. You've also been named Meta's Partner of the Year. Tell us, what does this partnership unlock for you across platforms like WhatsApp and Instagram?
Yeah, I think, Meta is indeed a leader in driving conversational AI. They've built out, firstly, WhatsApp itself is such a powerful channel. Everybody uses it, but they've added a lot of features in it to enable rich messaging. On top of it, they evangelize the ecosystem. As you can read, they've made a huge bet in adoption of AI across the world. So, all of that is helping. So they also refer a lot of customers to us, and in return, we drive a lot of revenue to them. So it's been a great synergistic partnership, and we continue to work with them very closely.
Okay, now conversational AI is no longer just a CX tool. It's a core revenue driver today. Beru, share examples of how enterprises are seeing bottom line impact and the kind of cost efficiency you are bringing to your clients.
Yeah, I think it's very dramatic, right? It helps them improve conversion rates, increase sales and revenue. It drives rich customer experience, so it improves customer delight, customer satisfaction, and so on. It's also reducing cost dramatically, right? Whether it's customer support cost, or if they have local branches or call centers and so on, they can make all of that much more efficient. So ultimately, businesses are seeing great results. It's a source of competitive advantage in their industry. The early adopters of AI are seeing great benefits in terms of customer adoption, market share gains, and so on. So it's a must-have tool, and it's no longer just a toy or an experiment.
All right. Tell us, what is the 12 to 18 month vision for Gupshop now? What are your expansion and revenue targets? And as AI evolves, Beru, that breakneck speed, how do you plan to stay ahead of the curve?
Well, to answer the second question first, really using AI itself, right? We are heavy adopters of AI inside the organization so that we can keep pace. We can improve our own organizational efficiency and productivity at the pace of which these tools are getting better, right? But in terms of 12 to 18 month plans, really our focus, as always, is to focus on the customer. What are the new tools and capabilities we can offer them, right? If we can bring value to them, they'll adopt our tools. It'll drive, all our revenue goals and expansion goals and so on, right? So ultimately, it's just how good of a product can we offer, and can we offer that in scale? Because we have like 50,000 plus customers around across 100 countries. So we have to offer that. Doing 1 or 2 demos is fine, but can you offer that at massive scale globally and deliver that? So I think, we spend a lot of time productizing it, automating it, hiring great talent, right? So we bring all the best practices and a lot of knowledge. And the more we grow, the more customers adopt us, the more knowledge we gain, and we can bring it to all our other customers as well. So really, use AI to keep up with AI.
All right, and on that note, it's time for me to wrap up our conversation. But many thanks, Beru, for joining us on Startup Street. Wish you the very best for all your growth plans.
Thank you so much.
On the hot seat today, India's luxury fashion scene is getting a major boost. Culture Circle, a hype-in luxury fashion app, has raised strategic funding from OYO's Ritesh Agarwal at a valuation of over 100 crore rupees. The platform is already seeing 4x growth and boasts over 1 million monthly users. From authenticated Jordans to Louis Vuitton, it's building a cultural movement for Gen Z. And this funding is aimed at scaling the AI engine SourceX and taking Indian streetwear global. Let's find out what's driving this momentum. Joining me now to discuss this further is Devansh Jain Naval, the co-founder and CEO of Culture Circle. Devansh, thank you so much for taking time out and being here with us on Startup Street. For those who are new to Culture Circle, what sets you apart in India's luxury and hype fashion space? And how did the idea behind the platform come to life? Take us through what's on offer.
Sure. So firstly, thank you so much for having me. For those who are unaware, Culture Circle is India's #1 marketplace for all things hype and luxury. What I mean by that is everything from limited edition sneakers to handbags to perfumes to apparel, t-shirts, hoodies that you cannot get access to anywhere else in India. We make them accessible. So earlier what you'd have to do is wait for potentially a trip to say Europe, or wait for your friend to come from Europe and you'd get that stuff maybe once in 6 months. We have made that accessible to everyone, to the top 1%, to the cultured is how we like to call ourselves. What makes us really separate is in terms of the number of products we have, right? Typically, traditional sort of marketplace dealing in limited edition products would have, say, 1,000 different products. What we boast to have is the world's largest collection of authenticated limited edition products on one app. And what we also allow you to do is we guarantee you the lowest prices on the entire planet. How do we do that? We allow you to compare prices between all globally verified sellers right on one app. So that's why we make hype and luxury accessible, trustable, as well as at the guaranteed best prices.
So making high-end fashion and luxury items available to more people. But, Ritesh Agarwal has backed the company, and this backing comes sort of after your Shark Tank appearance, and you sort of turned down an 8 crore rupee offer, right? So what convinced you that this was the right strategic move? How will Ritesh's involvement sort of shape Culture Circle's next phase of growth?
Sure. So, I mean, what OYO really stands for and what Ritesh himself has built is really built a two-sided marketplace. And that's how we also operate. We have a global network of different sellers who we source these limited edition products from that we can't get anywhere else. And we deliver it to customers. What OYO has done is a very similar business strategy in terms of being able to aggregate and organize all of these different sort of guest houses and PGs that used to exist and get them onto one platform. And the way we do that on our seller side is we have built a lot of AI technology in terms of our supply chain platform, which is called SourceX. And that has enabled us to deliver on our promise, again, of collection, prices, and guaranteed authenticity. So that's why Ritesh's involvement comes in, because he's really done this in a different industry before, and now we're doing it for potentially even a much larger industry globally.
Culture Circle is already valued at over 400 crore rupees, right? And you're sort of seeing 4x business growth. Can you sort of break down the key revenue and user metrics driving the surge, and where do you hope to close this year? What are you already clocking?
Sure. So as of right now, we're already clocking, our sales are over 100 crores annualized. And this is for a company that's only 15 to 18 months old. We launched in Jan 2024. So that growth has been remarkable. And the only thing that has told us is that there's genuine product demand in the customers. What we're doing for India, for example, is now we're launching more and more categories, as well as more and more retail stores. So we already have a few retail locations across Delhi and Hyderabad, Bombay, Gurgaon, etc. coming up in the next 3 months. So we'll have 6 more retail locations. Apart from that, we're launching a bunch of new categories. So everything you can think of, from super luxury handbags to watches, to collectibles, accessories. So everything that you'd want to really, cherish yourself with or gift yourself is what we're really focusing on. Apart from that, very interestingly, I'm sitting in Berlin right now because we're also planning a very aggressive EU expansion as well as an expansion across Asia, because we've done a successful pilot in Singapore and UAE and Australia, and the initial results have been remarkable. And we've already had sort of copycat apps trying to replicate what we're doing prop up in EU, in America, and in all of these territories. So now it only makes strategic sense for us to go and launch in all of these territories. So that's where the next phase of growth is also coming from.
So, you preempted my next question. You're looking at global expansion, but you're also expanding within India itself, right? From Delhi and Hyderabad to Mumbai, Gurugram, and 2 other cities. How do you sort of see physical retail complementing the app experience?
Right. So for us, we keep it super simple. The physical retail is actually the first touch point and the trust point for the customer. Because when a customer is coming in on our app, they're typically spending, say, 20,000 to 50,000 to even a lakh per transaction, right? Because that's the kind of products that we're selling. And sometimes to build that trust, the person needs to really have a touch and feel of the brand, experience the brand. So we really look at our retail stores as experience centers and as trust building centers where people can come in, experience what Culture Circle is all about, what is the culture that we're trying to build in India and across the world. And that sort of plays into the larger global online strategy as well.
All right, Devansh, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much for having me again. It means a lot.
On that note, it is time for us to head into a short break. But coming up next, EV energy tech company Kazam has raised $6.2 million in a Series B funding round. We put the founder on the hot seat to find out more about their growth blueprint. Stay tuned.
Welcome back to Startup Street. EV energy tech company Kazam has raised $6.2 million in Series B funding from the International Finance Corporation and existing investors Vertex Ventures, C and India, and Avana Capital Advisors. The investment will fuel Kazam's expansion across markets with its energy transition tools to accelerate adoption of sustainable mobility. To elaborate on these plans, joining us now is Akshay Shekhar, the co-founder and CEO of Kazam. Also with me is my colleague Arundhati. Welcome to Startup Street. With $6.2 million raised in your Series B round, tell us what are Kazam's immediate priorities for deployment of this capital? Is it market expansion, R&D, partnerships, or something else?
Thanks for having me. First of all, I think it's always a pleasure to be here. So Kazam, in this particular round is to get EV inclusion within the country. Just for the viewers, maybe to understand what Kazam is the energy gateway, which kind of digitizes everything right from your energy meter all the way to your electric vehicle getting charged with the charging station right in between. So for this particular fundraise, it's more about getting into the real Bharat, which is the tier 2 and tier 3 markets, to ensure that the last person over there is also able to adopt to EV very well. And it is to fuel all of these last cities.
Sure. Hi, Akshay. Arundhati stepping in here quick. Kazam's revenue has grown 4x in a year, right? That's from $1.5 million to $6 million. And you're sort of targeting $12 million this year. So what's driving this growth? And how are you managing scalability with profitability?
Yeah, I think it's been a crazy year for us, and I think it's just getting crazier over here. But what we're also seeing is a lot of adoption in the EV market, especially in the three-wheeler markets. You're also seeing a lot of incumbents enter in this place. What we are also able to see in the market right now is the tier 2 and the tier 3 markets have clearly created an arbitrage because they never were included in the CNG market in the earlier places. So what they have done is they've actually moved right from the petrol era to EVs. Where electricity is already distributed, right, in all of these places. So we are focusing on this EV inclusion side. And, one of my biggest markets would be places like Siliguri, Kuch Bihar, Lucknow, all of these places. And we want to kind of double down right now and go even deeper into the market to kind of ensure that. Yes, so we have already contracted most of this. As of now, when we speak, we are already at a run rate of $9 to $10 million. There. So $12 million seems, in our kitty at this point of time.
All right. Kazam has also onboarded over 68,000 chargers, enabled 5 million plus charging sessions. And just last month, the platform powered 25 million electric kilometers across 10 countries. Akshay, how do you approach interoperability and regulation in these diverse EV markets?
I think this is a wonderful question. As we scale, right, any new technology, it first goes through this entire phase of being proprietary. But I think the government itself has realized, and we have been one of the pioneers to kind of contribute in writing a lot of BIS standards within the country. I think the first standard was around interoperability, which came for 2 and 3 wheelers, because that was our first focus area. And here we've also been able to push for the fast charging. So the standard is IS 17017, Part 25 and Part 31. This allows now players to adopt to two guns separately, and the industry is now kind of come together in choosing these 2 guns. So this will allow a lot of interoperability from a vehicle charging point of view. The second point is, you also need to kind of connect on the software side of things so that the data that is coming from these electric vehicles are also being able to decode and ensure that you're able to push further EVs into the market. And for that, there is a completely entire new stack called as the Unified Energy Interface that we're currently building, and we're kind of the founding members over there. This is more like the UPI movement, but for energy, because there were no digital goods within the energy ecosystem, and EV charging is the first energy digital good that is coming into the market. This will actually allow the utility companies to kind of understand how the consumption of electricity is happening, where it is happening, who is doing it, at what time, etc. And this will kind of open up the real interoperability in the energy world. So this is the first step to it.
We're running out of time. If you could quickly tell us, you're building this digital infrastructure for EVs. What's your broader vision? Could Kazam become the AWS or UPI equivalent for global energy mobility?
I think the first thing it will be is the UPI for the country, because we're building this entire UEI stack. So what we will do is we'll go one step behind your charge point from where you're getting electricity, and we'll actually be able to reduce the cost completely for you. So if your electricity cost today is 1,000 rupees, we would be significantly able to reduce this by 20-30% by allowing you to even do peer-to-peer energy trading. Our first transactions for this has already gone live, and one of the key R&D focus areas for us in this particular year is to do this. So I think that's what we are currently focused on.
All right, on that note, it's time for me to wrap up this conversation. Akshay, many thanks for joining us on Startup Street today, and wish you the very best for all your aggressive growth plans.
Thank you so much.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Welcome to Indianomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position, but again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, very in a very, very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it'll effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you two quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I mean, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast. But even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, I mean, this is not. You hear the argument that, I mean, it's best to cut the policy rate before start with another make another easing move before inflation starts moving upwards. I don't think that's a correct argument, because, I mean, obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward, the inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about, I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack two quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, very, I mean, the amount of money that's being raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Indianomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Shogata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12, 13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity? Every day, bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI. Would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12, 13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4, 5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12, 13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in 2 separate questions. One, this 12, 13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samiran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down, and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally, perhaps, at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know if tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah. So I think there's a little bit of concern that is there amongst investors as well. They're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So
That's
it's like, twin fears working together.
Exactly.
But in generally, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be? Where should my money be?
So we have been overweight gold for a while, for actually the last 2 years. Actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should be putting in their money. What else, just in terms of asset classes?
Yeah, so that's one. Gold, we still have some allocation. We're not fully taking out.
How much?
Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold. And on the debt side, we are saying that maybe it's time to book out money from duration and add to conservative debt like corporate bond funds and using income plus arbitrage as tax-efficient vehicles to take allocation to debt.
Okay, so that's the overall thought process with respect to where the money should be parked. That's the sanctum view. But now I want to get to the exciting part. Because the way Alok has done this is that he's going to encapsulate all the mistakes we end up making in a 5 ka punch. So the 5 to avoid. Take it away, Alok.
Yeah, so I think the first one, that we typically see in client portfolios is over concentration or over diversification. So generally investors who have been investing for a long period of time, HNI investors who have a larger portfolio, they tend to end up accumulating too many mutual funds. We've seen in client portfolios with 40, 50 mutual funds as well. And as we know, each of these mutual funds have about 50, 60 stocks. So you overall end up owning like 1,000 odd stocks, almost the entire market. That's too much of diversification.